over the next 4 years, Guy.
Okay, here we go. Let's talk about this market open. You have to bear in mind and think about what happened Friday when you think about what has happened at the beginning of this week. And we've been struggling to fill the gap in terms of the sell-off that we saw Friday. Maybe we'll get there today. The FTSE's out of the gate, up by a little bit. I'm not watching the FTSE today. I'm interested in what's happening in France. That's going to be the trade today. What happens with the likes of LVMH? Did you see the ADRs last night? They were up 8-9%. Really decent pop coming through there. Expected to be replicated here in Europe this morning. ASML's a heavyweight in terms of the cap weighting. Therefore, it's going to have a big impact on the upside this morning. The IBEX is up by 0.3%. I've been rather remiss of leaving maybe the AEX off this market this morning. But we wait for the CAC to see how long it's going to take that to stock that market to get open and what the single stocks are within it going to be moving. Maybe we'll see the banks moving. Maybe on the politics story. We're certainly going to be watching very carefully what happens in tech this morning. But it's LVMH, MC, looks like it's going to be the main driver of this market this morning. It's not going to open. It's not clearly in a hurry to get things going in France this morning. So let me hand things over to Lizzie to see if she can give us a little look under the hood.
Yeah, I believe LVMH is halted for now. So we're waiting for the luxury names to open. But when you look at the sectoral picture, in the absence of luxury, it's autos that are leading the gains. So up 1.5%, and serious gains for Stellantis, up more than 4%. We'd already seen the stock up in the States and really yielding to the tariff pain with this $13 billion investment into the US, as you say, Anna, and that seeming to boost the stock this morning. Another few of the other names that we're watching, ASML, of course, off the back of their earnings, but also factoring in the geopolitics. The stock up 3.2%, so significantly higher, actually, than we had anticipated from the TradeGate suggestion. And Bouygues as well, up 3.2% off the back of that M&A.
Yeah, technology jumping to the top of the gainers board, and so we are seeing some positivity there. It's interesting that we don't have an opening yet, not just for LVMH, but also for Kering, for Richemont, for Christian Dior, for Burberry, and all of these stocks taking a little time to open this morning as we rethink the Chinese consumer around luxury, which is kind of amazing given that what we got was an increase, what was it, 1%? An increase in group sales over at LVMH. So maybe we know curb our enthusiasm slightly, but it was unexpected that we got that increase after 2 quarters of retreat.
Absolutely. There are notes floating around saying, actually, yes, the comparables were easy, but actually this was better than the comparables were. That doesn't tell the whole story. This was actually better than that kind of picture that the comparables paint. But we don't still have an opening for them. There's 3 stocks unchanged on the CAC 40 right now, and they're ones we're going to watch out for. Actually, I think I've just seen a number on Kering, so it looks like that one is maybe starting. I've still got Kering flat, so nothing moving there. So I've got Hermes, no change. LVMH, no change. Kering, no change.
Well,
they're thinking about it.
Yeah, well, while we wait for them, let's get some analysis. Christian Muller-Glissman, Head of Asset Allocation Research at Goldman Sachs Research, joined us round the desk. Good morning to you.
Good morning.
How are you feeling? Do you just put the tariff noise on mute, see it all as a diplomatic dance, embrace the Fed cuts and power ahead?
Well, I think, it's getting more bumpy, and I think it's been a very uncomfortable Goldilocks backdrop since the summer. Like, the markets have taken relief from the Fed easing, but they're easing because of a weak labor market. At the same time, the corporate sector has been very good, but now we haven't had a lot of data. No, the labor market hasn't been there. So the earnings season, I think, will be critical because it's the first time we're getting more data, understanding how strong the corporate sector really is. So I think that will dominate. There's a lot of uncertainty on politics and geopolitics as always, and you kind of want to be careful about making too many shifts on your portfolio based on that. So we're still modestly pro-risk if you're asking how we're feeling, and we're going into this earnings season with a view that it kind of probably will validate that the corporate sector is still in relatively good shape. And we actually think in the US in particular, the expectations, which is roughly 6% for that season, they probably will be beat again.
So if it's all a bit bumpy, how big does a dip have to be to buy it?
Listen, it's always dependent on what the dip actually is, like what the drivers are. If you have a major trade escalation, of course, we need to be careful. We need to understand kind of what the ramifications are for the economy. I think rare earth is something that has a real disruptive potential. And as a result of that, if there is some type of complete gridlock on the negotiations, I think we would have to be a bit careful. But I would say that the current backdrop where you're somewhat late cycle, unemployment rates are very low, profit margins are very high, is quite conducive to buying the dip unless you really see a sign of a recession emerging. So what I'm watching is, if we get a dip, is the yield curve flattening? and are cyclicals versus defensives really sharply leading the market lower. So I think if these two signals are happening, that tells us that the market is losing faith into the stability narrative. And I think we haven't seen that yet.
Let me just update on what's going on with the luxury sector, because we don't have LVMH open, but we have some of the others in the luxury space open. Christian Dior up by 10%, Kering up by 6.8%, Hermes up by 5%. Let's get an update from you, Christian, on the luxury space. And one of the positives that the market perhaps is clinging to this morning from the LVMH numbers is that China was an area of positivity, doing better than expected. Does that tell us something important?
Well, the way I would think about it is like tariffs really since Liberation Day have weighed on a lot of places more than on other things. So I think like luxury goods is to some extent one of those places where the market was very worried about second round and first round effects of tariffs. And now you have potentially turned the corner. I think you have a strong result. It seems expectations have come down enough. That sector has really been performing terribly for some time now. So I think maybe that's kind of why you get the relief now. I think generally we have to admit the consumer globally is holding up relatively well, especially the high-end consumer. Like what I always give as a statistic, 50% of consumption in the US is done by the top 10 income households, top 10% income households, which tells you they're probably the buyers of luxury goods as well. So that cohort of investors have huge tailwinds from wealth, huge tailwinds from income still.
Yeah.
So as a result of that, maybe we've started to turn the corner a bit.
Yeah, so maybe there's this correlation between the AI trade and luxury sales when we're looking at things from the US perspective. So the CAC is now open strongly, as you'd expect. Still no opening price on LVMH. We talk about tariffs there, and we were talking with our colleague Mark Cudmore in the last part of the programme about whether we'll see more volatility heading towards this still, I think, anticipated meeting between Trump and Xi, although that's not entirely certain. Are you bracing for more volatility? Because even though we've had a lot of drama in the last months, we haven't had a huge amount of volatility. Things have gone up quite steadily.
Yeah, I think like this is the type of Goldilocks backdrop I described earlier. If you have like growth going up without inflation, that's the traditional Goldilocks. What we had since the summer is essentially the corporate sector holding up really well, and the Fed is shifting more towards easing, and it has a similar volatility dampening impact. But there's one other thing that's really important is we're just entering earnings seasons. And if you look at the implied correlation within the S&P 500 options market, it's at one of the lowest levels in history. So the market expects this a very dispersed earnings season, very micro-driven. So that means that you have two things fighting here. There's more macro risks emerging with tariffs, but you also have a lot of micro news flow. And that means that theoretically that should anchor volatility at least. That's how the market is priced. But if you expect the macro to start to take over, you could argue that index volatility is a bit cheap because the implied correlation is so low.
Let's talk about pest control.
Oh, well done.
Didn't say it.
He's avoiding the word.
Cockroaches in the credit markets. Jamie Dimon's worried about them. How late cycle is credit now, and what is the signal for equity?
Yeah, we are underweight credit, we're overweight equities. So we kind of feel the asymmetry in equities is much better because you have convexity that comes from innovation. Valuations haven't gone up that much since the summer. Like most of the returns in US equities have been driven by earnings. In credit, spreads have tightened further. So you were asking, are we late cycle? I think so. I think there's a lot of things that tell us that we're late cycle. Unemployment rates are low, profit margins are high, risk premia are compressed. Normally what happens late cycle is you get re-leveraging. This was a very accelerated business cycle. Coming out of COVID, you remember the economy recovered very fast. And because it recovered so fast, you generated inflation and you generated a lot of Fed tightening, which prevented re-leveraging because you pushed up rates so fast, despite the fact that you had the unemployment rate so low and you shifted late cycle very quickly, you didn't get the re-leveraging. There was never confidence. There was always fear about the recession. There was always fear about the cost of capital being too high. And now I think we found that equilibrium and we really see these re-leveraging tendencies. Biggest LBO in history. No, we have like obviously certain cracks emerging in the private credit space. We have the Oracle deal, which was financed in a heartbeat. So to me, I think we are now in a bit of a re-leveraging phase, and that means credit quality will deteriorate. And at the margin, you will probably see a few more unpleasant headlines coming out of the credit space. And since the beginning of the year, it's been the biggest inflow story. So it's been a lot of flows into credit.
How long does the last phase last for?
That's a great question. It can last a very long time. It can last a very long time because if you look at private sector balance sheets in aggregate, they're very healthy. So like if you normally look at like late cycle backdrops, you get breadth in the releveraging. Think about the global financial crisis.
Yep.
You're not seeing that. Like currently you have selective areas that are levering up and selective areas that are being called out partially because of tariffs, because these are business models that levered up too much and they might have had a hit from the tariffs. But I think you don't see the breadth of the releveraging. We could easily have 2 to 3 years of releveraging with more M&A, more corporate activity.
And equities just go up in that phase.
Sorry?
And equities just go up in that phase.
They usually do. I
Yep.
think late cycle investing is unpleasant. It's normally not Sharpe ratio, very
Yeah.
high. Like this is a very interesting thing. In the late 90s, equities
Yep.
squeezed up with very high volatility. That we haven't seen yet. I think the markets are still trading a very friendly Goldilocks-ish late cycle backdrop. But once things actually get a bit more heated in terms of releveraging, reflation, actually then it normally gets a bit more volatile, but equities can still make progress.
So we might be worried about private credit, and that's a very useful conversation in that context, Christian. Some might be worried about bubbles in AI trades as well. Is all the risk attached to that clear to see? Is it all out there in the open? If something bursts, how systemic could something like a bursting of an AI bubble be?
I mean, listen, we've written quite a bit on that recently, and there's a few things that are important to note. I mean, we just published this morning a big report which tracks everything that exists in the world. We call it the world portfolio, 270 trillion.
Wow.
And one of the most interesting stats came out of that. Currently, global equities are 50% of that portfolio. If you look in the late 90s, they were 65. If you look in the 60s, Nifty 50 bubble, you were at 60. So like from the size of equities as an asset class, it doesn't look that bubbly. And also, I would say the AI ecosystem, where a lot of people are finger pointing, is very different to what happened in the tech bubble. In the tech bubble, you had a lot of companies that were call options on a tech revolution. And let's assume the internet wouldn't have come about and it would have been a fake news. All of these companies, including Amazon, they would have been worth zero because there is no internet. So think about now what happens if AI would not turn out to be as successful. All these companies that are currently in the news and that are very large, they would still have a business. They would still have a business model. They're diversified innovation conglomerates that actually have strong balance sheets. And that means to us, it looks much less bubbly compared to, for example, the tech bubble. But we need to be vigilant. And I think one thing you mentioned is credit. I think this ecosystem is now accelerating. And there will be on the side financing. There will be on the side CapEx beneficiaries that are more capital heavy, that require more leverage. And we have to watch those to see if there's excess. But at the margin, we've been saying that we're pretty early if there is a bubble. And there's not as many signs compared to history that would make us concerned.
Great to see you. Always a pleasure. Thanks very much indeed for dropping by to see us. Christian Muller-Glissman, Head of Asset Allocation Research at Goldman Sachs. So we're still wandering around the shop trying to figure out what the price of an LVMH handbag actually is. It's still not open in Paris, and we're waiting for a price. Clearly, we are going to see a big gap this morning in that stock. We're already seeing some of the luxury names moving sharply to the upside. Let's talk more about what is happening with the market this morning and the absence of that LVMH trade that you can see on the screen. Chloe Melly, over to you.
Good morning, guys. So yeah, LVMH, it's just open right now, up 12.3%. Great time. So LVMH posted a surprise return to sales growth in the third quarter, which indicates that maybe this slowdown in luxury demand is easing, is maybe coming to an end, and that is driving the shares massively up this morning. We're up almost 12% for LVMH, and it's also driving up the rest of that luxury sector in Europe. We've got positive movements in Hermes, Kering, and Christian Dior as well this morning. Moving over to Stellantis, which is also up this morning after announcing a $13 billion investment in the US over the next 4 years to try and reduce the impact of those tariffs and refocus on that key US market. So this is an investment that was expected. We were expecting about $10 billion, but the confirmation of that is driving the shares up this morning. We are up 3% on the back of this. Moving over to ASML, and we also are in the green for ASML today, up 3% after orders for its chip-making machines beat expectations in the third quarter. That was driven by a really high demand for this AI infrastructure, and so ASML is continuing the rally that we've seen in the shares over the last month or so. Moving on to France, where Bouygues and Orange are also up this morning. There's news that a group led by Bouygues, Orange and Iliad, which is another private telecom company, is buying SFR for 17 billion euros from Altice France, which is owned by billionaire Patrick Drahi. This deal will mean that France will go from a telecom market with 4 operators to just 3 operators. And the news of this deal is driving the shares up this morning. Bouygues in particular, given that it is leading the group. So we are up 8% on the back of that. And finally, let's end on one negative movement this morning. We are down at almost 3% for Nexi, which is a payments provider. It was downgraded to a neutral rating by BNP Paribas, and therefore it is down this morning 3% for Nexi.
Okay, thanks very much, Chloe. Chloe Melly from our equities team. The French market really on fire today, up by 2.3%, the most since May. We'll have more on the markets next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi Zahran, and this is Bloomberg.
Welcome back to the opening trade. We're about 90 minutes into today's session, and as you can see, it is green across the screen for European stocks, but particular outperformance for the CAC 40 in Paris. Thank you to LVMH returning to growth, but also with Prime Minister Le Cornu reaching a deal with the Socialists. We'll get back to LVMH in just a moment, but plenty of other corporate stories out this morning. Just look at ASML. Those shares up more than 3% after their third quarter orders beat expectations as that AI arms race boosts demand. We can get more now with Dasha Afanasieva, who is Bloomberg's Amsterdam bureau chief, but joins us today in London. Good to see you. Do you think the results are that good? Like, would the share price be higher were it not for the tariff story?
The share price could very much be higher were it not for
of the tariff story because there is a bit of an overhang because of the geopolitical tensions. But I think besides the orders beat, you've also got a more positive outlook on next year than they had last quarter. So they'd said that they couldn't confirm growth for next quarter. Now they've sort of tweaked it to saying that sales are not going to be any lower. So we're looking at flat or higher sales, which a lot of analysts have said is good enough. They also pointed to a fourth quarter that is between 9.2 billion euros and 9.8, and analysts expected 9.2. But against all that positivity, there is the China story, and we are seeing escalating trade tensions between China and the US. This week, we've spoken about how the Dutch government seized a chip maker in the Netherlands, all because of these heightened tensions, and we don't know how that's going to play out for ASML, which already faces export controls in China.
Yes, and some pretty negative language about China, but that doesn't seem to be sticking overtly, at least, to the share price this morning. Dasha, thank you very much for joining us. Dasha Afansieva, Bloomberg's Amsterdam bureau chief. Let's pivot then from that large European corporate to LVMH, which certainly is also flying, even more so, up by more than 12%. LVMH has unexpectedly returned to growth in the third quarter. For more, we're joined now by Bloomberg's Angelina Rascouet in Paris. Angelina, what fueled the growth then at LVMH? We've been talking a lot about the product lines that are drinkable at LVMH.
Hi there, Anna. Yes, indeed. I mean, importantly, all the divisions beat, including the key fashion and leather goods one. Even though it still posted negative results, it was better than expected. And the CFO of LVMH explained that this was due to improve traffic and volume, so not a price effect. Importantly, the struggling wines and spirits division, which was in a downturn for the past 2.5 years, returned to growth, and that was helped by champagne restocking in the U.S., by solid rosé wine demand, even though cognac demand is still struggling. Selective retail also beat, helped by a strong performance of Sephora in the U.S. And geographically, Europe is the only region that worsened. That's due to lower spending by American tourists because of the weaker dollar. But otherwise, crucially, the region that includes China is back to growth. So in mainland, demand is positive again. Offshore, so if you think about Hong Kong or Macau, it's still down, but it's improving. So overall, that was pretty positive. The CFO also talked about the impact of the creative changes that we've seen in the past year. New designers are being appointed, and she said that the impact of those changes will be seen gradually in the first half of next year.
I feel like I'm out of my depth talking about the new designers. Lizzie's all over that one. Angelina, thank you very much indeed. Angelina Rascouet joining us out of Paris on LVMH. More comfortable on the car story, so let's go there next. Stellantis says it will invest $30 billion in the United States over the next 4 years. This as the, let's call it a global car maker, seeks to curb the impact of tariffs and turn its business around stateside. Joining us now, our global auto editor, Craig Trudell. This feels like a kind of role reversal. Europe's had the limelight from Stellantis over the last few years. Is it just as simple as it's now the US's turn, and that's probably because of tariffs and various other factors?
Yeah, I mean, you had two European, dynasties, the French and Italians, and the Alcons and the Peugeots, combining to form this company, and it was run by a Portuguese guy, largely from France, for years. There was a lot of neglect in the North American business under Carlos Tavares, and a lot of sort of festering issues that really came to a head late last year. So you've seen this company try to come back from that, and it's been really a slog. I think the amount of investment here is significant. The sort of specifics of it in terms of more Jeep production, more production in the U.S. You're seeing Illinois, Ohio, Michigan, and Detroit in particular, getting a lot of attention here. And interestingly, the sort of losing out that we can tell so far is Ontario, that Canada is going to feel some effects of this. There was plans to build a Jeep at one of their two big plants in Canada. That is now into question. So will Mexico lose out? Doesn't seem like it. it seems that the Canadian business is now the one that is sort of on the outside looking in.
If you're going to build in the US, are you building petrol engines or are you building EVs? Because if I listen to GM, I'm thinking it's the petrol engine.
Yeah, it's very little electric in this announcement. There is one extended range electric vehicle alluded to in Warren, Michigan that will be built, but there will be an EREV version alongside a internal combustion engine.
The GM story is enormous. It has industry ramifications in what they're signaling.
I think it will be the first of several announcements that we hear from GM about them taking charges, unwinding some of their EV investment. And then I think we're going to see more of it for some of these other OEMs where, Stellantis really kind of took it on the chin yesterday. And the best I could sort of surmise from that move was that some of the investment that was made under Tavares to try and play catch up with electric vehicles, which Stellantis desperately needed, doesn't need it anymore.
So that's one of the things we'll watch with the European corporates when they report then, Craig, about the push into EVs and where is that still intact and where is it faltering. I noticed that Jefferies has downgraded BMW today. What else are we watching as we head then into the crucial European autos reporting season?
Yeah, I think one interesting trend we've seen is some of the companies that have been the strongest executors. I would put BMW in that camp. Also Ferrari, that was sort of the high flyer that was staying above it all last week, really had a tough day when it was supposed to be a celebration of their new electric vehicle and sort of a look forward to the sort of midterm plans. I think some of the companies that have done best, even they are now succumbing to some of the pressures that we're seeing. And my read of that downgrade at BMW, it was more sort of a relative play of some companies that have had a hard time, maybe seeing some value in those names.
Craig, thank you very much. Thanks for the update on the auto sector. Our autos editor, Craig Trudell. Stick with Bloomberg. We will be speaking exclusively with the Ferrari CEO. That conversation on the close, 9:15 p.m. UK time. This is Bloomberg.
Said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive. Getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, And if you want to learn to listen for it, we'll show you how.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
This is the opening trade. We're 30 minutes into today's session, and as you can see, the picture looks like this. We're broadly higher across the European continent 30 minutes into the open. Particular outperformance, though, out of Paris. We're up 2.5% almost. Thank you to Prime Minister Le Cornu getting that deal with the Socialists in the National Assembly, but particularly thank you to LVMH with that return to growth, that unexpected return to growth, powering the CAC 40 higher this morning. Guy, you've got more of the winners and losers.
Oh, yeah, we are definitely on the front foot this morning. As you can see, 464 up, 125 down. Volume is good. I'm thinking a lot of that volume is going through France this morning and the French market. Let's talk about the winners and losers. 52-week highs, 52-week lows. Get this, Kering is trading at a 52-week high today. This stock has made something of a comeback over the last few months. Part of that down to the kind of the creativity coming out of the company, the reorganization, the new CEO, all coming in and playing their parts. And the market is rewarding it, probably on the heels of LVMH today. But Kering at a 52-week high. We're up by nearly 40% on a one-year basis. Sort of in the same space, but at the other end of the spectrum, maybe you could argue, is Pandora. Certainly when it comes to the market picture, it is at the other end of the spectrum. This stock is down by 23, nearly 24%, and is trading this morning at a 52-week low, Anna.
Yes, so European stocks getting a boost from the earnings stories and from what we've heard from the Federal Reserve. So let's go to some of our other stories to highlight just that. Fed Chair Jerome Powell has signaled the U.S. central bank may stop shrinking its balance sheet in the coming months. Speaking at an event in Philadelphia last night, Powell also indicated American labor market prospects are continuing to worsen. U.S. Treasury yields fell to the lowest levels in weeks on his comments, with bets on 2 Fed rate cuts by the end of the year remaining intact. Apple's Tim Cook is promising to boost investment in China. This despite the tech giant facing significant pressure from the Trump administration to shift production back home. Apple still makes the bulk of its handsets in China, and the country remains a key market for the business. That said, Bloomberg is reporting that the firm is planning to make its new smart home devices in Vietnam. Sticking with trade, President Trump is ramping up pressure on China, threatening new levies targeting cooking oil and calling Beijing's refusal to buy U.S. soybeans, quote, an economically hostile act. Research by Bloomberg shows exports of used cooking oil to the United States were in retreat before the latest flashpoint in the trade war. So plenty of thinking about the twists and turns of the trade narrative and the whiplash that is created in markets by these trade headlines, Guy.
Let's get into the kind of the pointy end of that story and figure out exactly how you manage a trade war if you are in the logistics business. In order to do this, we turn to Jennifer Sabasaja, who's in Johannesburg with the perfect guest. Jen.
Yeah, guys, somebody who knows probably all too well some of the whiplashes of the trade tensions, as Anna was just mentioning there, is John Pearson, who is joining me in studio. He is the DHL Express Global CEO, joining us here in Johannesburg. John, great to have you on set. Thanks so much for being here. So, you know, over the past few days, as Anna was just mentioning there, we have seen ratcheted up tensions between the U.S. and China. From where you sit, what has this back and forth and some of this tension of 2025 done for the business?
Yeah, well, U.S.-China trade is lower than it's ever been. It's at a level of now, I think 9% of U.S. imports come from China, and there's some element of decoupling there. But that's sort of not old news and to be a little bit expected. I think what we've got to focus on is how trade is performing outside of those lanes. China growth to Sub-Saharan Africa is at 26%. China growth to Asia is at pretty much an all-time high. So I often use this analogy that, you know, water will find a way. And whilst arguably one country is retreating from trade, 219 other countries are embracing it and trying to find deals and sending things to countries and companies that they haven't sent before. But it's undeniable And I think it's expected as a result of the tariff situation and de minimis that the China-US trade is, dropped this year.
What's the best case scenario here, especially if you think about logistics and shipping, which is the backbone, which is your company, right? Sure. What is the best case scenario come November 1st if we do in fact see talks happening?
Well, the best case scenario is that everything settles. There's one or two big trade deals left to do, notably India and notably China on November the 1st. And if there's good news comes out of that meeting on November the 1st, that it settles back at a more acceptable level than these stratospheric levels they are now, I think we go into New Year with every country knowing what their tariff rate is and formulating, we should never underestimate the creativity of buyers and sellers who want to do business, make deals, sell things, export things. They will find other markets. So I think the best situation is that the two big deals get done at a level that both find some sort of acceptability in, and we go into New Year not talking about tariffs or de minimis very much.
Are you preparing, though, for a situation in which that might not happen? What does that mean for your business?
We're a global company in 219 countries. We're prepared literally for everything. We've been through COVID, which was the biggest thing for 102 years, and now we get into this tariff situation. Our job has been to spend time with our customers and answer their questions.
Right. Let's talk about some of the new investments, though, the company is making, which is part of why you're here. 300 million euro that you're investing into sub-Saharan Africa. Is this a result of some of the friction that we're seeing elsewhere? Why is this happening, and what is this money going towards?
I think it may be the result of the friction. What it's the result of is that when we open a new facility, a warehouse, a distribution center, a head office, is because we're growing. And if we're growing, it says quality is high, but the Africa Free Trade Agreement is probably working because intra-regional trade is Africa is at an all-time high.
And it's not even fully implemented.
And it's not even fully implemented, and I urge policymakers to finish those last bits off. But as I said earlier, the import growth from China to sub-Saharan Africa is 26%. That's machinery, that's construction equipment, that's things that are going to be used to make things, which tells me that the African economy is relatively strong and strengthening. In fact, the scorecard for sub-Saharan Africa is very good. Of the growth, of the trade growth in the first 6 months of this year, sub-Saharan Africa topped it. And the other fascinating thing, which I don't think many people recognize, was that the trade growth in the first 6 months of this year was the fastest globally in the last 15 years, apart from one pre-pandemic spike. And that was because China was pumping goods into all areas of the world other than the US, and there was a lot of forward ordering ahead of the tariffs coming in. And you amalgamate those two facts, and that is what drove that statistic I just mentioned to you, which was a surprise to many and a positive surprise to many.
Surprise to you as well?
Surprise to me as well, yeah.
Let's the 300 million euro. What is that going towards? More warehouses, fleets? What is this?
Exactly. In our business, it's more planes, it's more warehouses, more distribution centers. It's a fantastic head office in Midrand here in South Africa, and I think you group those investments under people, quality, and growth. What we give to our people is the best possible facilities. What we drive for our growth is the best possible life science healthcare facilities, cold chain facilities, e-commerce setups. So the industries that are thriving on the continent in Africa: life science, healthcare, energy, renewables, e-commerce, and agriculture.
Does that number, 300 million, potentially increase over time if, in fact, this is the growth engine in many ways?
We put our money where the growth is. So the reason we're putting 300 million in now is because there is so much growth that we know is coming our way. We're looking round the corner, if you will, as to how these things may end up.
What are the tailwinds that potentially fuel some of that growth?
Well, the tailwinds are that there are a number of countries, which South Africa is one, those countries that are anticipated to grow faster than any other countries on the planet. And that may be because of FDI inward investment. It may be because of a strong domestic economy. It may be because the China Plus One is putting Chinese organizations into South Africa. In fact, we've now got 40 Chinese salespeople dotted around the world, ready, and I like to say it this way, ready to greet Chinese executives off the plane and say, how can we help you with your new plans in South Africa or your new plans hands in Egypt or Thailand or Colombia or wherever it may be.
How would you assess the state of global trade then? Because it seems like maybe there's one country that is being left off while the rest emerge.
Global trade is resilient and robust and reliable.
No concern.
Well, every time we produce the Global Trade Atlas or the Global Connectedness Report or the Global Connectedness Tracker, it confirms that trade, global trade and globalization is on a very strong trajectory. And that's taken from 20 million data points. You know, sometimes it's said to me that you're too optimistic. I just take the data points and I see what it's saying. You know, one example of that is trade still travels over 5,000 kilometers on average. That's more than it did 10 years ago. So if trade globalization was giving way to regionalization, the number would mathematically come down. And it's not. It's still over 5,000 kilometers.
So optimism here.
Yeah.
All right, we have to leave it there with you. John Pearson, it's been a pleasure having you in studio.
Thank you, Jennifer,
John Pearson,
and thank you to your viewers.
the DHL Express Global CEO, joining us here in the studio. Guys?
All right, Jennifer Zabasajja, thank you so much for that interview. Both Jen and the DHL CEO were both in Johannesburg. And as we talk about those US-China trade tensions, at which is at the absolute coalface of, we're looking at gold hitting a fresh record, not just because of that, but also because of these Fed rate cut signals as well. It's cleared $4,200 a troy ounce, now up 1.5%. We're going to talk about commodities next. We're going to be speaking to Trafigura's chief economist, Saad Rahim, joining us to discuss that, the debasement trade, and broad investing in commodities. That's next. This is Bloomberg.
Break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
44 minutes past the hour, Wednesday morning. That's what's happening with equities. And equities are exciting this morning. France is fascinating. What is going on with LVMH is worth watching. Take a look at what is happening with gold and silver this morning, and life gets even more interesting. You've got gold clearing 4,200 this morning. We're at 4,205 this morning. We're up by another 60. Silver is ratcheting higher again. We're up by another 2.4% there. These are big gains. The debasement trade is absolutely on again this morning. You've got a dollar story which folds in what's happening with the Fed as well. All of this, I suspect, is top of mind when we think about what is going on in terms of the conversations around London Metals Week, LME Week, which is on at the moment, which means we get some great guests passing through here at Bloomberg. Saad Rahim is the chief economist at Trafigura, is one of those fantastic guests that joins us around the table. Good morning.
Good morning.
Great to see you.
Thank you.
What does the debasement trade mean to you, and is this the way to play it?
Well, I think the word debasement is a big word, right? It covers a lot of ground, so I think it's very clear. We need to be clear, I think, on what it really means, because as you say, at the start of the year, this was really about a dollar debasement trade, right? And people saying, okay, you know, if you even think back to the Mar-a-Lago Accord and what was happening around that, seems like a long time ago. And, you know, and where people were expecting the dollar to go and then looking for store value somewhere else. Now, it's come to mean much more around concerns around long-term government debt, in particular in developed economies globally, right? So it's not just a U.S. thing, it is also Europe, the U.K., it is Japan. And so people have been saying that's the new debasement trade, and we're worried about that longer term. But what's been interesting is actually, despite a lot of those headlines and the chat around the debasement, you know, it is really gold and silver. Silver is the best performing major asset class out there, up 80% this year. And gold not far behind, you know, absolutely outpacing the S&P, outpacing MSCI World. But if it's really that as well, people are also looking at crypto, and crypto hasn't moved as much, right? It's up but only about 20%, so not quite the same trade. But you look at then U.S. yields in particular now are down, right? So if it's really a debasement trade and people are worried about government debt, then why is the 10-year trading just at 4%?
So why is gold where it is, and is it going to keep going at the kind of pace that it is right now?
I mean, I think it's been a trade where, you know, in particular, a lot of it is being driven by physical buying, and in particular, if you look at central banks who are going out and buying, you know, huge quantities of this. So I think last year it was China's central bank, so China, India, Russia, Brazil.
And they're price insensitive, you think?
And they seem to be buying. I mean, they paused a little bit when prices rose last year, but obviously even at these levels, they're continuing to buy. But these central banks bought 30% of the mined gold output, or at least equivalent, last year. So they're obviously looking at this as a longer-term trade that they're going to, you know, trying to enter into. Now, what we are seeing in other commodities as well is there appears to be some strategic buying of physical commodities, right? So if we look at oil, for example, one of the key stories in oil markets this year has really been China's buying of crude oil to put into strategic storage. Are they perhaps worried about a dollar debasement, you know, as has been talked about by the administration, where they're looking at it saying, look, you know, we hold a lot of dollars. If these dollars may be worth a lot less, and at the same time, commodities priced in dollars then may be higher, well, why don't we convert these dollars into something that we know we're going to need later? So you look at crude oil, you look at iron ore, perhaps to a degree what's happening now, they're building copper stocks, you know, counter-seasonally in China. So maybe a lot of these things are related as well.
This always has the potential to turn into a conversation about FX then, Saad, given all that you've outlined there, which I don't want to do. I want to keep our focus on metals, but it is worth exploring the role that China is playing right now. And it's interesting. Is China then nervous about seizure of dollars if there were to be any kind of conflict, loosely defined? Is that what is, can you see a line between what the PBOC is doing and the gold price? Is it that obvious?
I think it's part of it. I don't think they're the only ones who are buying gold. I think a lot of investors are moving into gold. Again, you're looking at it saying if there are concerns about rate cuts coming, you know, but again, potentially pushing the back end of the curve then up due to those longer-term debt concerns, then people are looking to gold as a store of value and as safety. And also, I think that's maybe a little bit the drive to safe havens, which is driving the yields to come down again in the U.S. a little bit. But I do think that central banks, and they have been, I think, quite open about it, this concern that after, you know, the invasion of Ukraine, Russia's, dollar assets were seized and held. And so this is a concern, I think, for some of these banks that potentially in any kind of conflict doesn't have to be kinetic. It may be something else, maybe even in a trade war type scenario, where if, we've seen this week this kind of escalation around rare earths and trade, maybe that's a scenario they're worried about.
Yes, and I wonder if other central banks are also worried about it, because we were listening to the French central bank governor saying that we mustn't break international law on Russian assets. It seems as if that's sort of in their mind, and I wonder if that's linked to the discussion we're having. So China in focus because of the gold they're buying, but also in focus because they're trying to push some of the trade in the commodities that you follow into yuan. How successful are they being at doing that?
I think it's increasingly becoming a feature of these markets. It's always been there for, or at least for the last couple of decades, where they have done some trades, they've tried to denominate it in RMB. But what we've seen reportedly now is they're asking for BHP to start trading some of the iron ore, pricing that in RMB. And we're starting to see it again in other trades that they are starting to do. So clearly there is a shift towards that, which I think makes sense. They are the second largest economy in the world. Obviously, it's not a free-floating currency, so there is a question around that. But it does seem from their side that they do want to push some of that trade there. But what's interesting is even farther afield is if you look at Russia and India, some of the trades that they are doing on the oil side are also being denominated now in RMB. So it is not just China, but other banks, other countries that are also starting to do some of this as well.
We're just showing copper there on the screen next to you, Saad. It's within a whisker of a record now. Kenny Ives at Metals Week talking about it touching 12k a tonne. Does it worry you, though, that it's been more supported by supply factors than demand factors?
I think that's always a concern. As our head of metals research, Graham Train, always says, that's sort of the least bullish way to be bullish is if it's on supply, because those are issues that can be addressed in time, right? So really, if you're going to be bullish longer term, demand really has to be a big part of it. So there is a question around how much of the price is also being driven by other factors, including FX. So you talk to some of the banks, SocGen, for example, thinks something like 30% of the price is really due to what's happening on the dollar. And that may be true if you look at what's happening with inventories around the world, right? You look at what's happening in the US, but even now, like I said, with China building as well. So there is a little bit of a disconnect between the micro and the macro. We've seen that in metals markets in the past.
And you mentioned tariffs. What about Friday? Did it change your thinking at all, your strategy at all, when Trump declared his tariff threat 100% on China?
I think it just reminded everybody that, your strategy is safe until the next tweet, right? But I think it's become a feature of these markets now where we, have to expect the unexpected in a sense. But I think it is something where people, again, I think have gotten a little complacent with the risk that's still out there. And I keep saying, everyone's sort of saying, okay, well, 2025, what do the tariffs look like by the end of it? But there may be more to come next year, right? If some of these goals are not achieved, if the trade deficit does not close, for example, could we see further measures next year? Right? And I think that's the issue, that it is still very much a movable feast. And I think the market, has gotten, again, a little bit complacent with that, really focused on the AI story, what's happening there to, the detriment of everything else.
Okay, so let's talk about the AI story. There's a headline coming through from the ASML, I think it's the CFO, saying the company's got all the materials it needs for the coming months. The hint there maybe being that it doesn't have the material beyond that because of potentially the tension between Europe, the United States, and China. Does that have the potential to blow up the AI bubble? How nervous are you about what is happening in AI at the moment?
No, I think that's a really good point, as in these materials. I mean, this is part of the whole rare earths discussion and what's happening there, right? I mean, it's really China, U.S., to a degree Europe, but really China and the U.S. in an AI arms race as well, as much as anything else, right? We saw that with the DeepSeek moment earlier in the year, which, again, people seem to kind of move past. But I do think that if you look at how much of the investment that is going into AI, how much that is driving U.S. economic growth, which is what the rest of the world has really been reliant on for the last 4 years, in a sense. If that were to slow down, and by the way, we are already seeing a slowdown in year-on-year growth in data center manufacturing. So despite all the numbers being thrown around, it's saying, well, okay, if that's starting to happen already, where does this go? And to me, the fact that you have a company, OpenAI, who's losing about $10 billion a year, going up to, they're going to go through $115 billion of cash burn in the next 3 years, saying, on the other hand, we're going to spend $10 trillion equivalent on new power plants, building 250 gigawatts by 2033. These numbers, in a sense, don't really add up.
If they don't add up, where do I look to them not to add? Which asset classes are most vulnerable to the maths not working?
Well, most vulnerable, I think, would be equities, I think, clearly.
Sure.
But I think that's
in your world.
In our world, I think that, you would look at copper. I think there's been, a lot of demand that people are pricing in coming from there. Our CEO made the point yesterday, really, that, a lot of the core demand remains in sort of the more normal, exactly, air conditioners, refrigerators, whatever else. AI story is the future, but it's not yet the present, I think. And so you really need to see, okay, is that investment really going to materialize? But if it does come off, I think that's a real risk around some of these prices that are quite elevated. But that's why I think also where we come back to where we started, which is what gold and silver prices maybe are telling you.
All right, Saad, thanks for stopping by during Metals Week. Always good to have you round the desk. Saad Rahim, Trafigura's chief economist. We appreciate it. Well, coming up on the daybook today, we've got plenty more Wall Street bank earnings to bring you. Then at 2:45 p.m. London time, a load of central bank speak. We've got the ECB's Ren, Villeroy, and the Bank of England's Breeden all speaking at the IIF meeting in DC. Then at 7 p.m. London time, we have the Fed releasing the Beige Book, and of course the US government shutdown rumbles on in the background. But it's payday for the military. They found a loophole to make that happen.
Yes, and with all of those in mind, let's get the final thoughts from Bloomberg's Valerie Teitel. Because, Valerie, I was wondering what's going to be most important in getting a steer without the regular data on the US economy today. We've got banks talking, we've got the Beige Book, we've got this pay packet for the military, but not others. That could take a political turn. What's your focus?
Look, I think the Beige Book will be important in the absence of data. Powell even mentioned it yesterday in the Q&A after his speech, but also the Wall Street earnings are going to be important. Yesterday, none of the banks reporting yesterday declared any big exposure to First Brands or Tricolor. We did have some warnings from Jamie Dimon on the fact that if you find one cockroach, maybe there are a few out there, others lurking. Now, perhaps from Morgan Stanley or Bank of America, they do unveil some more exposure to these bankruptcies. So I think that'll be a key to watch. Also watch loan loss provisions. That's the banks trying to shore up their balance sheet just in case further delinquencies rise. So I think those are the two key things for markets that are generally risk positive this morning.
Can I bring in Andrew Bailey? Talk a little bit about what he had to say yesterday. Interesting on the labour market, but also interesting on kind of the risks he sees out there.
Yeah, he again warned about AI valuations. He's been quite vocal in doing so, and that was something Powell was asked about yesterday but didn't entertain. He said he doesn't want to speak about specific assets and their valuations. He didn't really mention or want to get weighted into that debate.
If he wasn't worried, he'd have just gone, no, I'm not worried about that, presumably. The fact that he didn't say anything, I thought about it. I was trying to think about that. He didn't want to be drawn on it, which kind of I think you can read some things into.
But it's very interesting. I think you guys were just speaking about commodities there, the rare earth trade. Could these export controls that China has just announced in some way dent the AI trade moving forward and put at risk some of those valuations? Those are the two, I guess, key things that we're looking at today.
Valerie, thank you. Bloomberg's Valerie Teitel. On a programming note, the Canadian Prime Minister Mark Carney is the first guest on the Michelle Hussein Show, a new Bloomberg podcast. It launches on Friday. We will be beating the drum toward that on Friday and bring you some highlights, perhaps, ahead of its release. French markets really on a tear this morning, up by 2.4% on the CAC 40. The Pulse is next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We are risk on.
I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The Fed Chair, Jay Powell, signals another rate cut is coming later this month as investors weigh renewed trade tensions between the U.S. and China. Well, the French Prime Minister, Sébastien Lecornu, boosts his chances of surviving this week's no-confidence votes after dropping plans to raise the pension age. And luxury stocks soar after LVMH reports a surprise return to growth, suggesting a persistent slump in demand is actually easing. Now, there is quite a lot going on today. I know we also look at sterling because of comments from the Bank of England governor, who's currently in Washington from the IMF World Bank meetings. I always look at gold because it's still on a record. I had a great conversation just last week with Ken Griffin of Citadel talking about the relationship also between gold and treasuries. Currently gold 4,207. Of course, a lot of it will play out in U.S. equities, following European equities, also given what we're seeing with AI. And of course, the main theme is Trump threatening retaliation for China's soy boycott. That's also playing out into some of the European markets. So let's go straight to the map. We're starting earnings season. So we have the U.S. banks. We are also getting luxury that's supporting, for example, the CAC 40 gain from 2.5% with LVMH. A bit of a surprise there, actually beating expectations. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the AI arms race has boosted demand at ASML. The Dutch firm topped order expectations for its semiconductor equipment in the third quarter. Now, we break down the numbers with Bloomberg's Tom McKenzie in just a moment. But first, trade war fears front and center of the agenda once again after the U.S. president said the White House might target cooking oil with China, the latest escalation between the world's 2 largest economies. So let's bring in Jason Rogers, our senior editor for energy and commodities in China. Jason, so how much of an escalation is this?
Well, to be honest, you could argue that this may be a bit of a misfire from Donald Trump. I mean, if you look at the situation that he's addressing, he's clearly very angry that, China is no longer buying large quantities of U.S. soybeans. Now, last year, that trade was worth perhaps $12 or $13 billion. The cooking oil trade that he's targeting, by contrast, last year, that was about $1 billion. So it's kind of asymmetric in terms of, his remedy for soybeans by actually targeting cooking oil.
So, Jason, what will be the response from China? Is it just going to escalate and escalate, or will anyone try to ratchet it down?
It's unclear precisely what raises hackles in Beijing. But the fact is that, targeting cooking oil, given the fact that actually over 2025, we've had a situation where cooking oil exports from China to the US have been in retreat in any case. Beijing is going to look at this and figure this really isn't any kind of, massive problem for the economy. It's probably a bit of a problem for certain commodity traders. They're going to have to, rejigger their supply lines and that kind of thing. But I don't think this is something that is going to overly worry the powers that be in Beijing.
Jason, thank you so much. Now, ASML has also reported orders that beat analyst expectations in the third quarter as AI continues to fuel demand for its chip-making machines. Now, we're joined by our very own Tom McKenzie. Tom, thank you for joining us. So when you look at the results, they were pretty good, but what really stands out?
Yeah, so the top line coming through for the third quarter, a pretty decent beat in terms of sales, 5.4 billion above estimates. Really interestingly, in terms of the extreme ultraviolet lithography machines, of which ASML is the only maker, that was also a really strong beat as well, 3.6 billion, well above the forecast of 2.2 billion. They also said that for 2026, sales should be about level with 2025. So there's a little bit more detail, even if they didn't give us the numbers for 2026. And clearly the AI momentum is serving ASML quite well. Christophe Fouquet, the CEO of the company, is saying that there is positive momentum around AI investments and it's extending to more customers. So if you think of the foundries like TSMC and Samsung, they need these machines to actually produce the chips that NVIDIA and others, AMD, are designing, and that is starting to benefit TSMC. Longer term, they stick to their targets, 2030, of trying to go for revenues of $60 billion US. That would be up from about 28 billion last year.
When it comes to China, a little bit of a different story because they're expecting actually 2026 not to be great in terms of demand from China.
Yeah, so China's really, really interesting to your point. So in fact, they saw net sales in the third quarter to China increasing at 42%, or making up 42% of all sales. So that was actually their biggest market in the third quarter. But to your point, Christophe Fouquet, the CEO, is saying that he expects that to decline pretty significantly into 2026. They have seen a pickup of customers there, particularly in the logic space as well, but at a time, of course, of increased scrutiny, particularly from the US. On rare earths as well, the CFO has just been talking in the last few minutes saying they have enough rare earth minerals and materials to tie them over because they are dependent on those for the next few months. So that's another factor that they're going to be scrutinized on as well. And they've seen more customers in China. They've got the rare earths to kind of tie them over. But at a time, of course, when trade frictions clearly between the US and China remain a prominent question for ASML, they're not able to ship their most sophisticated machines into the Chinese markets, but the lower grade ones they can still sell in to China for now, at least.
Tom, thank you so much. Tom McKenzie there with the very latest on ASML. So we have earnings. We, of course, have the Fed, and then we have this trade concerns between the US and China. Stocks climbing as optimism over a Fed interest rate cut is lifting sentiment. Now, Fed Chair Jay Powell signaling that another rate cut is on the cards later this month.
The labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So, those two states of affairs for our two goal variables, call for different monetary policy responses. So, as they come more into balance, I think the idea has been that policy should move from being, tight to some degree to being more neutral as those two things balance out.
Well, joining us now to put all of the dots together, Ursula Marchioni, EMEA Head of Investment and Portfolio Solutions at BlackRock. Ursula, as always, thank you so much for being here. I mean, there's always this U.S. trade tension that kind of flares up and then goes back down. You have, of course, a lot of questions on what central banks will do, and then we're in the middle of earnings season. What do you think drives investment in autumn?
Great question. Thanks for having me. So I think there's three main areas that I would look at. One is how to manage beta within portfolios. You referenced trade tensions. I think the volatility that we're seeing, the questions that we observe, continue to point to greater adoption of liquid alternative strategies, hedge fund strategies that can help continue to be exposed to growth, but in a manner that actually deliver some downside protection. A second element, Francine, that I believe will continue into year-end is the logic of regional and sectorial diversification. We've seen a lot happening this year at the back of the repatriation trade, European investors going back into European equities, Asian clients buying back Asian stocks. This has cooled down throughout the summer, but is set to continue to be a component and a lever for clients to diversify portfolios. And then the third element, I think, in terms of, we just saw Chair Powell, government shutdown. down, and the absence of data, we see now CPI being postponed to the 24th, points to the fact that big data can be a great friend in an environment where official statistics are on pause to understand what's happening. And so systematic strategies that look at, for example, satellite imagery or reading of consumptions in terms of credit cards can give some insights in terms of the real state of the economy and help investors continue to generate alpha in portfolios.
Ursula, I mean, it feels like the tide shifted in terms of the market's focus, for example, on tariffs full stop or on inflation full stop. And I don't know whether, I think that, I mean, someone spoke to the IMF head who was saying, you know, trade is a little bit like water. If there's an obstacle, it still finds its way to where it needs to be. Or whether there's a belief in the markets that the Trump administration is pretty much at the end of what it's been trying to do on tariffs.
I like the water analogy. I think a big lesson for me this year has been that disentangling big economies is a very difficult thing to do in terms of if we think about rare earths need in the US, if we think about chip needs in China, those aren't things that you can solve overnight. And so again, while obviously going towards end of the month and South Korea, there'll be messaging and noise that will continue. I believe that a central scenario where in the end some form of compromise is found is in everybody's interest. And so again, it points towards opportunities towards year end, but I go back to my point around selectivity. Yeah. For instance, my team looked at equity return variance recently. 70% year to date is explained by factor and sectors. We haven't seen something of that level for some time. And so again, going into year end, thinking about not only regions, but also sectors within those regions will be very important.
So I imagine some sectors are priced to perfection. And it also, I don't know whether it's a quirk of the market because there's so much money chasing the same story. We also saw this broken correlation between stocks and bonds, which you write so eloquently about. I don't know whether we ever go back to the world that was.
It's a great question. I think it's difficult to see that great moderation, perfect setup that supported the 60-40 performance for so long. But again, this idea of diversifying diversifiers has a lot of room to go. Private markets, speaking about gold, which again is at record high, but has a role in portfolio that hasn't been fully played out by investors, I think are elements that we need to think about. And then sectorially, thinking about Europe, banks, defense, industrial, great areas for different reasons, but all worth being looked at. And in the US, healthcare, financials, and AI, which beyond the news and the questions, continues to deliver from an earnings perspective.
I mean, this is a big question, right? Because AI, a lot of portfolio managers have a difficult relationship with it because you can't stay away from it. But at the same time, valuations do look very, if not expenses, priced to perfection. And yet we get surprised. How do you deal with AI?
Yes, so we continue to like the AI megaforce and see a positive way forward. If you think about questions in terms of parallels to 99, the leverage in the system isn't at that level. A lot of the capex is financed from free cash flow. The earnings continue to deliver. Alex Brazier, our global head, recently mentioned that what we observe in market is a mirror of what is happening in the economy. It's not a bubble, it's a mirror. And that concentration that we see in the growth of the US is real and is structural. And so again, with cautious and with continued attention, we believe there's opportunities to capture it in portfolios.
Ursula, what's your take on defense? So again, defense seems one of the major structural shifts actually for Europe. There's a question on whether there will at some point be some M&A in the sector, or whether, even if without M&A, it'll just grow and grow in Europe.
Yeah, I think it's an interesting question in the sense that there's clearly a structural shift that has been set in motion and will continue to play out. At the same time, defense and industrial do also allow investors to be more domestically focused, which at a time where US dollar weakness is set to continue is also a very attractive feature.
I mean, do you always look at it relative value with the US? And so, we talk a lot about also European competitiveness and whether that actually goes into European earnings compared to US ones, and maybe in the next couple of quarters.
Yeah, that's a great question. And if we look at just the Q2 seasons, we looked at the US, low double-digit EPS growth versus Europe at 0.5%. So there is a clear gulf between the two. And yet, going back to what we are observing this week so spectacularly, the element of diversification continues to be important. And so again, yes, it is about the absolute prospects, but it's also about how do you build a portfolio that can weather shocks and volatility that this week in particular we see, and the end of last week as well, we see continuing to play out.
Ursula, thank you so much for joining us. Ursula Marchioni there, EMEA Head of Investment and Portfolio Solutions at BlackRock. Now, coming up, a political lifespan or lifeline for France's Prime Minister, Sébastien Lecornu. But will it hold? Well, we'll discuss all of this with Charlotte de Montpellier, Senior Economist at ING. That's next, and this is Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
The popular support in public opinion polls for the euro is at the highest level ever reached. 79% for French citizens, 83% for Europeans. So it's not a debate about Europe and the euro. It's a debate about how to reduce the fiscal deficit.
Well, this is the Banque de France Governor, François Villeroy de Galhau, telling Bloomberg that the country must make major spending cuts to help bring down a budget shortfall that's fueling the political turmoil. Now, political tensions ease in France after the Prime Minister, Sébastien Lecornu, won the crucial backing of the Socialist Party in the National Assembly. It comes after he promised to suspend President Macron's unpopular pension reform.
C'est pourquoi je proposerai au Parlement dès cette...
This fall, I will propose to Parliament to suspend the 2023 pension reform until the presidential election. No increase in the retirement age will take place from now until January 2028, as specifically requested by the CFDT union. In addition, the duration of work taken into account will also be suspended and remain at 170 quarters until January 2028.
Let's bring in our very own Caroline Conan in Paris. Caroline, lifeline for Sébastien Lecornu and his government.
Yes, you could see on these pictures the former socialist president François Hollande clapping at the announcement that Lecornu is suspending the 2023 pension reform. You could see the first secretary of the Socialist Party, Olivier Faure, smiling. It's a big victory for the socialists. They are offering a lifeline to Sébastien Lecornu by saying they will not try and topple him during these two motions of no confidence that will be examined in Parliament tomorrow morning, proposed by the far left and the far right. Clearly, they have become the kingmakers in Parliament, and Le Cornu knew he had no other choice. Everyone in his entourage had been saying, you need to suspend the pension reform or we are likely to see another government collapse. And there was a sense, even within Macron's camp, that another government collapse could have cost even more to the French economy and to the French deficit. In the short term, suspending this reform will cost, according to Le Cornu, 400 million euros next year, 1.8 billion euros the following year. But of course, this means Le Cornu, in the short term, should survive this week.
So what about the debate on the budget?
The debate starts now. Le Cornu has actually given the power back to Parliament by saying he will not use the 49.3 article in the Constitution in order to force the budget bill through Parliament. So every single measure will be debated. Le Cornu proposed an initial draft yesterday that included 30 billion euros of savings, 2/3 coming from spending cuts, 1/3 coming from new taxes, the super tax on big companies extended. But of course, the socialists will want more. They have already said they will put back on the table the so-called Zuckman tax on those with more than 100 million euros of assets. So the debate will be heated in Parliament for the next 70 days so they can pass a budget by the end of the year. And what happens once a budget is passed is anyone's guess.
Caroline, thank you so much. Caroline Conant there in Paris. Now joining us is Charlotte de Montpellier, senior economist at ING. Charlotte, I mean, there's so much concern actually in the markets that France is the new Italy, that it's the bad student of Europe. But what's the next frontier for France? Can Sébastien Lecornu hold on to power and get something done?
Yeah, so let's hope the budget can go through. Actually, the suggested budget that he made yesterday is quite ambitious, I would say. So with a target for the deficit to reach 4.7% next year. But I think the likelihood that it goes as expected will be very low. So it means that the debate in Parliament will probably bring a completely other budget. The thing is that the situation, the public finance situation of France is deteriorated and actually has become even more deteriorated because of the suspension of the pension reform. So this means that the savings they need to find are very, very, very big, and the likelihood that the Parliament will reach that point, will be able to find an agreement on the savings is very, very low. So I think it's not the end of the story. We are in a situation with less political instability, that's good, but the public discussion are going to get worse probably about the budget.
Charlotte, is there anywhere where they can actually cut, find some money without doing too much harm? Is there any low-hanging fruit?
No, I mean, that's the problem. So it's not so easy to find ways of having savings that is okay with public opinion. And we have seen with the pension reform that all the reforms that actually are aiming at having less spending are very, very difficult to go through with the public mind. So that's a bit the difficult situation. And the issue is that it's not only for this year, for 2026 budget, but it will be the case for each and every year. So the suspension of the pension reform as such will bring a need to find 3 billion euro more next year in the budget. So it's a lot, and it will keep increasing every single year. So low-hanging fruit will not be enough, and they will need at some point to tackle some major reform, but it's not happening in the political situation as it is right now.
Charlotte, what does it mean for the markets and, of course, a lot of bond vigilantes trying to test France? Do you think that we could see, for example, spreads between Germany and France really getting to concerning levels?
I mean, right now the situation has been seen as a bit of an improvement because there is less political instability, but I think we should not be too optimistic, and the budget discussion in the parliament will very briefly show that it's not solved, the underlying issue is not solved. So it means that instability, political instability is likely to return, and it means that the spreads, they can even go up a bit. So I wouldn't be surprised if at some point in the current next weeks or months, we see spreads going up again, reaching 90 basis points, could even at some point reach 100 basis points, because the political situation is so difficult that actually the possibility or the likelihood that we are going to find a way in order to have a budget situation that is improved not only for this year but for next year and the years after, and that we are going to at some point see the deficit going back to 3% of GDP is very low at this stage, so probably means there is still the likelihood of some upward pressure there for the spreads.
Charlotte, how problematic is 100 basis points difference? And actually, is that a point where the ECB has to step in, or is there anything that the French government would be able to do?
No, it's not. I mean, I don't think the ECB will want to intervene at that moment. Let's be honest, this is due to a political situation, a political problem, and it's not due to some stress on the market, on some difficulties that are unwarranted. So it's not the case. It's actually a political situation. So I think the bar is very, very high for the ECB to intervene. But of course, the fact that they have this possibility, they would be able to intervene if really the situation would be very bad or would worsen very much. That as such is helping markets to relax, to be a bit of more peaceful. So the existence of this TPI instrument by the ECB is enough to probably calm a bit the market and not have so big of a widening of spreads. I don't think they will actually use it, but it exists, so it means that the situation can probably not deteriorate too much. That being said, I think the public finance situation and the public finance problem will remain a key topic for Europe in the next years.
Charlotte, you work for ING, I work for Bloomberg. We love numbers. So what do you think the probability of actually Sébastien Lecornu passing something of passing a budget compromise is? Is it 50% or is it higher, 60, 75%?
Yeah, very difficult to say at this stage because it's very early moment and we don't have the reaction of all political parties yet. I think no, there will be a discussion in the parliament. So there is a likelihood that they find an agreement, probably maybe around 50 or a bit above 50%. But if it's the case, it means that the budget that will go through, that will be voted, will be completely different compared to the one that has been announced yesterday. So if there is an agreement at the parliament, it will be for a completely different budget. And in that case, I would expect that the deficit reduction will be much smaller than what has been announced yesterday. So I think it will remain very, very clear that there is an underlying underlying problem for public finance. And that's very difficult to solve, actually.
Charlotte, thank you so much. Charlotte de Montpellier, their senior economist at ING. And of course, then we need to see whether there's even a possibility that Emmanuel Macron also resigns before his term is up. But let's have a look at luxury stocks because LVMH shares are surging. The company returning to sales growth in the third quarter. This is something that's very encouraging for the rest of the sector, and especially, as LVMH said, it saw encouraging demand in China, with sales in the region rising some 2% last quarter. It also posted growth in its wine and spirits division. Coming up, what AI means for impact investing across emerging markets. We discuss with Andy Cooper, founder and chief executive of Leapfrog Investment.
issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The Fed Chair Jay Powell signals another rate cut is coming later this month as investors weigh renewed trade tensions between the U.S. and China. The French Prime Minister, Sébastien Lecornu, boosts his chances of surviving this week's no-confidence votes after dropping plans to raise the pension gap. And luxury stocks soar after LVMH reports a surprise return to growth, suggesting a persistent slump in demand is actually easing. Now, the AI story is largely dominated by corporate earnings like ASML today and the tech arms race between the U.S. and China. My next guest says this often ignores how the technology is pushing inclusive growth for consumers in emerging countries like Asia and Africa. Well, joining us now is Andy Cooper, Chief Executive of Leapfrog Investments, a venture capital private equity firm with a focus on EM and impact investing. Andy, thank you so much for joining us. Now, first of all, this was an extremely interesting angle because you're right that AI, especially in emerging markets, can mean inclusive growth as long as you're not left behind.
Absolutely. Well, great to be here. And I think the dialogue globally around AI is missing a huge piece. It's focused on the arms race between the likes of OpenAI and Anthropic. But actually, the really interesting thing here is the way billions of customers are joining the economy and are engaging in a much more intensive way. You don't even need to be able to read or write these days in order to engage, in order to get a bank account in India, in order to acquire different financial services, healthcare, education. These things all are now possible for you because of a natural language form of engagement. And you're seeing companies that are growing based on this AI capability that were completely unthinkable 5 or 10 years ago. We have a company called Healthify that provides coaching on nutrition and food and weight loss to over 40 million people in India. And that company basically allows the AI to talk to people in their own language, knowing what their own local cuisine is. No individual could say, I know in 100 languages what the local cuisine needs are, and serves those people. And if you think about India as the diabetes capital of the world, the loss of weight for these folks and the improvement in their cholesterol is dramatic. So you're seeing social impact and you're seeing business opportunities at a scale that was inconceivable thanks to AI.
But Andy, I mean, there must be an entry to barrier, right? I mean, I had a conversation with Queen Maxima of the Netherlands at UNGA, and she does a lot on financial health. And actually, the numbers of people that don't have a bank account now is absolutely staggering. And I don't know whether it is because it's, you know, a lack of access or reading and writing, or it's just that it's not in their world.
So our world is changing dramatically in this respect. You're right, and Queen Maxima and I just had dinner, actually, and there are 1.4 billion people who lack bank accounts and 740 million people who are illiterate. The amazing thing about AI engagement now is that while we in the developed world are often using text and text prompting to continue to engage, people in the developing world are primarily using voice and engagement. And so that changes things dramatically. Also, if you look at those people in the developing world, here in the UK, we would say, well, is AI going to improve the lives of people like us? So when they do surveys, 42% of people say that. In South Africa, in India, it's 76%. And in Nigeria, it's 95%. And why is that? Because people are beginning to engage with this technology in a way that is completely different and is allowing for these customers that didn't sit on the grid before or only consumed a limited amount to consume vastly more. If you are an investor like us, a capital allocator driving returns for your limited partners, and you look at this, you say, wow, sure, OpenAI is the picks and shovels, but there is a gold rush going on here, and we can be backing the best miners across our portfolio to really generate high value for our investors here, and we can be changing the world for those individuals who have lacked these essential services for so long.
I know you touched that at the beginning, but what specific sectors? So if you look at healthcare, is it the enterprise, is it the app, or is it the software that goes into that AI?
So I think all of this is on the table. What we focus on at Leapfrog is the emerging consumers and their actual experience, so B2C companies. Today, our companies reach 560 million people across 35 different emerging markets, the likes of India, Vietnam, Indonesia, Nigeria, Kenya. If you really take that into account, that is more people than all of the European Union and the UK, or more people than all of North America. And those customers were off the grid or very difficult to reach just 10 or 15 years ago. So now what we're going to see is that accelerate. Instead of 4 billion customers, now you have 8 billion. But once there are AI engagement, and those people have AI enablers and agents, you're going to see 16 billion or 20 billion actual potential customers. And that completely changes the total addressable market, completely changes the kinds of companies we invest in.
And I guess it's a little bit too soon right now to know who the real winners and losers are, because it's so rapidly changing in terms of technology.
Well, that's why you need people on the ground, investors on the ground who have built a capability in these sorts of areas. So we invest in financial services, healthcare, and climate solutions. And you can actually see a number of the features of these winners. You can see if they're technology and AI enabled. You can see if they're operating in spaces that can be easily disintermediated by AI. For example, insurance. We all know how painful it is to make a claim in insurance, and it can take weeks or months in Sydney, London, or New York. Well, we have a company called SoftLogic in Sri Lanka, where 97% of claims are paid in the first 24 hours.
I've never heard of that. That's almost unbelievable.
Right, and it's the top life insurer in the country. This is not small, and the number 2 health insurer. Further, you're basically enabling people to submit very simple documents or very simple bits of evidence, but because of the AI, it's able to detect fraud, it's able to check treatments, able to do all of this very quickly. Now, if you're seeing that in developing markets, it's going to come here. It's only a question of time.
And it's a little bit like Deliveroo, right? I mean, they give you a refund quite quickly, but it's on algorithms. So there's always a concern about biases. I mean, again, as we use more and more of these products, do they get better?
Correct. It does get better, and the wonderful thing about very large numbers of people reached is that you have a large N, you have a large capacity to revise and improve these things. But there is no doubt that we need principles for responsible AI. We need to be able to audit for bias. We need to be able to track the reasoning logic of the AI. I will say, though, that in the developing markets, in particular, the optimistic story is far stronger than the pessimistic story. So while there may be some biases creeping in, and there may be work that you need to do to improve the algorithm, the fundamental thing here is that these customers are being empowered, they're acquiring more services, and you're creating industry champions at a pace and a speed that is unprecedented in human history. I mean, this is why we at Leapfrog think that the AI revolution goes beyond this analogy of the printing press. It really is like the development of farming or the French Revolution, which is an agentic revolution, where suddenly the forms of agency, who has agency, and their sense of having destiny, power over their own lives, really comes through. And this makes AI, I think, much more exciting even than the folks spruiking it for data centers in the US like to talk about, because it is a whole different change in who acts, how they act, and therefore how companies can act and how allocators can allocate capital.
I know we've had a couple of conversations with Google. I mean, if the barrier to regulation is lower, how do they make sure it's safe everywhere? Andy, thank you so much for joining us. Andy Cooper there, the Chief Executive of Leapfrog Investments. Now, LVMH surging this morning after the luxury firm's sales unexpectedly returned to growth in the third quarter. Bloomberg's Angelina Rasquet joins us now from Paris. Angelina, good morning. So what's fueled growth at LVMH this quarter?
Hi there, Francine. Indeed, I mean, overall it was a very positive result. All the units beat estimates, and crucially, the key fashion and leather goods unit did too, even though it still posted a negative, a drop in sales in the quarter. But the improvement, as the CFO explained, was driven by better traffic and volume. So it wasn't a price effect. The wines and spirits unit, which had been struggling for the past 2.5 years, also returned to growth, and that was helped by champagne restocking in the U.S. as well as resilient demand for rosé wines, even though cognac is still suffering. And Sephora in the U.S. was also, also showed a very strong performance when it comes to selective retail. And geographically, the only region that worsened was Europe. That is because tourists in Europe are spending less with the weaker dollar. But the region that includes China returned to growth, and that is really what the market was hoping for and what the market got.
So what does this suggest for the luxury sector?
I mean, as we saw this morning, LVMH, the stock rose 13%. It lifted all the rest of the sector. We'll have LVMH is one of the first ones to report. We'll have more companies reporting next week, notably Kering. The issue with Kering is that it's in turnaround mode. They just appointed a new CEO. He took over last month. They have a new Gucci CEO as well, a new Gucci designer. We'll have results also from Hermès next week. This one tends to be more resilient. So we'll see. And Richemont, which is very exposed to jewelry because of Cartier and Van Cleef, will report in November. But overall, yes, there are hopes that China. The question is, has China turned the corner? I think it's probably too soon to say for sure. And the CFO of LVMH actually explained that the current quarter has tougher comparables because last year in particular, the U.S. was very strong following the U.S. elections. So this will not be easily replicated. So that's pretty much, what we got.
Angelina, thank you so much. Angelina Rasquet there in Paris. Now, coming up, JP Morgan reports bumper earnings, but Chief Executive Jamie Dimon warns of cockroaches in the credit market. Details next, and this is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Now, Stellantis says it will invest $13 billion in the U.S. over the next 4 years as the automaker seeks to curb the impact of tariffs and reinvigorate its business. It marks the company's single biggest investment in America in over a century. We're joined by Stefan Nicola, our team leader for EMEA Auto. Stefan, a massive sum. Good morning. A massive sum. Run us through the details.
Yeah, it's indeed a big sum. Investments in several plants across the United States, in new models, in research and development, but also Stellantis noted supplier expenses. So that's a sort of a tiny caveat that the 13 billion will also include supplier expenses. But of course, it will create jobs. And, it's part of Stellantis's plan to really improve its business in the U.S.
So, Stefan, is President Trump's plan to bring automaking back to the U.S. actually working?
Well, that's a good question. We'll probably see that in a year or two. But certainly Stellantis has promised that this move will create jobs. And, other companies have announced similar investment plans. Whether this will create lasting jobs, we'll have to see. Of course, tariffs are never great for the automotive industry because they add costs and that crimps margins, and that, in the long run isn't great for these companies and the jobs they secure. But certainly the Stellantis announcement is a news that should please the union in the U.S.
Stefan, thank you so much. Stefan Nicola there, our team leader for EMEA Autos. Now, Wall Street's biggest banks have reported record growth. JP Morgan's chief executive set, though, a cautious tone, warning of risks in the credit market. Now, Jamie Dimon's comments follow the collapse of auto lender Tricolor, which resulted in a $170 million hit for the bank.
You should assume that whenever something happens, we need to scour all process, all procedures, all underwriting, all everything. And, we think we're okay in other stuff, but my antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one.
I mean, we say he's cautious, but he's also straight to the point. Our Charlie Wells is here to discuss. Charlie, when you look at actually what Dimon is worried about, I mean, he's usually on the money. So what does it tell us about the rest of the banks and what they should be looking out for?
Francine, really on the money there, and using cockroaches to address the elephant in the room, I would say, this concern about credit markets, about what other problems might be out there following that spate of bankruptcies we saw in the auto space. So really reflecting some concerns, some questions that analysts had, and not running from that, saying there could be more out there. This reflected a number of the other comments we heard from executives at these top Wall Street banks. We had Mark Mason at Citi talking about a consumer spending a little bit less, being a little bit more cautious with how consumers are using their discretionary income. We had David Solomon talking about potential winners and losers in the AI space, given a lot of the optimism that we've seen. But this overshadowed some really stellar numbers. You look at investment banking fee growth, you can see that at Goldman, Goldman, growth of 42% in that third quarter. That was a record for Goldman Sachs. You saw stellar reports across the board in investment banking fees, in trading fees as well. But when you take a look at how the market responded, you do not see this reflected in the share prices yesterday. You can take a look, a slip for Goldman Sachs, a slip for JP Morgan. You saw some positive responses to other banks, but again, this was overshadowed by some of that commentary and perhaps some over-enthusiasm for banking stocks in recent weeks.
Yeah, no rest for the wicked. There's more earnings today. What can we expect from the banks?
So coming up, we've got two giants on tap. We have Bank of America, and really important there is to focus on net interest income, given the lending business they have, given the exposure to the consumer, really focusing on that, especially given the state of rates, the change that we have had, given that rate cut in September. And then we have Morgan Stanley, arch rival to Goldman Sachs, coming up. You can look at the share prices of these banks. You can see how competitive this is. You can see how much optimism there's been for the likes of, say, Morgan Stanley coming out there. Investment banking fees will be in focus as well as trading. Bank of America lagging a little bit. There could be potentially an upside surprise here, but we'll find out in a few hours when these earnings drop.
We certainly will. Charlie, thank you so much. Charlie Wells there with the very latest on the banks. Let's now bring in Paul Davies, our bank and finance columnist from Bloomberg Opinion. Paul, thank you for joining us. I loved your column, so we woke up and we said, let's get Paul today on TV, because basically you say big banks are on fire. Why is the Fed eyeing more fuel? And there's this idea that, look, banks are having a great quarter. They're increasing financing to it's just going through the roof. And so it can be really tricky to contain risk if the Fed cuts interest rates.
Yeah, no, exactly. I mean, we've got this kind of, this bifurcated, I guess, news coming out in the sense that everybody's doing spectacularly well. JP Morgan had its best third quarter for trading ever. I mean, all of the banks reported, investment banking fees that were the best since 2021, which was when we had that, huge boom post-COVID and post all of the extra money that went into markets. But at the same time, we've got Tricolor and First Band, and it's, are they cockroaches? Are they canaries in a coal mine? It's like my head spinning from all of these animal metaphors. I mean, the point is that both of those potentially have some fraud involved, so they may be idiosyncratic, but at the same time, you might keep seeing more of these, one-off, odd, overextended situations coming, and that's, yeah.
Does it go back to exuberance? I mean, is that the word, like with deregulation? Do you worry about something, and you're right, there are a lot of animal metaphors, that something just going badly because we're too optimistic?
Yeah, no, absolutely. I mean, we've had stock markets, apart from, the interruption in April after Liberation Day, stock markets riding high all year, credit spreads are incredibly tight. We've already had executives this year talking about how exuberant markets are. And this really doesn't seem like the kind of market that you ought to be throwing interest rate cuts at, especially when you're just slightly worried about a bit of economic slowdown next year and a bit of softening in the labour market. And also, there's a wave of deregulation that people keep thinking the White House is going to bring. Alvarez and Marshall, this consultancy, put out a report, a somewhat punchy, somewhat optimistic report, in my view, this week, saying that up to $140 billion of capital could be freed up from these big banks. And it's like, okay, even if some of the biggest, most sensible banks don't throw that into the market themselves straight away, that's going into the pockets of shareholders who need to find something else to do with it. So it just all feeds this, incredibly heated sort of market scenario already.
But Paul, if you look at the things that go wrong, which I know you do very well in your columns, or you try and shift through, I mean, how much of that is just this market bubble because of AI? That keeps on being supported, by the way, but that's a big question mark that lingers over everything.
Yeah, I mean, that's the big question. I mean, in a lot of ways, people were sort of relatively comfortable with it for a while because we thought, okay, a lot of this investment in data centers particularly is coming from the cash flows within a lot of these, VC and AI companies. But JP Morgan their analyst did a study last week, I think, about the amount of debt now going into some of this stuff, and AI-connected, investment-grade debt issuance overtook banks as the biggest single sector of debt issuance now. So it's not just, the cash that VCs can afford to burn, or that, Microsoft or whoever are throwing into OpenAI. There's also a lot of debt going in there, and it's coming from private markets and it's coming from public markets too. So
yeah, private markets. I mean, if you're deregulating the banks, what happens to private markets? Is there talk, in the U.S. of having a closer look to private markets? Not so much.
No, not so much. I mean, in fact, what the White House has been doing more is rowing back from some of the Joe Biden era regulation that was trying to get, more insight into private funds and this sort of thing. One of the big concerns that's been building for a long time is just how much the banks are lending into the non-bank area, including to kind of private markets, private credit fund managers and this sort of thing. And indeed, JB Diamond of JP Morgan got some questions about this from analysts yesterday on the call. I mean, and again, there's like, at the higher quality end, everybody is very comfortable. They think they've got a lot of good collateral and everything is well secured, but there's the lending standards within some of those people that banks are lending to, and especially at the lower end and the riskier end. And it's like, yeah, when do some of these things start to go a bit funny,
Okay, so what are you writing on today?
Well, I'll be looking at Bank of America and Morgan Stanley just to see, how they line up next to the fall that we saw yesterday, and to try and get a better sense from them about what they think is coming in terms of deregulation, fourth quarter activity, and activity into next year.
Paul, thank you so much. We're such a fan of your columns. Paul Davies there from Bloomberg Opinion. Now let's return to Jay Powell and those comments, of course, about a potential Fed cut. Joining us now, Nora Melinda, our markets correspondent. Nora, so great to have you, and in the London studio. So how are the markets actually digesting those comments from Jay Powell?
Well, today we are seeing stocks in the green, at least as we're looking at futures here ahead of market open. I mean, we did see them end lower yesterday at market close on Wall Street. I mean, people are really just looking to Jay Powell for any sense of relief right now. I mean, there's so much uncertainty in the market. So it's really just about people seeing this a little bit as him waving a green flag, if you will, in amidst a cloudy backdrop here. I mean, of course, he's talking about a slowdown in the pace of hiring and potentially potentially weakening further here. So it really is people just trying to figure out how to position themselves in a very, very cloudy backdrop.
Yeah, not easy when you don't get data because there's a government shutdown. Right. So how are the markets positioned?
I mean, given the fact that there's an absence of data, we're really looking for any sort of indication about the health of the economy. People are really pointing toward rate cuts here at the end of October, coming off of the rate cut that we just received back in September. So, I mean, we're going to get the beige book today, later today, and also people are really digesting the bank earnings as kind of a proxy here in the absence of data. But you're seeing a bit of a flight to safety. I mean, you're seeing some bids here on gold.
Yeah, I mean, gold is unstoppable, right? It really definitely feels like that. When you look at the U.S.-China, how's that playing out? Because everything seems to have upped the ante.
Yes, I mean, headlines flying left and right here. People really on the edge of their seat as to what's happening next. But, I mean, that definitely continues to be a very uncertain dynamic, as there's a bit of a tug-of-war from both sides. So it feels like a tug-of-war between the bears and the bulls right now. But, I mean, if you look at the markets right now, year to date, we are still seeing double-digit gains on the S&P 500 on the year. So, I mean, it's really just about what happens next year, and the tariff, of course, conversations will continue, and something that we're really going to be parsing as we get through these earnings during this corporate season.
Yeah, so Nora, how much actually are they looking at earnings, and how much are they just doing what the Fed does to help them out?
It sounds like a little bit of both. I mean, as I'm chatting to sources, of course, people are going to look to earnings to kind of get an idea of how the economy is being underpinned. People, of course, digesting what we saw from banks just yesterday, and as it continues moving forward. But it really is going to be a modge-podge of whatever you can grab. You got to listen and see what it could potentially mean moving forward here.
Yeah, I mean, questions for investors is like, how do you cut the noise from the real stuff?
Absolutely.
Right? That's the hard bit. Nora, thank you so much. Nora Melinda, our markets correspondent. Up next, Bloomberg Brief. There's a lot going on in the markets. The stock rally continues. We were talking with Nora about gold, for example, topping 4,200. Global stocks advancing again. Strong earnings seem to have reignited some of the risk appetite. Markets that frankly have been whipsawed for days by these shifting trade war fears. Gold surging above 4,200 an ounce, and that again boosted by U.S.-China frictions and also expectations for Fed easing. Dollar falling against all major peers. Bets that the Federal Reserve interest rate cuts have been growing, but also China, I think, stepping in to support the yuan. We'll have plenty more throughout the day, and this is Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Let's talk about this villa. Very traditional. A lot of things of the past.
I live
my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They built this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human being, for the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Futures pointing to gains as strong earnings and rate cut bets following Fed Chair Powell's remarks reignite risk sentiment. That's in spite of fresh tensions between Washington and Beijing, with President Trump threatening to stop trade in cooking oil from China. And Bank of America and Morgan Stanley set to report after solid results from peers. So it was a choppy session yesterday. We were down 0.2% for the S&P, down 0.7% for the Nasdaq 100. We look to be reversing that this morning as risk sentiment returns. Swaps now pricing in 1.25 percentage points of cuts by the end of next year. So clearly just a little bit more enthusiasm for rate cuts after Fed Chair Powell's remarks yesterday. Perhaps, though, a little bit of skepticism about this trade war escalating. Let's take a look at bonds, because we did see the 10-year yield earlier this morning below 4%. We're just on 4% now, 3.47 on the 2-year yield. So as you can see, those yields are holding in at those levels very, very staunchly. We're seeing dollar weakness today as we're seeing strength in sterling, the euro, and the yen for a change. And we're also seeing gold continue to hit records. It was about $4,200, yes, an ounce a little bit earlier this morning. So let's get to some individual market movers now. Over to London and Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with a check on NVIDIA. Shares are moving higher, up over 2%, and this comes back on the back of NVIDIA finding a new buyer for its chips. This time it's the UK data center startup Nscale, who has entered into an expanded agreement with Microsoft, and on the back of that, they are contracting 200,000 of the latest GPUs from NVIDIA. So those shares are called higher in the pre-market. Let's move on to Stellantis. Some other news coming from this car maker. They have pledged $13 billion of U.S. investment. Now, this coming off the back of them wanting to amp up their U.S. production. They want to do it by 50% over the next 4 years, even moving some production from Canada into states like Indiana, Michigan, Ohio, and Illinois. They have pledged that they'll add at least 5,000 jobs, and they say that their suppliers are likely to move more production to the U.S. and more job gains off the back of that. So Stellantis cheering this news. The stock is up 0.3%, trading higher in Milan. Over to to Papa John's. We mentioned this yesterday on the back of takeover speculation. Reuters is now reporting that they did receive that bid from Apollo at $64 a share. So Papa John's surging yet again in trade today, up 10% off the back of this. Now, Bonnie, Papa John's has declined 65% since its highs in 2021. It's been well speculated as a takeover target. Let's see if we get a deal sometime soon. Bonnie?
More M&A. Valerie, thank you so much, or take privates, I should say. That is Valerie Teitel. And in just moments, we'll be speaking with Jeffrey Yu of BNY. He'll be joining on the Fed's policy path forward. And we'll take a deep dive into bank earnings a little later on with Stephen Bigger of Argus Research. President Trump then re-escalating trade tensions with Beijing, posting on Truth Social, "We are considering terminating business with China having to do with cooking oil and other elements of trade as retribution. We can easily produce cooking oil ourselves. We don't need to purchase it from China." Joining us now is Bloomberg's Alan Wan. Just on this particular mudslinging, what do we actually use cooking oil for, Alan?
Yeah, I mean, we used cooking oil for biofuels, like renewable diesel fuel. And this was basically, China has been exporting quite a bit of used cooking oil to U.S. over the past year. It was worth $1.2 billion to China over the past year. But this was something that the U.S. bought a lot of during the Biden administration when it focused on green energy. But for China's sake, though, the percentage of exports of used cooking oil has been on the decline ever since the government started to do away with some of these incentives. In comparison, the U.S. exports $12.6 billion of soybeans to China, which are hurt, and China's not buying any, which is hurting American farmers. So it's definitely a lot more difficult for the U.S. than for China in this regard. And I mean, there's a reason why Trump is doing it, right? It's retaliation for the fact that Beijing isn't buying soybeans. It's buying from the U.S. It's buying from Argentina, from Brazil.
Right, but as you say, U.S. imports of cooking oil dwarfed by what China would normally buy in soybeans, so not exact retaliation or not exact tit for tat. The USTR, Jameson Greer, says there is still a scheduled meeting, though, between Trump and Xi. So should we just ignore all of this rhetoric for now, or at least discount it?
Yeah, I think the market is discounting it quite a bit. I mean, when you start talking about used cooking oil, it's not something that a lot of people are super concerned about. Like I said, the market isn't that big. Nevertheless, you shouldn't ignore it. But this is just it seems like the range of measures they've been sort of hitting each other with have sort of been on the wane, right? We've gone from threats of 100% additional 100% tariffs on Chinese goods to even like canceling Xi and Trump talks. But overnight, Greer said that tensions are easing. Mind you, there are talks going on between U.S. and China right now in Washington. Senior officials are talking, and even Trump said that he still sees a positive outcome from the talks.
Alan, thank you so much. We'll be speaking again, no doubt, very soon. That is Bloomberg's Alan Wan. Jeffrey Yu of BNY sees intensifying policy and export risks in Asia. And looking at the United States, he writes this, quote, "Inflation risks in Q4 and beyond will be critical for both Fed policy and investors as they balance the U.S. dollar as a store of value against companies' margins and their ability to absorb costs versus passing them on." Jeff joins us now. He's senior strategist at BNY. So, Jeff, we've just started earnings season in earnest, really, with the banks. So maybe we're not seeing any kind of impact of trade just yet. But what do you anticipate for Q4? Will we see a lot of pass-through in terms of trade?
Well, I think it really depends on whether you are asking before the recent, trade issues or after, right? So there may be a bit of a sting in the tail. But overall, I think what we're looking for in terms of companies, they are a bit worried about the U.S. consumer slowing down to some extent. So how are they going to absorb that, to maintain top-line growth? Are they going to have to absorb whatever costs are coming through to keep the consumer going? But if there are further signs in the forward outlook that the consumer perhaps is not as strong, I think that is a risk that's coming through. And given what Chair Powell said yesterday, again, about the labour market, I think that's going to be a concern for all corporates involved.
And we also had comments from Citi yesterday pointing to the fact that consumers are being discerning. So these are all, little red flags that we should be keeping an eye on. You know, we are seeing equities price in growth from somewhere or continuing to. Either that or they're just completely delusional. Which would you say it is, Jeff?
Well, I think the growth right now is still being priced in terms of capex in the AI trade. We know if we look at the leaders of US equities, it is quite concentrated. That has been established for a while. So I think the broader medium to longer term market outlook is in the past, we used to say, you know, where the US consumer leads, the rest of the world will follow and equity markets will follow. Now, if that's changed, if the US has become a tech-driven, capex, investment-driven economy, then maybe we just need to view things in a different way. And any slowdown in the US consumer, that perhaps is not going to have too much of a negative impact. So I think we're still in this transition phase and looking for proof of any changes. But, you know, ultimately, I think if there is a sharper slowdown, then the Fed will have to react, and I think equity markets will react as well. But for now, I think most people are talking about resilience, but mindful of the risks.
Jeff, what is your reading of these latest salvos from the US and from China as we approach a meeting that's apparently still scheduled between Trump and Xi, and also, of course, the fourth plenum? Will Xi be reluctant to do anything vis-a-vis US-China relations before that?
Well, I think as far as the plenum's concerned, you know, that is a bit more of a medium to longer term focus. We're talking about the blueprint for the next 5-year plan coming through. So that goes well beyond what's going to happen in the next 3 to 4 weeks. I know some parts of the market are looking for a short-term stimulus. Again, I don't think that's what this plenum is for. But having said that, I think China does want stability in relations, and I think the US wants that as well. Hence, you know, despite the to and fro, I think, you know, both sides they're ending with let's talk. You know, the Ministry of Foreign Affairs overnight in China was talking about that again, hoping for talks and find some sort of a resolution. I think that's what markets are pricing in right now, this form of an equilibrium. If we have to just roll things every 3 months, so be it. But I think the preferred way is for something more permanent.
Jeff, this move down to 4% and even below on the 10-year yield, what is it saying to you?
Well, I think overall, international investors in particular, we're looking at our data. You know, they are getting back into the Treasury market. They want to buy this. They're seeing the US Treasury market as a safe haven. And also, on the fiscal side, you know, lest we forget, we do have tariffs, you know, coming through. That's contributing to coffers. Maybe the shutdown's contributing as well. Maybe not the optimal way for fiscal consolidation, but that's helping things as well, especially if you compare the US to Europe, for example. But one other thing to note is the dollar is also strengthening just gently at the same time. So as opposed to what we've seen earlier this year, markets seem to be more accustomed to buying US treasuries, but also going back into the dollar at the same time. So this reserve currency status, the treasury market as a reserve asset, that pretty much is in place.
Yeah, that loss of confidence in the US Treasury market that we were worried about doesn't seem to be coming to fruition. But you did point to maybe perhaps a different risk, you know, that of a consensus trade unwinding. How much are you seeing that right now, and does it pick up steam?
Well, it is always a risk. And if we look at US equity markets, for example, and just US asset allocation in general, we're noticing that foreign investors, cross-border investors, they are now actually more overweight US equities compared to US investors, just by a small bit, but that gap is actually the widest for the year. So for international investors, you know, they are crowded into this as well. There is a risk that they need to take some positioning off, especially if they see the dollar strengthening. Will they start to actually hedge out their dollar risk at a better level, at a stronger dollar level rather than a weaker one? That's something we're monitoring as well. In emerging markets, some of the very well-owned high real yield carry trades, places like Hungary, like South Africa, we're seeing serious unwinding there as well. But it seems like in the order of things, if we're talking about unwinding consensus trades, US equities, US assets, and that's going to be the last in the queue.
Jeff, can I ask you about Fed Chair Powell's remarks to the effect that the Fed may stop rolling off its balance sheet purchases in the coming months, and what that will do when it trickles into the economy, if it does?
So I think that is has been priced in for a while, or has been expected for a while. And Fed and Chair Powell said they're still perhaps some ways away. But I think the markets are gradually pricing in that easing in financial conditions to the horizon. And also to highlight, this is not unique to the US. I think we first saw it with Japan. You know, their tapering process. They've adjusted that for the Bank of England. They've recently, in their update for next year, they've reduced their balance sheet contraction from £100 billion to £70 billion. They're going to sell less in the long end as well. So I think this post-COVID balance sheet expansion wave of contraction, that reversal process, it's run its course. We're not going to go back to pre-COVID levels in terms of balance sheet size. Fed Chair Powell was very clear about that, but they just want to make sure we don't have any incremental tightening in financial conditions on the quantitative side while the global economy is going through a bit of a soft spot.
Yeah, taking every precaution. Jeff, thank you so much for joining us this morning. That is Jeffrey Yu of BNY. Now to other top stories trending on the terminal this morning. ASML rising after reporting orders that beat analyst expectations. The strong numbers reflecting how AI continues to fuel demand for its chip-making machines. Bookings reached $6.3 billion. The CEO did note that business in China will be, quote, significantly lower. LVMH shares surged after the owner of Louis Vuitton and Christian Dior unexpectedly returned to sales growth in the third quarter, suggesting a slump in luxury demand is easing. The company saw encouraging demand in China, with sales in the region rising 2%. It also posted growth in its wines and spirits division. President Trump suggesting the $20 billion in U.S. aid to Argentina could be contingent on Javier Milei winning the upcoming elections. Milei is less than 2 weeks out from a pivotal midterm election that is set to decide the future of his reform efforts. Coming up, France's benchmark index rising the most since May as political risks ease. We'll bring you my conversation with Banque de France Governor François Villeroy next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Earnings season is here.
Earnings season begins once again.
So much going on.
Bloomberg is first to break the numbers.
From Snowflake, from Pure Storage, from Urban Outfitters, and yeah, from NVIDIA.
Coming up, we'll talk about some of the other earnings that are coming out.
With the smartest insights.
Third quarter numbers are going to be really important. The commentary is going to be important. It's all going to be about margins, because margins lead to earnings. And if earnings come down, we have a problem.
You have to come back again soon. This is really excellent.
Continuing coverage on Bloomberg.
This is is Bloomberg Brief. I'm Bonnie Quinn in New York. French stocks rallying this morning. The OAT Bund spread at 78.5 basis points now as Prime Minister Sébastien Lecornu's new government is seen to perhaps survive the upcoming no confidence vote. I spoke with the governor of the Bank of France, François Villeroy de Galhau, after Lecornu presented his budget proposals to Parliament.
What we can say about France is that we have obviously to reduce fiscal deficits. There was a first step this year to 5.4%. We must go to 3% in 29. It's our European commitment. It's also our national interest. And so the step next year to 26 must be another significant reduction. I said it should be around 4.8%. We will see what the debate in Parliament will give as outcome. The budget presented by this new government is 4.7, but again, we will see.
How do you see that happening, though, given that this current coalition wasn't viable without caving on pension reform, and that's going to cost 400 million euro next year, 1.8 billion the following year?
Again, I won't comment on the details of the measure. It's not up to the central bank. It's up to the political and parliamentary debate to discuss about the measures. It's not our role. Let me stress perhaps two elements which are more favorable as a context. First, that the French economy is resilient. As a euro area economy, we had good surprises and we had to revise up our growth forecast for this year to 0.7%. It's not brilliant, but it's resilient. And second, which is very important for our political debate, that the popular support in public opinion polls for the euro is at the highest level ever reached. 79% for French citizens, 83% for Europeans. So it's not a debate about Europe and the euro. It's a debate about how to reduce the fiscal deficits, and we need this direction.
Obviously, markets responded well, at least to this initial proposal, but perhaps that's because at least now the government doesn't immediately crumble. Are you concerned that French market turmoil will rear its head again, particularly if now the door is open to less fiscal consolidation?
I think we have to reach a significant reduction of fiscal deficit next year.
How?
And the how, it's not in our hands. I can only say that having less expenditures, having a better control of expenditures, not only for central government, but also for social and local expenditures, is part of the answer. We have the same social model as our European neighbors, but it costs us in France more than our neighbors. So we should look very pragmatically at our neighbors, what is the most efficient solution. So most of the solution belongs to the expenditure side. Part of it could be on the tax side, but again, it's a legitimate democratic discussion. We believe in democracy.
Well, I do want to point out that political extremes could still scupper this government. There are confidence votes on Thursday, and as you know, obviously Marine Le Pen's national rally or the far left have been in increasing positions of power. You wrote just a few months ago that the Banque de France's independence from political power is well asserted and widely recognized. Are you concerned that that may not be the case as we go forward and these extremes become more central?
No, I don't see risk for the independence of the Banque de France or of the European Central Bank or of what we call the Euro system for two reasons. The first one is legal reasons. It's enshrined in the European Treaty for the Euro. And as I said, European citizens are very supportive of the Euro. And second, I think our Euro system, ECB, Banque de France, did a good job in fighting inflation. When we say with Christine Lagarde that we are in a good position today, 2.2% on inflation, very close to our target, 2% on interest rates, which is much lower than in the US or in the UK, we were successful in the victory against inflation.
And that was our interview with the Banque de France governor, François Villeroy de Galhau. Coming up, eroding lending standards. Wall Street heavyweights issue credit market warnings. More on what's making headlines in your front page news next. This is Bloomberg.
climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg Brief. I'm Bonnie Quinn in New York. It is time now for your front page news. First up on the Wall Street Journal, the Trump administration has revoked the visas of 6 people over their comments about the killing of Charlie Kirk. The State Department did not specify what types of visas they held, nor if they were in the U.S. at the time the visas were revoked. The department said it has, quote, no obligation to host foreign nationals who wish death on Americans. Next up on the Washington Post, 5 major broadcast news networks, including Fox News, have rejected the Pentagon's new press policy, calling it restrictive and threatening core journalistic protections. The new policy says reporters could have their press passes revoked if they publish information that has not been authorized for release by the Pentagon, even if the information is unclassified. And on the Financial Times front page, top U.S. financiers warn of an erosion in lending standards after credit markets were shaken by the collapse of First Brands and Tricolor. Apollo Global Management CEO Mark Rowan saying the unraveling of the two businesses followed years in which lenders sought riskier borrowers. All right, let's take a look at those markets because futures are pointed higher today. It could be risk appetite is coming back on after Fed Chair Powell's remarks. It could just be that it's Wednesday and we've had an up day and a down day so far this week. The dollar index weaker, stronger euro, yen and sterling today.
Break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, We are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Futures pointing to gains as strong earnings and rate cut bets following Chair Powell's remarks reignite risk sentiment. That's despite fresh tensions between Washington and Beijing, with President Trump threatening to stop trade in cooking oil from China. And Bank of America and Morgan Stanley set to report after solid results from peers. So let's take a look at how we're setting up for the U.S. trading session. Certainly futures are pointed well higher. Russell 2000 futures blowing every other index out of the water. The S&P down about 0.2% yesterday. The Nasdaq 100 was down 0.7%. It certainly was a choppy session with that spat continuing between the U.S. and China, this time involving cooking oil as a retaliation for no imports of soybeans on the part of China. We should note that it is government shutdown day 15 as well. That is percolating in the background. And then, of course, Fed Chair Powell's remarks, swaps contracts pricing in about 1.25 percentage points of rate cuts by the end of next year now. So we see yields continuing to decline. Jeff, you earlier talking about how that faith in the Treasury market is not ebbing. The 10-year yield was below 4% earlier on today. We're back above it now, but we are seeing those yields hugging those levels very closely. And, of course, gold above $4,200 a ton today. Ed Yardeni says gold is the new Bitcoin. So for some stocks to watch, let's get over to London now and Valerie Teitel. Valerie.
Good morning, Ivani. Let's start with a check in tech on NVIDIA. Shares are higher for the chip maker, up 2.3% after it unveiled it found a new customer. This time it's the data center startup in the UK called Nscale, who expanded their agreement with Microsoft, and on the back of that are contracting 200,000 of NVIDIA's GPUs. So NVIDIA rising in pre-market trade on the back of this. Sticking in tech and moving over to ASML. This is the chip equipment maker, the most valuable company listed in Europe. Stock is higher by nearly 3.5%. This comes on the back of some pretty strong earnings. Their sales bookings for the previous quarter beat expectations by $500 million, and the company says it's still on track to increase its revenue by double into 2030. So some positive news to start the string of tech earnings this week. Remember, we do have TSMC reporting out of Taiwan overnight tomorrow. Moving on to the restaurant space, pizza on your mind, Vani. Papa John's higher once again in pre-market trade, up nearly 13%. This is turning into a days-long saga. We've now heard from Reuters confirming some earlier reporting that Apollo has submitted a bid to take the company private at $64 a share. There still seems to be some speculation whether this bid will be accepted, as we're still trading at $55 a share at the moment. Vani?
I'm refusing to picture those pizzas in question, Val. It's too early in the day. That's Valerie Teitel. Thank you so much. President Trump now targeting cooking oil from China. He said in a Truth Social post, "We are considering terminating business with China having to do with cooking oil and other elements of trade as retribution. We can easily produce cooking oil ourselves. We don't need to purchase it from China." Joining us now from Washington is Bloomberg's John Harney. So the escalation would seem to continue, John, except that we don't import nearly as much cooking oil as China imports soybeans from us. And if both stops, we're going to be hurt a lot more, right?
It certainly looks that way at the moment as the trade war moves to another front, from perhaps the factory floor to the kitchen cupboard. You're right. The United States imports very little cooking oil from China. However, there is something else here that we should be mentioned, and that's used cooking oil, which has been deployed to make renewable diesel fuel. And that has been a flashpoint even before the second Trump administration, because soybean farmers felt that they were being frozen out. Now, this latest warning from Donald Trump came about over China's refusal to buy soybeans, which has disrupted the agriculture industry, the American agriculture industry at harvest time, and alarmed American farmers, an important constituency that largely votes Republican.
For sure, and we should mention that even though it's a small amount in comparison with the soybean exports, we do still import a record amount of cooking oil last year. That was the record set. Now, turning to Argentina, President Trump suggested the $20 billion lifeline for that country could be contingent on Javier Milei's success in the midterms. Just take a listen.
We're going to work very much with the president. We think he's going to win. He should win. And if he does win, we're going to be very helpful. And if he doesn't win, we're not going to waste our time, because you have somebody whose philosophy has no chance of making Argentina great again.
Such a strange arrangement, John. I mean, essentially, this is, I don't want to call it interference in another country's election, but if Milei doesn't win, the U.S. pulls its aid. How does this work?
Well, we'll see what happens in the election, I guess. It's very crucial for Mr. Milei and his party, because his economic reforms sort of hang in the balance. There was another vote a few weeks ago in which his party, his agenda fared very badly with voters, and it looks as if the Peronist movement, which was founded, of course, by Juan and Eva Perón long ago, and favors a much larger government, more left-wing policies, if you will, is ascendant right now. And this, of course, what Donald Trump said, President Trump said, his warning that the United States might just pull out if Mr. Milei does not do well in these elections, kind of adds to the jitters of investors, of people in Argentina, and not least Mr. Milei himself.
Absolutely. It's almost reversing some of the goodwill that's been put out there. John, thank you so much for joining us this morning. That is Bloomberg's John Harney. Back to some stocks we're keeping an eye on. ASML rising after the company reported stronger than expected orders in the third quarter and said sales next year would be at least on par with 2025. This comes as the AI race fuels demand for its chip-making equipment. Joining us now is Bloomberg's Dasha Afanasieza, and that is our reporter who covers ASML. So, Dasha, ASML is a chip equipment maker, obviously. Who is spending on chip equipment right now? What can we tell about the AI cycle from these results?
So ASML makes lithography machines, and it's actually the only maker of the most advanced EUV machines in the world that are critical for the AI rollout. And companies the likes of TSMC, NVIDIA, etc., have committed hundreds of billions of dollars to the AI expansion, and some of these are lower down the supply chain, but essentially ASML is one of the main bottlenecks because it's the only company that makes these particular machines. So the fact is it's expecting to benefit from this rollout over the coming years, and we're already seeing that now, and we're already seeing that from quite a strong quarter in Q3.
Yeah, we did have a word of caution about China, though. Where would China go to get its equipment if not ASML?
Exactly. So China can't get access to these most advanced machines. So they tried to cobble together technology solutions of where you sort of project the pattern, the really complex pattern that ASML machines make once and then shift the device slightly and do it again. But it's really not ideal. So they come up with fixes, but of course they want these machines, and there are export restrictions. And the big note of caution in the results today was that actually China sales would drop quite a lot after a strong 2024 and 2025. So that they'll drop next year and become a less significant part of ASML revenue.
All right, well, for now, those shares are up 3.5%. Our thanks to Bloomberg's Dasha Afanasieva. LVMH shares rising as much as 14%, the most since January of 2024, after the luxury group reported an unexpected return to sales growth in the third quarter. Joining us with the latest from Paris now is Bloomberg's Angelina Roscoe. So, Angelina, what has fueled growth this quarter, particularly at LVMH?
Hi there, indeed. I mean, what was interesting is that all the divisions beat estimates, and crucially, the key fashion and leather goods unit beat, even though it was still negative in the quarter. But basically, it was helped by improving traffic and volume in, in stores. So it wasn't driven by price. Crucially, the wines and spirits division, which had been in a downturn for the past 2.5 years, also returned to growth. It was helped by champagne restocking in the U.S., good demand for rosé wines, even though demand for cognac was still weak. Geographically, Europe is the only region that worsened. That's because U.S. tourists are spending less because of the weaker dollar. But otherwise, China returned to the region that includes China returned to growth, and that's really what's pleasing markets this morning.
Yeah, absolutely. I think all the luxury retailers are pretty much higher on the back of these results, thanks to the potential for the Chinese consumer to return. What is selective retailing? Because that was also up.
Yeah, that was basically the unit that includes Sephora, and Sephora had a good performance in the U.S. in particular. It was helped by the launch of Rhode, the skincare brand in the U.S. And overall, I mean, as you say, the rest of the sector rose on this. We're going to have more sales numbers next week, notably Kering. Kering is the owner of Gucci, but Gucci is in turnaround mode, and also at Kering they have a new CEO. Luca De Meo just took over last month. They have a new designer at Gucci, so we'll see about that. And then we'll also have results from Hermès, and that one tends to be typically more resilient. So that's what I can say.
Amazing, Angelina. Thank you so much for joining this morning. Angelina Roscoe there in Paris. Now to other top stories trending on the terminal this morning. Stellantis shares rise after vowing to invest $13 billion in the U.S. over the next 4 years. The automaker is looking to curb the impact of tariffs. The plan will boost annual vehicle production by 50% and add more than 5,000 jobs in factories in Illinois, Ohio, Indiana, and Michigan. Apple CEO Tim Cook pledges to boost investment in China during a visit to the world's second-largest economy. The pledge comes despite threats from President Trump to slap tariffs on its foreign-made products. China is Apple's biggest market outside the U.S. and remains a key manufacturing hub. And in Japan, there could be an upset in the race for the next prime minister. Surprise candidate Yuichiro Tamaki could get the backing of 3 opposition parties. It would prevent the governing LDP from taking the premiership again after the ruling coalition collapsed last week. Coming up, we're into the last stretch of big bank earnings this morning. We'll discuss with Stephen Bigger of Argus Research next. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
We published a story recently about the explosion of robotic companies and innovation in China. I think we said there's something like 50 or 60 robotic startups in China. Are we behind, and should we be concerned about that?
I think as far as the state of innovation, no. Most of those robots aren't built for work, for the things that, which is the entry point for these robots today. They can do some interesting things. A lot of times it's backflips or making coffee or something, but not really useful work. These robots can pick up to 50 pounds on our next generation. So they're great for the education of robotics, getting people interested. But as far as humanoids, they've got to check that safety box before they can come into any of the facilities here. And that's a big bar that we haven't seen much of out of the Chinese robots.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. So the first round of big bank earnings delivering solid results. Bank of America and Morgan Stanley up next later this morning. Joining us now is Stephen Bigger, Director of Financial Services Research at Argus Research. So we did definitely get some beats and some phenomenal results yesterday, Stephen, but were there any warning signs to you that we should look out for more of today?
Good morning, Bonnie. No, it was a pretty banner quarter. We're only one day in, but clearly the results are showcasing that capital markets activity has shifted into a higher gear for banks, whether it's investment banking, trading, debt underwriting, really across the board, IPO activity, and it's just been more of the same. I think for the banks yet to report, I would expect. And it was kind of expected coming into the quarter, and I think that's why some of the stocks may have been a little soft yesterday, because of they had a nice head of steam coming into the quarter in expectation of some, what we thought were going to be pretty strong number based on deal flow throughout the third quarter.
Yeah, you point out that capital markets revenues have shifted now into a higher gear at the mega banks, and that sluggish loan growth will show improvement because the September cut can't really be factored into this set of results. So we should see more of the same in the coming quarter, right? Talk to us a little bit about what we will see from Bank of America. We need to be looking out for net interest income there in particular.
Well, NIMs have been kind of flattish, so far, quarter over quarter. There's not been a big change in dynamics for either rates paid on deposits or yields earned on assets and loans. So I think we're, kind of in a flattish environment. The yield curve has steepened more recently, however, so I think that bodes well, certainly for the net interest margin. I don't expect any big changes in deposit costs at this point. As you said, the Fed rate cut happened too late in the quarter to really have an impact, but we do expect some stimulus from that lower rate and lower rates forecasted in the next couple of quarters to help with loan growth as well, which has been really anemic in the low single digits. So the banks could use that as a help on the lending side of the business.
Stephen, what did you make of Jamie Dimon's comments yesterday to the effect that, where there's one cockroach, there's often a lot more? Could there be more cockroaches, particularly in the credit space?
Well, credit quality has been benign for the last few quarters. We've not had any kind of upsets. Over the past quarter, we had some of the in the auto space, of course, some loans, Tricolor, et cetera, that were provided some trouble with for banks, and we have worried, for 2 years now about commercial real estate. That just has not come to fruition. So I think the consumer, is hanging in there. There are still concerns there about more sluggish jobs growth. That could, if unemployment ticks up, that's certainly a harbinger of higher defaults and lower credit quality coming around the corner. So I think banks have been, call it cautious. Jamie Dimon is typically a glass half full type. It's not a bad character trait in a banker. Obviously, they are conservative in their approach to credit quality, and so I don't see anything in the near or intermediate term that is cause for concern in terms of credit quality right now. Keeping an eye on the consumer, keeping an eye on charge-offs of credit cards and auto loans, and those have moved up a little bit here and do bear watching.
Yeah, and Citi pointing that out as well, that consumers were becoming more discerning. Goldman really just hit it out of the park when it came to investment banking fee growth. Will Morgan match them today?
I expect so, yeah. There tends not to be a large differential with that banks are doing, the investment banks, that is, are doing well. They tend to do well across the board. You might have little variations. One may grow in the low teens or one may grow in the high teens. Some of that is positioning, if it was a particularly strong quarter for debt or for equity, or in the case of Goldman, they advised on some very large deals in the course of the quarter, so they may have a little bit of an edge in terms of the growth rate this quarter. But Morgan Stanley, very well positioned, and then of course the wealth franchise we expect from that side of the business. We've had banner equity markets and a lot of inflows we've seen to the market. So I think that's going to be very beneficial for their wealth management side of the business.
Stephen, I know you're looking for more M&A activity. It's a more benign environment. Obviously, we just had the Fifth Third Comerica announcement. Where else might we see some deals within the banking industry?
So I think the mid to lower end of the market is ripe for consolidation. We've had the 22 to 24 period was very sluggish in terms of merger activity, and so I think a fair amount of pent up demand. I think you saw that with the Fifth Third Comerica tie-up. So these are pretty good deals for banks. You have to have in this day and age a lot of volume. Having big assets is better for growth. You can leverage your expenses over a larger base. The banks are spending tremendously on technology, AI initiatives, whether it's digital transformation, whether it's cybersecurity. So to the extent that they can leverage those costs over a larger base, that's very beneficial. So I do think we're only 3 quarters into the new administration, and I think that's got some of the banks thinking about an easier time through the regulatory process, through FTC, through the Justice Department, and I think we'll see more of that activity among the banks after what was a low period for the past 2 or 3 years.
All right, and the S&P Financials Index up 10% this year, so lagging the market just a little bit. Stephen, thank you so much for joining. That is Stephen Bigger of Argus Research. Coming up, we're going to get you set up for your trading day with more earnings and the Fed Beige Book. This is Bloomberg.
world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. Bank of America and Morgan Stanley earnings coming shortly, before the bell, in fact. And then, of course, the Fed releases its beige book at 2 p.m. Eastern. We'll be scouring that to see what conditions are like across the country. United Airlines reporting its results after the market close. We're well into earnings season. So let's take a look at some of the pre-market movers then. NVIDIA leading Mag 7 stocks higher, up more than 2% right now. Nscale cutting a deal with Microsoft for about 200,000 NVIDIA GPUs across Europe and the United States. We'll be keeping an eye on shares of Microsoft. Nscale, obviously a private company. ASML rising as well after its earnings report. It says the AI boom is fueling demand for cutting-edge chip-making machines. Word of caution about China there, though. And Papa John's, well, that speculation continues. Reuters reporting of Apollo's take-private bid for $64 a share. So even with this second day of gains here, we're not at that price yet. Let's take a look at the macro picture, though, because as you can see, stocks were higher for many different idiosyncratic reasons, including earnings season, but there are plenty of risks out there still. That is not deterring futures, which are pointing higher as we enter day 15 of this government shutdown. NASDAQ 100 futures up almost 1%. I mean, we had an up day Monday, a down day Tuesday, so it's time for an up day, right? Let's take a look at yields. The 10-year was below 4% earlier on this morning. We're back above that now, 401.29. And then, of course, the VIX has been between 19 and 23 all week. So quite the elevated level in terms of what we've seen in recent times, but maybe not, you know, screaming at us that we should be in panic mode, but definitely not calm either. And I do want to point out that gold is at a record once again today, above $4,200 an ounce. Ed Yardeni saying this morning, a little tongue-in-cheek, I have no doubt, that gold is the new Bitcoin. All right, that does it for Bloomberg Brief this morning. Do continue to watch surveillance for those bank earnings and lots more. That conversation ahead. This is Bloomberg.
you know what to tell people about what the tariffs are going to do on the United States economy and the investment environment, or is it not clear yet?
If you look at the impact of the tariffs, they were much more significant and broad than I think the market expected. Looks closer to 19% on balance versus 2 and change last year. So effectively, it's a 20% increase on 10% of household goods that are imported into this country.
And do you think it's going to lead to a recession?
Well, we think that it's going to impact both inflation and the economic growth scenario. So we were coming into yesterday expecting the real economy to grow at 2%. And inflation to be closer to 2.8%. If you just go through the math, it would suggest there's probably 1 to 2 points upward increase on inflation and a similar amount on economic growth. So it could put us in a position where we're teetering.
So the tariffs will likely depress the GDP growth rate and increase inflation. So what's the advantage of tariffs?
From our standpoint, we have a hard time seeing the benefits of tariffs. They do tend to be inflationary in the short term. As you're pointing out, the longer term impact on economies is probably the greater downside.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
The real focal point right now should be on earnings.
Earnings continue to be the North Star.
Earnings are strong, but valuations are also very high.
Equity investors just forgot about the idea that there might be some short-term pain involved.
There are still risks on the horizon.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday following a volatile 3 days, tensions continuing to simmer between the US and China as Fed Chair Jay Powell is keeping October rate cut bets alive. Investors are looking to results from Morgan Stanley and Bank of America to wrap up earnings on Wall Street.
So there could be some optimism right now in this market. At the same time, you do have this cloud when it comes to the rhetoric between the two biggest economies, the latest salvo being between President Trump saying that maybe we're going to cut off Chinese cooking oil. At the same time, the hot rhetoric, government shutdown, still in a data desert, and what is Jay Powell saying, the Fed chair? Basically, time is standing still for us. We are still in September, and the bias is to the labor market.
Let's deal with China and the US first. Let's break that down. So last week it was rare earths. This week it's shipping, soybeans, and cooking oil. I'm just counting and running through the list. Is this positioning for negotiation, or is this just the direction of travel now for the rest of the president's term?
I think it's a little bit of both. Both of these economies have shown that they're willing to go for these industries that both economies are relying on, that need and the world needs when they want to get something out of a deal, an upcoming meeting with China. So we have this upcoming meeting potentially. So what are you going to do before that? You're going to increase the rhetoric. I thought the Financial Times reporting was really interesting because it talked about the fact that China brought this up in the summer and said it wasn't going to do it, and they would be prepared to, but wouldn't do it, and all of a sudden they started doing it again. China knows that that is the lever to pull when they want to get the U.S. attention when it comes to rare earths, and China knows when they want to get, especially a Republican president's attention, it's to go to soybeans.
So companies are starting to engage and make multi-year investment decisions. This from Stellantis, $13 billion. 4-year plan to invest in the United States. At the same time, check out the news over at Apple. Tim Cook of Apple over in China this week, vowing to boost investment in China. I can't wait for the White House to read those headlines to see their reaction to it.
Because what they want to see is that companies invest more just in the United States. And if anything, we've seen some companies even go more to India, which Apple has done in the past. This is what is the problem when you have rhetoric like this and destabilizing trade headlines. Companies don't know where to act. At one point, potentially, could this all escalate to a point where the U.S. is basically banning some companies to operate in China or delisting Chinese companies from the U.S. stock exchange, which is why most people say this is all a hedge. These economies are too reliant on each other, and this is the levers they want to pull to have a negotiating tool into the meeting at the end of the month.
If you are just tuning in, welcome to the program. So the state of play in financial markets, futures bouncing back, equities higher by 0.6%. Later this hour, numbers from Bank of America. Next hour, around 7:30 Eastern Time. We should wrap things up with Morgan Stanley. Coming up over the next 60 minutes, we'll catch up with Marvin Lowe of State Street as Powell keeps the door open for rate cuts. George Pollack of Signum Global as US-China trade tensions continue to simmer. And Chris Marinac of Jenny Montgomery Scott as we wrap up earnings for the big banks on Wall Street. We begin this hour with stocks bouncing back as Chair Powell keeps rate cut bets alive. Marvin Lowe of State Street is writing the following. We're on board that one should price another cut at the end of the year, even if we're still in the December pause camp. Marvin joins us now for more. So, Marvin, the more interesting call there is the December call, because October, it looks like Chairman Powell set us up for a rate cut. What is it about December, the data, the backdrop, that makes you think this Fed is going to pause?
Yeah, we still think that inflation is, part of the dual mandate that the Fed's going to focus on. Data that we're looking at, the alt data that we have access to, is showing that it's getting a little bit bubbly again in October after, really being somewhat muted throughout the summer, which was a surprise to everyone. But it's going to complicate the discussions for the Fed for sure, in our view, as they kind of get near the end of the year.
So, Marvin, why won't it complicate the October meeting? Because they probably will have CPI. They may not have the jobs report.
Yeah, I mean, for sure. So, I think most of the committee clearly is on board with at least one more cut. Whether or not there's one more cut versus two more cuts at the end of this year is something that the committee's pretty split on for the most part. So, there's no doubt that there is weakness in the jobs market that did not really make its way into the data over the summer. I mean, we kind of heard that from Chair Powell yesterday. And, within that insurance kind of cut discussion, it's consistent with what we've heard up to now, that the labor market concerns are going to be driving these short-term decisions.
Marvin, though, isn't the path of least resistance to hold in October when you don't have the data, and then cut in December when you have more of a full picture of what's going on in the economy?
Yeah, I mean, certainly that makes sense. I think from a risk management perspective, if we kind of listen to what the Fed was saying over the summer versus what they were saying in September with Jackson Hole in between, and the concerns that really started to pop up around the economy, there's nothing that has happened since September that would make those concerns less. If anything, with the shutdown, with potential impacts on consumption at the federal worker level, the potential for furloughs, that all is a strange brew that ultimately one concludes is probably worse than where we were in September, even though the Fed is saying things are, for the most part, not that much changed. If they were apt to cut, which they were, they're going to be more apt to cut it, is the way I interpret it. But, certainly what you're saying makes sense. I just think that they would rather get that one out of the way.
Jay Powell said that yesterday, and then he went on to say, and yet people are spending. Yet this is a resilient economy. Yeah. So on some levels, they are cutting into strength, are they not?
Yeah, for sure. And that's kind of the longer term concerns that, those of us that are kind of looking further out the curve and thinking about structural potential changes that really keeps the 10-year somewhat elevated relative to what you would expect during a cutting cycle. And I think that also is making its way into kind of how bond investors are evaluating all of that longer-term inflation discussion.
Yeah, Marvin, let's dig into this. I think it's worth exploring. Yeah. Do you believe the weakness we're seeing in payrolls growth is an outlier, one? And two, do you believe that's largely driven by structural factors or cyclical factors?
I think that there is a bit of both. Not trying to dance around the situation, but I do think that supply is a big part of that discussion. And if we kind of put supply into that and think that, replacement value, if you will, how many jobs have to be created without the unemployment rate increasing is closer to or below that 100,000 job level per month, the job market doesn't look as weak as what we've seen in terms of, history, if you will, and certainly within recent time. And immigration is a big part of that. So yeah, there's a structural component to it, which complicates it, which I think also plays into the discussion at the end of the year going into next year.
This is the risk, I think, Marvin, and we have to think about more the kind of upside risk that it might lead to in financial markets as well. That maybe it's the outlier, that the Fed gets lulled into reducing interest rates when the rest of the economy seems to be okay, and financial conditions are already incredibly loose. And what's interesting about the financial market commentary of the last 24 hours, particularly from the big banks on Wall Street, is that the numbers are good, but they've got concerns about valuations. The CFO of Citi, Mark Mason, said it's hard to look at how equity valuations and multiples sit today and not think there are some sectors that are likely frothy and overvalued. Jamie Dimon at JP Morgan had this to say on private credit markets: I shouldn't say this, but when you see one cockroach, there are probably more. Marvin, how are you approaching a situation where the backdrop seems to be pretty decent, financial conditions are very loose, and the Federal Reserve is obsessed over one data point, rightly or wrongly, and it's payrolls growth?
Yep. And Jamie Dimon really does have the best sayings. It really does come down to, and I keep, as a rates person, as kind of a bond person, you always come back to inflation. And there's an inflation component to that, whether it's a function of their ability to get to 2% or the volatility around inflation. Do we enter a phase where everything that you mentioned, Jonathan, creates less certainty that inflation becomes anchored? Whether it's anchored at 2% or 2.5% is part of the discussion, but just being anchored is as important. And if it's not anchored, you need more compensation around that. What we've seen from kind of institutional buying of equities is that it hasn't been as robust as what the indices would show. There's more of a buy and hold because everyone, for a certain degree, is frozen in this world where the numbers are still coming out positively in corporate America, but valuations are so high that, I'm not going to add a lot to it, but I also can't sell right now.
Marvin, so where does this leave the Fed in 2026 if you do have a scenario where inflation is becoming unanchored?
Yeah, so one of the things that I found really, really interesting, number one, is that we know that the Fed's view on where neutral is, kind of that long-term debt that we talk about, has been creeping up. But even if we look at their projections going into 2028, they don't have it going back down to 3% yet. So 5 years after the start of this cutting cycle, if you will, if we kind of take the forecast, they don't believe they can get to 3%. So I do think that we wind up finally acknowledging that neutral rate, where the Fed finally stops cutting, is not only higher than 3%, but potentially not that far from where we are now.
Marvin, enjoyed this. It's good to hear from you, as always. Marvin Lowe there of State Street, breaking down his thoughts on the Federal Reserve and what it means for financial markets as well. Later on today, plenty more Fed speak. Governor Waller speaking later on this afternoon. Remember, the blackout period begins this weekend, going into the Federal Reserve meeting 2 weeks today. As we think about inflation and the pursuit of that inflation target over at the Federal Reserve, a lack of credibility maybe. Gold up for a fourth session. Gold, record highs, up almost 60% year to date.
Gold is so high, and it's becoming this safe haven that even Jamie Dimon, who doesn't really like it, is like, I can maybe make somewhat of a case that you should maybe have it in your portfolio now, even though he doesn't love the idea of that. It's because where else do you go? Risk on in the equity markets. At the same time, tons of geopolitical fragmentation and concern, and the Fed's going to be cutting interest rates, so you're just going to pile into the precious metal.
And that's what's been happening all year. 4,200 on gold this morning, up by 1.3%. With an update on stories worldwide, let's get to your Bloomberg brief and cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, good morning. President Trump, as you've been speaking about, threatening to stop trade in cooking oil with China. The potential move comes as retaliation against Beijing for its refusal to buy American soybeans. Trump posted on Truth Social, "We can easily produce cooking oil ourselves. We don't need to purchase it from China." Trump is expected to meet with China's Xi Jinping later this month. ASML shares rising after orders beat expectations, with AI demand staying strong. The semiconductor equipment maker is citing positive momentum around AI investments and a growing pool of customers. ASML optimistic on plans to ride the AI boom in the coming years, but noting business in China will be lower. LVMH shares are surging after the company saw an unexpected return to sales growth in the third quarter. Sales at all divisions exceeded analyst estimates and demand picked up in China. suggesting the persistent sales slump in luxury is finally beginning to ease despite uncertain macro conditions. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie later this hour in about 30 minutes' time. Up next on the programme, Tough Talk.
We have to be careful with China. Look, I have a great relationship with President Xi, but sometimes it gets testy because China likes to take advantage of people, and they can't take advantage of us.
Up next on the programme, we'll catch up with George Pollack of Signum Global, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Your day ahead shaping up as follows. More bank earnings later on this morning. In about 30 minutes' time, around half an hour away, we should get numbers from Bank of America. In the next hour, 45 minutes later, should get results from Morgan Stanley. So Brian Moynihan's head pick set to report through the next 60 minutes, 90 minutes plus. Those results should wrap up earnings on Wall Street. Then later on this morning, 9:15 Eastern Time, check this out. Ambassador Greer, Treasury Secretary Scott Bessent, both speaking at 9:15 at a time where tensions are really starting to simmer between the US and China.
Obviously, this is going to be about China, and if their press conference is not, all the questions are going to be about China. Ambassador Jameson Greer yesterday was talking about whether or not that 100% tariff that the president threatened on China goes through. Depends a lot on what China does. AKA depends a lot if China decides to allow rare earths to go out and be exported into the world, including the United States. This is really the issue and the biggest chip China has on the table going into those talks.
It's whipsawed financial markets since Friday, Monday, into Tuesday's session. This morning we bounced. We'll see if it holds. Up by 0.6% on the S&P, higher by 0.8 on the NASDAQ. On the Russell this morning, positive and outperforming by more than 1 full percentage point. Under surveillance this morning, tough talks with China.
We have to be careful with China. Look, I have a great relationship with President Xi, but sometimes it gets testy because China likes to take advantage of people, and they can't take advantage of us. But we have a fair relationship with China, and I think it'll be fine. And if it's not, that's okay, too. We have a lot of punches being thrown, and we've been very successful.
So here's the latest this morning. President Donald Trump threatening retaliation against China for purposefully not buying U.S. soybeans. Bloomberg's Jack Fitzpatrick joins us now from Washington, D.C. Jack, welcome back to the program. It's been too long. Let's talk about what's on the table this morning. Cooking oil. And over the last week has been shipping, been a range of things. Soybeans been on the table for a while. Rare earths has been something in the background we've all been thinking about for the last several years. Jack, is this all positioning for leverage in negotiations at month end, or is it something more?
I think what we can say for sure is that President Trump does not want to go into a conversation with Xi Jinping around the end of the month and go towards that threat of an additional 100% tariff on November 1st from a position of weakness. His tactics on these always are leaning forward, trying to be the aggressor and not end up kind of trailing back on his heels. It'll be up to Scott Bessent and Jamieson Greer to follow up in a press conference to describe maybe in a more nuanced way exactly what their approach is. But just looking at history and President Trump's usual approach, I think it's safe to say he knows what's on the calendar in a couple of weeks, and he wants to demonstrate that he can walk away or he can inflict additional economic pain on China if need be. That's how he goes into these discussions, trying to set himself up to be on offense rather than defense.
Jack, let's just stay with the Treasury Secretary. Anne-Marie was talking about this just yesterday. The Treasury Secretary is changing his approach somewhat. He's trying to get the rest of the world on side as well going into this meeting at month end, calling on India and Europe to join them, because ultimately some of the decisions that China is making, particularly around rare earths, won't just punish the US, it might punish everybody else too. Jack, is that going to be the strategy into month end?
There's a lot to keep track of going towards the end of the month, and you're right that it's up to Scott Bessent and everybody else in the Trump administration to figure out how to align the broader tariff and trade strategy with a focus on China. That is a difficult task. I will say it's difficult to read into President Trump's comments and his approach on China and apply a distinct logic to everything else that goes on in the big picture, because we know how significantly President Trump is focused on kind of man-to-man discussions. He wants that meeting with Xi Jinping. I wouldn't necessarily read into his comments and his approach going towards the end of the month as if he has a distinct vision for how he wants Scott Bessent to carry out his approach on India and the rest of the world. The way Trump usually focuses on this is how can I go into the discussion I want to have with the other principal in the position I want to be. It creates a lot of chores and a lot of complex work for the people around him, but that's his approach, and I'm not sure necessarily that the president himself has thought of how he wants to approach India and other major countries vis-a-vis his comments on China.
It's a very different approach. Jack, appreciate it. Jack Fitzpatrick there of Bloomberg down in Washington, D.C. Anne-Marie, you know well, you go to these meetings often. Typically, the diplomats get together months ahead of time. They hash out the whole thing 99% of the way. The leaders turn up and they sign off on the thing. The president has a very different approach, and it generates the results others can't generate, particularly the Middle East, a great example of all of that. What kind of results is it going to generate when he sits down with the Chinese leader later this month?
I think the base case is because the current truce on the tariffs expires November 10th. They'll be meeting before November 10th. I think the base case that these two leaders meet, they say more work needs to be done, but there's an extension of the truce. Maybe they come out with China buying some more soybeans and a little bit more of a lifting of restriction on rare earths. I think that could be a base case scenario. But the president is setting it up also to escalate on a much more different approach. And your point about Europe, Germany is finally saying they are concerned about these export issues. They are talking on the national level and the EU level, but will they do anything about it is the question.
Joining us now is George Pollack of Signum Global. George, welcome to the show. The focus, quite rightly, on international issues in the past week, particularly a fantastic success. Could be a crowning moment for the president in the Middle East. Next up is China. Back home, we've still got a government that's shut down. George, are we just ignoring what's happening at home?
I don't think we're ignoring it. I think it's very much omnipresent, especially if you're flying in an airport, if you're interacting with the government whatsoever. What I think is the administration has understandably been focused on the Middle East this past week, and now whether that seems to be in the past, they're going to turn and now see a more explicit focus on resolving the shutdown.
George, you think it gets resolved by November 1st. What are the pressure points between now and November 1st that get this shored up?
The biggest pressure point by far is the notion that healthcare enrollment opens November 1. And while that doesn't mean you have to enroll that day, we're going to see millions of Americans exposed to the reality, either that they don't have healthcare insurance coming next year, or that their premiums are going to go from $300 to $1,000. And for the president who's been so focused on prices, that's just not a that's not a solution he can accept.
So what's the off-ramp? How do they actually open the government?
I think the reality is the off-ramp has to be some kind of climb down from both the Democrats and Republicans. Democrats have to understand they're not going to get a comprehensive subsidy deal while the government is shut down. Republicans don't want to give that, and they don't want to incentivize further hostage taking in the future. Republicans have to understand that they need to give Democrats something once the government reopens, and that's a substantial and real negotiation on the future of these healthcare subsidies.
At the same time, the president, he was doing this yesterday, was talking about potentially more of these furloughs becoming permanent layoffs. And he says that these would impact people that are working on democratic policy objectives. What is he talking about?
Between you and me, it's something that I don't really understand as to what he's talking about specifically, because these programs impact all 50 states, and when he impacts one House district, he's impacting an entire state. When he impacts a whole state, he's impacting Republicans. The past projects they've threatened and the past firings they've done have impacted horribly moderate House Republicans who are crucial to keeping the majority. So while they're saying they're targeting them, in reality, there's unintended consequences that include Republicans taking the fall for their state losing money and their state losing jobs.
We saw that yesterday. We had Congressman Mike Lawler on the program, and of course they froze billions of dollars of infrastructure spending in New York, and that's going to be impacting the congressional district he sits in and represents in Westchester. So do you view this all as threats to try to get moderate Democrats, especially in the Senate, to vote for the clean resolution?
That's exactly what this is. This is basically, I know you have a ton of federal workers in your district and your states. If you don't vote for the CR, we can make it that much more painful. And you've kind of seen that take an effect. Yesterday it was reported that the likes of Angela Alsop-Brooks in Maryland, the likes of Ruben Gallego in Arizona, these states with heavily federal presence of federal workers are talking about making a way out of this shutdown. They see this as a significant vulnerability, and they want to address it before the damage becomes even more permanent or more severe.
Hey, George, it's got to get your thoughts, as always. George Pollack there of Signum Global. George, thanks for joining us. George, not alone. Many people like George thought this would end quickly. Secretary Bessent managed to maneuver things to make sure the military gets paid in the middle of this month. It's going to be the next day in 2 weeks' time that might be the crunch point for many.
That's going to be a problem. They can get enough funding together and move some funding around budget so they get the payroll done by October 15th, but what happens on October 31st? Great point there by George about the Maryland senator, though. Maryland has 2 senators. Virginia has 2 senators. They're all Democrats, obviously. These are the areas where the federal workers are really going to be calling their constituents and say, okay, we want to get paid. You need to reopen the government.
Are you starting to see the cracks?
We are. I think you're starting to see the cracks for some of these moderate Democrats. So I understand why George thinks potentially it could be November 1st. But if the Trump administration is able to maneuver some money for critical and essential individuals, maybe it can go longer.
The government shutdown continues here on Wall Street. The volatility continues as well. Friday, Monday, Tuesday. This morning so far holding steady, up by 0.6% on the S&P 500. Coming up this hour, we'll be catching up with Jill Ford of Wells Fargo on the IPO resurgence. What a year so far. We'll get into the numbers in just a moment. Plus, Yahira has your morning movers. Papa John's shares jumping on reports that Apollo has submitted a bid to take the pizza chain private. That stock in the pre-market is higher by almost 12%. Papa John's up by 11.65%. Live from New York City this morning. Good morning to you all. You're watching Bloomberg TV.
Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Live from New York City, welcome to the program. 3 hours away from the opening bout, a price action shaping up as follows on the S&P 500. What a 3 days. Friday, Monday, Tuesday. Friday, the biggest one-day drop since April. Monday, the biggest one-day rally since May. Tuesday, an almost 2 percentage point swing on the S&P 500. Just about finishing the day down. On the S&P 500, positive by 0.6% on the S&P. On the NASDAQ, up by 0.8. On the Russell, up by 1 full percentage point. And we'll see if these gains hold across the board in the equity market. Turn to the bond market. 2-year, 10-year, 30-year bond yield shaping up as follows. 2's at 347, close to multi-year lows. On a 10-year, I don't think we've had a close with a 3 handle since April, so look out for that. The 10-year just north of 4% at the moment, down by 2 basis points on the day. And let's finish on gold. The rally for the year. Only a second ago, we were up 50% year to date, and now we're up almost 60. 4-day winning streak, up another 1.4% so far this morning.
And a lot of strategists are saying this is just going to continue into next year, potentially 5K on gold next year. I was actually shocked by Jamie Dimon saying he could maybe actually kind of make a case now for putting gold in a portfolio. Someone who would say, never do that. It's not worth it. But look what's going on in the world. You have really hot rhetoric where a lot of unknowns are what's going to happen at the end of the month with this meeting between Xi Jinping and President Trump. The Fed doesn't have data, but they're still cutting interest rates at the end of the month. So if it's risk off, you're a little bit nervous. Why not put in the precious metal?
The data they will have will be CPI on October 24th, and inflation may well print 3%, and they'll still be cutting. Gold's at 4,200 at the moment. We'll come back to that story later. Bank earnings on deck, remember. Bank of America should drop in about 15 minutes' time. Then we're waiting for Morgan Stanley 45 minutes after that. So that's your setup for the next hour or so. Let's get you some single names, some morning movers this morning with Yahara Arnott. Hey, Yahara.
Hi, John. We start with NVIDIA. Shares are up nearly 2.5% as Microsoft lines up another buyer for its chips. Nscale, an AI data center developer, will build a site for Microsoft in Texas where it will deploy more than 100,000 of NVIDIA's most sophisticated chips. And just to highlight the demand here, this is the 4th deal we've seen between Microsoft and Nscale in the past 2 months. Meanwhile, moving on to Bloom Energy, that stock also popping nearly 5.5% in the pre-market as UBS hiked its price target to $115, though. As you can see, we are trading above that. It comes as analysts have rushed to raise their price target after the stock saw a 27% pop on Monday after Brookfield unveiled an investment of $5 billion in the company. And from tech to pizza, we end on Papa John's surging 12% in the pre-market on a Reuters report that within the last week, Apollo submitted a $64 a share bid to take the pizza chain private. No deal is guaranteed, but it does mark a trend with these private equity firms buying up these restaurant chains from Subway to Jersey Mike's for steady cash flow despite their thinner profits. John?
Yahara, thank you. Appreciate it. More from Yahara in about 60 minutes' time. On our radar this morning, more bank earnings on deck. Bank of America, Morgan Stanley set to report. Investors watching for strong results and profits in trading and deal-making. Elsewhere, ASML shares rising on stronger than expected orders for the third quarter, with bookings hitting $6.3 billion US. The company seeing sales for next year holding steady, fueled by the massive boom in AI infrastructure spending. And finally, President Donald Trump threatening to cut off imports of cooking oil from China, retaliating against Beijing for its refusal to buy American soybeans. Trump calling China's refusal to buy those soybeans, quote, an economically hostile act.
So it looks like the cooking oil would be a direct response to soybeans. I don't think anyone thinks they're going to put soybeans and rare earths and chips on the same sort of table. So cooking oil, soybeans, maybe they can work that out. It's going to come down to these rare earths. Will China be willing to lift some of the restrictions they put on their rare earths? We are talking about the fact that China owns the market. They own the rare earths, they process them, they sell them. It is more than 75 to some of these, it's 95% of the market. And it's not just hurting the United States, it's hurting everyone that is a buyer right now.
The president's approach typically is escalate to de-escalate. And we've seen that play out fantastically well in places like the Middle East, particularly the developments of the last few months and particularly this week. With China, this time around, it feels different. And Peter Chiav talked about this. This time, it's not the US doing the escalation. In the last week or so, it's China doing the escalating. And you just wonder how that complicates the president's strategy into month end.
Well, it sounds like Xi Jinping maybe picked up a copy of Art of the Deal and is trying to match Trump in terms of how he negotiates. I think at the end of the day, both these leaders know how intertwined their economy is. But remember Trump's first administration? It took 18 months just for agricultural purchases. Do we really think they're going to be able to nail down a host of issues that go way beyond soybeans in just a matter of months? Potentially, that's going to be challenging. They could meet, but these talks could extend well past their meeting.
For those of you tracking this story, if you're looking for an update, we should get one around 9:15 Eastern Time. Scheduled to speak, the Treasury Secretary, Scott Bessent, alongside Ambassador Greer, so look out for that in a few hours' time. Let's turn back to markets. EY reporting the global IPO market rebounded in the third quarter, rising 19% year over year in deal volume, with the US leading the way. Jill Ford, co-head of equity capital markets at Wells Fargo, writing the IPO market is now past volumes we saw for the whole of 2024. September is the best volume month since the final manic innings of 2021. Jill joins us now for more. Jill, good morning.
Good morning.
It's good to see you. Let's talk about the numbers. Just how stunning has this been for you and the team?
Well, you know, I was here, and thanks for having me back. I was here back in July, and I was, as you could tell, wildly optimistic about what 2025 was going to have in store for ECM, particularly around IPOs. The IPO market was beginning to thaw. There was a nice diversity of IPOs coming out, different sectors, different market caps, different growth profiles. And it was finally at a point where buyers and sellers were coming together and finding common ground. And the deals obviously traded great. The IPO cohort for 2025 is right now up 35%, double what you could get in terms of the S&P or the NASDAQ. All of that has come to a bit of a halt in October. You know, we saw 16 deals come from Labor Day onwards. As you mentioned, September, the largest volume month we've seen in quite some time. And now we're sort of stepping back, but there's a couple of wrenches in the plan, and people are wondering whether or not the last couple of months, which are always challenging in terms of windows to get out, might prove to be, you know, not as fertile as I hoped, and push some people into 2026.
We'll talk about some of the wrenches in a moment. You mentioned diversification. How diverse were some of the listings? Because typically all we hear about now is AI, AI, and more AI. Is it more than just that?
AI certainly sucks all the air out of the room. And it's not just AI itself. It's, you know, the broader tech landscape around AI. It's energy to fuel AI. It's real estate. There's so much that touches that theme. And I think people are not only looking at the picks and the shovels and, you know, the actual moat around the technology, but all of the ecosystem that goes around AI. So that in and of itself is a very investable theme. But beyond that, you've seen insurance services, you've seen fintech, you've seen obviously around the crypto infrastructure as well. You've seen things that are quite boring come out that people want to buy. And there's all different types of investors who are looking through different lenses as it relates to their portfolios. I've been really encouraged by not just the diversity of companies, but the diversity of buyers who have come to the table as well.
The volume is just so stunning from where we were this time last year. Is it all down to the regulatory environment in Washington?
It's a couple of things. One is we've had an incredible backdrop, very low volatility, Broadly speaking, the VIX has been quite low. Markets, everyone sees the markets marching up, but up until this past Friday, we had not seen a move of more than 2% since April. So every time things got a little frothy, they came back down. Every time there was a dip, there were people in to buy it. And that is an incredible backdrop for IPOs who have to be out for 7 or 8 days. Fast forward to October 1st, we're now in a place where, there's the trade rhetoric that you mentioned, which is causing people to take pause going into year end. And then, of course, the government shutdown puts a lot of people on ice. There are 2 camps of companies that are in different stages of coming public. One who have comments from the SEC, who are considering their options. They're limited, but they have options. There are others who need the SEC to be open to move forward. They're likely, if we don't see some movement soon, going to be forced to push into next year.
Well, the shutdown on Trump 1 lasted 35 days. Is there potential that maybe people just put everything on ice until next year and we have another kind of frozen IPO market from now until year end?
I think it will, if the SEC does not reopen, it will be muted, certainly. There are ways for certain companies to get out. There's a 20-day rule where they can declare a price range and a size, which is tricky, right? 20 days is a long time in this marketplace to be out there exposed, and you whittle down your options in terms of where you can ultimately get done. But there are ways to get out. It's for the companies that were a little bit further behind those, in terms of getting comments back from the SEC, that will see their options push forward into next year.
Can we finish on longer-term trends, just briefly? Private for longer is a phrase we've all heard a lot of. Private for longer. And you heard Jahaira about 5-10 minutes ago talk about the potential for Papa John's to become a private company, given the reports of Apollo's potential involvement. How are you thinking about that concept? And is that a concept that you're challenging? Private for longer. Companies going private. Public companies reducing the number of them.
It's all about options. I think many private companies have access to a much deeper investor base than ever before. And so if it works within their growth strategy and growth plans to have that private capital to put off, and what I call it is treading water until you go public, those are incredible options. And there's lots of different ways to skin the cat with respect to privates. It's not just your plain vanilla crossover round that exists today. I think ultimately for many of these companies, they're big companies. They will have voracious appetites for capital, and the public markets are the ideal place to do that. So I do think eventually, again, the pipeline is massive. We've seen a muted IPO volume for years. We're now starting to see people get shaved off into next year. There will be a long time where people need room to access the window that exists, and staying private for longer is certainly an option for many of them.
Treading water. Tells you there's an inevitability about them ultimately becoming public with that phrase.
Right. I love that idea of they're treading water. But you have to think, if you are a corporate executive and you saw what the regulatory environment was under the Biden administration, you do all this work. Trump comes into power. You basically want to get in right in the beginning. But if you're nervous about trade headlines, shutdown, maybe you wait a little bit. But this looks likely is going to persist.
Jill, it's good to see you. Thanks for dropping by.
Thank you very much.
Appreciate the update. Jill Ford there of Wells Fargo. Let's get you an update on news worldwide with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. It is day 15 of the U.S. government shutdown, and President Trump is renewing his threat to cut federal programs. He says he'll have a list of priorities headed for the chopping block this Friday. The Trump administration has already terminated more than 4,000 federal workers and suspended funding for clean energy and transportation programs in Democratic-run states. There could be an upset in the race to become Japan's new prime minister. Surprise candidate Yuichiro Tamaki could get the backing of 3 opposition parties who met earlier today. It would prevent the governing LDP from taking the premiership again after its ruling coalition collapsed. Tim Cook is betting big on China, pledging to boost investment despite the ongoing U.S. tariff threats from President Donald Trump. The Apple CEO met with China's industry minister today, who urged closer cooperation with local suppliers. Apple still leans heavily on the country for iPhone production, even as it diversifies some manufacturing to India and to Vietnam. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the program, resilience on Wall Street.
Markets have been very resilient in the third quarter. We expect over the next 12 months, you'll see a real pickup within the banks, more mergers and acquisitions, especially if rates continue to trend down.
That conversation up next with Chris Marinac of Jenny Montgomery Scott, plus Scarlett Fu breaking down the results in just a moment. From New York City, you're watching Bloomberg TV.
key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg. Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Anand in Bangkok. This is Bloomberg.
Stocks are up this morning by 0.6% on the S&P. On the Nasdaq 100, bouncing back by 0.8%. Bank earnings coming through this morning. Bank of America just dropping. Morgan Stanley coming up later. Let's get to these results. The stock is up by more than 2%. Scarlet Fu, I see a lot of beats this morning from this name.
Yeah, and we're getting a beat here on the most important line here for Bank of America, and that is net interest income. That is, of course, the difference between what the bank makes the difference between what it lends out and what it spends on deposit. And that is a key measure here for this bank because of its massive consumer presence. $15.23 billion versus the consensus estimate of $15.03 billion. And this kind of sets up Bank of America for its investor day next month, where it'll kind of guide out what it sees in terms of net interest income going forward. Helping to underpin that net interest income number is loans. Loans coming in higher than anticipated, $1.17 trillion, while total deposits did miss by just a hair. $2 trillion versus the expected $2.02 trillion. And continuing with the theme of markets trading revenue and investment banking revenue beating, we certainly got that with Bank of America here too, with trading revenue at $5.35 billion, better than the anticipated $5.01 trillion, as well as investment banking doing better than expected, $2.01 billion, whereas analysts were looking for somewhere in the neighborhood of 1.6. Just to keep in mind here, some of the provisioning for downturns in the economy and bad loans. We're looking at provision for credit losses of $1.3 billion, which is less than what analysts had anticipated. They were looking for $1.61 trillion. So again, this is a good news story here for Bank of America, especially with that net interest income number. And the stock is being rewarded up 3.4% in pre-market trading after yesterday gained 2.5% following day one of bank earnings. John?
Scarlett, this was great. Thank you. Scarlett Fu there of Bloomberg. Scarlett's going to be back with us when we get numbers from Morgan Stanley in about 42 minutes' time. So this is a beat on wealth, investment banking, beat on trading revenue, beat on net interest income, upside surprise across the board here. Net interest income for the third quarter, $15.23 billion, the estimate $15.03 billion. Put it together with yesterday, JP Morgan also beating estimates. Citi, revenue beat in every single division, and it was a record third quarter for the likes of Goldman Sachs. That stock this morning now, off the back of these numbers, up by 4%. Chris Marinac of Janney Montgomery Scott writing the following: themes for the quarter are resilience in bank earnings as the investment banking and trading areas create plenty of additional revenue for any credit issues. Chris joins us now for more. Chris, welcome to the show, sir. What a morning. Thanks, what a 24 hours for bank earnings so far. Chris, you said credit issues. How many credit issues do you see?
Well, for B of A, it's very limited this morning. They had a very small change in past dues. They had non-accrual loans behave very well, and the charge-offs were excellent. So, you have to like what they did in the quarter. I think if you see problems, they did not emerge as of 9:30. So it's very encouraging on these credit details.
What do you make of what's going on in credit, though, overall? Jonathan earlier in the morning was talking about this Jamie Dimon quote about if you see one cockroach, there's probably more on the way. Mark Rome was talking about how it does not surprise me that we're seeing late cycle accidents. A desire to win competitive markets sometimes lead to shortcuts. Do you think this is going to become a problem in the years to come?
Well, I think you're going to see incremental issues, and I think so. Will you see more problems? Yes. Is it something that the banks can defend with earnings and existing reserves and capital? That's also yes. So I think that they can handle this quite well. But it's like the weather changing. It's not going to be sunny and 75 degrees outside any longer on credit. We're going to have a few issues. And as we transition into fourth quarter, first half of next year, I do think you'll see more. It's just that the charge-offs have not been that great in the industry, and the banks continue to earn a lot of revenue to cover any shortfalls on credit as they emerge.
Well, it feels like it's sunny and 75 degrees this morning for Bank of America. Even when you look at advisory revenue, this is coming from the banking side of the house, what's going on in the IPO market. We just spoke to a guest about. Revenue came in at $583 million, well above what analysts were expecting. Chris, is that where these businesses are really driving this growth in revenue?
At this time, yes. I think that the spread income at the bank could come back. We still haven't seen enough loans go on the books at the regular way bank business, but I think on the capital markets and trading side, it is very strong with a very good pipeline ahead.
This stock looks good this morning. Bank of America higher by more than 3%, Chris. Just to go through the numbers again, revenues, profits growing across every segment, revising guidance for net interest income to the top end of the range as well. So a good story to tell for the likes of Bank of America. And Chris, maybe a good story to tell at Investor Day. Investor Days aren't something that we typically see from Bank of America and Brian Moynihan. And a few weeks ago, we saw a bit of a reshuffle for the leadership beneath him, just a reorganization, if we can call it that, Chris. How pivotal is this moment for this bank, Chris? What are you looking for?
Well, the company wants to have a comeback, and I think as they transition, they want to try to be another alternative to JP Morgan in the marketplace. So the Investor Day is very important. I think the reshuffling of management is always a good idea to continue to put their best foot forward. And I think the results today speak of volumes of what the company's trying to do.
Morgan Stanley's coming up next, Chris. Based on what we've heard so far, I imagine it's a sign of things to come. Is that fair?
Yes, sir. I think you will see a repeat at 7:30.
Goldman Sachs already behind us, good. JP Morgan, decent. Bank of America, great. Morgan Stanley, the same again, according to Chris Marinac. Chris, I want to talk about the regional players with you as well. Big change in the past few weeks. Fifth Third, taking out Co-America. And we expect to see more. It's really, really strange to see M&A benefit everyone, Chris, including the banks, because the banks are getting together themselves. How much of that kind of action will you see in the next 12 to 18 months?
Well, typically one deal begets a second, begets a third. So I think the question is going to be, will we see something before year end? And we may not, but I think we will see more as 26 develops. There is a gap between regional bank pricing and other bank stocks. And so that gap in terms of valuation is what led to Fifth Third buying Comerica, doing it on very good terms for book value and earnings. I think you can repeat that with other transactions. We have a very clear regulatory highway now to do M&A, and that's going to work at all ends of the spectrum, at the regional level, at the mid-cap level, and beyond. So I'm very encouraged by what we saw with Fifth Third, and I think you will see more of those repeated.
As we talk about Bank of America, looking at Morgan Stanley, could they be buyers when it comes to what's going on in the M&A and the consolidation in the banking sector?
I see them more as advisors on deals in the bank sector. I don't see them as a buyer. They could be buying elsewhere in the financial ecosystem to boost up other parts of their scale. But I think the regional banks will primarily be the consolidators, along with other mid-sized banks who are trying to graduate to the $50 billion level.
And then the big banks will just benefit from being these advisory firms. Chris, is there a sense in the banking industry that they would need to get this done when it comes to the M&A opportunities while the regulatory environment is on their side in Washington?
Well, sure. I think the window still is 3 years long. I mean, we still have plenty of time to do it. So I think the reality is as companies can have their stock prices improve, earnings continue to accumulate capital builds, you can see more M&A. That's why this is not just a fourth quarter or first quarter of 26 event. It really happens over multiple quarters, in my opinion. And I think the more that these companies have stronger earnings and capital, it just affords them the luxury of considering these strategic deals.
You look at these earnings and you wouldn't think that there's a tremendous amount of clouds on the horizon when it comes to trade policy with the world's two biggest economies, that the U.S. government is shut down. Chris, how do you look at these banks going forward as they deal with a number of risks, especially when it comes to the uncertainty out of Washington?
So the biggest change in my career the last several years has been lower leverage. The banks are simply not putting the same leverage out as other private capital or even insurance companies in real estate. So that low leverage is going to give them a less charge-off number as we go through time. Yes, they will have bumps and bruises associated with lending, but I don't think you're going to see the losses be anywhere near as high as we saw 15, 20 years ago. And that's going to build more confidence with investors that the banks actually know a lot more of what they're doing in this cycle, and they can limit the losses and continue to build returns. I think the compounding of bank capital is very strong, and that's also going to feed off of the M&A cycle.
Hey, Chris, it's good to see you. Thanks for jumping on. Chris Marinac of Jenny Montgomery Scott. He's going to stick with us as we wait for those numbers from Morgan Stanley, so stay close. Morgan Stanley about 35 minutes away. Bank of America just dropped in moments ago. Numbers really decent across the board here. Investment banking fees up 43%. That's been the theme at the moment. It's just beats across the board. If you're worried about credit quality and what's happening with credit and some of those issues, I know it's a massive focal point, particularly given the issues over the last few weeks with First Brands and Tricolor. This came from PNC just moments ago. Decent numbers from them too. Here's the quote from the CEO. Credit performed well, and we continue to build on our strong capital levels. So we're not seeing these scary signals come from a variety of the banks that where you'd sit here and say there's something to be worried about here in a big way. You have these idiosyncratic issues, and I think we're just hoping that we're not going to see more of them. But I do think we got a dose of reality from Jamie Dimon when he turned around yesterday and said, when you see one cockroach, there may well be others.
And he said it wasn't our finest moment. Clearly, this is something that they certainly regret. It doesn't feel like it's systemic, but you do see top financiers, top CEOs talking about the fact that there is a little bit of a warning sign here.
Up next on the programme, we'll catch up with Steve Orth of Federated, Tobias Adrian of the IMF, Tony Rodriguez of Nuveen, and we get more bank earnings. We'll catch up with Chris again in just a moment.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. Let's talk about this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They everyone should be happy. Something to eat and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress. I changed during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human beings, for the world.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Looking across at the macro outlook, we're still feeling pretty positive.
The gap between where GDP is and where the jobs market is, I think, is the key issue.
With the Fed's focus on jobs, they cut 25 basis points in October.
It's not entirely clear what would catalyze the Fed to change its view.
To a certain extent, we are flying blind right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now with numbers from Morgan Stanley just around the corner, about 30 minutes away. Equity futures higher, session highs up by 0.6% on the S&P. What a volatile 3 days. On Friday, the biggest one-day drop since April. On Monday, the biggest one-day rally since May yesterday. A 2-point range on the S&P 500. Just unreal stuff. This morning, up by 0.6%. A helping hand coming from this name right here. Bank of America in the pre-market higher by 3.8%, following some really strong numbers from that bank. Beats across the board.
Beats across the board. Bank of America really firing on all cylinders. The banks are just crushing it. If you put this together, what we heard yesterday from JP Morgan, on track for another record year of revenue. Goldman Sachs notched its best third quarter results on record. Citigroup, the best performing U.S. bank stock right now with this turnaround plan with Jane Fraser, which for a while Citigroup was dealing with a ton of regulatory issues in Washington. The banks are crushing it across the board. Obviously, everyone is talking about, though, what potentially the risk is, and that's the cockroach.
The bar getting higher and higher. Morgan Stanley, about 30 minutes away. Later, make sure you don't miss this. I think it's worth watching, particularly given the tension between the US and China and how that's driven markets over the last 3 sessions. Secretary Besson, Ambassador Greer, 9:15 Eastern Time, set to speak together as both sides, the US and China, position for leverage ahead of negotiations at the end of the month.
And that'll potentially tell us how we're going to close today, depending on what those two individuals say regarding this relationship. They are still working towards this meeting between the two leaders, but every single day there's a fresh salvo from Washington or Beijing, and the rhetoric just keeps getting amped up. Last night, it's cooking oil because of what's going on with China shrugging off American soybeans. Earlier this week, it was ports, sanctions on a U.S. subsidiary of South Korean ports. Last week, it was rare earths. This is just going to continue. The knob is just going to be dialed up even more as we get towards the end of the month.
If you are just joining us, welcome. Equity futures session highs up by 0.6% on the S&P 500. Coming up this hour, Steve Orth of Federated Hermes as Bank of America beats estimates. Chris Marinak of Jenny Montgomery Scott with Morgan Stanley numbers coming up next. And Tony Rodriguez of Nuveen as Powell puts the Fed on track to cut interest rates. We begin this hour with stocks finding a firmer footing as big bank results roll in. Steve Orth of Federated writing the following: it is possible that many companies will fail to beat whisper numbers of bigger than expected beats. This could cause some modest pullbacks for the stock market and for the market generally. Stephen joins us now for more. Steve, good to see you, sir. Good morning.
Good morning.
Thanks for being here. You said earlier this year, tie yourself to the mast, close your eyes, shut out the noise, and just keep moving forward with the ship because it's going to be okay.
Yeah.
Is that still the approach?
Yeah. We actually just set at this time of the year, we always set our 2-year target. We have a 1-year target also, but I'd like our clients to think forward a little bit further. That's kind of our horizon. We've got a 2-year target on the S&P of 8,600. And we don't think it's unrealistic you'd get there. You have a GDP that's reaccelerating next year. You've got multiple drivers of that we've talked about extensively. You have an AI industrial revolution going on that we think is very, very real. And importantly, and this is a key element of our forecast, is we have margins expanding on the S&P. And, you know, most people at this time of year tell us that we're at peak margins. How many times have we heard that? So I had my guys go back and check this. We have relentlessly expanded margins on the S&P. Okay, 1 or 2 years you might dip a little bit, but the trend has been higher every year. And we think that's a combination of the mix of the S&P shifting towards higher margin, higher cash flow, lower asset businesses that just have higher margins, and productivity enhancements, which are increasing partly due to policy and partly due to AI. So when you add that all together, it's pretty realistic, frankly, to see earnings on the S&P by 28, which is where we'll be looking at in 27, getting close to $400 a share.
Talk to me about the multiple. When you describe the mix shift, what kind of multiple does that mix shift warrant?
So this is another heuristic that we've been talking about on this show for a while now, but that really, I think, fails people. The heuristic is, a fair multiple for stocks is 18 times. And in a 3% inflation environment, that's roughly been the case over a long period of time. But that's when the S&P was largely an industrial and financial index. If you adjust for the mix shift of the S&P over the last 5 years, where it's now largely a tech index, these are businesses with high cash flow, high return on investment. They're clearly, mathematically, worth a higher multiple of earnings. And when you adjust for that dynamic, we think the right multiple on the S&P is about 22 times. So we would say it's fairly to cheaply valued right here. So we're using 18 for the everything else, and we're using 25 to 28 for the Mag 7, if you will. And we get to a fair multiple of 22. So I think those two things are what make us more optimistic. And I think they're actually quite realistic.
I just want to say this up front, that the following statement are not my words. It's John Stolfus of Oppenheimer. He said the boomer mentality was holding people back and keeping them out of the market because of what you just said. Is that what you're confronting on a daily basis with investors?
Yeah, I mean, so many investors, you know, this is one reason why we've been talking about a secular bull market. You know, by a secular bull, I mean a market that does 10x over 20 to 30 years. You get only one a generation. I mean, we've only had two up to now. We're in the third one. I'm counting the move from off the Great Depression lows. We had a 20-year run, then the move off the 73, 74 crisis, which ended in 99. And then in 2013, once we broke through the old highs, we started this new secular bull. And one thing you always need to have is you need some sort of an industrial revolution happening. We've got that. And two, you need to have people have nearly lost their shirt in a historic way as the base, because that creates the wall of worry that's very hard. And you mentioned it, the boomers. A lot of boomers got almost wiped out in 07, 08. It was scary.
They're conditioned by that.
Yeah. And then you have, you know, that's why you have these corrections along the way that just reinforce that fear. I mean, look what happened in late March, early April. Even Wall Street was running for the exits. And a lot of people raised cash. And now we've got this wall of cash. Everyone is very anxious to get back in. They've realized they're wrong, but they don't really want to say it. And that's why the corrections, I think. I mean, we've had a 30% move here without a 5% correction. That's like almost unprecedented over 6 months. So, you know, we're feeling that there probably should be some kind of a pullback. My guess is it'll be lighter than you think because, you know, because so many people are anxious to get back in. And we put out a piece this week that listed 6 ways you could get a pullback and, you know, thinking through each of them. And, you know, some are obvious, like, you know, the Fed shutdown goes longer than thought, but a lot of them are self-correcting. I mean, you know, if the government shutdown goes much longer, the pain on either side is going to be so high that you know they're going to have to come back to the table. The ones that I think could be more serious are China. I think, frankly, the comeback this morning on cooking oil was actually an attempt to de-escalate, because cooking oil is not really important to China. So, in a way, they kind of pulled a thing there that's like saying, hey, by the way, we do have other things too, but let's try to de-escalate this talk. But I think Xi's use of his one real ace, which is rare earths, I think that was a mistake on his part. I think even the Europeans are thinking, well, we have to figure out another way. We got to detach ourselves from these guys, and it's going to take time. So we'll have some sort of interim deal at least, but we're probably on a program to get out of that. We can't have China controlling the rare earth production. So
If this is your case about the potential choke points to the one big beautiful world in your piece, and trade you think potentially is going to offer the biggest headache, from now until when these two individuals meet, is that going to be an opportunity for a catalyst for these people that are sitting on cash to get back into the market?
Well, we're seeing that, right, Anne-Marie? I mean, we had a pullback on Friday, again on Tuesday, and money just keeps coming back in. So we'll see. I think if they come away at the end of this month with a kind of divorce, which I think is highly unlikely, but if they do, then we could have a more serious correction.
If you're so nervous about China's hold on rare earths and they're dictating what they're going to basically be able to export to the rest of the world, do you think the U.S. is having the right approach by having equity stakes in companies that are important for national security?
Yeah.
You don't think it distorts capitalism?
Well, I'll distort capitalism in this case because we need to have rare earths, right? And what Trump understands is the Chinese were subsidizing rare earth production, and they drove the U.S. and European rare earth producers out of the market, basically. They underpriced the market and drove them out of business. So it's such an important element of almost everything in the economy, including our military. I think it's the right call here to say, look, whatever is the Chinese are going to do, we're going to support production of this key element of what it takes to, because otherwise you're in a real vice grip.
If free markets and open trade only works if everyone embraces free markets and open trade. And China over the last few decades did not do that, which is why you've seen the Republican shift in the last 5-10 years. They're willing to sacrifice elements of capitalism at the altar of national security. Yeah. I think President Trump has led the way on that.
And Steve is exactly right. The big issue, of course, is what it means for the supply chain to the U.S. Defense Department. Almost every single weapon has these rare earths in them, and that is why it is a challenge when China has 90% of the market.
There's a few contradictions that kind of make me laugh, but one of them is the auto market over in China. People will say that tariffs don't work. They'll be the same people that celebrate the auto market over in China. Yeah. Just try and sell a BMW 20 years ago into China.
Impossible.
They were all pushed to go in there and produce there, and now everyone's celebrating the auto market in China. That's quite a contradiction, isn't it?
Yeah, and what we're thinking and looking at here, Jonathan, is we're thinking that post the settlement of this, let's call it the near-term plan for these economies to detach, which will take 3 to 5 years, which companies have major exposures to China? And, how is that going to play out? I think it's not a surprise that you see Apple today making a big investment in China, because they're one of the companies in the S&P, big ones, that have major China exposure, Tesla being another one as an example. So they're going to have to play both worlds. Apple's China investments, I can assure you, are not to export from China. They're to keep a Chinese market. They need it for their revenue base. So, that's possibly a viable option. But this is going to be one of the things you're going to have to sort out here is who really depends on China, because that's going to be, I think that market is going to be kind of increasingly separated from the rest of the world. I think it's partly, I think even the Europeans kind of woke up over the weekend when Xi pulled this.
Yep. Took long enough.
This ace, that he thought, well, let me play this card. See, and Trump's known he's had that card. That's why he's after Greenland. So, you know, he didn't need to do that to make. But I think it was a mistake. I don't know. I'm not at the table.
But this was fun anyway. Steve, it's good to see you.
Yeah, likewise.
Thanks for sharing the 2-year view as well. Appreciate it. Steve Orth there at Federated. Thank you, sir. Let's give you an update on news worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Shares of Bank of America rising after the bank reported net interest income for the third quarter that beat the average analyst estimate. Revenue came in at $28.1 billion, an uptick of 11%. B of A was also helped by the huge surge in deal-making in the quarter. Advisory revenue came in at $583 million, and that was well above the nearly $447 million estimate. Dollar Tree sales have slowed after it raised prices to offset costs of President Trump's tariffs. Same-store sales rose 3.8% so far in the third quarter. That compares to 6.5% in the previous quarter. The discount retailer says earnings per share is expected to grow by a high teens percentage next year due to cost benefits. JP Morgan CEO Jamie Dimon saying he will offer to help Democratic Socialist Zoran Mamdani if he becomes the mayor of New York City. Despite voicing skepticism about Mamdani's plans to raise taxes on corporations and on the wealthy, Dimon says, quote, New York will survive. The New York City mayoral election is set for November 4th. That's your Bloomberg brief. John.
Vonnie, thank you. The best line from Jamie Dimon. Well, we survived Bill de Blasio. Gonna leave that there. Up next on the program, trade tensions with China.
We have to be careful with China. Look, I have a great relationship with President Xi, but sometimes it gets testy because China likes to take advantage of people, and they can't take advantage of us.
Up next, Tobias Adrian of the IMF, joining Bramo down in Washington, D.C. That's just around the corner. You're watching Bloomberg TV.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Live from New York City, welcome to the program. Some gains on the screen this morning, up by 0.6% on the S&P, up by 0.75% on the NASDAQ. Under surveillance this morning, trade tensions with China.
We have to be careful with China. Look, I have a great relationship with President Xi, but sometimes it gets testy because China likes to take advantage of people, and they can't take advantage of us. But we have a fair relationship with China, and I think it'll be fine. And if it's not, that's okay, too. We have a lot of punches being thrown, and we've been very successful.
So here's the latest this morning. President Donald Trump threatening a ban on cooking oil from China as retaliation for its refusal to buy American soybeans. With a special guest down in Washington, D.C., Lisa has more. Hey, Lisa.
Thank you so much, John. Yeah, real focus this morning on cooking oil, as well as just trade tensions. I am here with Tobias Adrian, the IMF Director of Monetary and Capital Markets. Wonderful to have you. You wrote this in your latest fiscal sustainability report, saying the first sign that the ground is shifting is the continued appreciation of risk asset prices. Markets appear to downplay the potential effects of tariffs on growth and inflation. Just how excessive does the risk rally seem to you right now, given these concerns in the backdrop?
Yeah, absolutely. So let me first point out that the first order driver for the risk rally has been the upward surprises in terms of profitability. So profits remain very strong, and the global economy, continues to grow strongly. And, that is really the underlying driver. Having said that, we do assess equity markets to be stretched, but the magnitude of the stretching is about 10%, and that is only about half of what we had in the dot-com bubble back in '99.
So do you not necessarily see the risk in AI? Is it in credit spreads? Is it in developed market debt? How much is it in maybe not the usual places of elevated equity prices?
So equity prices is one place. Another place are credit spreads and sovereign spreads that are very tight. Indeed, issuers, corporate issuers, country can access markets, and issuance has been very strong this year. So I think the vulnerability is that there could be bad news at some point. For example, if profits were to disappoint at some point, or if there are other adverse shocks, there could be a repricing. We saw that, for example, in April, when markets sold off very rapidly, the magnitudes of the sell-off, was comparable to what we had seen in earlier, severe circumstances, such as the onset of the COVID crisis. Of course, we have seen a huge rebound since then, but it shows you a little bit that the reaction to news when asset prices are stretched can be somewhat outsized.
We've heard a lot about cockroaches recently, and I know that it's early in the morning, at least in the East Coast, so I apologize for this. But when we talk about First Brands, when we talk about Tricolor and the defaults, the sort of collapses there, Jamie Dimon of JP Morgan talking about there's never just one cockroach in the kitchen. And then this morning, Blue Owl's Mark Lipschultz coming out and saying, excuse me, this is fear-mongering. It's not in the private credit space. Which is the right way to look at this?
So we, of course, look very closely at underwriting standards in private credit. And, one thing I want to point out in the private credit space is that when there are any issues, typically those are worked out via what is called payment in kind. So this is sort of like, a constant restructuring. And as a result, you have seen, very little actual defaults, right? So what you're seeing is more like a workout. The two cases that you're alluding to, there was some private credit exposure, but much of that was really in the leveraged loan space more than in the private credit space per se.
So do you see a systemic risk there, or is this just sort of a one-off reality check in terms of some of the lending standards?
Absolutely. So we think that for the moment, this is fairly contained. Of course, there's some deterioration in subprime space, but in terms of magnitudes, this is fairly contained relative to the size of the credit markets. However, what we are watching is really this question, as there's more liquidity allocated to the space, could that lead to a deterioration of underwriting standards, right? So it's more forward-looking over the next 2-3 years, what is happening to underwriting standards? And one of the challenges there is the opacity, right? Can you assess that well?
I wonder what the bigger risk right now is. Is it a deterioration in the underlying economy in the United States, or is it some sort of runaway inflation on the heels of otherwise solid economic growth?
So, both sides of the dual mandate of the Federal Reserve are certainly in focus at the moment, right? So inflation remains somewhat above target, and there's a cooling of the labor market. So having the right balance to the policy approach is really key. And I think the debate is really about this balance, and there are arguments on both sides.
The idea of running off the balance sheet or stopping some of the runoff of the balance sheet, which Jerome Powell was talking about yesterday, in addition to signaling additional rate cuts this year, based on what you're seeing in terms of the excesses, maybe in some of the risk assets, in terms of the solidness of the economy, does that seem appropriate?
Yeah, so let me talk a little bit about the balance sheet and the impact on longer-term bond yields, right? Term premiums certainly have been rising in recent years, and the level of term premiums, say at the 10-year or the 30-year, are comparable to what we had seen pre-crisis. And we do think that balance sheet policies of the major central banks have something to do with that. So there is a relationship between the net supply, so sovereign supply, net of central bank ownership, and these longer-term term premiums.
You know, you talk about in your fiscal sustainability report that ultimately it's going to come down to countries getting their house in order, getting their books in order, stop having so much debt, try to ratchet it back. Does it feel like screaming into a void?
Well, getting back to the cockroaches, the way to get rid of them is to put your house in order, absolutely. And, you know, I think in our personal finances, we always work on, you know, building buffers and having reserves for rainy days. And the same is true for countries, right? You want to have the appropriate buffers. You want to have space, for example, fiscal space. You want to have space in terms of monetary policy against further adverse shocks. They may not happen. Hopefully, everything goes well and we're going to rally through the future. But sometimes bad things happen. Actually, when you think about the past 5 years, we've been through a series of negative shocks. And it is the ability to react globally and in many countries to cushion the economic outfall that then has led to fairly good outcomes.
Just real quick, what's the environment like at this IMF meeting?
I think it's cautiously optimistic. So we do have a huge amount of uncertainty in the world, right? I mean, there are major shifts going on. Measures of policy uncertainty are elevated, but of course markets are shrugging that off to some degree, right? I mean, volatility in markets is pretty much at historical averages. And so, you know, markets take a fairly optimistic view. And so it's somewhere in between, so like the broader big picture questions, some of the uncertainties about how this will all resolve, but then also quite a bit of optimism relative to economic performance that has continued to be fairly strong.
Tobias Adrian, thank you so much for being with us here in Washington, D.C. That was Tobias Adrian, and it makes me, John, want to go home and clean my kitchen.
Lisa, thank you. You're not the only one. Thank you very much. More from Bramo through the next few days covering the IMF meetings down in Washington, D.C. Up next, we'll catch up with Chris Marinac of Jenny Montgomery Scott with Morgan Stanley results just moments away, plus Yahaira has some of your morning movers. Bank of America shares higher on the back of strong earnings. That stock is up by more than 4%. Live from New York City, you're watching Bloomberg TV.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Just moments ago, numbers dropping from Morgan Stanley. We'll get into the details in a moment, but just the headlines for you. Third quarter wealth management net revenue, upside surprise, surprise, surprise. 8.23 billion, the estimate 7.78. Equity trading revenue, 4.12 billion, the estimate 3.41. So it's just been a clean sweep of beats over the last 24 hours for the big banks on Wall Street. We'll get to Scarlet Fu in a few minutes to get you the details on all of that. Turn to the equity market. Futures bouncing back up by 0.6% on the S&P. The gains continue. They resume on the Nasdaq, up by 0.75%. Some outperformance on the Russell, up by 1 full percentage point. Let's get you some morning movers. The latest on the banks and more with Yahira. Hey, Yahira.
Hi, John. We start with the Bank of America, up 4.8% in the pre-market on a solid earnings beat. Net interest income, a key source of revenue for the bank because of its focus on commercial and retail lending, hit a record, up 9%. And like all of its peers, deal making helped fuel results. Investment banking revenue blew past analyst estimates, up a whopping 43%. And speaking of deal making, another take private deal looks like it's in the works. We just talked about Papa John's earlier. Well, Grindr is up 5% after the LGBT-focused dating app confirmed that its largest shareholders are exploring an acquisition that could take the company private. And we end on Dollar Tree shares. Those are soaring 6.7% in the pre-market amid some optimism for its long-term growth. That comes despite the company posting slower sales in the third quarter because it had to raise prices due to President Trump's tariffs. John?
Yahira, thank you. Thank you very much. The deal flow, it's so difficult to keep up to speed with it. This from the Financial Times just moments ago. An investment consortium that includes BlackRock, NVIDIA, XAI, and Microsoft has struck a $40 billion takeover of one of the world's largest data center operators as it launches an initiative to underwrite the infrastructure for artificial intelligence. The story goes on to read, the investment consortium, which also includes BlackRock's affiliate Global Infrastructure Partners and Abu Dhabi fund MGX, will acquire Texas-based aligned data centers from Macquarie Asset Management. Just sharing the first few paragraphs of this news from the Financial Times.
And then you wonder why you continuously have some of these companies in the stock market continue to post gains. It's because billions of dollars are being put towards the AI infrastructure and the build out. The investment group, they're saying, has earmarked, Jonathan, $30 billion in equity, a further $70 billion in debt financing to buy and build these data center companies. And something you and I have been talking about, which is going to come home to roost next year, the electricity prices already in Texas are surging. What is this going to mean for some of these constituents? They're going to be calling their Congress members, they're going to be calling their senators and saying, you're going to have to do something about this.
There's a lot of capital sloshing around, whipping around. A lot of capital needs to go towards energy and the potential constraints that maybe we're already hitting in certain places. Let's turn back to the banks. Morgan Stanley up in a pre-market by more than 2% with the latest on the results. Here's Scarlett Fu. Hey, Scarlett.
Hi, John. Yeah, so deal makers and traders really have driven the banks to big stellar performances this third quarter, and that remains the case here with Morgan Stanley. But the extra wrinkle here, or the thing that you want to pay attention to for Morgan Stanley, is its wealth management business, which is more stable, it's fee generating, and it's not victim to the market's moves and swings. So Morgan Stanley's wealth management business reporting
reporting revenue of $8.23 billion, much, much higher than what analysts were looking for, which was $7.78 billion. And that was an increase of about 7%. So this is a big, big beat here. And of course, net revenue did rise more than 13% from the same time last year. When you look at the trading side of the business, equity sales trading, which is really the dominant part of Morgan Stanley's trading business, $4.12 billion. That is better than the expected $3.41 billion. Fixed sales and trading revenue, a smaller part of its business, but that too was a beat, $2.17 billion versus the expected $2.07 billion. And investment banking revenue also higher than anticipated. One thing that got my attention, though, was the fact that it did not seem to provision for any credit losses in the third quarter. Zero was the third quarter provision for credit losses. Analysts were looking for somewhere in the neighborhood of $97 million. So from Morgan Stanley's perspective, that seems to be, they have enough money set aside right now for loans that could go bad. I'm guessing that this will come up on the investor call. JP Morgan had actually set aside more money for the third quarter, while Goldman Sachs set aside less. Expenses, non-interest expenses, did come in higher than anticipated. And this is something that's been consistent with the banks that have reported, certainly from Goldman Sachs. $12.2 billion for non-interest expenses. Analysts were looking for just under $11.85 billion. And compensation expenses, which tends to be the most, the heftiest part of expenses for banks, was $7.44 billion, also higher than what analysts had anticipated. But it is that wealth management number, John, that investors and analysts are fixated on, and that is why you see the stock moving up about 2.5% in the pre-market trade.
Scarlett Fu, thank you, Scarlett, with the latest. Let's unpack some of that. Chris Marinac of Janney Montgomery Scott still with us. Chris, Scarlett was going through that important wealth management number. That's a $500 million beat. Now, Chris, can you just explain why that number is so important to this bank?
Well, it's the highest margin business they have, John, and it's very much recurring revenue. So the more business of that you can have, it's going to sustain this revenue growth and margin for a longer time. It's going to be less volatile than other parts of the trading and investment bank business. So I think that wealth business continues to compound over time, and that's why the investors focus on it to the degree that they do.
Chris, Scarlett mentioned the provision for credit losses, zero. Chris, I just wonder what your reaction is to that compared to what we saw from the likes of JP Morgan yesterday.
Well, I'm a little surprised, but by the same token, they have a lot of capital and a lot of earnings. I also think the mix of loan growth could be very much skewed towards a wealth management customer that does not have much risk. They may also have, and they seem to have, relatively benign charge-offs in the quarter compared to last. So I think that also went into the calculus on no provision. But even if they would have had a provision, they still would have had an excellent quarter, beat expectations, et cetera. So in this particular quarter, it may not matter. I would prefer to see more reserves than zero, but I do think that there's flexibility, and particularly I think the types of loans they grew is part of why they did not have an increase.
Chris, now that we got Morgan Stanley, basically, we have all of the banks reporting, the top banks. What are your initial thoughts so far about the industry as a whole?
Well, it's in very strong footing. We continue to build capital. I really think that the credit picture continues to be very stable and benign. Yes, we have problems that are percolating under the surface. I think these incidents that we've seen the past 4 to 5 weeks will most likely continue here or there. You know, corporate bankruptcies are higher than 2019, but only by a few percentage points. It's not that much of a deterioration, but generally speaking, we'll see more issues as the temperature comes down on credit. But I still think that overall, the banks can make a lot of money here, continue to get paid more than they have because the stocks are very inexpensive, and then continue to roll into a very strong year end.
I guess what I'm asking and trying to get at is, what would be your top pick after seeing the latest results?
Well, I think the regional banks still have a lot more to go. I think Fifth Third is in a very interesting position given the Comerica news, and also that I think the market has moved on from their credit incident pretty quickly. First Citizens, FCNCA, is very interesting. It's a company that has been digesting Silicon Valley for 2.5 years and not getting a lot of love. They are buying back stock hand over fist and continue to do quite well, growing the core business that they've always had, in addition to the old CIT and Silicon Valley. So that, I think, is an up-and-coming regional bank. We also would pay attention to Wintrust, WTFC, and also feel very highly about the Pinnacle-Synovus merger that is coming down the road the next few months.
Chris, just finally, it's a question that I've thought about before, and forgive me if I've asked it before as well. It comes up repeatedly, I know. But Chris, when is a regional no longer a regional, as they all start buying each other and they get bigger and bigger?
So I guess it probably crosses 300 billion would be the line in the sand, maybe 500 billion. You know, I think we think of the Truists and the U.S. banks and PNC in a different category. than Fifth Third and Regions and some of the other more ordinary regional banks. But I still think that from a size perspective, we have to be cognizant of the quality of how those companies go. That's going to be the secret sauce, is getting larger with more scale, but also keeping the quality very much intact.
Chris, are there specific regions that are looking more attractive than others right now?
So the Midwest continues to do really well because of the onshoring in the country. I think that is a region that I think will be better than folks realize. The Southeast still has the demographics. You still have the tax benefits being in Texas and Arizona and some of those states as we have migration away from California. Florida continues to be quite important. So I think that sort of Midwest and Sun Belt would be the top areas, but I would not forget other parts of the country because there's still a lot of people in the Northeast. There still is a lot of infrastructure in the Northeast that can still do well and perform in 27 and 26.
Hey, Chris, it's good to see you. As always, thank you, sir. Chris Marinac there of Janney Montgomery Scott. Thank you. Just moments ago, we got those numbers from Morgan Stanley. Scalafu went through the numbers well. Fantastic as always. Beat. You saw it on wealth management. Net revenue, $8.23 billion. The estimate was $7.78. That's a big beat. Equity trading revenue, $4.12 billion. The estimate, $3.41. That's why the stock is up by 3.5%. These are the major players on Wall Street. When you start to talk about the regionals getting together, and when I said to Chris, where do you want to be? What's the attractive region at the moment? He went to politics almost straight away and talked about the policy from the White House shaping the kind of regions you want to be at because of the activity you'll see there.
Well, at the same time, what we were just talking about, this massive scoop from the Financial Times about how you have this consortium with billions of dollars to take over an AI data center. Where's that all happening? That's happening in Texas. Where's all the wealth generating from? Individuals, high net worth people. They're coming from New York down to Florida. They're going from California to Texas to Arizona. That's potentially why you're so interested in the regional players. And similar to Gerard Cassidy was talking about, now you have really a starting gun when it comes to these regional players and the consolidation. That's going to benefit the entire banking industry.
The banks have been flying all year. We're up again this morning by 3.6% if you're looking at Morgan Stanley as we wrap up earnings season on Wall Street with beats pretty much across the board. Let's give you an update on stories worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. And let's recap. Shares of Morgan Stanley, as you say, rising after topping earnings expectations for the third quarter. Net revenue of $18.22 billion was well above analyst estimates, plus another beat on investment banking. CEO Ted Pick saying in the release, consistent execution of our strategy led to record revenues. An investment consortium that includes BlackRock, NVIDIA, Microsoft, and xAI is taking over one of the world's largest data center operators. Texas-based Aligned Data Centers will be acquired from Macquarie Asset Management. The group will expand Aligned in the coming years to double its data center campuses in the US and Latin America. And Walmart teaming up with OpenAI, the retail giant will enable customers to browse and buy products directly on ChatGPT. Shoppers will be able to shop Walmart and third-party sellers' products directly on ChatGPT by clicking a buy button. The function launches in the fall. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes. Up next, the Federal Reserve's balancing act.
There really isn't a risk-free path now since it appears that inflation is continuing, but now, the labor market has demonstrated pretty significant downside risks as payroll jobs have declined.
Chairman Powell, without much data, leaving the door wide open for another interest rate reduction at the end of the month. We'll catch up with Tony Rodriguez of Nuveen in just a moment. Live from New York City, you're watching Bloomberg TV.
The belief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are gonna kill everybody. So we gotta figure this out. And we're not gonna do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Clean sweep of beats for the big banks on Wall Street in the last 24 hours. The latest just moments ago, Morgan Stanley up in the pre-market by more than 4%. Fantastic live blog driven by Bloomberg News. On the Bloomberg terminal, this came from Paige Smith. I'm not noticing a single metric that came in below Wall Street analyst expectations for this name. Morgan Stanley up nicely in the pre-market as we wrap up earnings on Wall Street. For the broader equity market, bouncing back, we look like this on the S&P 500. Equities higher by 0.6%. On the NASDAQ, up by 0.8. In the bond market, 2-year, 10-year and 30-year bond yields shaping up as follows. Yields down across the board, down about a single basis point on 10s, just north of 4%. We're going to squeeze in a lot of Fed speak over the next few days going into the quiet period. A lot of attention on the Federal Reserve going into that quiet period ahead of that next meeting with very little economic data.
I'm sure they're happy they're entering this quiet period because what can they say as they're in a data desert? What has really changed since the end of September? The Fed seems to be stuck in time. That's the sense I got from Jay Powell yesterday. Basically, the bias is still to the labor market, as you've been talking about. The one piece of data they are definitely going to get is CPI. And how uncomfortable is that going to be for the Fed to potentially have a very hot CPI print and not know the latest labor market reporting because the government is still in shutdown mode?
Based on the estimates, that CPI print could well have a 3 handle. That number expected to drop on October 24th. Delayed, of course, it was meant to come out this morning. Under surveillance this morning, the Federal Reserve's balancing act.
There really isn't a risk-free path now since it appears that inflation is certainly running above our target and appears to be continuing to increase quite gradually, but increase. It's still on the way up. So there's a risk there that would lend to greater persistence. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined.
So here's the latest this morning. Fed Chair Jay Powell reiterating the lack of a risk-free path for the central bank as its dual mandate creates tension. Tony Rodriguez of Nuveen writing the following. Barring surprises in the data, we expect the Federal Reserve to cut interest rates by another 25 basis points at their meeting later this month. Tony joins us now for more. Tony, good morning.
Good morning, John. Good to be with you.
Just want to run through that line from Chairman Powell. He's mentioned it a few times in the past few months. There really isn't a risk-free path now. If he believes that and continues to cut interest rates, what is the risk that he's putting more priority on versus the other?
Well, I think right now they're almost getting a little bit of a free pass on this October meeting because there is a little bit of a lack of data. So that hasn't really challenged that view of what to do. And they can placate kind of all the political pressure because ultimately they are telegraphing that they're expecting to be lower over the next few quarters. So taking the move now versus waiting for the next meeting in December it's kind of a freebie to take it now, wait for maybe the data to hopefully, ultimately come out from the government and see if that supports that move or not. Then they can delay December, continue in December. But given that they are modestly restrictive now, given that we're seeing some softening in the labor market, unemployment's up almost 1% over the last year, still a low level, I think it gives them kind of a free pass to take the cut here in October, see what the data brings after that.
This isn't true of the whole committee, but certain members of the committee are very spooked by what's happened with payrolls. And it's been a huge downshift. We've gone from averaging 200K to averaging something closer to zero over the last 3 months. The Fed chair yesterday said you're at a place where further declines in job openings might very well show up in unemployment. Now, we haven't seen that so far. We've seen a huge downshift in payrolls, but actually unemployment stay close to the low fours. Does that raise questions about whether this is structural or cyclical and what is just going on here, what exactly is going on with the labor market?
Oh, it definitely raises questions. And we do think that the preponderance of it is on the structural side because immigration has really gone through an absolute shock. We've gone from, what had been a run rate of 1 million, kind of peaked at 2, but now is at 0, maybe net negative. So that clearly reduces the amount of jobs that we need to create to keep that unemployment rate steady. Ultimately, the Fed's going to look at that unemployment rate, and as long as the job numbers are sufficient to keep that rate steady, they'll be fine with that.
What's sufficient? And how much has that changed? What is sufficient now?
Yeah, and that has changed. So what we would have argued had been, call it 150 to 175,000 jobs per month type of number. Now we think is more in the ballpark of 50,000 jobs plus or minus. That's the deceleration in immigration, along with that longer secular move of demographics that has been lowering that, over the last decade or two.
Tony, why wouldn't they go on hold later in the year when they actually have all the data? This is a Fed that's gone out of their way time and time again to say they're data dependent, and then all of a sudden in the October meeting, they're not going to be data dependent?
Yeah, and I think the answer to that is really around the fact that if you took political pressure off the table, I think that might be the argument that carried the day, and they might wait until that next meeting.
So you think they're acting because of politics?
I think political pressure is part of the calculus. You've seen it in a lot of the shifts in the commentary from a lot of the Fed members, some voting, some not. But clearly the narrative has shifted. And in part, it's a little bit in trying to maybe help preserve the independence of the institution by not engendering unnecessary political pressure by being in this October versus December move, when really, ultimately, they go from moderately restrictive to a little bit less restrictive. It's not really a game changer from a stimulation perspective to the economy. So take the move, keep the pressure, down a little bit, maybe helps preserve the institution, wait for data to come out.
But it's a very low unemployment rate. So when Jay Powell talks about this weakness in the labor market, he's just talking about this low hiring environment, but it's also a low firing environment. Isn't this the moment where you would say we should wait for confirmation of data?
Yeah, what I think has happened is that since the unemployment rate's gone up about 9/10 over the last year, we would say maybe 4% is the natural rate. You're a little bit above that. Our forecast is for 4.5% by the end of the year. So you're starting to bump up against a level that does become worrisome for the Fed. So if we were to see 4.5 sooner than year end, possibly see above that, then I think you run the risk of kind of that self-reinforcing move of a more quickly rising unemployment rate. So getting ahead of that by at least getting closer to neutral in terms of the funds rate is what I think the balance of risks argument leads to, meaning a cut here in October.
Tony, what do you think the market's positioning for? Let's talk about that. 10's down to 4, 2's breaking 350. What does that tell you at the moment?
Yeah, I think, they're certainly pricing in the cuts, but I think you're also getting a little bit of insurance on maybe more downside to the economy. So you could argue that maybe gold is a little bit of that if you don't think it's a debasement trade only. I think in the bond market what you're seeing, because ultimately we think long end rates are fair here and might be even a bit higher given all the fiscal spending, the structural term premium increase. So I think it's telling you we're trying to buy some insurance against a more significant slowdown, given the potential for some of these exogenous shocks from trade, politics, et cetera.
There was some nervousness for a bunch of reasons back in April about extending duration. when you see moves like this, sometimes they just feed on themselves, that maybe people start to think, oh, bonds do work. Maybe now's the time to extend duration. Are you pushing back against that?
Yeah, we don't think it's a time to extend duration. We think that, again, we're at fair value, but we do think that duration will work as a hedge. If we're wrong, we're not calling for recession. We'd say probability of recession maybe 30%. But if, in fact, that starts to rise, you see greater weakness in the job market, we do think duration then will play its traditional role of a solid hedge in a weakening environment, because then we'll see a more aggressive Fed. Then I think we'll see a 10-year that could get down to below 3% in a real, true, deep recession. Our calls avoid recession. The 10-year hangs around 4%, so there's no real big money to be made on the duration play.
As they start to cut interest rates for the riskier parts of markets, are you identifying some credit stress that would be alleviated by lower interest rates?
We are, and that's primarily because we've been at this higher level of rates now for a couple of years. So for the large indebted kind of lower quality companies, that is something they can handle for 6 months, 1 year, 2 years. The longer it lasts, the more difficult it is. So taking some of that pressure off of that kind of company and having lower end consumers maybe be able to refinance a home, that kind of thing, that can be supportive of both consumer spending and corporate credit. Now, both are in good shape, consumer spending and corporate credit, but this will help, I think, lower rates would help prevent maybe that next shoe to drop in terms of weakness.
We've had two shoes drop. First Brands, Tricolor, came up on the call yesterday with Jamie Dimon at JP Morgan. He talked about cockroaches. Anne-Marie brought this up a little bit earlier as well. Worried there could be others. Are you worried about that?
Well, we definitely think there's going to be more cockroaches, right? There is going to be more credit stress. We're expecting a rise in the default rate, but we're going from a very low level to what we think will be more consistent with historically average levels. So we don't think it's going to become a problem for, say, the financial institutions in terms of their asset quality or for the broader economy in terms of recession.
You don't think it infects public market sentiment to some degree as these headlines start to come to the surface?
Yeah, I do think that, for example, when we talk about risk premiums, which are clearly at, whatever you want to call it, rich, frothy, elevated levels, we do think you can see some widening in risk premiums as a result of that kind of, one cockroach shows up, another one shows up. You get a little bit of weakness for sure. But again, we don't think it's kind of the cycle is turning into a negative credit cycle here.
That would be the worry. Tony, it's good to see you. Thanks for dropping by. Tony Rodriguez there of Nuveen. That full quote from Jamie Dimon yesterday. I probably shouldn't say this, but when you see one cockroach, there are probably more. Everyone should be forewarned on this one.
He's sounding the alarm. A number of banks are sounding the alarm about these concerns. They're not saying it's systemic. It's idiosyncratic to potentially some bad moves, a bad bet. But the issue is, if there's one, are there others? And the problem is you just don't know until you know. And this is going to be potentially an issue for 2026.
Up next on the program, we'll catch up with Alex Ullman of Barclays, Gil Luria of D.A. Davidson, Tiffany Wilding of PIMCO, David Kelly of JP Morgan Asset Management. The third hour of Bloomberg Surveillance is coming up next.
Sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book.
This is funded by the NEDO, so-called Japanese agency. And also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting the usage of the ammonia as the power-generating fuel.
It's more expensive than normal standard fuels.
Yes, it is. And at this moment, the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
We published a story recently about the explosion of robotic companies and innovation in China. I think we said there's something like 50 or 60 robotic startups in China. Are we behind, and should we be concerned about that?
I think as far as the state of innovation, no. Most of those robots aren't built for work, for the things that, which is the entry point for these robots today. They can do some interesting things. A lot of times it's backflips or making coffee or something, but not really useful work. These robots can pick up to 50 pounds on our next generation. So they're great for the education of robotics, getting people interested. But as far as humanoids, they've got to check that safety box before they can come into any of the facilities here. And that's a big bar that we haven't seen much of out of the Chinese robots.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
The real focal point right now should be on earnings.
Earnings continue to be the North Star.
Earnings are strong, but valuations are also very high.
Equity investors just forgot about the idea that there might be some short-term pain involved.
There are still risks on the horizon.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, 90 minutes away from the up and about. Your scores look like this. Equity futures, session highs up by 0.6% on the S&P. On the Nasdaq 100, up by 0.8. Two more banks reporting this morning, two more beats. Bank of America, Morgan Stanley in the pre-market higher by 1% for Morgan Stanley. Bank of America up by 5.5 and just beats across the board.
Beats across the board. Looking at Morgan Stanley, too, right now, they reported, Jonathan, revenue from trading stocks up 35% to $4.12 billion, surpassing estimates. This is huge in terms of how they want to take on Goldman Sachs in that division. And when I look at these banks, all I keep thinking is the policy in Washington, how much that's fueled them. Some of the chaos and uncertainty around trade, that was great if you're on a trading desk. And the fact that you're in this deregulatory environment, how much has that helped in terms of these advisory fees when it comes to the IPO market? These banks are crushing it, partially because of what this administration is doing.
Goldman the same yesterday. Record third quarter revenue. We've seen this across the board. Citi beat in every single division. JP Morgan beat. We saw it again this morning. Bank of America, Morgan Stanley. So we can park the bank earnings. No problem there, at least for now. You get some calls later. Now we can focus on trade again. 9:15 Eastern Time. Ambassador Greer, alongside the Treasury Secretary Scott Bessent, on trade. And it's the trade tension that has whipsawed this market over the previous three sessions. I've gone through this a few times. Think about the last 3 days. Friday, the worst day for the S&P since April. Monday, the best since May. And yesterday, an almost 2 percentage point swing on the S&P 500 from session low to session high.
And all dictated by President Donald Trump's Truth Social post. Friday, it was about potentially 100% tariffs on China, because what China did and coming out in terms of what they plan to do in terms of export controls on rare earths. Then on Sunday, he said, I think me and China, we're going to get to a good place. Potentially, there'll still be this meeting. The market viewed that as taco. Well, it's not taco right now. Trump is just negotiating out loud leading into this meeting. So you are going to see more days like this. What is it going to be? Ports, rare earths, cooking oil, soybeans, everything is on the table.
You know, I hate the phrase taco. If you think about things, remove yourself from financial markets.
Fully taco.
Just think about where we've been since the start of the year, what happened in April, and how much higher tariffs are now than before the president went into the White House. Now, if you call that chicken and gow, just how much higher are tariffs now versus where they were at the start of the year?
Or as the Iranians, they would certainly say he does not taco. I would go back to what Ethan Harris said during all the trade headlines in April. Trump always tries again. He anchors it to the extreme. You've talked about this. Puts the bias and anchors to the extreme and then sees where he can get away with in terms of negotiating. He came out in April with sky-high tariffs, but yet then the world sort of blanked and accepted the level we are at now, which is definitely double-digit tariffs, higher than we were this time last year.
A multiple of where we were, and stocks are still close to all-time highs. The S&P up by 0.7%. Will it come back to bite? We'll see. Coming up on the program, Alex Altman of Barclays as stocks are edging higher, Gil Luria of D.A. Davidson as the AI chips race is heating up, and Tiffany Wilding of PIMCO with Fed Chair Jay Powell signaling an October rate cut. We begin this hour with stocks bouncing back. Alex Altman of Barclays writing the following: the period of the year, this period, is typically when small investors accelerate their purchases of stock. And that is not a trend I'm willing to fight. Alex joins us now for more. Alex, good morning.
Good morning.
Do you see a lot of that already?
We are. We're seeing effectively record amount of option volume, with a lot of it being driven by small investors. You can look obviously across the meme cohort. We just had the meme ETF that was mothballed and has come back to life now. I think it's pretty clear that we're getting sprinkles of 2021 all over again.
Is Friday a good example of that? When we had massive options volume and they weren't rushing for downside protection, they were actually looking to play the bounce back of the equity market.
Yes, but I think there's other things which you've just highlighted. You know, you've got a pro-risk friendly administration. You've got a deregulatory environment. You've got an AI arms race that is going on. You've got a weaker dollar as well. You've still got record inflows by foreign investors into the US equity market. So it's not just retail investors. I think people love to use them as a catch-all, as an excuse as to why stocks are going up, but ultimately there's lots of verticals. Also, let's not forget that the 401k plans are still buying stocks in their life plan 30s or whatever you want to call it every single week. And as long as people still have jobs, as long as we're not seeing those firings, that passive inflow is coming too.
We don't throw mud at retail investors on this program. Just to be very clear, I'm not one of those, because I think retail has done a better job than some people on Wall Street have since the pandemic. They've leaned into investing. They've had a bias to buy in a way where I think Wall Street's been reluctant. For the people that sat out the rally since early April, and it's been a really fast move, are they being sucked into this into year end, trying to catch up on performance?
So it's a really good question. And the short answer is not yet, but I think that we're going to start seeing it. So if you look at, for example, the hedge fund cohort, represents what, 7, 8, 9% of the market. Their beta to the market is actually quite low at the moment. And what's happening is that's offsetting the fact that their net exposures have increased. And so what I mean by that, it looks like they're very exposed to the market, but the stuff that they own is still very high quality, high profitability, large cap. And obviously we've talked about small caps on this program before. The fact of the matter is that these kind of positioning biases, which is pretty crowded, legacy from the higher for longer environment is effectively not what's going to work. So I think that's what's effectively going to force them to chase this market, because they are long, but are they long the right stuff?
If everyone's chasing the market, if we get a down day, then don't you just expect absolute another record to beat on the next day, like we saw Friday to Monday?
Well, look, I think a lot of what we saw, for example, on Friday was driven by the vol control verticals. And by that, I mean, we had this period of very low realized volatility. We had a 2.7% move in the S&P in one day. And that triggered a lot of systematic selling. On our estimates, systematic exposures to the S&P or just to US equities dropped from about the 98th percentile to about the 72nd percentile over a 2-day window. That was, on our count, about the top 15 or top 20 2-day move lower in systematic exposures that we've seen over the past 10 years. So you think about how quickly we just flushed out some of the risks that needed to sell, and the S&P only went down by less than 3%. That, to me, is a clear indication of the kind of bull market that we're in right now.
Are people starting to prepare in the options market for what can happen at the end of the month when it comes to the meeting of Xi Jinping and President Trump?
Yes, but it's not just because of that. We've obviously got a Fed meeting as well on the 29th, and we've got a confluence of mega cap earning, all happening in that 1 week. So yeah, you can see there's a big kink in the vol curve. That's been prevalent really for quite a while now. And obviously we've had a parallel shift up in all of the vol curve as a function of this tariff blindsiding.
But are people looking for the upside or the downside?
Well, that we don't know, but we can see it effectively effectively within the option skew as well to a degree. So skew's quite high at the moment. And what I mean by that is that the puts trade relatively expensive versus the calls. Why would that be? Well, a lot of people say, oh, people are reaching for protection, people are bearish. Actually, it's more a reflection of the fact that generally skew tends to steepen when people are long, which kind of makes sense. You only really buy protection if you've got something to protect.
Earnings season hasn't started yet. Earnings season starts in 2 weeks when we get the major tech players reporting. Just got this note from HSBC. Check this out. Upgrading NVIDIA to buy from hold, citing the ongoing growth of artificial intelligence, raising the price target, street high 320 from 200. They're looking potentially for upside of 80% from yesterday's close. And the quote from them is, room for significant full year 27 earnings upside. Alex, I've had a lot of people come on the program worried about valuations. And given the strength of the balance sheets of some of these major tech players, just how much oxygen is actually left in some of this trade?
I think there's probably quite a lot. It depends really on how effectively you want to think about the narrative. And let's be very clear. We can talk about valuation all day, and if you'd use valuation as a reason to not buy equities this year, then it's been a struggle. But at the same time, we can talk about things like gold, right? So gold, what is the valuation of gold? Well, S&P's underperformed gold by 30% this year. So the point being is that valuation, I think, becomes a bit of a murky ground. What we're in right now, and kind of tying it back into retail, we've got to accept the fact that we're in a narrative-driven market. And I'm not going to say that valuation doesn't matter, because it does matter enormously. But when you're in a narrative-driven market, you can deviate quite spectacularly from what the valuation-driven framework would tell you to.
I see people joking about it. I got a message just moments ago from a Bloomberg subscriber. I'll keep their name personal, anonymous. They said this, breaking, and I've seen this joke before, OpenAI to partner with OpenAI to help fund OpenAI, OpenAI up 90%. We've seen those kind of deals being made. Are you noticing anyone being pushed out of the market by those kind of deals? Are they scared of those deals? Or do you see those deals actually just as another reason to draw people in?
I would say it's a very bifurcating topic. So you've got some individuals. We actually had a big hedge fund dinner last night, and we were discussing this. And show of hands, how many people think we're in a bubble? How many people don't think we're in a bubble? And there's a lot of ambivalence exactly to that point, because yes, there's enough grey hairs in a room to remember the circularity of say the dot-com bubble. But similarly, you've got to acknowledge we're talking about businesses that are cash volcanoes as well. And so the analogy is this like more like dot-com? Or is it more like the railroad construction? And ultimately, yes, we're building acres of data centers, but at the end of the day, that data centers will get used for something. And as long as it's being predominantly financed by internal cash flow, and not all, we're clearly seeing a massive uptick in IG issuance, then actually it's less of a problem. So I think there is a lot of runway. And again, I think we've just got to distill it back to what kind of investing environment we're in right now, acknowledging that valuations can get very deviated from what we would consider fair, and accept the fact that the flow of funds and narratives can run for a lot longer than people think.
Can you go through the show of hands again? When you ask them, hands up, who thinks we're in a bubble? How many of the people with their hands up also thought they should be buying the said bubble?
Well, back to my point about hedge fund positioning, in terms of there is still a large degree of skepticism as well. And also, you've got to remember that a lot of hedge funds, the industry's changed a lot. If you think about the vast majority of AUM is now tied to, in some way, shape or form, relatively low net exposures, relatively factor neutralized. So even if in a case a lot of these individuals would have wanted to participate in it, it's just not really the mandate anymore for a lot of that part of the industry. And then when you talk about the mutual fund and long-only industry, consider the fact that they often have weighting caps on their portfolios. So the concentration risk in the S&P is also another headwind in order to perform as well as you would want to during, if we are indeed in a bubble. Just for the record, I don't think we're in a bubble. I don't think we're there. And if we are, it's so early stage that I think.
How would you know? What would you see? What are you looking for?
At the very least, a broader acceptance and embracing of this narrative. And right now, I would say that we're nowhere near there. If we want to talk about bubbles, let's talk about gold. Right? So no one I talk to talks about a gold bubble right now, and yet simultaneously think about it. As I said earlier, S&P's underperformed gold by 30% this year. 30. The only other times that's happened has been during deep equity bear markets, 2002, 2008, and 4 periods in the 1970s on an annual basis. And we haven't even finished the year yet, right? So I think when we want to talk about bubbles, and again, it's dangerous to compare like relative value when it comes to bubbles, but I would say that actually if there's a bubble brewing, it's more in gold than it is in stocks right now.
Interesting. Alex, thank you, sir. It's good to see you.
Thanks very much.
Alex Altman of Barclays, gold higher by by 1.3% this morning. Stocks too, we're high about 0.75% on the S&P as we count you down to the opening bell. Let's get you some news elsewhere, some top stories worldwide with your Bloomberg Brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Let's recap those banking beats. Bank of America reporting third quarter earnings that beat. Investment banking revenue up 43% to $2.05 billion, better than the $1.65 billion analysts had expected. M&A advisory fees at Bank of America soared 51%, and net interest income rose 9.1%. Shares of Morgan Stanley, too, rising after topping earnings expectations for Q3. Net revenue of $18.22 billion, well above the estimates, plus another beat on investment banking. CEO Ted Pick saying in the release, consistent execution of our strategy led to record revenues. Salesforce is planning to invest $15 billion in San Francisco over the next 5 years to strengthen the city's dominance in AI. CEO Mark Benioff posted on X that the investment will help, quote, build a greater, safer city for everyone. The investment will go towards a new hub on the company's San Francisco campus to support workforce development and training. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next, the Morning Calls Plus. Gil Luria of D.A. Davidson as the AI chips race heats up. That conversation up next. Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's in very strong footing. We continue to build capital. I really think that the credit picture continues to be very stable and benign. Yes, we have problems that are percolating under the surface. Generally speaking, we'll see more issues as the temperature comes down on credit, but I still think that overall the banks can make a lot of money here and then continue to roll into a very strong year end.
It's fair to say, based on the quarterly results of the last 24 hours, that the banks are making a lot of money. Chris Marinak of Janney Montgomery Scott there, following the bank earnings this morning. Decent, solid numbers, more beats from the likes of Morgan Stanley and Bank of America. It follows the same story yesterday from Goldman, from Citi, and from JP Morgan. Equity futures shaping up as follows into the opening bell, 1 hour and 13 minutes away. Equities up by 0.8% on the S&P, on the NASDAQ up by 1 full percentage point. That's your bounce right there into the cash open. So that's the price action. Here are the morning calls. First up, Piper Sandler raising its price target on Citi. That stock is up by 1.4%, up again today. Your second call from Barclays, raising its price target on Goldman to $8.50, citing investment banking activity on the, quote, upswing, up another 1.6% for that name in early trading. And finally, check this out. HSBC upgrading NVIDIA to a buy with a street high price target at 320, expecting significant earnings upside on chip momentum. That stock is higher by 2.54% going into the cash open. Let's stick with tech. ASML shares rising after its orders beat expectations with AI demand staying strong. Joining us now, Peter Alstrom of Bloomberg joins us now for more. Pete, welcome to the program. What do you see from ASML, and what does it mean for what we could see elsewhere from some of these major players?
Well, ASML, of course, makes chip-making equipment, so it sits sort of at the beginning of the supply chain, sells its machines to the likes of TSMC and Intel and Samsung, who then go on to sell their chips to NVIDIA and the rest of the AI universe, including OpenAI. So what ASML said is that revenues for the quarter were actually a little bit light. They came in at 7.5 billion euros. Analysts were expecting 7.7. But what they did is they talked about their bookings, which were higher than expected. They said the bookings were 5.4 billion euros compared with estimates of 4.9 billion. So that gave investors some optimism that, in fact, the purchases of their chip-making machines are picking up a little bit. And the CEO, Christophe Fouquet, talked a bit about this. He's seeing strong demand from the AI customers in particular, so they're able to sell into this market. Their EUV machines are really at the top of the market. Those have been very big sellers for them, especially with the likes of TSMC. A couple of their customers have had some weaknesses, Intel in particular, but now Intel's been able to get a bit of momentum, including with that investment from the U.S. government. So they've been able to make some investments. It sounds like they're going to also be a bit more aggressive in terms of their purchases of ASML machines so that they can make these chips to supply this demand going forward.
Peter, I'm so pleased you went there. I think that's a really important dynamic to be thinking about here. There is a massive effort right where you're sitting to build out domestic fab capacity in the United States of America. And Intel, if the White House has anything to decide, is going to be a key part of all of that. Now, Peter, I wonder what that means for where the orders come from for the likes of ASML and where maybe there might be some tension in the future with the likes of ASML and maybe certain countries in Asia.
Yeah, that's exactly right. For many years, the U.S. government, U.S. companies sort of allowed the most advanced chip production to go to Asia, to Taiwan in particular, also to South Korea. Now what we're seeing is this very concerted effort in the United States to bring some of those companies here. They're the same companies. TSMC is building its fabs here in the United States. Samsung, SK Hynix are all building their fabs here in the United States. We're also seeing ASML benefit quite a bit from China's investment. Chinese companies can't buy the most advanced machines. They can't buy the EUV machines, for example, that are making the chips for NVIDIA and for Apple, for that matter. But they can buy other machines from ASML that are a little bit less sophisticated. That demand has been very strong for them. They think that that's probably going to taper off in the future, but there are investments being made here in the United States that should benefit. TSMC is certainly one of those. They're by far the most advanced producer of these chips. But Intel, as you mentioned, Intel is coming on. They're making some progress. There's a lot of hope. There's a lot of investments now in Intel and it being able to reclaim some of the past glory and get back to chip production.
A lot of hope and a lot more money based on the investments of the last month. Peter, appreciate the update. Peter Alstrom there of Bloomberg, live in our Washington, D.C. bureau in the nation's capital. Gil Luria at D.A. Davidson joins us now for more. Gil, welcome to the program, sir. NVIDIA center stage in the last 5 minutes. Big upgrade from HSBC. Big price target too. Street high, 320. Gil, when you think about things regarding NVIDIA, is it still the only game in town, or does AMD provide a bit of an alternative?
NVIDIA is not the only game in town, but will continue to be the main game in town. All of its customers are trying to diversify. They've been trying to diversify, but it's hard because NVIDIA continues to introduce products at such a fast pace that it's very hard for other products to even be comparable, which is to say, Google especially, and to some extent Amazon, are going to increasingly use their chips more. That's Broadcom. And then all of these customers, Microsoft, Amazon, Google, Meta, xAI, are going to have some AMD componentry just because they want to have diversification. But unless the AMD chips catch up in performance next year to NVIDIA's chips, that is going to be a small proportion. One way or another, even if AMD's chips are great and Broadcom continues to generate a lot of good ASIC chips, the custom chips for these customers, NVIDIA will continue to have overwhelming share of this market for a while longer.
These companies continue to chug along, stock prices higher. We're seeing upgrades like this morning of HSBC at the same time where the rhetoric between China and the United States is really heating up. How are they going to get potentially caught in the crosshairs between Washington and Beijing?
They already have. NVIDIA, in fact, has missed its last 2 quarterly reports because of China. China is somewhat out of the numbers. It's not completely out of the numbers, but it's somewhat out of the numbers. And unless the US and China can arrive at some sort of broader framework for an agreement, NVIDIA's sales into China are going to be very much impacted for a while longer, and as long as that's happening. They have been all year, and it's been a drag on NVIDIA already. Having said that, the market is growing so fast right now that NVIDIA can probably live up to expectations without significant contribution from China. If China does come back, which it may not, NVIDIA can do even better. But the demand right now is so big that NVIDIA can probably do okay even if the demand from China is limited.
Who can't do as well as NVIDIA if the demand from China is limited?
It would impact NVIDIA more than any other company, but also AMD and Broadcom and much of the rest of the ecosystem that sells into China will be impacted. And long term, whether or not there's a full decoupling from China, we're already well on our way to having a much different supply chain than we had even a couple of years ago. You were just having a conversation about the fact that we're going to have to build a lot more of the supply chain in the United States. It's going to be a long process. It's very complicated. It goes well beyond Intel and TSMC. It goes through their whole supply chain that we will be gradually moving into the US and into other countries that are not China and not Taiwan in order to make the supply chain more robust. It's a matter of national security, and one way or another, we're having some level of decoupling from China. Whether both sides agree to that or not, companies are already understanding that there's never going to be stability in this relationship, so they need to diversify.
Gil, we've got to go. Appreciate you jumping on. Gil Luria there of D.A. Davidson. Following this upgrade from HSBC and, frankly, NVIDIA, a big bull now on this stock, looking for 320. That price target increased from 200, implying upside of 80% from the last close for NVIDIA. That stock is higher now by 2.5%. Up next on this program, Tiffany Wilding of PIMCO as Fed Chair Jay Powell signals an October rate cut, plus Yahaira has some morning movers for you. Morgan Stanley, Bank of America, both rising on big beats this morning. Morgan Stanley up 4.6%. Bank of America up by close to 5%.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The opening about 60 minutes away. The price action shaping up as follows. Higher by 0.7% on the S&P, gaining by almost 1% on the Nasdaq 100, and outperformers from the small caps this morning. The Russell 2000 higher by 1.1%. Let's get you some single names. Lift the lid on the index with your morning movers. Here's Yahira. Hey, Yahira.
Hi, John. CEO Ted Pick must be very happy right now because Morgan Stanley just stole the spotlight from Goldman Sachs with revenue from trading stocks surging 35%, beating Goldman in an area it long dominated. And aside from that, Morgan Stanley saw beats across the board thanks to booming investment banking and wealth management. Over at Bank of America, net interest income, a key source of revenue for the bank, rose to a record up 9%. Both of those stocks up 4.4%. Meanwhile, as we wrap up the big bank earnings, we move on to the regionals. PNC Financial, those shares are falling 3%. Despite beating on both the top and bottom lines, and the credit picture looks solid for the bank. PNC set aside less for future loan losses than analysts predicted, and it also posted fewer bad loans than predicted for the quarter. And we end on Dollar Tree. That stock is surging in the pre-market, up 7.5% amid optimism for its long-term growth strategy as it put out new metrics. And that is despite the company posting slower sales in the third quarter because it had to raise prices to offset President Trump's tariffs. John?
Yahira, thank you. Thanks for the update and thanks for this morning. Speaking of the president's tariffs, we've heard from the Treasury Secretary Scott Bessent just moments ago saying this about China, going into negotiations month end where we should see a meeting between the two leaders of respective countries, the US and China, President Xi and President Donald Trump. Scott Bessent saying optimistic on China. We are now communicating, also saying at the same time there's lots of levers to pull that could damage the country.
And we're going to get an update on that at 9:15 when he is standing alongside Jamieson Greer. These two individuals are having those conversations with their Chinese counterparts, potentially building out a potential deal that President Xi and President Trump can both walk away with in South Korea as a win. We have to remember, though, this might bleed into 2026. If you don't think that there's going to be issues that continue to arise from this relationship, then you'd be remiss. Remember, it took 18 months, and Trump won, just to get one agreement done when it comes to purchases. And this time, so many more issues, and really deep policy issues like fentanyl that cut to the president's base are on the table.
The latest headlines from the Treasury Secretary, Scott Bessent. More still to come. As Anne-Marie's mentioned a few times, 9:15 Eastern Time, so about 43 minutes from now, you should hear from the Treasury Secretary alongside Ambassador Greer, attempting to get some clarity here on just where these trade talks are going into that meeting with the two leaders. The Treasury Secretary saying this morning that meeting should be a go. Your equity markets near session highs up by 0.75%. The opening bell about 1 hour away. As we turn to the Federal Reserve, Chairman Jay Powell signaling the U.S. Central Bank is on track to deliver another quarter point interest rate cut later on this month. Bloomberg's Mike McKee joins us now for more. Good morning, Mike.
Good morning, John. Well, the chairman has spoken, and it is basically what the markets wanted to hear. This was his last appearance before the blackout starts on Saturday. We have some other Fed officials coming up this week, but basically now that we know where Jay Powell is, we pretty much know where the Fed is going to come out on October 29th. That was his main point, that the Fed remains on track to cut rates then. There is still a significant downside risk to the labor market that overrides the fact that inflation is still on the way up. And he said that's even beyond tariffs, pointing to the service industry prices. And he also mentioned that they're getting closer to the end of QT, which makes the bond desks happy, but doesn't tell us much about the 29th of October. We were at, Jay Powell and myself, were at the National Association for Business Economics annual meeting up in Philadelphia, and the economists had some interesting views there. They feel the Fed is only going to cut rates one more time this year because they're seeing some problems in the economy with inflation. It's still well above 3%. It's cutting into GDP growth, but that may change next year. There was an interesting couple of panels on employment, and they're talking about an employment shortage because of the immigration crackdown that could be a major problem next year, and people, they think, are kind of overlooking that. So there's some gloom and pessimism out there among the economists, but nobody quite knows where we're going because, as Anne-Marie said, all of this stuff could just, with China and tariffs, bleed into 2026.
Mike, when you were over there, can you just sort of give us some detail, some colour on the kind of debate around the step down in payrolls growth we have seen, and how many people think it's structural versus, say, cyclical?
Well, there's a little bit of a cyclical component here because, of course, the economy is slowing, but there seems to be a more structural issue longer term that the economists were concerned about, and they had a number of people who were demographic and hiring experts on panels who noted that because of the crackdown on lower income, lower wage, manual labor workers, the agricultural industries are already in trouble, and we're seeing signs of that, and especially construction is going to be in trouble going forward. One panelist said that there's going to be a 500,000 worker construction shortage in 2026. And the outlook very dour for the labor markets in terms of that and the retirement of the baby boomers. We're going to be short people, even though Jay Powell says it's not pushing up wages yet.
Mike McKee, let's hope it does, because, anyway, all right, Mike, thank you. Appreciate it. We all want to get paid, don't we?
Right. You got to keep asking. I hope people are still asking.
I mean, come on, they should be asking. Let's stick with the Federal Reserve. Tiffany Wilding of PIMCO writing the following. Chairman Powell's comments were consistent with our expectations that the Fed will cut rates again at the October FOMC meeting. Tiffany joins us now for more. Tiffany, good morning. So that's October. How much visibility do you have beyond October?
Yeah, well, I mean, I definitely think there's going to be more discussion around the December meeting. It does seem like October at this point is another cut. And I think part of it will be looking at the data that the government has not been able to issue since the government closure. And I think the concern actually is that the longer the government stays shut within October, there's not an obvious catalyst for it to reopen like there has been in the past to date. That you could have major issues around collections in October as the BLS field workers literally just can't collect the surveys. So you could have an October where it's not about a delay in the data, but a skip. And, and that's going to be, a difficult situation for the Fed come the December meeting. I think it's going to make, their job even harder.
Tiffany, but how uncomfortable is it going to be for the Fed to cut with potentially not having the latest labor market report, but having a CPI report that estimates are showing a hot print?
Yeah, I mean, so I think that they'll obviously look at a wide range of data. We have gotten other private indicators of labor markets, the ADP data in particular, which has been, very consistent, I think, with the signals that we've gotten from the official, the BLS data, that labor market activity has slowed quite dramatically. And as Mike McKee discussed, there's definitely supply and demand factors that are slowing that. We've seen immigration policies that have reduced labor force potentially even reduced labor force supply, certainly slowed the growth of it. But on top of that, though, you've also had these trade policies, tariff policies that are increasing costs across industries, making it a very challenging environment for some industries to work in, and that is resulting in a reduction in labor demand as well. So at the current point, we've seen a reduction in both. Of course, the Federal Reserve is worried about the downside risks to to employment. And so I think that's the consideration going into October. Certainly we will continue to see some inflation reports that are above the central bank's target as you get additional price adjustments. But it does look like that's relatively contained. That is and that will wear off eventually.
The impact of tariffs, will that become a bigger story in December, given a lot of companies, even during this earnings seasons, were talking about the fact that they were able to bear the brunt of it, but at some point they're going to have to pass on the cost to consumers?
Yeah, I mean, and I do think that, as the thing about uncertainty is, and we've had elevated policy uncertainty, is that you don't really want to make any adjustment to your business because you don't know. You don't know the sort of rules of the game, if you will. You don't know what the policies will be. But as companies become more certain that the tariff policies are here to stay, then that means they need to make the adjustments that that they maybe have been holding off on to kind of see how this shakes out. And I think companies have various ways that they can react to this, and within industries there'll be competitive forces that they'll have to deal with, and that's been one reason that we think that the price adjustment piece of this might not be where the full adjustment lies. And it does look like, when we look across a range of data, that the labor markets and companies trying to manage costs and labor costs in particular is also being part of the adjustment here as well. So if you have larger companies that can hold down prices, they can afford to do so, then that's a really tough operating environment for everyone else. They're going to have to cut costs. They're going to have to cut labor in order to to continue to manage in that environment.
Given some of the forces you described, Tiffany, do rate cuts help?
So the Federal Reserve would still characterize their policy as being restrictive, in restrictive territory. And I think when you look at investment trends, excluding AI, they are quite stagnant, maybe even contractionary. That's both business investment ex AI as well as residential investment. Just looking at that alone would suggest to you that interest rates are in restrictive territory. So I think the Federal Reserve would say, just given the balance of risks, moving back to a more normal stance, more neutral stance at least, is a very reasonable policy, and that's what we think they're doing.
Of course, there's some debate about what neutral is, Tiffany, and it's a wide range of estimates. Where are you, and where do you think the Fed ultimately is?
Yeah, I mean, we think, we've sort of argued that on a real basis, kind of a 0 to 1%, these things are very uncertain, as you suggest, 0 to 1%. So that kind of suggests, 2 to 3% real neutral interest rate. We think that could be higher within the band. There are various factors that have contributed to, a potentially higher, slightly higher neutral rate within that band over the last, number of years. But ultimately, that's going to be something that the Federal Reserve has to figure out. And, as they adjust policy slowly, they will get indications from the economy. And as they're cutting interest rates, if they see the economy's, reaccelerating, and inflation is stickier than they expected, then, they can stop, they can continue, they can pause, see what happens, and they'll kind of get more, they'll sort of feel their way to neutral, if you will, and get more information. One other thing just to note as well is that fiscal policy in the U.S., we will get, more of the benefits from the offsetting tax cuts in the One Big Beautiful Bill Act in 2026. So that's something else that the Federal Reserve is going to have to navigate that could be tricky as well.
Tiffany, appreciate the time. As always, Tiffany Welding of PIMCO, speaking to the go slow approach of this Federal Reserve, and in many ways describing why this situation is so different to where we were in 24 when this Fed was a lot more aggressive. Equity futures on the S&P high by 0.75%. Equities advancing this morning, going into the cash open later on this morning. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. President Trump suggesting the $20 billion U.S. aid to Argentina could be contingent on Javier Milei winning the upcoming elections. Millet is less than 2 weeks out from a pivotal midterm election that is set to decide the future of his reform efforts. At least 30 news organizations rejected the Pentagon's new press policy. The policy prohibits journalists from accessing or soliciting information that the Defense Department doesn't make available for them. Outlets and networks including Fox News, CNN, ABC, CBS and NBC, none of them signed the new policy by Tuesday's deadline. Stellantis vowed to invest $13 billion in the US over the next 4 years to help mitigate tariff costs. The plan will boost annual vehicle production by 50% over current levels. The dollar figure includes R&D, supplier expenses, and investments in manufacturing operations, making this the company's single largest investment ever. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, we'll set you up for the day ahead. Plus, we'll catch up with David Kelly of JP Morgan Asset Management to break down these markets and look ahead to the economic data we're not getting this week because the government shut down. So it's all about CPI. A week away, a week or two away, and then it's into the Federal Reserve at month end. From New York, this is Bloomberg.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We've got a 2-year target on the S&P of 8,600. And we don't think it's unrealistic you'd get there. You have a GDP that's reaccelerating next year. You've got multiple drivers of that. You have an AI industrial revolution going on that we think is very, very real. We're feeling that there probably should be some kind of a pullback. My guess is it'll be lighter than you think.
Steve Orth of Federated, bullish on this market going over the next 12, 24 months, 2 years out. Equity futures right now, 0.75% higher on the S&P 500, on the Nasdaq up by 1%, on the Russell up by a little more than that. The opening bell about 42 minutes away as we count you down to that cash open. Here's the trading diary for the rest of the week at 9:15 Eastern Time. Talked a lot about this. The Treasury Secretary, Scott Bessent, and Trade Representative Jamieson Greer holding a press conference on the economy. Look out for that. Look out for this too, 2 p.m. Eastern Time. The Fed releasing its beige book. Also today, some Fed speak for you from Myron, Waller, and Schmidt, plus earnings after the bell from United Airlines. On Thursday, we would have been getting a lot of data, looking very unlikely due to the government shutdown. On Friday, President Trump meeting with Ukrainian leader Zelensky in Washington. That's the next big push on the foreign policy front.
Yeah, and the president talked about this when he was having this crowning moment and achievement in Egypt when it comes to what happened in Gaza. He said he wants to shore up what's going on in Ukraine. He said yesterday Zelensky's going to come in asking for tomahawks as he expects. Pete Hegseth, the defense secretary, said there will be a weapons discussion, maybe not so much on tomahawks, but this is all going to be about potentially more weapons for Ukraine.
Stay tuned going into the weekend. As we stick with the markets, let's stay with the US. David Kelly of JP Morgan writing, many investors should likely consider diversifying their portfolios by adding alternative assets and international equities. David joins us now for more. David, welcome to the program, sir. Let's get to that statement. Give us the why. Why?
Because we've got a tortoise of an economy and a hare of a market. I mean, if you look at sentiment, it's practically submarine sentiment. People feel absolutely miserable about this economy, and I think that's overstated. But if you look at the economy itself, we're slowing down to a crawl in the fourth quarter. We're going to pick up a bit next year, but I think it's going to be less than 2% real GDP growth. But meanwhile, we've got this extraordinary stock market. We've got very high corporate margins, and on top of that, we've got price-earnings ratios which are close to the dot-com bubble peaks. And when I look at that, it is out of whack. And so people should do everything they can to diversify their portfolios. They've drifted into being very overweight large-cap U.S. equities. And so I think they need to row against the tide and add other assets which are just not that expensive.
David, that's a struggle because the names we're talking about abandoning, NVIDIA, Microsoft, Amazon, Meta, Alphabet, these have delivered fantastic gains. AMD, Broadcom, on any given day up 10, 15%. David, do you really want to give that up?
Well, there are two things. First of all, you got to be tax smart about this. So you should use new cash, stuff that you don't have to pay capital gains tax on, to try and rebalance the portfolio. But second, if you go back to the dot-com bubble, and there are growing echoes of that in what we're seeing here, every company was not a winner. There were some great companies which exist today and which are leaders today, which were leaders back then, but there are many other companies, more companies, who disappeared then. So I think people just have to be very careful about valuations, company by company here. And it's, I just think that everybody is essentially overweight the most expensive part of global capital markets right now.
So where do you suggest they should be looking?
Well, the first thing is U.S. investors are chronically underweight the rest of the world. And one of the things we've seen so far this year is the dollar's been coming down. And we know that the Fed is very likely to cut at the end of this month and probably cut again and just keep cutting, even though the economy is moving forward. Now, the European Central Bank is not going to be that dovish. I don't think the Bank of England is going to be that dovish. The Bank of Japan is going to be raising rates. So all of that tends to push the dollar down. So we think the dollar will fall. And what we've seen in the past, and we show this in our guide to the markets, if you have a long period of dollar weakness, you also get a long period of international equity outperformance. And so I think that's the first place I would go is, why do I only have 5% or 10% or 0% of my equity money in international? That's the first place I'd go. And then the second thing is just alternatives. Alternatives in general have not rallied as much as these sparkly, champagne-filled public markets in the last 3 years. And that does leave some opportunities there.
David, though, when you think about international, do you have any pause or concern in terms of what we're seeing in terms of the rhetoric out of Washington and potentially companies and countries that can get caught up in this trade war between China and the United States?
Well, yeah, I think you've got to look company by company, but ultimately the rest of the world collectively is economically stronger than the United States is. So if you pick a fight with every kid in the playground, you may have a problem here. I think what's happening is a lot of countries are trying to find ways of operating outside of the U.S. sphere of influence. So I think what you'll see is over time, other countries, first of all, they're doing more fiscal spending in places like Europe. I think in China, they are very aggressively building up their technology base so they don't have to rely as much on US technology. So I'd want to have a bet outside the US. I realize that what the US is doing is not helping them, but it's not helping us either.
Well, David, let's talk about Europe. So European banks are up by 58% so far this year, and the ECB is projecting growth for 2026 of 1%. Now, if the US economy is a tortoise and the market is the hare, what on earth kind of an animal is Europe right now, with the economy basically stagnant and the equity market ripping?
Well, Europe is a bit of a tortoise, but remember, you've got virtually no population growth in Europe, so on a per capita basis, it's not quite that bad. But these companies, the banking industry in Europe has been very cheap for a long time. So I think the rally that we're seeing in European financials makes sense. But I think you also just go company by company, and also recognize that the euro is, I think, very undervalued. And if the euro goes up in value, and every time the euro goes up 5%, your European stocks are going to go up 5%. So it's a lot of the gains we've seen in European equities so far this year have been because of a rising euro, and we think that trend has got a long way to play out.
The pushback I think we're getting around Europe at the moment, David, and I'd love your input on this, is when it comes to the major theme at the moment supporting both the economy and the market, which is AI, that Europe's in no man's land, that they barely have any competitors on the tech front, and when it comes to the energy needed to supply it, they're trapped by the left and the green lobby and can't do anything in response. David, what can they do to break out of that? And do you see any sign of that happening?
Well, yeah, they're not leading this charge right now. I think that's true. It still doesn't mean you should avoid individual European companies. And remember that, in the US, there's tremendous investment going on in AI. There's not quite as much cash flow coming in from genuine users at the end. People are getting real value out of AI. So it's quite possible the capital spending cart will get ahead of the sort of income horse in AI in the US anyway. And also, we have to sort of look at this over time. Is AI really going to be a technology that you can sort of fence in the way that, for example, Apple was able to fence in hardware, and make money out of hardware forever, or Microsoft or Meta. So it's not clear in AI space who the ultimate winners are going to be. Is this a technology that really there will be one winner today, it's going to be the same winner 10 years out? Or will it mutate over time? And will that give an opportunity to companies who aren't necessarily leading the charge here, but are able to catch up?
True. Thoughtful. As always, David, thank you, sir. David Kelly there of JP Morgan Asset Management, with equities near session highs up by 0.8% on the S&P. Coming up tomorrow, Brian Levitt of Invesco, Erica Najarian of UBS, Neil Dutta of Renmac, and a conversation you do not want to miss. Fed Governor Christopher Waller, live from New York City this morning. Good morning to you all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Let me break down our CapEx into the buckets that we spend. Big part of it is cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. It is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg. All right, we're in for a rally after some big bank earning beats. 30 minutes until the start of trading. I'm Matt Miller. Danny Berger still on assignment. She'll be back tomorrow. Open interest starts right now. Coming up, more bank earnings roll in with trading revenue soaring at Bank of America and especially at Morgan Stanley. A parade of data center deals as well as the energy industry rushes to keep up with AI demand and tensions simmer. Cooking oil becomes the latest pawn in the U.S.-China trade war. Stocks to watch today include the banks again, but this time we have big green arrows here. Bank of America up 3.5% after beating expectations on net interest income. Morgan Stanley knocking the cover off the ball with trading revenue of more than $4 billion, beating out Goldman Sachs has been working to do. And you see NVIDIA there also up almost 3%. It's joining a consortium with BlackRock to buy a data center company for $40 billion, the biggest data center purchase of all time, and an analyst raising its target on NVIDIA to a level that would value the company at almost $8 trillion in the next 12 months. There's a lot going on. Let's get back to those bank earnings. I want to bring in our Wall Street, Chief Wall Street correspondent, Sridhar Natarajan. He joins us here at the desk. So, Sri, I was looking at the chart of Morgan Stanley trading revenue versus Goldman Sachs over the past couple of years, and they've been trying and trying and trying, and they finally overcame their biggest rival.
And that's important, and I know you don't hold much value to banks beating analyst estimates.
That's
but
true.
In this case, significantly beat estimates, notched more than $4 billion in the quarter again, and were roughly $400 million ahead of Goldman Sachs. And that's important because in the last 2 or 3 years, Goldman Sachs has had a stranglehold on this business as the dominant player there. It was a crown that Morgan Stanley held for many of the years after the global financial crisis. And when they lost it, it did hurt inside Morgan Stanley, and it has been a sore point for CEO Ted Pick. So he will have a pep in his step with the numbers out today. But not just that. Investment banking fees up 44%. Great performance across advisory, debt capital markets, equity capital markets, and in their wealth and asset management business, the wealth management business that they love to call the ballast of their business, known for its stability. Revenue significantly higher. They pulled in roughly $80 billion in net new assets, which matches the target they've set, quarterly target that they need to meet to get that roughly $1 trillion in net new assets every 3 years, and pre-tax margin up to roughly 30%. It's something that Ted Pick had promised to analysts and investors when he became CEO. So hitting that mark and staying at that mark will be important.
What about Bank of America? They also came out, I heard Allison Williams on Bloomberg Radio this morning saying the net interest income beat. How key is that?
It is important for Bank of America for multiple reasons. One, the stock has been languishing all year. In fact, has been languishing since the Fed started hiking rates back in 2022. So it will be a big fillip for the bank to be able to beat expectations. Also remember that the thing that has been weighing down on this bank has been its held to maturity treasuries at low rates that has not been a big boon to its net interest income. As those securities start to roll off and they replace them with higher yielding securities, that will benefit NII. And Allison has said that will be a tailwind for the bank. When you match that with some strength in the investment banking business, that will be a big help for Bank of America. And I point this out also because at Citigroup, which is their closest rival, at least in the investment banking space, not JP Morgan or Goldman Sachs or Morgan Stanley, Citigroup had been making some good strides with their new banking head, getting ahead of Bank of America for much of this year, to now post a number in the third quarter where they're significantly ahead of Viz Raghavan's crew at Citigroup. That will make them happy out at B of A.
All right, Sri, thanks so much for wrapping that up. Sri Natarajan talking about the banks, and we're going to get, by the way, also to all the cockroach comments today. From the banks to the AI boom, investors led by BlackRock's GIP agreed to buy Aligned Data Centers in a deal that values the company at $40 billion, including debt. Joining us with more is Bloomberg Tech co-host Caroline Hyde. So, Caroline, I think it's the biggest data center deal ever, and there's a huge consortium with Kuwait and Mubadala joining them.
Yeah, MGX, which is the AI infrastructure investment fund coming from Mubadala. But we've also got XAI in the mix, Microsoft in the mix. Basically, every big player that needs compute or wants to finance compute got in on this consortium about a year ago. And here we have the first deal, $40 billion. Overall, this focus on AI infrastructure has about $100 billion of a pool of capital to put to work. They are targeting Texas in this particular instance, $40 billion. They're buying it from Macquarie, which, of course, is an Australian institution that has been all in on infrastructure of all guises for years, and they've been betting on telecoms, but they've also been betting on these sorts of data centers, and it couldn't come at a more frothy moment in the world of AI, so no wonder they're managing to get this deal pulled off, because everyone knows that really what's going to fail us is a lack of power and a lack of infrastructure, rather than perhaps a lack of demand when it comes to AI.
ASML, it's a Dutch company, right? A lithography company.
Extreme ultraviolet lithography.
There you go. So what's the story with ASML today?
The story is everyone's been wanting in on the most sophisticated side of chips because of AI as well. So you're wanting these lead-edge logic chips as well as memory, and people need the equipment to build them. What's interesting, though, is China kind of pulled forward their demand. 42% of their fiscal third quarter numbers came from China. Now, we know that that's going to tail off in the second half and into 2026. The CEO did a good job at signaling to the market and to analysts, look, China's going to fall away because of the geopolitical moment we find ourselves in, but I've got demand here to keep on going. He says, more broadly, 2026 is going to see sales not fall. He didn't say we're going to have ultimate growth, but he did signal that they're going to be able to make up for some of that lack of demand from China from others. So it's all about EUV, but it's also about equipment more at large. They had the biggest, though, amount of EUV demand since 2023. So that was a really good sign that still the demand is there to keep buying this very expensive equipment.
I'm sure you'll talk about this at 11, but HSBC, Frank Lee there, upgrading his share price target on NVIDIA. If it comes true, that would be an $8 trillion company in 12 months.
I'm sure Jensen probably thinks it'll be more than that in 12 months. This is the company that still owns the ecosystem. Yes, AMD's been chipping away and been getting that deal with OpenAI. And yes, you start to see all these other rivals try to come to the fore. But more broadly, if you want the compute, if you want these AI data centers, you're putting $40 billion into Texas, you're getting N-Scale doing a deal with Microsoft to keep on building out in Texas. They're offering 240 megawatt amount of compute coming from Texas on top of basically the overall, I think that takes it to 2,000 NVIDIA GPUs they're going to be putting to work for Microsoft alone in the next 2026 to 2029. Demand's insatiable. No wonder people are going to try that market cap.
We really are partying like it's 1999.
We are.
Caroline Hyde, looking forward to Bloomberg Tech at 11 o'clock. Now let's get to politics. Tensions continue to simmer between the U.S. and China. President Trump threatened to stop trading cooking oil, buying cooking oil from China in retaliation to Beijing not buying soybeans from us. He posted on Truth Social yesterday saying the U.S. can easily produce it ourselves. And by the way, I think we're talking about used cooking oil. With the latest from Washington, we are joined by Bloomberg senior editor Mike Shepard. Is that right, Mike? Are we talking about recycled cooking oil?
We are talking about recycled cooking oil, and it goes into biodiesel that is increasingly used as an alternative fuel here. This is not a new issue. The Biden administration had tried to take it on, and the Trump administration, when it took office, even took some steps to try to rein in Chinese purchases. But, Matt, it adds to the growing list of issues between the U.S. and China when it comes to trade. We saw earlier this week shipping really burst into the fore as something that is extremely contentious with the two and is being used as another bargaining chip. Rare earths elements, yet another one. Yet with all this noise, Matt, we still do see two things happening that are important to remember. One, officials from both sides are still talking, and they've been having discussions this week here in Washington on the sidelines of the IMF and World Bank meetings. The other is that U.S. officials, for their part, still see prospects for a meeting between President Donald Trump and his Chinese counterpart Xi Jinping at the end of the month at the APEC summit in South Korea. So there is still room for the two sides to reach some sort of an accord. Scott Bessent, at an event earlier this morning, indicated that, look, he will continue conversations with his Chinese counterparts, and he may even meet with He Lifeng before President Donald Trump's meeting with Xi. And Bessent may even go to Asia beforehand, too, to try to set the stage. Whether we get any sort of a real breakthrough this week here in Washington remains to be seen. There is a lot to work through. We'll try to get some more clarity, though, from the U.S. side when Scott Bessent, the Treasury Secretary, and the U.S. Trade Representative Jamieson Greer are set to give a news conference shortly and perhaps offer a little bit more sense of what each side, the U.S. and China, is willing to start giving in order to get that trade deal that both sides are really hoping to reach.
Yeah, we'll be watching that very closely as trade headlines have moved markets over the past few sessions. Mike Shepard there in Washington, thanks very much for your insight. Quick check on what's going on in markets. Feeling a little exuberant today, looking at a 0.7% gain on the S&P futures right now. NASDAQ futures up almost 1%, and Russell futures up more than that, with treasuries at 4 even. Let's get a look at some of the movers on our radar today. Stellantis vows to invest $13 billion in the U.S. over the next 4 years to reinvigorate its business and mitigate tariff costs. We'll be talking about that later on in the program. Dollar Tree projected earnings per share to gain at a compound rate of as much as 15% over the next 3 years. Not sure if that's a great sign for the economy. And TrueCar agreed to be acquired by Fair Holdings in an all-cash deal valuing the automotive marketplace at about $227 million. Finally, Papa John's continues to rise, surging again today on a report that Apollo submitted a bid to take the pizza chain operator private at $64 a share. Private equity is awash in cash. Coming up, regional banks have earnings and ease concerns about the cockroach debate. Details next with Herman Chan. This is Bloomberg Open Interest.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Let's get to high interest now. Look at what's making headlines around the world. JP Morgan CEO Jamie Dimon said he will put aside his skepticism of Zohran Mamdani if he becomes the next mayor of New York City. He spoke at a conference in Washington.
I have to deal with the world I got. Not the world I want. And if he becomes mayor, so be it. If he becomes mayor, I will call him and offer my help.
Dimon added that he said New York will survive. We survived de Blasio. Dimon also warned of more potential cracks in credit markets, calling them cockroaches following the collapse of Tricolor and First Brands. Blue Owl Capital co-CEO Mark Lipschultz pushed back on those comments in an interview with my co-host Danny Berger at the CASE Summit in LA.
I guess he's saying there might be a lot more cockroaches at JP Morgan, or I'm not sure I know what he's saying. I mean, it's not a private credit issue. I mean, it's a liquid credit market.
And Oaktree co-founder Howard Marks said his company actually made a profit from investing in First Brands. He said they sensed red flags early and made their exit, a rare feat as some of Wall Street's biggest firms face losses. But months, Howard Marks said, for months, they had seen this coming. Now, Bloomberg Intelligence senior U.S. regional bank analyst Herman Chan joins me at the desk, and I think this is fascinating because Dimon, not only did he say cockroaches, but he kind of threw some shade at private credit, right? Implying that the BDCs, the business development companies that hold these funds, will feel the heat if bankruptcies increase. And Mark Lipschultz was like, not us. Right. We're doing our fiduciary duty. And Mark said, not only did we do our duty, but we actually made money on this trade. So what does it look like from a regional banking perspective?
Yeah, so regional banks kicked off earnings reporting today with PNC, First Horizon, and Citizens. I would say we don't see any cockroaches on the regional bank's balance sheet so far. So far, so good. We actually had a pristine credit quarter so far with net charge-offs down, provisionings flattish, and some early credit metrics like non-performers down as well. That being said, some of the regional banks that will report later in the week, like Fifth Third and First Horizon, will have some exposure to Tricolor and First Brands.
So we have had PNC shares slide in today's market because I guess what? They're paying more for deposits, or that's what their earnings showed? They
really showed a strong quarter in terms of the Q3 numbers, specifically on fee income and capital markets activity. Their fourth quarter guidance actually came down a little bit, disappointing because of the strong 3Q. So I think it's just a matter of having a really robust quarter and then disappointing a bit for fourth quarter results.
What do we know about the others that are out today? Citizens Financial beats. First Horizons also jumping after it beat. So what do we know about those two?
Right. So I think the general theme is top line growth really strong, really driven by fee income, capital markets activity across the three names that we're talking about today. Lending was a bit soft, especially with we were a bit disappointed on the commercial lending front. So we'll see how it shakes out for the rest of the
names that will report, but overall really solid results all across the board.
I was talking with David George from Baird yesterday, and I noticed when I looked at his coverage universe, he has outperforms on a lot of the regionals and not on the big money center banks. And he told us, you know, that's because those big six shares are pretty expensive right now.
Right. They've run a lot over the past year or so, given the robust trading activity and strong advisory and capital markets growth. The regional banks don't have that much, but they are positioned well for interest rate volatility, and we've seen a lot more M&A in the regional bank space, and that could lift potential sellers as well.
All right, Herman, great to have you on the program. Thanks very much. Look forward to more of your research on Bloomberg Intelligence. BIGO is how you can access that. Herman Chan runs our coverage of the regional banks. Coming up, Infrastructure Capital's Jay Hatfield on whether markets are pricing in the risks of a recent U.S. trade escalation. I will say, you know, when Jay was on last year, when he was on earlier this year, he was making some forecasts that dropped our jaws, but he's turned out to be right the whole time. So here's one investor that got it right as everybody else was running scared. This is Bloomberg Open Interest.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachian Zahran, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Used to be, one would say, what's that got to do with the price of tea in China? When they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
There's a lot of complacency around tariffs. It's clearly meant to last, and I think the market is struggling in terms of how to discount that. And all I can say now is, again, I think when I look at market pricing, when I look at volatility levels, it's far too low relative to the underlying risks that are building around the tariff issue.
That was Citi's chief global macro strategist, Jim McCormick, on Bloomberg earlier. Let's bring in Jay Hatfield. He's founder, CEO, and portfolio manager at Infrastructure Capital. And, you know, as I was saying before the break, you've been coming on here for a couple of years now. And last year, you told me and Katie and Shanali you were bullish. You told us why. You had made an interest rate call of 3.75% on the 10-year. And we thought maybe you were crazy, right? But it's starting to look real. I mean, we're looking at 4% even on the 10-year. How is this all happening?
Well, the two leading indicators of the economy,
which of course the Fed does not use because that's one of their 3 flaws, is they're terrible forecasters, is the money supply. And we use M0, but you can use the other ones, and the housing sector. So in a normal cycle, the Fed tightens, the housing sector crashes, and we have a recession. In this case, we never really had a boom, so we're having just a minor recession in housing. And of course, we all know there's an AI boom, but it's not like the internet boom. This is a economy-wide boom, which is even affecting my old sector when I was an investment banker, utilities of all things. So you have the tech spending offsetting the weakness in housing and construction. So we're avoiding recession, but we thought that would weaken up the employment situation. And we had sort of the opposite reaction to the president. We're like, oh, finally they got it right, because it was delayed by 3 months because of their poor ability to detect that. So we thought that would be the catalyst for the Fed to cut, because they're Keynesian, so they care about the labor market. And that's what's unfolded. And that's why we think we will get 3 cuts, even though the inflation data is ambiguous, possibly not available. Well, I guess it's going to be available, but it's going to be ambiguous.
Well, and you have different inflation data, right? Because we're looking at core CPI at around 3% and maybe even over. But you have your own CPI, CPIR, I think you call it. How do you adjust that again?
Well, so this is really, really hard to believe, but the BLS doesn't even update their shelter calculation for 6 months. So it's like we were reporting on the market 6 months ago. It's worthless. And they use renewing rents versus market rents. So they're 2 years behind. This is why the president calls the Fed too late, because they use CPI-U instead of R. If they had used R, so in other words, just use market rents. There's this thing called the internet. You can look them up. They encompass every single home in the country, and it's real time. So you don't need the BLS to calculate shelter for you. So we just use that number. And so CPI-R year-over-year core is about 1.3%. It's less important in PCE, but it's below 2. So instead of saying, well, I think shelter is going to come down, they should say, well, it's already come down, and we just haven't gotten around to measuring it properly. So the issue with the BLS really isn't their employment data, it's their inflation data is terrible. And it makes the Fed terrible at their job. And that's why we really haven't been focused as much on independence of the Fed, but more on incompetence.
By the way, have you talked to anybody in the administration about this, or anybody in the new BLS management about this? Because I know President Trump follows your research and has, tweeted about some of the things that you've pointed out.
We've had no direct contact, but I do think that not just us, but everyone knows about this. This is not a secret. Malpass has talked about it. I don't know why it hasn't been fixed. I don't know why the Fed doesn't just adjust it themselves. I mean, they can use our numbers, but we're just doing it from the internet. It's a very simple thing to do. So it's just pure incompetence, needs to get fixed. Hopefully the new Fed chair will fix it.
All right, Jay, we're going to hold you over. We got the opening bells next. I know you recently raised your year-end price target for stocks, so we'll talk about that. We'll talk about the potential or the debate about whether or not this is a bubble. I talked with Paul Tudor Jones about that yesterday as well, and the trade war that seems to be moving markets over the past couple of sessions. Jay Hatfield staying with us through the opening bells. A check on futures as we head there. We're looking at gains today as we get more big deals in AI, a $40 billion data center deal, and banks beating, and Morgan Stanley just knocking the cover off the ball with trading revenue. Right now, futures up 0.7% on the NASDAQ, 1%. This is Bloomberg.
Let's suppose you hire people in this business and they start losing money. How long before you say, you know, this isn't for you?
When we bring people on, we're looking for a previous record of success. So we don't train people, particularly on the investing side, right out of college. They would have come with already experience. Then there's also the why are they wrong or why are they right? Are they right for the right reasons or are they wrong for the wrong reasons? And then there's also collegiality. How do you work in a team? But I would say that within a 2 to 3 year period, usually you get a sense whether, someone's talent.
Do you ever hire English majors or history majors, or you only hire STEM majors?
I encourage my boys to go to liberal arts and to be in whether it was poli-sci, economics, and be fluent in other areas. So I think having a broad perspective can be very helpful.
If somebody is very good at what they do you say to them, you're very good, but go to business school, or you say, don't go to business school because you're very good at what you do?
So I didn't go to business school, and I think that the markets are a great business school. So it's we don't encourage people to go to business school. We encourage them to take the CFA. That's a good way to get more technical trading. If it was something that they feel they wouldn't be complete without going to business school, there have been people who've done nicely with us who've wanted to go, but that's been more the exception.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at gains across futures right now, about 0.7% on the S&P. We did fall yesterday on concerns about a cooking oil spat, cooking oil versus soybeans, but only 0.2% on, and in fact, less than 0.2% on the S&P. Ringing the bell at the New York Stock Exchange, Hewlett-Packard Enterprises celebrating a 10-year anniversary of its listing, and the stock has done very well over that time. It's up almost fourfold, and in the last 5 years, it has tripled if you reinvest your dividends. So I always look at total return on the terminal. Not publicly traded, but Interbrand ringing the bell down at the NASDAQ market site. More interesting today is obviously the bank earnings. So let's take a look at what's going on. These shares climbing. That's not what we saw yesterday, of course. Goldman Sachs and Morgan Stanley dropped. Sorry, JP Morgan dropped even after beating estimates. But today, Bank of America beats estimates. It's up 4%. Morgan Stanley makes more than $4 billion in the quarter on trading. It's up 5%. And then NVIDIA right now, it's up 2% after it joined a consortium with BlackRock's GIP. I think it's going to be called the AAIP, and they're going to buy ADC for $40 billion. It's essentially a data center play with a lot of people involved. Let's go back over to Jay Hatfield, founder and CEO and portfolio manager at Infrastructure Capital. And Jay, let's start on AI because of, this big deal, and every day it seems like somebody else wants to do 10 gigawatts of compute, which is a massive amount of power. I think OpenAI has announced 26 gigawatts of deals in the last couple of weeks alone. Do you think this is a bubble? Because a lot of people have said, in fact, Bank of America put out a survey, 54% of fund managers said they think we are in an AI bubble.
Well, I'd say two things about that. First, that's the great thing about the U.S. capital market is we do have bubbles, and that attracts capital into the sector, and we're always first in technology. So I wouldn't be so negative on bubbles, but there's a de facto bubble function on the terminal. So if you hit NVDA, equity, EEO, go, you can look at 26 earnings and 26 earnings multiple, and then you can switch it to headline growth. And you can see that NVIDIA is growing well over 20%. The PEG ratio for the market's about 2. So it should trade at a 40 multiple. So I think there's like another 15 or 20% upside just on a GARP basis. And I'm pretty certain that we will be in a bubble. And so therefore, probably NVIDIA will trade at a 3 and 4 PEG at some point. But for right now, it's actually like we hold it in our macro hedge fund because it's a reasonably priced company. The only exception is Tesla in terms of the Mag 8. So I would just look at those companies.
Tesla is the only one that looks like a real bubble to you.
Absolutely. It trades at 150 times earnings, and we don't believe in any of their businesses being very profitable in the long run.
All right, so let's put Tesla, well, no, let me actually hit on that for a second. Tesla has been one that just crushes shorts. I remember when they IPO'd, you know, Corey Johnson used to be on this network all the time, just ripping apart their earnings or lack thereof, and yet the stock continues to climb. Don't you worry about that?
Well, I would never short it. So just to be clear, really Tesla was the first meme stock, and you may like or not like Elon Musk, but a great stock promoter. You know, financing is secured. So he's always going to have a new business that will probably keep the stock up, but economically and in the long run, it's almost certainly not worth $400 a share.
All right, so back to the rest of AI, because that's where the real money's being made, right? And this is what Nir Kesar argues on Bloomberg Opinion, that, you know, it's not just those stocks even. 95% of the S&P is going to grow earnings next year, and these companies aren't leveraged like the companies were in the dot-com bubble, less than 100% debt to equity, and back then it was twice that. And the other thing is we're in kind of a different environment, right? Paul Tudor Jones talks about the fact that in 1999, we had a budget surplus and the Fed was raising rates. Now we're just spending like drunken sailors, and the Fed's cutting rates, he thinks, down to maybe 250 at a terminal rate. What's your take?
Well, the way we estimate the terminal rate is, if you look historically, and you can look this up on the terminal as well, the Fed fund rates trades at 75 basis points over inflation. So to assume 250, you would have to assume 1.75 inflation. By our numbers, we're already there. When the money supply is negative, you're going to have low or negative inflation. So if we get to 175, and the Fed acknowledges that, we talked about that, so we think we're already at 175. So that's entirely possible. That's in range. We're really assuming 275, and that's why we have 375. The 10-year always trades 100 over the Fed funds rate.
It's fascinating that you think inflation is going to be 2%. I guess that's not using the measure that the BLS currently gives the Fed. But I want to talk about the trade war, because that has been driving markets back and forth. And also I teased that we would cover this. President Trump on Friday said he might raise tariffs 100% more on China. That drove us down to the biggest drop we've seen since April on the S&P. Then Sunday he said everything's going to be fine, so we rallied up 1.5% on Monday. You know, now we've got this cooking oil thing, which is even difficult to believe that we buy that much recycled cooking oil from China, but they're definitely not buying soybeans from us. What do you make of this, and how should traders be paying attention?
Well, one key distinction is there's a difference between tariffs, which we're in favor of because they lower the budget deficit. So we're forecasting that the budget deficit goes to 1.3
But you don't mind that we have to pay that tax, that we U.S. consumers end up
I
footing the
do,
bill?
And that's one great thing about that tax is the president can impose it. It would never be passed by Congress. It's going to be unpopular, and probably the Democrats will sweep in the midterms because taxes are unpopular.
Especially regressive taxes.
Right, but he's imposed that, so that's good because that's probably the only way you're going to get fiscal conservatism. But I would distinguish tariffs from trade wars. So with 20% tariff, you can manage that. A third goes to each side, and consumers are a little bit upset, but not that upset. But if you have 100% tariff, you're really disrupting trade flows, and that's terrible. The good news, like we told a bunch of reporters on Friday, that when the market was crashing, well, look, it's bad, but probably stabilize on Tuesday. It actually did sort of the reverse because of those tweets you mentioned. But it's okay to have this overhang during earnings season. I would just be aware of that after earnings peaks in a couple weeks, then people will focus on the trade war. We think it's going to be resolved positively because it sort of has to for both sides, but there's going to be ups and downs. And then, of course, the budget shut down. But none of that's going to be material when you get this type of earnings reports. We think they're going to be really strong. We already saw the investment banks blow it out. We think the tech companies will do well, even beat expectations. So always play, all the cyclical elements of the market comes from earnings season. And so you can be virtually called, even in the short run, like you can make a call on Friday that the market's going to stabilize on Tuesday simply because the big banks are reporting.
All right, I mean, earnings, Nick Collis from DataTrek points out they've beaten by 8% in each of the last 2 quarters, and it looks like that could happen again. I want to get to the cockroach debate because Jamie Dimon, because you're kind of bullish the backdrop like Bruce Richards, right? And Jamie Dimon is seemingly always worried. Now he says, you see one cockroach, there are probably more. Mark Lipschultz pushing back on that. Howard Marks, proving that they don't have any issues. What's your take?
Well, it's also important to note that Jamie Dimon really runs the biggest bank in the United States. So it's like driving an aircraft carrier. So you have to be conservative. You have to assume everything's going to be terrible. But we have to make money in the markets. And so you have to look, and these were very low quality companies.
First Brands and Tricolor.
Right, which Blue Owl said, but we think it's also true for KKR and other high quality private equity firms. They have high quality counterparties like Harley Davidson. They don't have these small, small low
car
quality
filter maker.
Yeah, and roll ups and these sort of low quality companies.
Subprime car loans.
So we think it's because there was fraud. It's not a wide based credit problem.
Allegedly,
right? Well, it looks like fraud, but. So therefore, it's not a broad-based economic problem. So maybe there's one more bankruptcy, but for the private equity firms, they have higher quality counterparties. In the case of KKR, they only have 10% in asset-based financing. And not that they want to rely on this, it's not even their money. Like this would be their investors losing money. Of course, they don't want that, but it wouldn't really affect their fee stream materially. So it's not like banks where they actually take direct losses. So we think that all the private equity firms are focused on KKR because they're the lowest exposure, highest quality brand.
So you like that? You're buying KKR?
We are, just because that's a great business. Like it's 10 times better than our business because people can take their money out of our ETFs at any moment, cannot take money out of private equity firms. And you need to have these huge brands because CalPERS and other institutions are locking their money up for 12 years. So it's not like we can enter as a competitor. We can compete in ETFs, but we can't compete with these big private equity firms.
Jay, thank you so much for sharing so much of your time with us. I'm glad we got through so many topics. Jay Hatfield there, he's the founder and CEO at Infrastructure Capital. Coming up, big earnings beat across the board in terms of finance again today. But today the stocks are up. We'll discuss the outlook with RBC's Gerard Cassidy. And happening right now, Treasury Secretary Scott Bessent, as well as U.S. Trade Representative Jamieson Greer, they're holding a news conference. Greer says China's rare earths move is a global supply chain power grab. And Bessent says China can't be trusted with the global supply chain. He says if China aims to be unreliable, the world must decouple. We'll continue to monitor their remarks for headlines. You can also watch the news conference on your Bloomberg terminal. Just type LIVE GO. This is Bloomberg Open Interest. That was...
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Time now for our top call, some of the analyst action and focus this morning. First up is HSBC, upgrading NVIDIA to a buy. The analyst sees room for significant upside in earnings amid the ongoing growth in AI that we report on every second of the day, and raising the price target 80%. That would mean NVIDIA, would have a market cap of almost $8 trillion. That is significant. Next up, Guggenheim initiating coverage of Uber with a buy rating, naming the company its top pick in the rideshare and delivery sector. And finally, Morgan Stanley raising its price target on Citi to $134, saying the bank delivered the highest quality beat across the board compared to its peers. Let's stick with bank earnings. Bank America's investment banking revenue beat estimates as deal-making surged in the third quarter. Morgan Stanley revenue blew past estimates, as well as trading finally got up and over Goldman Sachs. Let's bring in RBC's head of U.S. bank equity strategy and large cap banks analyst, Gerard Cassidy. Gerard, it's a pretty exciting, I think, week for bank earnings. Yesterday we saw some, I guess, share valuation weirdness with JP Morgan and Goldman Sachs, but today we've got real movement in, I guess, the trading league tables, right? Because Morgan Stanley had been aiming to get over Goldman Sachs with trading revenue for years, and they finally have achieved it.
Yes, the results, as you pointed out, across the board were very strong for all the large investment banks and the universal or money-center banks that had obviously big investment banking operations. And Morgan Stanley's results do stand out. Not only did they post those strong numbers that you just referenced, but they also put up a return on tangible common equity number of over 23%, which is a very strong number. So across the board, the capital markets revenues for all of the players were very strong. And even in regionals, PNC reported today, and they have a smaller investment banking operation, and their numbers were better than expected because of that as well.
But PNC, it looks like they're paying too much for their deposits. For some reason, the shares fell, at least in the pre-market.
No, that's fair. They had a greater mix of commercial deposits, and those rates were higher than your consumer deposits. And that was part of the reason that you saw some uptick there in the deposit rates. But we should also remember that it's also a timing issue. The Fed cut rates late in September, so the third quarter results don't really reflect the rate cut. And as that rate cut moves through on the deposit side for all banks, including PNC, you'll see lower deposit costs in the fourth quarter and into next year.
By the way, we have PNC year-to-date shares up now, down 5%. You haven't outperformed, so what kind of upside do you see there?
We think there's real strong upside for all the regional banks, and the reason being is our view that the Fed is likely to cut rates another 25 to 50 basis points in the next 6 months, and this will steepen the yield curve, and that will be very positive for regional banks. And not only that, we think loan growth could pick up, particularly commercial loan growth. And regional banks tend to have 60 to 70% of the revenues coming from lending versus the money centers and the investment banks, of course. Then in the money center case, it's closer to 55, 60%. So if we're right that the yield curve steepens and the loan growth picks up, regional banks like PNC and others will certainly see better performance in the next 12 months.
Morgan Stanley, on the other hand, up 32% year to date, and you have a hold or a sector perform on that bank. You think, what, the shares are overpriced at this point?
The challenge for and to be candid, we missed the run in Morgan Stanley, but when you look at the valuations of these companies, they're priced for peak performance, and they're delivering. And so that is, I think, one of the real positives here. The real question going forward is that will the capital markets activity in terms of ECM, DCM, and advisory continue to at this very strong pace? We think it will through the end of the year and into next year, but it's tougher to figure it out, of course, in the second half of the following year, meaning 2026. But if they can maintain, and their peers, this elevated level of ECM, DCM, and advisory, as well as trading numbers, then the stock is going to hang in there. But we got to remember we're near record levels in some of those categories, so it might be tough to surpass that. And the other thing, too, is when you compare the year-over-year increases this year for the investment banks and the capital markets players, the increases have been great. But next year, even with the elevated numbers, the year-over-year increases are, that so-called second derivative, the rate of change, is going to decline for all of these banks. So that's another thing investors have to keep in mind.
Gerard, great to get some time with you. Thanks so much for joining us. RBC's head of U.S. Bank Equity Strategy, Gerard Cassidy. I will mention you've got a buy on Bank America as well. Investment banking revenue there up 43%. It looks like Brian Moynihan is doing everything right. Coming up, Stellantis revealing its plan to jumpstart its battered business in the U.S. We'll have details on the maker of my Dodge Challenger next. This is Bloomberg Open Interest.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Stellantis vows to invest $13 billion in the U.S. over the next years in an attempt to reinvigorate its business, mitigate tariff costs, as well as discuss with Steve Mann, Global Autos and Industrial Research Analyst for Bloomberg Intelligence. I'll start off with a caveat, Steve. You know I love this company because they make my beloved Dodge Challenger. I love the Power Wagon as well. They have, I mean, Mopar or no car is a phrase I've grown up with. But they haven't made a lot of things lately, right? They just don't have much to offer out there. Oh, I have that F8 green color as well. They don't have a lot to offer out there, so is this going to help them boost their product offering?
Yeah, I mean, look, if you look at the past few years, you step back and you look at the past few years, you know, the company's basically been focusing internally, cost cutting, and that's at the expense of consumers. So, you know, their market share have been down relative to the big three and relative to everybody in the U.S. market. But, you know, with the new CEO, they're changing their focus. They're changing their strategy. Let's, you know, we've done a lot of cost cutting. Let's look, you know, outside of the company and let's listen to our customers and get them what they want. And that's why, you know, we have this $13 billion investment purely focused on the U.S. market.
Do they have a big tailwind, Steve, because of the Trump administration reducing regulations on things like, you know, CAFE standards? Because, you know, Ford has skewed like pro-environment. GM still has a 6.2-liter V8, but Stellantis is all about the Hemi, like the big inch V8 motor. And that was going the way of the dinosaur in the Biden administration.
Yeah, look, that's absolutely correct. You know, some of the emissions standards have been eased in the U.S. Penalties have been essentially eliminated related to, you know, fuel efficiency and emission. So that's also helping them bring back like the V8 Hemi, which is very popular. But look, Stellantis actually, you know, checks off 3 boxes here with this announcement. First, it's with the consumer. Second is with the UAW. Now they're saying that they're going to reopen the Illinois plant. You know, that's going to make the UAW rank and file very happy with that announcement. You know, they're going to satisfy the policymaker, the Trump administration. You know, with the $13 billion investment, again, purely focused to the U.S. And lastly, the most important is the shareholders. Right, 13 billion. Well, there's argument in terms of, well, are some of these money already been announced, been already spent? That's not the point. I think the main point here is that they're refocused on the U.S. They're most important, there's most profitable market. So with the new CEO, there's a change in strategy, and you know, they're looking to become much more profitable than they are today.
You know, you mentioned Antonio Filosa, the new CEO, met without really any fanfare because it took so long. It dragged on the search. Tavares was such a disaster. Do you think he could surprise us to the upside, Steve? And I've only got about 30 seconds here.
Yeah, it definitely surprised me. I had some doubts because he was at the helm of the U.S. market, the U.S. business, when Carlos was the CEO. But I think it's a benefit now. I see it's a benefit. He's seen everything. He was on the ground here. Now he's making the changes.
All right, Steve Mann of Bloomberg Intelligence, thanks so much for joining us. Look forward to reading more of your research. You can find that, by the way, if you look at Stella, if you look at GM, if you look at Ford, just type BICO GO on your Bloomberg terminal to see Steve's work. Coming up in the next hour, Sarah Ketterer of Causeway Capital joins us, plus the president of BlackBerry's IoT business talks about the expansion in, or really the takeover in car software. This company that you maybe never have heard of, QNX, puts its software in 250 million cars. And HSBC's, frankly, just upgraded NVIDIA with a price target valuing it at $8 trillion in 12 months. He joins us later in the program. This is Bloomberg Open Interest.
cidade estava sitiada.
Nisso, ao começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
CBS News on the Hour, sponsored by Eggland's Best.
I'm Deborah Rodriguez. It's payday, and thousands of federal workers are only getting partial checks because of the more than 2-week-old shutdown. Others aren't getting paid anything at all. The pain could go deeper. Correspondent Caitlin Huey-Burns.
President Trump is threatening more targeted cuts.
We're closing up programs that are Democrat programs that we were opposed to. So we're being able, and they're never going to come back.
His comments came during a meeting with Argentinian President Javier Milei, whose country has been offered a $20 billion bailout by Trump.
The Supreme Court is set to hear arguments this hour in a case that could undermine one of the last surviving parts of the Voting Rights Act and flip states from blue to red. CBS's Jan Crawford.
The court has restricted the use of race in other areas, such as when it ended affirmative action in college admissions. And if the justices use that reasoning in this case, that could really change the rules for how states draw up their legislative districts. The political implications could be huge, including in those current redistricting efforts for the midterms, possibly as soon as next year.
Homeland Security has complied with an order to dismantle protections around an ICE facility in Broadview, Illinois. CBS News Chicago's Ezel Rezai.
The fence coming down exactly 3 weeks after it went up. There was an 11:59 overnight deadline. We're seeing now that deadline was met. We know the fence went up on September 23rd, and just last week, a federal judge approved the village's request to remove the fence. They said it was a hazard, with neighbors also complaining it limited access and visibility.
The bodies of 2 dead hostages being buried in Israel today. A funeral for a third already held. A 4th set of remains identified today as a Palestinian. And Hamas is taking policing to an extreme in Gaza. Linda Gradstein from Jerusalem.
Hamas published a video showing its armed men publicly executing 8 men who were blindfolded, bound at the wrists, and kneeling in the street. The group said it was carrying out death sentences against collaborators with Israel and outlaws. The Palestinian Authority sharply condemned the Hamas crackdown.
NATO getting ready to stand up to Vladimir Putin, with Russia staging ever bolder incursions into NATO airspace.
If it poses a threat, I can assure you
that our military people have all the authorities they need to make sure that that plane immediately does not pose a threat anymore.
NATO Chief Mark Rutte affirming that NATO's rules of engagement do allow the alliance to shoot down Russian military aircraft, manned or unmanned, if necessary. Vicki Barker, CBS News, London. This is CBS News. Plans to build a Trump presidential library in downtown Miami have hit a snag.
A Florida judge temporarily blocked the transfer of the Miami-Dade College property to the nonprofit raising money for the library. She ruled the school's trustees failed to provide reasonable public notice before conveying the land. Miami historian Marvin Dunn had requested the injunction.
No president, including Obama, should get this land, much less for free. So it outrages me that this happened in secret.
The college's trustees plan to appeal the judge's decision. Michael Wallace, CBS News.
Loneliness and social isolation could increase the risk of dying from cancer. CBS's Michael George.
A study published by the British Medical Journal found cancer patients who experience loneliness face an 11% greater risk of death. It's believed the stress response of isolation can negatively impact the immune system. Loneliness is also associated with cognitive problems and sleep disorders.
Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well, so check us out there. A lot of news flow today, a lot of earnings today. We'll stay on top of it for the next 2 hours. It's Scarlett Fu and Paul Sweeney, and this is the Bloomberg Intelligence program for the next 2 hours. Caroline Hyde's going to join us, B-Tech co-anchor, on some of the top tech stories of the day, and there are a lot of them. A lot of big investments in some of these AI data centers from the likes of BlackRock and Microsoft, so we'll break it all down there. Kim Forrest, founder and CIO of Boca Capital Partners, will get her thoughts on the markets. We're getting some regional banks also reporting earnings, so that means we turn to Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. regional banks, and we'll see how they are doing as well. Alison Williams, you know her, you love her. She covers all the big money center banks and investment banks. She's going to break down what we've seen. Today we had some numbers out of Morgan Stanley, B of A, so we'll break that down as well. Luxury is back in the forefront and maybe showing some signs of life there after a tough period here. Deb Aiken's going to join us. She covers all the global luxury brands from London for Bloomberg Intelligence. She's going to join us as well. So a lot coming up over the next couple hours. Let's kick it all off with Lisa Mateo and a Bloomberg Business Flash.
You got it in this Bloomberg Business Flash, brought to you by IBKR. Will the U.S. economy enter a recession by the end of Q4 2025? At IBKR Forecast Trader, the yes recently at 6%. Start predicting today at ibkr.com/forecast. The last trading day for this contract is March 26, 2026. Well, we've got stocks bouncing back on earnings optimism. Data from Bloomberg Intelligence, it actually shows that of the first 24 S&P 500 companies to report, 71% have exceeded forecasts. forecasts. The last of the big U.S. banks reported earnings for the quarter. Solid quarter for Bank of America. Return to deal-making boosted profits. A beat on third-quarter earnings. Its shares are up nearly 4%. And a beat on third-quarter net revenue over at Morgan Stanley. Its shares up more than 6.5%. We go to Citizens Financial. It reported underlying earnings per share for the third quarter beat estimates. Its shares up about 0.1%. The same story at First Horizon Bank, but its shares taking a dip down about 9%. PNC Financial beat analyst estimates for profit revenue in the third quarter, posted credit quality metrics that were better than expected too, but its shares also taking a hit, down about 4%. We go to the NASDAQ, up more than 1%, 299 points. The S&P 500 rising more than 1%, and the Dow up about 0.8%. In the yield space, the 2-year 3.49%. That's little change. The yield on the 10-year 4.01%, and that's down about 2 basis points. Gold hit a new record. Let's go to COMEX Gold, up more than 1% at $4,218 an ounce. And the dollar weakening against all its major peers. It's weakening by about 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Market Drivers today is brought to you by Van Eck, celebrating 70 years of helping investors stay ahead in a world that never stands still. Visit vaneck.com. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu. And we're joined by Bloomberg's Denitza Sakova. Denitza, what are you looking at today?
Let's start with Dollar Tree. The ticker is DLTR. It's having a really strong day after a pretty good forecast on earnings. The stock is up about 3%, and the forecast is that earnings per share are expected to grow by high teens percentage in fiscal 2026. They're giving good projections for the next 3 years, and investors are seeing a lot of optimism there. The stock is up 29% year to date, so definitely one of the gainers there. That said, there are a lot of pressures. There are tariffs, their transition to multi-price models. Obviously, lower-income consumers are suffering. They had their sale of Family Dollar, which didn't go so well, and the price tag was pretty low than what investors were expecting. That said, we're seeing some optimism from the company. They say these costs will dissipate. The retailer is getting majority of its foreign source goods from China, so that's one potential pressure. And perhaps one reason Jefferies analysts remain cautious, they're calling the company's overhaul messy. Still up 29% year to date, but some caution there.
All right, let's see how that shakes out. Another one that you're keeping an eye on has a great ticker, PZZA.
Yes, it's been a big week for pizza. This time we're talking about Papa John's. Shares are up 10%. It's coming off news that Apple Global Management submitted a bid to take the company private. Situation is fluid. We've seen a lot of speculation about this recently, and the stock has been reacting quite positively. It's already up 19% before those news, so this is boosting the stock further. Of course, there has been a lot of pressure on those chains. We're talking about tariffs. We're talking even about weight loss drugs and people kind of avoiding those foods. At the same time, Domino's, Papa John's, they've been trying to do all those different deals, lower sometimes menu prices. They have been.
Do they have a stuffed crust pizza?
That's the problem. They don't.
Oh, man, we learned that yesterday.
Yeah, that was one of the. Yep. It did very well. That's what they said. It did very well.
It was a winner.
We saw a big reaction to the stock, and Domino's is doing well. But we're seeing some analysts saying that the company is in perpetual turnaround. So perhaps that's why investors are excited about the bid to take it private.
Okay, one more here.
Another private story. We're talking about Grindr, the dating app. Its largest shareholder is exploring an acquisition that will take the company private at no less than $15 a share. The ticker is GRND. Stock jumped 4% on the news today. The move was reported with Semaphore. It was prompted by a recent decline. The stock is actually down about 29% before the news. So big drop there. The two main shareholders that own more than 60% of the company have engaged into exploring the possibility of taking the company private. This is, of course, a fluid situation, as we saw, similar to Papa John's. The company said that there is no definitive take-private proposal, but they're looking into it. We saw some disappointing results from them, which kind of explains the really tough start year to date and potentially why the company may be looking into a bid to take it private.
All right, good stuff. Denitsa, thank you so much. Denitsa Sokova of Bloomberg News. And for more conversations like this, subscribe to our new Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. You can subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. It's yet another day of data center deals.
Yes.
I feel like this is a never-ending story here, and it continues to propel the stock market higher, and that's kind of what's happening here. The Nasdaq up 1.3%, the S&P 500 up 1.1%. So we needed to bring Caroline Hyde, our B-Tech co-anchor, in to our New York studios here to kind of walk us through some of the big stories. And I guess let's start on the one that became official, which is BlackRock's GIP buying Align Data Centers. This is a $40 billion AI bet.
And to be fair, it's a lot more than BlackRock. You've got BlackRock, but you've got MGX, which is Mubadala's AI investment company, part of that sovereign wealth fund focus on AI. But you've got Microsoft in the mix. You've got NVIDIA in the mix. You've got XAI in the mix. Basically, anyone who likes financing data centers or needs access to data centers or has some GPUs to put inside data centers seemingly wanted in on what was a $100 billion get-together pool of capital. And this is their first chunk of change, $40 billion being committed to Align Data Centers. It's over in Texas. And this was actually owned by Macquarie, a big Australian infrastructure player. And they are now managing to sell off. It's a huge campus. You're thinking about operating in US and indeed in South America, Align. They've got 50 campuses. They've got 78 data centers. But all of this is as we seem to have insatiable demand for compute, and therefore values go skyrocketing.
So your tech beat, Caroline, is always front and center for this market. It's even more so, certainly the last 2 years with AI. It's even more so in the last 2 weeks with a lot of these circular deals. They're being referred to circular deals, where people are investing in each other's companies and things like that. And the dollar amounts are so huge. I know. Are your sources, are they saying this feels a little frothy? What are your sources telling you?
I think a lot of people are starting to put the word bubble in the context of AI and infrastructure right now. Look, you even had the CFO of Citigroup yesterday talking about his anxiety when it comes to potential frothiness in the AI market. You've had the Global Managers Survey coming from Bank of America yesterday, the most we've ever seen in terms of majority thinking that these AI players are too highly valued. So certainly the circularity gives people pause. We had a great fan manager on just yesterday really saying, look, even though they think NVIDIA is a bet, even though today HSBC has raised the price target on NVIDIA to maybe putting this at an $8 trillion company in the next 12 months, but people do have pause when they're putting $100 billion in equity investment into OpenAI, basically so that OpenAI can keep buying its own GPUs. You see that happening over in Europe. Another key player that we've got to keep an eye on is Nscale. There's currently a private AI data center builder out. I might add they've never built one single AI data center, but they were a crypto miner that's pivoted. And now they're committing to doing 4 data center projects with Microsoft. But Nscale, of course, got the anointment from Jensen when he went over to London saying, I want to back you in my equity, because guess what? 2,000 GPUs are going to be offered in those 4 projects to Microsoft. So it just keeps on being this idea that ultimately, where are we getting the money from? At the moment, build it and they will come is the mentality. We need the infrastructure before you can really get the productivity gains. So NVIDIA is putting its cash to work.
Okay, so circular funding, and yet another example of that. So what I'm confused about is how some companies that had indicated things would be kind of rough just a few months ago have now turned around and are seeing a completely different tune. ASML, which is a Dutch semiconductor equipment maker, had warned that the trade war, the tariffs on China was going to be hurtful to its business. Now it's completely turned around and said, you know what, demand is great.
Maybe they'll be able to eke out growth in 2026. I think it's also our expectations for ASML came down some. If you're looking at a quarter-on-quarter basis, the sales and the bookings fell. It's because China is so outsized in their revenue stream, and China's going to start dialing back in 2026 because of the geopolitical issues and the fact that the US is asking its neighbors and allies to stop allowing such semiconductor equipment into the nation. And you just had the House China Committee saying once again we're worried about ASML, but also KLA and some of the other US players. So I think that we are seeing, yes, ASML managing to calm anxiety, that they will still see growth from other pockets for these EUV. This is extreme ultraviolet lithography. They're the only people that make this particular sophisticated equipment that is making your leading edge chips that are going to be fueling our AI consumption. So if they're the only player, well, they've got really a sort of a built-in demand pool, but China is going to be dialing back, and the market wanted to hear that others were going to step in. And it seems as though they are going to.
Yeah, just amazing, turning around and saying that demand is there, and why not? I mean, we're seeing money being thrown at the space like I have never seen before anything else, and that includes the internet. Caroline Hyde, thank you so much. We appreciate it. As always, Caroline Hyde, she's the B-Tech co-anchor. She and Ed Ludlow, they are absolutely on top of this whole global tech scene. They cover it like nobody else. We appreciate getting a few minutes of Caroline's time here in our Bloomberg Interactive Broker Studio. And Scarlett, boy, another good day in the market here today. And despite the fact that I didn't hear too much positive spin today on the trade situation with China. I mean, we heard some tough
I think people just moved past it, you know?
I guess.
Yesterday, when we opened lower and we thought we were going to have a down day, and we did, but the S&P 500 was barely lower at the end of the day.
Yep, we'll see. And get gold. Guess what? It's up another $65. How about that? That's the basement trade. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. We've got stocks bouncing back. Earnings season shows the strength of corporate America. Also positive comments on AI demand from ASML Holding. That sparked some gains in chip makers. ASML, they posted stronger than expected orders in the third quarter. They also said sales next year should be at least on par with 2025. Its shares are up nearly 2%. What's also helping an analyst upgrade of NVIDIA? NVIDIA shares are up more than 1%. So let's go to the NASDAQ, up more than 1%, 303 points. The S&P 500 rising 1%, 74 points. And the Dow up 0.7% or 361 points. In the yield space, we have the 2-year, 3.48%. That's little change. And the yield on the 10-year, 4.0%, and that's down 2 basis points. The Bloomberg Dollar Spot Index, that's weakening by about 0.2%. We did have some economic data out today. New York State factory activity that unexpectedly expanded. The outlook climbed to the highest since the start of the year. We'll get to the numbers. The Federal Reserve Bank of New York's October General Business Conditions Index had increased 19.4 points to 10.7. Later today, it's the Fed's Beige Book. September CPI will be released October 24th. And finally, shares of Papa John's Pizza, they're on the rise, up nearly 8%. Reuters reporting Apollo Global Management has submitted a bid to take the chain private, $64 a share. And finally, Dollar Tree, those shares up nearly 1%. The company said it's sticking to its previous guidance for the quarter and for the full year. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here with you in our Bloomberg Interactive Broker Studio and streaming live on YouTube as well. Again, as Lisa was just reporting, a risk-on day today for sure. We continue to have some good earnings coming out of the big banks and the regional banks as well. And we'll talk to Herman Chan of Bloomberg Intelligence in just a moment on those regional banks. Right now, let's talk to a professional money manager, Kim Forrest, founder and chief investment officer at Bouquet Capital Partners, joining us from Pittsburgh via Zoom here. Kim, what kind of conversations are you having with your clients over the last, 4, 5, 6 days as we see these big 1% moves kind of in either direction driven by a lot of kind of cross currents, whether it's trade or tariffs, or what are the conversations like?
So here's the good part. Most of my clients have experienced volatility in the past. They've selected our style of investing because they're comfortable with volatility. And, the conversations are great because we're talking about what's going to happen in the future and the fact that most of the companies in the portfolio, while they can be volatile, they have clear prospects ahead of them for, growth in their businesses. And I think that's important. Whenever things get tough, you go back to the fundamentals. And that's what we do here.
Does the market care about the China-U.S. trade tensions, the tit for tat that's happening on a daily basis, the threats of 100% tariffs, the
cooking oil?
Cooking oil. Thank you very much, Paul. I mean, like every day there's a new thing to throw into the pot. Does it matter to investors right now?
On some days, the answer is a big fat yes.
Go.
And on other days, they're willing to overlook it. It's the craziest thing. So I've been doing this since 1999. I became a software analyst a sell-side analyst looking at software companies in 1999. Great timing,
Great
right?
timing, kid. Yeah.
Yes, exactly. Anyhow, but so I think the market, from what I can see, can only hold maybe 2 ideas in its head at the same time. I'm serious. Even though people are trading, on all these individual stocks, the movement of the day is 1 or 2 things. Some days it is China, but it looks like today we're back to the things are okay in the economy trade, as well as AI doesn't seem to be diminishing trade. So those are the 2 things that I think we're thinking about today, and a little less about China.
So, Kim, I want to follow up on that, tap into your technology background, and of course, the story today, the story of the past 2 years or 3 years in this marketplace has been AI. And I know you've had experience with the dawn of the internet and that type of hype. What's the concern here, or is there a concern of some of these circular deals that we've seen over the last 3-4 weeks where Company A is investing in Company B, so Company B can buy some of Company A's products and so on and so forth, and the numbers aren't small. These are tens of billions, hundreds of billions of dollars. How do you put that into context?
Well, I think because these aren't deals where money is actually being shoved across the table at each other quite yet, these are all kind of promises of future plans. I think it is somewhat disturbing. Probably the biggest problem I have is when NVIDIA is investing in other companies where it's a direct tie to, hey, you have to use our chips. So, you know, and we're going to pay you to do it, right? Like, that's uncomfortable. That should not make any investor feel great. The rest of these, I still think AI is in its early days of being proven. Oddly enough, in the 90s, I actually worked at AI companies, so I understand the technology, and I see a lot of holes in it. Probably the biggest hole that is missing is what exactly is it going to enhance our productivity? We don't have a really easy answer for that. I believe that AI can, but OpenAI is so big and open and all-encompassing. I don't believe it's the AI that's going to rule us all. I just don't. But that's what a lot of these deals are kind of assuming, that there's one leader that's going to emerge and eat everything else up. That's a dangerous proposition, and especially with timing, because we don't know when productivity is actually going to start picking up here from these investments. So I think investors are rightly to be cautious and optimistic all at the same time.
Yeah, I mean, especially because it's early days here in this whole AI revolution. To kind of count on one winner is, you know, you're out there looking for lottery picks. Kim, before we let you go, I want to get your thoughts on the debasement trade, this idea that people want to de-dollarize, de-risk their portfolios, you know, get out of the dollar, get out of U.S. Treasuries, go into crypto, go into gold, go into silver. And that certainly played itself out. But then over the weekend, we had this massive sell-off in crypto that, you know, really put into question whether altcoins, smaller altcoins, can survive. How much does that matter to what you do on a daily basis? I mean, it certainly is a reflection of the appetite for risk, but does it have any spillover effect into traditional equities?
I don't think so. I actually think it makes traditional equities look stronger. You know, who knows what you're buying in a small coin? I don't really get it. It's you're buying supply and demand of a coin that has nothing backing it.
Well said.
Or better yet, it has other, you know, ephemeral coins backing it. Even better, like you're building, you know, this stack on top of nothing. And I look at de-dollarization as impractical. Until we price cars, houses, and food in some other currency, guess what? The dollar is, you know, the currency of record, and everything else is relative to that. We saw that in the inflationary period where, you know, you were not protected by your Bitcoin because it traded down along with all your stocks. So that mythical, like, oh, I'm going to de-dollarize, that's great. If everybody is then using that coin, whatever coin that is, to actually set the price of goods and services. And we're not there yet. We're not even close.
All right, Kim, really appreciate your joining us and sharing some common sense there. Kim Forrest is founder and CIO of Boca Capital Partners, joining us from Pittsburgh. Here in New York at our Bloomberg Interactive Brokers studio is Herman Chan to give us a snapshot of what we've been hearing from the banks. And we're not talking about the big banks because we know that they blew away all estimates thanks to investment banking, thanks to trading in equities and fixed income currencies and commodities. But for those regional banks and how they're doing, they're much more a reflection of demand for loans and whether people and companies are able to pay back their loans. What are we hearing? What's the story so far in the early days of regional bank earnings?
That's right, Scarlett. The regional banks are more a reflection of what's going on Main Street than Wall Street. We are seeing some pickup in lending, which is great to see. We're seeing margins fairly solid, and unlike what Jamie Dimon said yesterday about seeing cockroaches, we're not seeing any cockroaches on regional banks' balance sheets, which is also really constructive. The credit quality is really solid, and we're not seeing the higher loan losses. That being said, there's been a lot of volatility in some of the names today, with First Horizon down 10% last time I checked, and PNC down 4%. So that's for First Horizon in particular, that really reflects their comments on the call saying that they're actually a buyer of banks and not a seller. the market seemed to think they would be one of the potential takeout candidates as M&A is starting to pick up.
So the market is going to decide who the buyers and sellers are, I would think here. Is there a sense of scale where these companies, where some of these banks like a PNC, like what's your bank up in Buffalo?
M&T.
M&T. Okay. Is there a sense of where they should be in size if they're not already there?
Yeah, PNC in particular has talked about having aspirations to manage $1 trillion balance sheet. So that's, on par.
Is that a regional bank anymore?
You would say that's not. So they want to graduate to be a much bigger bank, basically doubling their size. So they've talked about they're already a coast-to-coast operator now in California and now in Texas. And traditionally, they have a more mid-Atlantic and Midwest footprint. So that really really suggests consolidation, more M&A in the future.
So as these regional banks have aspirations of becoming super regional banks and perhaps even bigger than that, does that mean that they inevitably will need to build out their investment bank as well and their trading operations, and they'll start to look like smaller versions of the big banks that we currently have?
Yeah, some of the super regionals are a bit like that now. Banks like PNC, banks like Citizens, banks like Fifth Third and KeyCorp do have some growing investment banking platforms, but on the other hand, they're not banking the largest corporates that are doing a lot of the activity, and so they're doing capital markets for their middle market clients, which inevitably isn't going to be as profitable. So as they grow bigger, the hope is that they will bank larger corporations and then have that opportunity to cross-sell the capital markets capabilities.
All right, 30 seconds. If I want to build a real estate property, or I want to buy a business, and I go to my local bank, is he going to make, or she going to make me a loan?
Yeah, I think so. The market's open now, as long as you have the liquidity. That banks are open for business. They're not shy about lending. So if that's what you want to do, feel free to call your local banker.
You got to pass the credit check first, Paul.
I know. That could be a little dicey. I'm pretty good. I'm pretty good at my credit, I think. Herman Chan,
just flash them your money clip.
Yes, cash when you walk out the door. Bring your money with you. Herman Chan, senior analyst. He covers all the regional banks and often in the news. There are lots going on in the regional bank business. But again, as Herman mentioned, that it's Main Street, not Wall Street here. So it gives you a good sense of kind of how small companies, small mid-sized companies, which are the backbone of this economy, and individuals are doing on the banking side. Appreciate that. Still green on the screen. Solid morning trading here. S&P up 70 points. That's 1.1%. The Nasdaq's up over 300 points. That's 1.4%. And the Russell kind of leading the way, up 39 points, 1.6%. So a solid day, I guess. I'm not really sure why.
It's early days. It's early hours so far. But I liked what Herman said about how First Horizon is down because the market thought it would be a target rather than a buyer. We still haven't heard a follow-up to the Fifth Third Comerica deal. And it feels like earnings season will get that kind of chatter going again.
Yep. We'll keep on top of that as we do. We're going to have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Equities extended their gains after Treasury Secretary Scott Bessent, he suggested the possibility of a longer China tariff truce that's tied specifically to rare earth. We go to the NASDAQ, up more than 1%, 293 points. The S&P 500 rising more than 1%, 69 points. And the Dow up 0.6%, 303 points. The two-year yield, 3.48%. That's a little change. And the yield on the 10-year, 4.0%. And that's down 2 basis points. To commodities, COMEX gold up more than 1% at $4,212 an ounce. We have Brent crude at around $62 a barrel, WTI crude around $58 a barrel. And as far as currencies, the Bloomberg Dollar Spot Index, that's weakening by about 0.2%. We have some more big AI bets. Investors led by BlackRock's Global Infrastructure Partners, well, it agreed to buy Aligned Data Centers. It's a deal that values the company at $40 billion, and that includes debt. And in other news, Waymo robo-taxis, they're going to make their European debut, launching in London in 2026. Get ready for it. The Alphabet unit's going to start testing out a little... I know. That's what I was thinking, too, but I didn't want to say it, but you did. There you go. Safety drivers are going to be there in the beginning. That's coming up in the next couple of months. And Apple has made some updates for a few of its products. This is ahead of the holiday shopping season. We're talking about the iPad Pro, the Vision Pro, the 14-inch MacBook Pro. Most of the new products are going to use Apple's latest in-house chip, and Apple also preparing to expand its manufacturing operations over in Vietnam. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. I'm not the expert here, but boy, just looking at the earnings from the big banks, the big global investment banks, they've been so strong. I mean, just really solid across.
They're making it in.
And they're making it. I guess the times are good, and they're taking advantage of it. And Allison Williams joins us here, senior analyst. She covers these big global banks. She's done that for decades. She knows them backwards and forwards. One of the absolute experts on Wall Street on this. Let's start with Morgan Stanley. I've competed against them my whole career. Man, they're good.
Yes.
How about this quarter?
Save the best for last.
Yeah.
I mean, obviously, it's a strong environment for equities, especially the third quarter was a very strong environment. We hit records multiple times, including in the end of September. We had new records earlier this quarter. But, as we know, when you manage a team, when you have that strong environment, you want people that are going to take advantage of it. And I mean, equities trading really jumping. We saw strong growth actually at J.P. Morgan and Morgan Stanley. Goldman trailing a bit. So raising maybe some questions about what happened there, but also equity fees, Morgan Stanley doing well. And then the wealth business, I mean, that's really the focus for investors. Those flows really strong.
Yeah, wealth management net revenue of $8.23 billion. It was estimated to increase 7% to $7.78 billion. So that was a big, big beat. And this is the part of the business that Morgan Stanley has really been focused on to kind of separate it from Goldman Sachs, because this is the steady Eddie business where it's fee generated, it's recurring. You're not dictated by the whims of the market and volatility and anything that could happen in any quarter, right?
So to your point, the wealth and asset management tends to be more favored by investors because it does tend to be more of a recurring revenue model. Obviously, if the market goes down 20% or up 20%, that has an impact on fees. But it's not comparable to something like the underwriting or the pure transactional business. Recall the pandemic when things completely shut down. I mean, granted, they recovered, but the fact of the matter is, like, it's less volatility, more recurring revenue. Investors like that fee income, and they like sort of the relative stability of that business.
So one thing that really jumped out at me, Allison, when I was looking at the earnings is the fact that all the banks provisioned for credit losses. JP Morgan set aside more than what analysts thought it would set aside. Goldman Sachs set aside less. Morgan Stanley was estimated to have set aside $97 million. It ended up setting aside zero for bad loan losses. What does that say?
They did, and I mean, for Morgan Stanley, lending is such a small part of their business. It's the least out of all the banks. So if you're going to see zero, you would see it there. But the one question we do have, which I think will become clear as we see many of the other banks report, is, we're seeing a very strong consumer at these big banks. But is there differentiation in terms of the high-end consumer or lower-income consumer? A lot of these banks, the focus really is on the higher-end consumer. J.P. Morgan, despite a lot of the headlines that came out from Jamie's comments, we look at the credit card business and the credit trends in that business, super strong. Their charge-off rate, they actually guided down because they had to, because the delinquencies are coming in, so much lower. Bank of America, we also heard from today, delinquencies coming in well. We know that J.P. Morgan really focuses on that Sapphire card, that high-end card. So they are seeing a strong consumer, but will we see something different when we see some of the other card companies report?
When you think about it, the drivers of the investment banking business are pretty darn simple. Listen to Chief Financial Officer Alistair Borthwick. Here's what he told analysts on Wednesday, quote, "We've seen more certainty now around trade and tariffs and around taxes as well. It's allowed our client base to make longer-term decisions. That's reflected in our investment banking activity." It's as simple as that. But again, it's hard to predict kind of what those macro trends are going to be. Switching gears to the Bank of America, their bankers did really well. Not that that's a surprise, but they put us a big growth rate.
They did, and to your point, Paul. I mean, you've been in this business, right? So having clarity is generally helpful for the investment banking business. That's why we did see sort of a fall off mid-year. But what we've heard from the banks and their bankers is that, look, clients are beginning to accept that there is some level of uncertainty they'll have to deal with. It's not going away necessarily anytime soon. So if you need to come to market, now is probably a good time. And by the way, record equity prices, Fed cutting rates, those are also helpful in bringing some of those deals to market. Bank of America, by the way, talking about their backlog up very strongly for the fourth quarter. So this momentum into this next quarter is likely to show up again in the fourth quarter results.
So for Bank of America, it feels like investors were singularly focused on the net interest income number because it had not done so well just a year ago, and Bank of America was really focused on improving that. This was a big beat on the NII number here, and they actually guided higher for the fourth quarter. The bank is going to hold its first investor day, I think, since 2011 next month. How does this set up Bank of America for this investor day?
So I think they are set up well for the investor day. And keep in mind, investor day will be focused, I think, on the long-term trends. We have gotten some management changes, some announcements related to succession planning. And I think, Brian Moynihan has done a great job with the bank. I think the investor day is really going to be focused on, what is the look forward. And AI is something that we've heard a little bit about Bank of America talking about that this quarter. Goldman Sachs bringing out their 3.0 program. Morgan Stanley actually had been talking about that with their cuts last year. How is AI going to contribute to the structural profitability of Bank of America? So cyclical, some very strong trends this quarter. Structural, they've done a good job, but what is next for the bank?
I mean, I just forgot how big Bank of America is, and they grew through so many acquisitions. 213,000 employees. It's got a market cap of almost $400 billion. They seem like they've got the right mix of assets at this point.
Yeah, so to your point, they did grow a lot through acquisitions under prior managements. And I think, what Brian Moynihan has come in and said was they're really going to focus on organic growth. They focus on the strategy, responsible lending. There's some noise around that when times are good, right? Because everyone said, well, are you being too conservative? But then when times are bad, that is really helpful to managing the downside. And that's one of the things that I think can give investors comfort as we worry about recession risks in the coming quarters, right? So things are great right now. Net interest income, I think, was really positive in the sense that they narrowed the guidance to the higher end of the range. Investors are excited about that. They're showing good loan growth. Right. All of this bodes well going into next year. Right. If there is a risk of recession, they do have sort of that strong underwriting as a protection.
All right, and the board took care of Mr. Moynihan. They paid him about, $31.5 or $33 million last year, so good payday for Mr. Moynihan. Allison Williams, senior analyst. She covers all the big global banks for Bloomberg Intelligence. Appreciate getting some of her time today. We're going to have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney here. We are taking a look at the stock market. It is in the green. The S&P 500 up 1%. The Nasdaq higher by 1.3%. The latest earnings, particularly from the big banks, very encouraging. If you're looking at Bank of America, if you're looking at Morgan Stanley, even if you're looking at PNC, which is a big bank, just not quite as big as the sixth largest. Let's also look at earnings from companies like LVMH, the luxury giant. It's like a supermarket in a way, right?
Of luxury.
It's a conglomerate. Okay. LVMH shares are higher right now after a surprise return to sales growth. So maybe that is leading to folks saying perhaps the downturn we saw in luxury is over. Let's get some perspective from Deborah Aiken. She is Bloomberg Intelligence luxury goods analyst. Deb, good to speak with you. What are you thinking when it comes to LVMH's results and what it signals about whether luxury is back?
Hi. So really a very big sentiment indicator. The comments from the company late last night out of Paris were more positive than the market anticipated. When we look at the numbers in terms of the organic sales growth, the market expected around -1. We came in at +1, but it's about the sequential improvement from Q2 to Q3. And the fact that all 5 of the business units improved versus Q2. And more than that, China is mid to high single-digit growth versus a year ago. The US is robust. Europe is doing the same as it did across the board doing okay, but missing out on tourism, and Asia ex-Japan is positive. We know 4Q US will face a bit more of a difficult comp after the spending last year beyond the election and the Trump win. But into the first half of 2026, the market is looking more positive, and it's certainly rallied the whole of the sector this morning and this afternoon.
Hey, Deb, what's the correlation between luxury spending and just kind of the broader stock market around the world? Because markets are really performing well. How does that correlate to just luxury spending?
You know, the big thing on luxury spend has been that the very high end has done well. So Hermes, Brunello Cucinelli, where they work with a restricted volume operating model, they've done well in terms of their top line growth. But when I think about an LVMH, you know, given how big they are, they need a big volume there, even with some pricing, to manage growth in this category. And instead, what we saw last year and the beginning of this year was maybe a little bit of trading down. So brands like Tapestry's Coach, Ralph Lauren, they became really so popular, not only in the US, but more on a globalized basis too. And so the view has been that the sentiment around the share prices has very much been opposed and opposite to what's been happening on the stock market. But with the exception of the mid-range, and the mid-range have done better because the view in the investor mindset has been that the luxury buyer will trade down. They've done that in some brands, but not all brands. In some categories, not all categories. And generally, we expect the biggest and the best to come back first.
What about LVMH's wines and spirits division? We've been hearing from Constellation Brands and other spirits companies that, you know, there's been this massive shift in consumer tastes away from alcohol, certainly the younger generation. Does that affect a company like LVMH?
So a different kind of thing with LVMH. I think at the very high end, we had some US weakness. So they operate in wines, fine wines, high-end champagnes, cognacs, and others. Champagne is doing well and is back to growth in the US. Rosé wine is doing very, very well. But some of the spirit side is still struggling a little bit. And I think that's because we've seen some trading down. So we had China very heavily stocked. And the US not so solid through the first half of the year, but there are signs of that coming back. If I look at the numbers on the Q3 for wines and spirits, they're at +1, and they were at -4 for Q2 and -9 for Q1. So it seems as though inventory is leveled out and we're starting to see some selling.
Deb, I learned from you long ago when looking at luxury, you have to also pay attention to what's happening in China and the Chinese consumer. Are the Chinese spending either in China, or are they traveling to the London, Paris, New York, Milan type thing? What are you seeing?
Yeah, we're still seeing a lot of the spend. We're getting mid to high single-digit growth in that Q3 from LVMH year on year is on localized spending. We are seeing pockets of growth on the tourism side. So there is a more positive view and mix linked into the commentary from these results. But overall, we are still absolutely missing Asian tourists, Chinese tourists from Europe. And also in Europe, we're missing the strength of the dollar having swung over last year with US purchases here. And you are seeing some, but not as many in terms of full recovery versus 2019. There's growth year on year, but not versus 2019 into the US either when it comes to the Chinese tourist. We used to say a third of luxury goods, just over, were from the Chinese cohort, and that would include on land and traveling, right? And we still think there's a way for that to go. But certainly on land and locally, they're doing better than they were.
All right, the Chinese may not have been in Europe, but boy, the Americans were just all over it. Anywhere you looked in Italy, I mean, we were there. I mean, you know, it's kind of odd But anyway, Deb Aiken,
They were
thanks so much.
everywhere you turn.
Everywhere
at a luxury store.
Yep. Luxury goods analyst for Bloomberg Intelligence. We appreciate that. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research starting right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Hour 2 of the Bloomberg Intelligence program. We're going to check in with Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. He thinks we're going to talk about crude oil. I'm going to ask him about cooking oil, see what he knows there. I don't know if there's a market there. Yeah, exactly. Mike McKee, Bloomberg International Economics and Policy Correspondent. He's down there in D.C. We'll get the latest on what's happening down there from an economic perspective. Cheryl Pape, Senior Portfolio Manager at Angel Oak Capital Advisor. We'll get her thoughts on these markets. So we got a lot coming up in the next hour with the markets trading higher. Let's check in with Charlie Pell.
All right, thank you very much. And here's what's going on. We are seeing a renewed wave of dip buying. The Dow, the S&P, NASDAQ, all advancing, equities extending gains after Treasury Secretary Scott Bessent suggested the possibility of a longer China tariff truce tied specifically to rare earths. Right now, we have got the S&P up 68. That is a gain of 1%. Year to date, S&P up 14.1%. The Dow up 292, well off session highs, up 0.6%. NASDAQ up 308 now, up by about 1.4%. Our Mag 7 index up 1.4%. The 10-year 4.01%, with the 2-year currently yielding 3.49%. Gold is up 1.4%, 41.99 the ounce. West Texas Intermediate crude flat on the day, 58.70 on WTI. Brent, meanwhile, lower little change, 62.34 barrel, down by 0.1%. A further retreat for Bitcoin, just above 111,000 Bitcoin today, down by 1.8%. Big banks are rallying on solid results out of Morgan Stanley and Bank of America. We did see Morgan Stanley's stock traders soar past expectations in the third quarter, topping rivals on the surge in trading activity as President Trump's policies kept markets on edge throughout the period. Allison Williams is a senior banking analyst with BI. She was a guest moments ago here on Bloomberg Intelligence.
Equities trading really jumping. We saw strong growth actually at JP Morgan and Morgan Stanley. Goldman trailing a bit. So raising maybe some questions about what happened there, but also equity fees, Morgan Stanley doing well. And then the wealth business, I mean, that's really the focus for investors. Those flows really strong.
Allison Williams of Bloomberg Intelligence. So Morgan Stanley shares, they're surging 6.8% right now. Bank of America up 5.5%. Also reporting this morning, PNC. Its shares are trading lower. PNC down by 4.9%. Again, recapping, equities higher, looking at a 1% gain right now on the S&P 500 index. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, thank you so much, Charlie Pellet. Paul Sweeney and Scarlett Fu here, Bloomberg Intelligence on Bloomberg Radio. We're streaming live on YouTube. And of course, Charlie gave us some of the earnings that we want to pay attention to, but we also want to look at what's going on in terms of M&A. So for that, let's bring in Christina Aquino of Bloomberg News to take a look at some stocks on the move. And Christine, you are starting with BlackRock.
Yeah, let's take a look at BlackRock. That's having a good day. So ticker BLK, shares are up just over 1%, but earlier up as much as 1.9%. And that is because we did get news that BlackRock's global infrastructure partners agreed to buy Aligned Data Centers. So that's currently owned by Macquarie Asset Management. It's going to be a $40 billion deal. And yet another example of just how much firms really want to get into this data center trade.
Well, you know what's funny? I thought this was a huge deal. So I emailed Neil Sipes, Bloomberg Intelligence, and also covers BlackRock. And I said, Neil, is this a big deal? He says, no big deal.
It's a drop in the bucket.
This is what BlackRock does.
Exactly.
No big deal. They make these kind of bets all the time, which I thought was funny.
Yeah,
so I guess that's the world we live in here.
Exactly. Like everybody just wants to get into this data center trade. And yeah, exactly right. Like 40 billion doesn't seem like it's a lot of money to spend, especially when you consider the expected return from this space in the AI theme. And so, so the idea is that, Aligned, it's based in Texas, operates throughout the U.S., South America, 50 campuses and 78 data centers under management. Interestingly, BlackRock's partners in this investment, guess who? Microsoft and NVIDIA.
Nice. Good partners.
Good partners. Probably, though, will fuel some of those circular funding concerns that we've seen permeate the market space over the last week or so. But anyway, that is doing well for BlackRock shares today.
And you're looking at Stellantis as well.
Yes, let's take a look at Stellantis, ticker STLA. Shares also doing well this morning, up now more than 1.3%, so extending some of those early morning gains. So this is the maker of Jeep SUVs, and they've been struggling to gain market share in the U.S. for a while. And so now they vow to invest $13 billion in the U.S. markets over the next 4 years. And, they're saying that this is their single largest investment in more than 100 years. Analysts are seeing this as a move to counteract any pain from tariffs, because in July, Stellantis estimated that their hit from tariffs is probably going to be the equivalent of $1.7 billion, at least for this year. Bloomberg Intelligence, though, weighing in and still saying, they would like more details about this investment, especially because it's not clear if, is this actually a new investment, or is this just part of their CapEx plan, which is currently estimated at about 10 billion euros. So it's comparable,
All right, and lastly on Morgan Stanley.
Morgan Stanley, we got those results today, and shares are doing well. So ticker MS, and we're now seeing that stock up more than 6%. Stock traders, definitely the headline figure for Morgan Stanley's earnings. They exceeded revenue expectations in the third quarter with more than $4 billion of revenue. But the cherry on top of the sundae is the fact that they beat Goldman Sachs. So Goldman Sachs comparable stock trading revenue, only $3.74 billion. I say only, but so this is something definitely that Morgan Stanley traders will use as bragging rights, at least until the next earnings season. Investment banking fees also rose 44%. Wealth business doing well there, exceeded revenue estimates. They pulled in $81 billion in new assets and recorded a pre-tax profit margin of 30%. Wells Fargo's Mike Mayo weighing in, saying that the equities revenue was best in class.
All right, Christine, thank you so much. We appreciate that. As always, Christine Aquino, she's a managing editor for Markets Live. And for more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you get your listening stuff. All right. Usually when we talk to Mike McGlone, he's Bloomberg Intelligence Senior Commodity Strategist. We're talking gold, we're talking oil, we're talking Bitcoin. Mike, is there a market for cooking oil? Are we talking like Mazola stuff?
Well, I know you want to go to the mighty soybean. It's the most significant, it's just that great U.S. product that we're a dominant player in. But what's happening with cooking oil, as you mentioned earlier, is China used to be a pretty significant exporter to the U.S. Now, Trump administration cut that off a little bit, partly to support the U.S. soybean market. What's really happening this year is China has not taken any soybeans in harvest. It's really odd. Now, Trump has called it an economically hostile act. It's actually, for Chinese, who are very good traders, it's actually economically irrational, because Chinese soybeans in the U.S. right now are about 15% the average price of a soybean in Brazil. It's harvest, plenty of supply coming on. They haven't, they have soybeans left over for last year. And Chinese have always been good traders. They usually buy the cheapest price, but they're willing to pay a higher price, I think, to kind of just get back at Mr. Trump with his trade war.
Yeah, I mean, it's long-term strategy here as far as China's concerned, or the way that they would put it. In reading the story about this threat on cooking oil, I noticed that there's something called UCO, used cooking oil, and how it's a flashpoint. What is used cooking oil, and how is that different from regular cooking oil, or is that what we're dealing with when we discuss cooking oil? I mean, just the fact that it's used is fascinating to me.
Well, it's used, and it's a primary feedstock for biofuel. And that's what's really happened in the U.S. There's one thing that we've done in this country, and most notably through ethanol, Scarlett, is we create a net energy exporter, and we create enough energy, and a lot of it's because we use our food for fuel. Now, to put that in context, before the the proliferation of automobile, a lot of our crops was used for transportation through feeding animals, so horses. So it's just coming back around. But the significance is we have major pressure on U.S. soybean prices because a massive supply out of Brazil, and China's world's largest demand pull source of soybeans are taking Brazilian soybeans. So in the U.S., we're looking for sources of demand. How about biofuels? My uncle, who's a farmer, Dennis Shanner, used to like to say, you could put soybean oil straight into your diesel tractor at 5% and run it no problem. So it's a great source. And so that's why soybean oil this year is up about 27%. Soybeans are flat, and soybean meal's down about 10%. We just need more demand pull for our soybeans. And maybe that means we can use that soybeans rather than some of this renewable fuel from, the used cooking oil from China.
So if we're having good crops, good soybean crops here in the U.S., and China is not buying it, what's that mean for our farmers?
Pressure's lower. It's really hurting farmers right now. So they had the best of all worlds, unfortunately, after Russia invaded Ukraine, pumped prices very high, created a lot of profits, 22, 23, a little 24. Now they're really getting hammered. Prices are going down because they're creating more with less every day. We just brought in all that excess supply, incentivized a lot of supply out of South America. So they're getting hammered now, and they're looking for sources. Trump administration started to help them. But right now we have corn around $4 a bushel. Probably has to stay low for a while, unfortunately. The average cost of production is around $3.70. We have soybeans around $10 a bushel. Probably has to stay a little lower. Unfortunately, shut off those excesses of supply, and that's the problem. Farmers are getting hurt now with these low prices.
Which is so interesting, given that they're such a big constituent of President Trump, and he's talked a lot about making sure that they're taken care of. Mike, Paul had talked about how you are the go-to guy for all things gold, silver, as well as Bitcoin. So I wanted to get your take on what's going on in crypto, because we're a few days removed from that big crypto crash on Friday and Saturday. And things are settling it down a little bit here, but we are seeing Bitcoin slide for a second straight day. What kind of damage has that crash done to this space overall?
Scarlett, I appreciate you mentioning it, because in June I wrote about Bitcoin and cryptos could lead the next U.S. recession by going down and creating a reverse wealth effect. And I reiterated that today. Bitcoin has 1929-like qualities right now. It looks like it's heading lower. We have massive excess supply in cryptos. There was one in 2009. And now, based on CoinMarketCap.com, there's 25 million. A lot of excesses. It looks like they're starting to hit lower. So the key thing I've been watching over time, really like to watch, is the ratio of ounces of gold per Bitcoin. The high this year was around 38. Now it's ticking down around 26. Our model, Josh Daniels on our team says, we have a model, looks like the average price could be around 15, means it could still cut in half versus gold. And here's the key thing to remember. There's 25 million cryptocurrencies, unlimited supply, and there's only 4 precious metals, gold, silver, platinum, and palladium, and the average of precious metals this year are up about 60 to 70%. That could continue. Limited supply, more demand, massive excess supply in cryptocurrencies, and just a little bit too much speculation.
Good stuff. As always, Mike, you break it down for us so we can understand it. Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. He covers everything from pork bellies to Bitcoin. Go figure. But he is our go-to person on all things commodities. Let's head down to Washington, D.C. here. Our own Michael McKee is there, international economics and policy correspondent for Bloomberg News. Mike, we heard from Fed Chairman Jay Powell yesterday. He made some comments. What stood out to you in a world where we hear from Fed people kind of all the time?
Well, I think the real bottom line here is that the Fed chairman is saying we're going to cut rates on October 29th. And that's important because this is the last week before the Fed blackout. We still have more Fed people to hear from. But if you know the chair is going for the 25 basis point cut, then you pretty much know what is going to happen. And he gave us no reason to think that the markets are mispriced for that at this point.
Okay, makes sense. And that's why we did see stocks give up a lot of their losses yesterday. The S&P 500 still did close in the red, but not by a whole lot. Looking at data, there's no government official data due out right now because of the shutdown, but we did get Empire Manufacturing, which is New York manufacturing. And that was a surprise because it was a positive number when economists were looking for a negative print.
There have been a number of surprises recently in some economic indicators that are private sector. Even the ISM's better than expected, even if the manufacturing number was down. What we're seeing, I think, is a little bit of a fall rebound coming after we saw the summer slowdown. Now, the question is, how much does that affect both inflation and jobs? Is it just that there is a little bit more business, a few more orders, or are companies hiring? And that's the problem. We're not seeing that at this point. And so the Fed remains concerned about what's going to happen. And as we heard from Chair Powell yesterday, they think that the labor market is a bit more of a problem than inflation, which is still going up.
Talk to us about inflation, Mike. How do you really think about it? Because just to me, I thought inflation, there's a good argument that it could have been materially higher than what we're seeing right now, simply a result of the tariffs and maybe some pass-through mechanism from the economic supply chain, but not really seeing it that much. Is this just a question of timing, or is it just a one-time reset?
Well, it's a little bit of both. At this point, timing matters because the president's application of tariffs has been spread out over a long period. We didn't really get the whole world tariff going until August, and so we're seeing some bleed through in that into inflation now, and probably that is going to pick up. That's the Fed's expectation. We're also seeing some countries cut prices a little bit, not a whole lot. But I think the biggest thing for economists is that we hadn't seen tariffs like this since the 1930s. And so when they tried to model it, they put in the idea that we would see all of these effects at once and at a much higher level, because that was the original April presidential declaration. And then the president has carved out a lot of exceptions. He's cut down on the tariff levels for a number of countries, and we've implemented them over a period of time. So the models haven't given us an accurate picture of what's going to happen. And basically, everybody's just sitting back now and waiting to see how this bleeds through and how long it's going to take. Inflation's going to go up from tariffs, but we don't have a good handle on how much or how fast.
And very quickly, before we let you go, Mike, just an update here on the U.S. Support for Argentina and its currency. The president now adding that some of the support is conditional.
Yes. That's a key point, because Javier Milei has midterm elections coming up in a week or so, and if they lose control of the Argentine legislature, then it's going to be impossible for him to pass his legislative reforms that he wants, and therefore the president says it's not worth investing in Argentina because they're still going to be losing money, and they're still probably a candidate for default with the IMF. And if he does win, if this helps him to win, then the president says the U.S. could go ahead with the $20 billion whatever it is. We're not exactly clear how that works, whether it's money to Argentina, whether it's loans, whether it's guarantees. It isn't very clear, but it looks like we're going to have to wait a couple of weeks until the Argentine election to find out.
Michael McKee, thank you so much. We appreciate that. Mike McKee's down there in Washington, D.C. He is the international economics and policy correspondent for Bloomberg News, giving us the latest read on some of the economic news and policy coming out of Washington, D.C. S&P, 6,700. Nice, even round number, up 0.9%. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's all day long here at Bloomberg. This Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses, Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitments, see if your company qualifies at oracle.com/Bloomberg. The Dow, the S&P, NASDAQ 100 Index, Russell 2000, all moving higher. A renewed wave of dip buying is underway with the S&P now up 0.8%, up 55 at 66.99. We're well off session highs. The Dow up 245, now up 0.5%. NASDAQ holding on to a gain of 1.1%. The NASDAQ 100 Index up 1.2%. And the Russell 2000 Index of small cap shares also up now by 1.2%. The 10-year 4.00% with a 2-year that's currently yielding 3.48%. Gold up $57 the ounce, 4,200 even on the precious metal. We've got spot gold up by 1.4%. The West Texas Intermediate crude oil down 0.6%, 58.36 a barrel, and Bitcoin now down 1.8%, 111,000 on Bitcoin. Nvidia added another bull today as HSBC upgraded the chip maker to buy from hold, citing the ongoing growth of AI. HSBC also raised the price target on the stock to a street high of $320. Nvidia shares right now at $181. The new target implies an upside of roughly 80% from Nvidia's last close of $180.03. And investors led by BlackRock's Global Infrastructure Partners has agreed to buy Align Data Centers in a $40 billion deal, one of the asset manager's largest infrastructure investments ever. BlackRock shares, they're up by 0.8%. Again, recapping, S&P higher, S&P up now by about 0.8%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan. We are streaming live on YouTube. That's pretty much everywhere. So head over to youtube.com and search Bloomberg Local Radio, and that's where you'll find us. I guess, we got some good bank earnings coming in over the last several days. Expectations for earnings, I think, are pretty positive here. Certainly had a good first half of the year in terms of earnings growth. And we've also got a Fed that's cutting rates. So I guess what's not to like there for a lot of folks. Cheryl Pate, she does this stuff for a living. She's the senior portfolio manager at Angel Oak Capital Advisors, joining us from Atlanta, Georgia via that Zoom thing. Cheryl, what's your backdrop for this market? How positioned are you for this market?
Yeah, no, I think going into bank earnings seasons, we have been looking for outperformance from the banks. I think when you look at the equity markets overall, sort of price to perfection, valuations are sort of, at robust levels, and we do see value in the banking sector relative to other pockets of the equity markets. We also like the banks from a debt perspective. I think there's a lot of tailwinds that you highlighted, robust capital markets activities. You've got an M&A wave we think is coming and a deregulation trend as well. So lots to like here.
Lots to like. Was there anything within the earnings that gave you pause or gave you reason to be worried?
I think we always watch credit most carefully. I've been surprised to the upside, I think, on consumer credit. You saw JP Morgan guide down their card NCO number for the year, in fact. So I think we feel pretty good about consumer credit on the whole. We're still watching some pockets of maybe student lending and lower FICO, lower income type consumers. We are, clearly watching for idiosyncratic credit events, and I think, there could be more to come there, but not enough to make a sort of credit cycle. So on the whole, I think we've been pleased with that. I think maybe there's expectations for share buybacks. Maybe that is a little getting ahead of itself. We do have some momentum going, but it may be a little slower to come. But those are kind of the key takeaways we have thus far.
How about just broadly speaking on these markets? We've got the Russell 2000 outperforming the S&P 500 today. How do you think about where you want to be in market cap in this market here? Obviously, the big cap tech names have been really the drivers for the longest time here, and the small and mid cap stocks have lagged. But how do you think about that?
Yeah, and I'm coming at this from my seat at, looking at financials more broadly. I think positioning into the quarter, we like the large caps a lot. Think there's probably more of the deregulation angle that hits the large caps more specifically. But as we look forward to lower rate environment, I think the steeper yield curve, lower rate theme is underappreciated in the regional banks. And it may be time for a pivot into regional from large cap from here. You've got some nice NIM expansion, steeper yield curve, and you've got a nice M&A wave that really is an outsized benefit to sort of the regional and smaller caps here.
Interesting. In terms of equity positions, I know you don't hold equity positions in JP Morgan or Bank of America, but you do hold debt positions in both. And once we see the big banks report their earnings, they're usually very quick to follow up with debt issuance. Right. Is that something where you're going to follow up and buy more debt?
Yeah, we are definitely looking to deploy into debt into this market. I think there's been a lot of activity. Typically, there is big issuances post earnings, and I think we've seen a lot of debt being called away. A lot of debt that was issued sort of 5 years ago, coming into a call period with a very steep back end spread, makes sense to refi in this environment, especially as you start to lose regulatory capital treatment. So I think that will be a big theme for us. We did raise capital in one of our funds earlier this year. We've got a lot of dry powder that we're looking to deploy into bank debt specifically.
Cheryl, when President Trump was elected to the second term, the financials were an area that we're expected to receive a real lift from a less heavy regulatory oversight. Is that actually happening?
Yeah, I think that is absolutely happening. I think it's most evident in M&A. A couple of years ago, you would have never seen a deal like Fifth Third and Comerica. Regional bank M&A was really on pause. Not only are you seeing a willingness from this administration to approve deals faster, you're probably seeing about half the time to get a deal approval. It's running around 110 days. It was north of 200 under the prior administration. So it's easier to get deals done, and it's easier to get bigger deals done, which I think is good for the sector overall. There's a need for scale here. And then I think the other thing in terms of deregulation momentum is excess capital. And that's, more of the large cap banks. There's a lot of excess capital there that we will see come through, I think, in additional buybacks and capital actions. So that it is certainly happening as well.
Right, Cheryl, thank you so much for joining us. Cheryl Pate is, of course, an investor. She is a senior portfolio manager at Angel Oak Capital Advisors, joining us to talk about banks and the markets. Paul, it feels very 2007-ish with the deal making taking place, with the banks reporting these incredible numbers. A lot of companies saying they may go private. We're hearing a lot of speculation about that. The latest is Grindr, and in this case, the dating app has confirmed that it received a letter from its largest shareholders interested in exploring a take-private transaction. So let's bring in our Bloomberg Intelligence internet analyst, software and internet analyst with us, Nicole D'Souza, to give us a little bit more here. So Nicole, Grindr, this dating app that's focused on the LGBT community, does not actually have a proposal to evaluate. It's just telling everyone, hey, this is happening and there's percolations of this happening.
Correct. So as of right now, what we know, what's been reported, is there are two investors, Raymond Zage and James Liu, who together control about 60% of Grindr. They are in talks with Fortress Investment Group to secure debt financing to take the company private. There has been no direct proposal at this time, but discussions seem to be around a $15 share price, which would value Grindr at around $3 billion.
Talk to us about this company. How has it performed as a publicly traded company?
So year to date, the shares are down around 29%. That being said, Grindr is one of the few dating apps that is still growing paying users. So we've seen dating apps.
They're still growing users?
Yes.
Okay.
And that, at this point right now, is a little bit rare for dating apps, right? We've seen Tinder lose users. We've seen Bumble lose a lot of users. Grindr, because of their niche user base, has been able to hang on to a good amount of their users and grow users every year.
What is their strategy going forward? Because I did read something about how they have this 3-year plan where they're targeting some pretty aggressive growth. And the fact that they're growing users is a good sign, but the dating app business doesn't seem to be that great right now.
Yes, so they have a couple of different levers that they can pull. The first one is raising prices. They've talked for the first time about raising prices. They haven't raised prices since 2018. So they're looking now at potentially raising prices, introducing a new premium tier. Right now, they get around $24 per paying user, so there is a little bit of room for growth. They only have about 8% of their total user base of 15 million users who actually pay for the app. So there is room there. They're also growing advertising revenue. Grindr is one of the few dating apps that does have a pretty solid ad platform. They grew ad revenue around 40% last quarter, which was a big step up. We expect that to continue. They're looking at new ad units. They're looking at better targeting. So we do think there's room for ad revenue to really grow from here.
I mean, so you step back for the digital ad story, it's still a very bullish story for digital advertising. I mean, there's still that big macro call of digital advertising, whether it's the big ones like Facebook or the smaller ones like Grindr, taking dollars away from traditional analog media. Is that story still in play? And if so, how long do you think it goes for?
I think it is still in play. I mean, we do still see some ad dollars going to more traditional sources. So, you know, obviously digital advertising is much better targeting. You can do things like direct response advertising where users are taken directly to a website to make a purchase. It's a good use of ad dollars for companies. Grindr has a really unique user base. Their user base is more affluent, they have higher discretionary income, they tend to be higher educated, so it could be a really great platform for a lot of advertisers who are looking to advertise to that base.
They're also Gen Z,
yes.
Pretty heavy as well. So talk a little bit about how that is very appealing to advertisers.
Yes, so actually it's funny because Grindr is one of the only dating apps really who isn't necessarily seeing an issue attracting Gen Z users. They've talked a lot about how the issues that other dating apps are facing, they don't really face because it's such a unique user base and because people come to Grindr not just for romantic connection, but also just to meet people, to make friends, to have a community. So Grindr has done a great job of attracting these users, of holding on to them. And again, it could be a great place for advertisers to reach Gen Z.
30 seconds left. Now, why was the stock down, or is down 40-some-odd% this year?
So they have missed on a few revenue metrics. They were a little bit light on revenue last quarter, a little bit light on EBITDA. But again, we think the long-term growth perspective for this company is really strong. They have been growing users, which is unique for dating apps. So we're very comfortable with the 20 to 25% revenue growth through 2027.
Okay, Nicole, thanks so much. Appreciate that. Nicole D'Souza, she is Internet and Software Equity Analyst for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio. Again, the potential deal in this space, Grindr take-private interest is out there, maybe from some shareholders, so we'll see how that plays out. The market's still showing some interest in moving higher here. S&P 500 up 45 points, so we'll stay on top of that. All right, this weekend, listen for the global debut episode of the Michelle Hussein Show. In her premiere episode, Michelle speaks with the Prime Minister of Canada, Mark Carney. Each week, she'll make sense of the world with one essential conversation, bringing her signature blend of curiosity into conversation with world leaders, business titans, and cultural icons. Listen and watch. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We are seeing a renewed wave of dip buying, and equities are extending gains after Treasury Secretary Scott Bessent suggested the possibility of a longer China tariff truce tied specifically to rare earths. So here's where we stand. The Dow, the S&P, NASDAQ off session highs, but still very much in the green, with the S&P up 37, now up by 0.6%. Dow Industrials are advancing by 128 on. The Dow up now by about 0.3%, and NASDAQ higher by 0.8%. The Russell 2000 index, the outperformer today, actually performing in line right now, up by about 0.9%. We've got the 10-year 4.00%, with the 2-year 3.48%. Gold up $51 the ounce, 41.94 on the precious metal, up 1.2%. Silver with a 52 handle again, 52.66. Silver up 2.4%, and a retreat for crude, 58.44 right now on WTI, down 0.4%. Morgan Stanley's stock traders soared past expectations in the third quarter. Morgan Stanley shares, they are advancing today. Right now we got Morgan Stanley gaining by 5.5%. Bank of America's third quarter earnings beat estimates. Bank of America up now by 5.4%. So what about the banking outlook going forward? Cheryl Pate is Senior Portfolio Manager at Angel Oak Capital. She was a guest moments ago right here on Bloomberg Intelligence.
You know, I think positioning into the quarter, we like the large caps a lot. You know, I think there's probably more of the deregulation angle that hits the large caps more specifically. But as we look forward to lower rate environment, I think the steeper yield curve, lower rate theme is underappreciated in the regional banks. And it may be time for a pivot into regional from large cap from here.
Cheryl Pate of Angel Oak Capital. Speaking of regional banks, this morning we did hear from PNC, stock down now by 2.7%. Recapping, S&P higher by 0.5%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. Paul Sweeney and Scarlett Fu here on Bloomberg Intelligence on Bloomberg Radio. We're streaming live on YouTube. And, you know, for all the talk of all these companies involved in AI deals, circular deals where they're teaming up with someone and they're buying something or investing in something and partnering with something to buy their own chips back, one company is noticeably absent from all these announcements, and that is a big one. It's Apple.
Yes.
Where is it?
I don't know.
They have a lot of cash.
They do. I don't know. I don't know their AI play. That's what I don't know.
Well, their AI doesn't work very well on their phone right now. I can tell you that. Anurag Rana is a tech analyst at Bloomberg Intelligence, and he joins us now from Chicago. So, Anurag, there are some headlines here that Apple is looking to beef up its smart home offerings, lessen its dependence on China. This is something that the president of the United States has been pushing Apple to do, to bring some of its manufacturing back to the U.S. But Apple is not doing that. It is beefing up its manufacturing operations in Vietnam. What's going on with Apple?
See, when you look at it, whether it's accessories or, you know, putting together the phones, you really cannot do that in the U.S. We don't have the size factories or automation to do that. So you will have to do that somewhere in Asia. And as they're diversifying away from China, because of the obvious threat between U.S. and China trade wars, Vietnam is a proper location where they can assemble, let's say, some accessories or smaller products where, you know, they may cost you $100 or $50, but they have the low-cost area to produce them or I would say assemble them.
So Anurag, we've spent the last 2, 3, 4 weeks speaking with you, speaking with Mandeep, speaking with other tech experts about all these deals around the AI ecosystem that we've seen. $10 billion here, $100 billion there. Companies ranging from Microsoft to AMD to NVIDIA to OpenAI. We have not talked about Apple. And I'm not sure if that's a good or bad thing. I don't know if these deals are good or bad. I just know there are a lot of them. They're coming out of the woodwork. There's big numbers. And Apple's just conspicuous by its absence, it feels like. How do you think about it?
Yeah, you could look at it both ways. One way is you criticize that they're not really at the forefront of the next generation model out there. But the other way you can say is, let everybody else fight it out. In the end, it'll go to the one that has the best model and include that in its own distribution channel, which is basically iOS. we have heard from Mark Gurman, has done some really good work on this particular aspect of it, is the next version of Siri may have technology from some of the third-party providers, whether that's OpenAI, Anthropic, or even Gemini. Our bet is that, we hope that they go with Gemini because they already get a lot of money from Google for the search business. Maybe there is some revenue sharing on that part as well. So we think eventually, we don't know when, they will get it right when it comes to AI infusing in their product, but it's going to come with some third party rather than in-house AI.
So in other words, they're kind of waiting for the dust to settle, waiting for winners to emerge before picking their horse and riding it. Is that something other device makers, handset makers are doing as well? I mean, Alphabet doesn't have to do that because it has its own AI business and it makes handsets.
Yeah, and it's very well integrated because it's the Google Gemini, it's part of Android, and then Samsung is going to license that. So they are all set on that particular aspect of it. But it's possible that Apple may choose to work with Gemini, Google itself again, get their technology, infuse it in their products, and you and I get the same experience we would get, on like, for example, using ChatGPT or Anthropic. I think from what we have heard from Mark is the research right now is they are running parallel chatbots internally, try to see which one has a better output. And eventually we know with Apple, it's going to go with the highest quality of searches or queries or answers. And let's hope that they get it around in the March timeframe that it's rumored to come out.
Earnings for the tech companies are going to be in a couple of weeks here. What should we be focusing on this quarter, Anurag?
So we are bifurcating the entire tech space into two buckets. One is area where we are going to see some weakness. That's going to be more on the consulting side, more on your traditional software side. And on the second half of the equation is companies that will see an uplift in their revenue because of AI-related investments. So CoreWeave and Microsoft fall in that bucket. But on the other side, you're going to see some struggle with, let's say, IBM Consulting, although IBM software should do well. And that is the bifurcation that we have. What is going to be most important for Microsoft, for example, is all the headline news that we are hearing about lower capacity or some constraints in data center work, whether that's going to have an impact on Azure guidance or their cloud revenue guidance for next quarter, that is going to be the biggest question going into the quarter for Microsoft.
Which of the names have the potential to surprise most to the upside, given what you've seen so far in terms of estimates?
I think CoreWeave has one potential, but at the same time, this stock moves so much on a daily basis with any new announcement that comes out. So it's tough to say whether a lot of that optimism is probably baked into the numbers at this point.
So what's the big thing that you guys are working on? I've referred so many people to the Bloomberg Intelligence Technology team's AI report here, which really is definitive, I think, and kind of laying out for people what AI is and, what are all the facets of it here. What's the next level of analysis for you guys in Bloomberg Intelligence Technology?
So the biggest thing we are trying to hone in and bifurcate this investment cycle that you mentioned, during the initial remarks. There are two aspects of it. One is everything that OpenAI is leading. It's signing contracts with NVIDIA, Oracle, AMD, and so forth. Now, at this time, OpenAI doesn't have the money to fund a lot of that stuff. They have enough financial backers to take care of it. So, so that's one area to focus on. The second part is companies like Meta, Amazon, Microsoft. They are going out and building capacity or signing up deals for data centers and new chips. Now, they have the cash to do it. So we are trying to figure out in these cases to see both of these scenarios to see which ones of them will have a greater impact on the downstream ecosystem, whether it's hardware providers or chip providers, or for that matter, data center providers as well.
All right, Anurag, thank you so much. Anurag Rana is Bloomberg Intelligence tech analyst on what's been going on with Apple, AI, and a bit of a preview into the earnings season that's coming up. Speaking of which, Paul, I was looking, Netflix will be reporting in 6 days' time. I know it's not a traditional tech name, but it does kind of kick off tech earnings season.
It does. It trades like a tech name a lot of times in terms of valuation and volatility, but it's been just a great story. The streaming business continues to grow. There's more competition there for sure, but Netflix continues to invest in great content, and it shows in their numbers. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Renewable fuels research for Bloomberg NEF joins us here in our Bloomberg Interactive Broker Studio. David, I've got Brent crude at $62 a barrel. I got WTI crude oil at 58 barrels. I don't think the oil producers are happy with those prices, are they?
They're not. They might be a little bit less happy, I think, as time goes on. We're sort of bearish on the market for the next few months, as is most people.
And is that a simply supply and demand issue?
Yeah. Both supply, a lot of new supply, and weak demand. So bad for producers, good for consumers.
So where are we in terms of OPEC as the driver? Because I look at the U.S., like what I've learned just in my lifetime, it's just relatively recently that the U.S. went from being a net importer of fuel, and that's what I grew up with, to now we're a net exporter of oil and gas. So how does that balance with OPEC in terms of kind of managing the market?
Yeah, OPEC traditionally, obviously the gatekeepers of the market. Over the next year, we see them adding about 3 out of every 4 new barrels to the market, with Brazil, the U.S., Guyana adding others. It's bad for the U.S. producers, though. If you look at Bakken producers, they're about $5 out of the money. If you look at Midland, Permian, they're about $8 a buffer.
So what do you mean out of
the money? It's not profitable to continue to drill those new wells.
So with WTI at $58, what's their cost of production?
About 63 in Bakken.
Really?
Yeah, about 50
I thought it was down like in
Midland.
the 50s or something.
In Midland, Permian, yeah. So
Okay.
that's like the best of the best versus the sort of like least efficient.
Again, I watched the first season of Landman. What I know is you guys, or the people down in the oil patch, they're like $75 a barrel. Everybody's making money. People at the pump aren't too upset.
Yeah.
It's kind of a good area, but they're far away from that.
They're far away, and it's going to get further, I think.
Talk to us about where we are in just the renewables discussion, broadly defined. Has that reset in the last couple of years, last year, last 9 months, maybe?
It's definitely reset here in the U.S., but I do think there's a bit of leaving the U.S. behind globally. There doesn't seem to be any winners here in the U.S. The drill, baby, drill dream is kind of gone. If you heard the Dallas ad a few weeks ago, nobody was particularly happy. These prices are not good for U.S. producers. They're good for the consumer, and that's something to watch. That could be positive.
We we were broadcasting from the Bloomberg Philanthropies Conference at the Plaza Hotel a few weeks ago, talking about a lot of this NEF, new energy finance, the renewables. And I think the message from investors, from developers, from consumers, all these people we spoke to was, hey, come along. This renewable thing, this transition into cleaner energy, it's happening.
Yeah.
U.S., if you want to come along, that's great. If you don't, that's fine too. Is that kind of how the rest of the world is kind of viewing this?
Yeah, green whispering is something
What
we've
is it?
heard. Green whispering.
Okay.
So instead of greenwashing, people doing the same thing, just less vocal about it than they were before. So you're still seeing really strong numbers going into transition technologies. You're still seeing big markets like China and Europe pushing ahead, maybe at a slower pace than before, where there's some implications from, let's say, U.S. pressure, but mostly planning ahead. New technologies popping up left, right, and center. If you look at China this year, they're selling more EVs than the U.S. is selling complete cars, total cars.
Right.
So it's still happening.
Again, my takeaway from talking to a lot of smart people like you in the energy spaces, and then on the other side, talking to all these AI people, and you put the demand for energy globally for the, I don't know how much longer, just from AI plus the rest of the regular economy, it seems like we're gonna need some of everything almost.
100%.
Like even nuclear. Like I'll put a little nuclear reactor next to this data center. That sounds reasonable to me. So how do the world of renewables and the world of fossil fuels, are they just going about their business as usual, or what's?
Yeah, all of the above comes to mind, right? You're still going to see a lot of replacement. Oil and gas is just a depletion business, right? You're sprinting to stay still in many cases.
Yep.
And it takes a long time for these projects to come online. It might be 10 years for your average project, right? So you might see this oversupply in the short term, this year, next year, but longer term, you don't see that same thing. So there still is a required investment in oil and gas, so we avoid price spikes, for example. You don't want to have like a diesel go through the roof, gasoline go through the roof, your voters are unhappy, rates go up, right? So there's a knock-on effect for all of this in managing this sort of measured decline in use, if that's the way it's going to go long term, right?
So where do you think oil, I mean, I don't know if you like WTI or Brent, whichever one, Where do you think the price of oil goes generally over the next couple of years?
Yeah, there is a happy medium. Next year, we think on average across the year, 54.50, about that level.
In WTI?
In Brent.
In Brent
terms, yeah.
50, well, say that again?
54.50.
Dude, we're at 62.
Yeah.
Oh,
I mean,
boy.
the market is diluted at the moment, I think. You're seeing all this supply coming online, so I think it's looking pretty bearish.
For what it's worth, you're in line with Mike McGlone, Bloomberg Intelligence. He says it's going lower, and he's been saying that for a while. What's the big theme you guys are working on these days?
Trade. Trade is really interesting. Reworking all of the different routes. Sanctions are keeping my job very interesting, right? Whether that's on allies or non-allies.
Yeah.
Things are moving.
So different trade practices, tariffs impacting the global energy market.
Yeah, exactly. Yeah, and you're seeing some interesting things that are popping up this week, like the IMO vote in a few days' time, to see if there's an initiative to push new fuels or cleaner fuels in. So, some really interesting things happening.
All right, we're going to stay on top of it, folks. The fossil fuels, we're on it. The renewable fuels and energy, we're on that too through our good friends at BNEF. These are the folks that are just absolutely going really deep in the analysis of this transition in the global energy markets to new energy. We got a great group of people that are doing good work, and that's why we feature them on this program. Dave, thanks so much for joining us. David Doherty, head of oil and renewable fuels research at Bloomberg NEF, joining us here in our studio. He doesn't mail it in. Again, WTI crude oil off about 30 cents, $58. I think I'm going to fill up Beamer this weekend, maybe like a 280 handle, 289 handle. How about that? All right, we're going to have more coming up in just a moment as we close out the morning session of trading. S&P up 30 points. This is Bloomberg Morning.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. Key case before the U.S. Supreme Court, a challenge to a section of the Voting Rights Act. CBS's Jan Crawford says it's about Louisiana's congressional map, which has 2 majority black districts.
A group of white voters challenged a second legislative district in Louisiana. They say it's unconstitutional, that you're not supposed to consider race. The government's not supposed to consciously sort people based on their skin color. So that's kind of the convoluted question that the court will take up, but it could have dramatic implications for how states draw up their legislative districts.
On day 15 of the government shutdown, members of the military are getting paid today, but other federal workers are seeing only partial pay or nothing this week. CBS's Caitlin Huey-Burns.
President Trump is threatening more targeted cuts.
We're closing up programs that are Democrat programs that we were opposed to. So we're being, and they're never going to come back.
His comments came during a meeting with Argentinian President Javier Milei, whose country has been offered a $20 billion bailout by Trump.
Overseas, NATO Chief Mark Rutte says most of the alliance is set to buy more American weapons.
More than half of NATO allies have now signed up, securing this crucial flow of support for Ukraine.
The State Department's revoked the visas of at least 6 people for their online posts about Charlie Kirk.
An Argentine national lost their visa after saying Kirk devoted his entire life spreading racist, xenophobic, misogynistic rhetoric. So did a German national who posted, "When fascists die, Democrats don't complain." The State Department says the U.S. has no obligation to host foreigners who wish death on Americans. Days after Kirk's assassination, Secretary of State Marco Rubio warned anyone here on a visa cheering on the public assassination of a political figure should prepare to be deported. Michael Wallace, CBS News.
The world soccer body FIFA said today it hopes all 16 host cities in North America for next year's World Cup will be ready. President Trump has threatened to move some of the matches, such as those in the Boston area, if safety is an issue. Now to South Carolina, CBS's Christian Benavides reports a measles outbreak has 16 known cases in Spartanburg, and around 150 children have been told to stay out of school and quarantine at home.
The highly contagious virus spreads through the air and can linger for up to 2 hours. Symptoms can include high fever, cough, runny nose, red eyes, and a rash. The virus can also cause severe infections, especially in kids under 5.
More than 100 students in Minnesota's Twin Cities are quarantining after being exposed to the measles. Wall Street, right now the Dow is up 108 points. This is CBS News. A new petition drive is aimed at the Super Bowl halftime show.
Bad Bunny isn't for country music fans who started a petition on change.org to have George Strait replace him as the Super Bowl halftime show performer.
Sometimes I feel like Jesse James.
They say they're worried the 31-year-old Puerto Rican reggaeton star will turn the show into a political stunt after he opted not to tour in the U.S. because of concerns over ICE raids. Fans say 73-year-old Strait could help the show pay true tribute to American music's rich heritage. Deborah Rodriguez, CBS News.
A Florida judge has blocked the planned transfer of prime Miami land for Donald Trump's presidential library. A local activist alleges that officials at a local college violated the law when they gifted the real estate. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
The Treasury Secretary soothes the markets once again. Welcome to the Wednesday edition of Balance of Power as Secretary Scott Bessent floats a longer tariff truce with China, enough to send stocks higher today. And we're going to consider the outcomes here as we listen to the Treasury Secretary and the U.S. Trade Representative when we talk to Bloomberg's Michael McKee. He's in Washington for the Beige Book today. It is day 15 if you're playing along on your home game of the government shutdown, and we've got new polling from Ipsos showing potential storm clouds looming for both Republicans and Democrats. We'll get into it with Cliff Young at Ipsos. The shutdown is not keeping the midterm campaigning quiet. 3 important Senate primaries are lining up that we're going to talk about with our panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano along for the ride. Mario Parker at my side for this first hour of Balance of Power. And we start, as always, on Wall Street. Let's get up to date on the trade this Wednesday with Charlie Pellet at World Headquarters in New York. Charlie, how we doing?
Right now, higher across the board. Joe Matthew, we have got the Dow, the S&P, NASDAQ very much in the green right now. Stocks are rising as Treasury Secretary Bessent fuels U.S.-China trade hopes. Also, we're seeing a renewed wave of dip buying. And, of course, those bank earnings this morning out of Bank of America and Morgan Stanley. Right to the numbers on Wall Street now. S&P up 28. That is a gain of about 0.4%. We do have the Dow Jones Industrial Average up 71, up 0.2%. NASDAQ up 148, up 0.6%. We are off session highs. 10-year 4.03% with a 2-year that's currently yielding a 3.50%. Spot gold up $46 the ounce, 41.89, up 1.1%. Silver now up 2%, 52.46 on silver. A retreat for crude down 0.4%, 58.44 a barrel on WTI, and Bitcoin down 2%, 110,800 on Bitcoin. As the government shutdown drags on, Wall Street's worried about the impact of a lack of government data. Tiffany Wilding is economist at PIMCO. She was a guest this morning on Bloomberg Surveillance.
The concern, actually, is that the longer the government stays shut within October, there's not an obvious catalyst for it to reopen, like there has been in the past to date, that you could have major issues around collections in October as the BLS field workers literally just can't collect the surveys.
And you can hear more of the conversation with Tiffany Wilding of PIMCO on the Surveillance podcast. NVIDIA shares higher, up now by 0.2%. NVIDIA adding another bull today as HSBC upgrades the chipmaker to buy from hold. And Walmart is on track to join the elite crop of companies with $1 trillion valuation after its announced partnership with OpenAI powered the stock to a record. That's according to Mizuho analyst David Bellinger. Again, recapping here, stocks higher, S&P up 36 right now, up 0.5%. Balance of Power continues now. Back we go to Washington. Once again, your hosts, Mario Parker and Joe Matthew.
All right, Charlie Pellet, thank you so much. We'll have more from Charlie on the markets just about 15 minutes time here on Balance of Power. So, yeah, whatever. It's rally time. Time to buy stocks with a government shutdown, no off-ramps in sight, no trade deal, no breakthrough with China. And it's buy, buy, buy. Welcome to the Wednesday edition. We've got a lot to talk about as we connect the dots between Washington and Wall Street. I'm Joe Matthew here on Bloomberg Radio, satellite radio, channel 121. You can watch us, as always, streaming on YouTube. Search Bloomberg Business News Live. You'll see what Mario Parker looks like. He's back with us again today. And Mario, we're looking at the guidance. President's got a pretty busy first, or not very busy first half. He's going to be showing up at 3 o'clock in the afternoon with Kash Patel, the FBI director, to hold what has been billed as a news conference. And we have no idea what they're going to talk about.
We don't know.
Are you hearing anything?
Not hearing a whole bunch, but I'm buckling up my seatbelt for sure, given that it's a press conference.
And it's Kash
because
Patel.
when there aren't press conferences, we still go for about 60 to 90 minutes.
How
with the
true,
president
yeah.
as well. I mean, it could be a celebration of some of the crackdowns that they proposed toward the group that they've classified as Antifa.
Right.
Could be something shut down related with paychecks as well.
Right.
We're just not quite sure what we have in store.
You did not list Jeffrey Epstein on the list of options, but I'm guessing they'll be asked about it. If you're following what's happening on Capitol Hill, 2:15 p.m., we got another vote on the continuing resolution that will fail as it continues to do here. Interesting, John Thune is only voting now on the Republican version of the CR. We're not doing the vote on the Democratic version, and that's not going to matter because we're going to stay shut down apparently for some time, as Mario just mentioned. They're figuring out the paychecks and removing a lot of pain points here on the calendar.
Absolutely, and at the same time, simultaneously, both sides are digging their heels in. They both see no incentive toward folding or giving in to the other side. Right. Now, what you do see, though, is a couple of some smattering in this bizarro world of D.C. that we're in right now. The fact that Marjorie Taylor Greene is among the Republicans putting the most pressure on her leadership to at least come to the table to talk about some of these subsidies.
Yes, bizarro world that we're in here in Washington. Scott Bessent, as we mentioned at the top of the hour, though, soothing some concerns on Wall Street. We had that deep dive when the president posted on Truth Social about a new 100% tariff, massive tariffs, he says. Then it was off again on the weekend, saying everything would be fine. Scott Bessent held a news conference today with Jameson Greer, the USTR, and spoke to the potential for a longer trade truce with China. Here's what he said.
Not only is China fueling Russia's war, but China's actions have once again demonstrated the risk of being dependent on them on rare earths, and for that matter, anything. If China wants to be an unreliable partner to the world, then the world will have to decouple.
Decouple. We've heard that word before. Michael McKee has as well, and he's with us now in our Washington studio. Bloomberg International Economics and Policy Correspondent. Great to see you a couple hours before the Beige Book. I'm just wondering what you made of the messaging, the timing for the message today, and exactly what we're going to expect here as a potential truce.
The whole thing reminds me of the old joke about when the guy goes to the doctor and says, it hurts when I do this, and the doctor says, well, don't do that.
Doing that.
I'm not sure why Wall Street keeps bouncing around like this, because the song remains the same.
Yeah.
President comes out, makes a threat to China. Today, Scott Bessent came out and made a threat to China and said, this is all China against the world, but if China will wait on imposing the rare earth restrictions, then we'll wait on putting on the 100% tariffs. So now everybody's happy again for the time being. This all really does seem like posturing among all of the countries and negotiators involved, and probably posturing more for domestic consumption, both in China and the United States. And they are still planning to get together in Korea, the president and President Xi. And so it looks like we're on course to maybe avoid all of this. And, don't keep selling if the president tweets something, because it's probably not going to happen.
Huh.
And Joe, you used a really good adverb, I think, soothe the market with Bessent as well. And Mike, are we expecting just more of this kind of jostling over the next couple of weeks until they finally meet? I mean, this is quite a roller coaster here.
I think we probably will get that. There are reports out of China that Xi has got opposition to what he wants to do there, and there are certainly concerns about the Chinese economy that are probably causing him some heartburn. And so he's got to play to his domestic constituency, and neither one of these guys seems to be able to avoid the tit-for-tat tweeting kind of thing. They haven't really taken any action against each other since the president last put on tariffs, but they do keep sniping, and I think we're going to get more sniping until this actually happens. And then the two of them will meet, and you know that Donald Trump will come out and say, this was a great meeting, and we're best buddies, and then we're all going to have to go through this again while we wait to see what actually came out of it, whether anybody follows through.
Exactly. It's almost like you've seen this before. That's just a couple of weeks away. As we also anticipate the next Fed meeting, Stephen Myron speaking this morning about this trade uncertainty with regard to China and other countries. Tariff uncertainty has been the name of the game for months here, making it more important for the Fed to cut rates, justifying the rate cuts. And I'm kind of confused about the rationality here. Wouldn't it be, or hasn't it been until now, the opposite?
Well, the whole thing made me laugh when he said that, because basically what Stephen Myron is saying is, my boss went out and tanked the markets by talking about China, so now we have to cut rates because he did that. There are concerns about what's going to happen with the trade wars down the line, and it just adds more uncertainty to it. But the Fed has basically already said we're going to cut rates at the end of the month. Jay Powell yesterday pretty clear on that. And so
he did describe himself as out of consensus in that conversation, I guess.
Yeah, he's very much out of consensus in terms of how far he wants to go, how fast. But if you look at the dot plot that they put out at the last meeting, he's roughly in the neighborhood of where the Fed thinks it will end up. But the timing is the big difference. The rest of the Fed thinks maybe end of next year or into 2027 before they get down to 3% or so.
And how difficult is it? I mean, they continue to outline this scenario, which is very, very tough, where you're saying just low hiring and just the anticipation, not necessarily seeing the job losses just yet, but the anticipation of that, and still being hovering above that 2% target for inflation.
Yeah, they've got a real dilemma, and Powell and all of them talk about that all the time. The chair yesterday noting that there's no good path for the Fed. The problem is they sort of have to pick one and do something about it. And right now they've picked the labor market as the weakness that's going to hurt the economy the fastest, because they're still clinging to the idea that the tariffs will see prices go up once in each segment and then level off, and inflation will stop going higher because of them. That's a bet that they're making, and it may turn out to be wrong, but that's where they're going now, because they don't think they have any other choice.
So when the Beige Book drops today, and you'll be talking about it on the air, is that going to be the best source of material, anecdotal data the Fed will have to work on until the BLS reopens and starts putting numbers out?
Yeah, it is, although the Beige Book is really for the people on Wall Street who want to look at it, because the Fed officials and all the regional banks have been talking to the CEOs, the companies, the auto dealers in their districts for quite some time. So they have a pretty good idea of what the companies are telling them is going to happen. We just don't have the actual data on what has happened. So they're making a sort of forward projection here, and the Beige Book will reflect that. So in that sense, it may be a little bit more important than it has been, because we don't have the actual data to rely on.
And hovering over all of this, I think, as we all know, the elephant in the room is the fact that Jay Powell is down to his last few months, maybe. I mean, Bessent came out yesterday and said there's about 5 candidates now on the list. Is the market paying attention to that as much right now, or is it more?
No, I was just at the National Association for Business Economics conference. It's 400 economists from companies around the country, and they're not really paying much attention, because basically everybody thinks that it's down to 3 people, and the president's going to pick one of them, and they're very well known, the Kevins and Chris Waller. And so at this point, nobody's too worried about that. They'll turn to it when we get there, I guess.
Michael McKee with us in Washington. Listen for Michael's reporting when the Beige Book does hit 2 p.m., right, Eastern time. And I do want to mention, just hitting the terminal with a headline from Semaphore. Bessent says $40 billion for Argentina. This number's getting bigger. We'll have more ahead right here on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We're well off session highs. Still looking at gains for the Dow, the S&P, NASDAQ, just about everything in the green right now. S&P advancing 31 to 66.75. That's a gain of 0.5%. The Dow right now up 97, up by 0.2%. NASDAQ up 160, higher now by 0.7%. With the Mag 7 index, the Bloomberg Mag 7 index up 0.7%. 10-year at 4.03%, with the 2-year 3.50%. Spot gold up $52 the ounce, trading at $41.95, up 1.3%. A retreat. West Texas Intermediate crude now at $58.26 a barrel, down 0.7%. And Bitcoin down 1.9% at $110,948. Treasury Secretary Scott Bessent is floating a longer tariff truce in return for China putting off its recently announced plan to tighten limits on critical rare earths. Papa John's International shares are surging on a Reuters report that Apollo Global Management has submitted a bid within the last week to take the pizza chain operator private at $64 a share. PZZA on the ticker, up now by 7.6%. And TrueCar has agreed to be taken private in an all-cash deal valued at about $227 million, shaking up the online vehicle marketplace at a volatile time for the automotive industry. TrueCar up now by 59.5%. Again, recapping stocks higher with the Dow, the S&P, NASDAQ all in the green right now. S&P 500 index up by about 0.5%. Balance of power continues now. Back we go to Washington. Once again, your hosts, Mario Parker and Joe Matthew.
Charlie Pellet, thank you, sir, live from World Headquarters in New York, where they know a lot about pizza. How about Charlie dropping the Papa John's at the lunch hour? Now we all want pizza, Charlie. Thanks a lot. Producer James is going to order out. We do this a lot around here, Mario. James, take it out of petty cash. Brendan will hook it up. Couple large pizzas here before the end of the show.
Sounds good. I'm glad it wasn't just me. My stomach started growling too.
Well, you know, you saw the pizzas coming into the Senate the other night when they were doing the big block of nominees. When they start rolling in the We the Pizza, they're stacked up to the ceiling. You know it's going to be a late night. But I don't know they're going to have a lot of late nights in the meantime here. I mean, senators are back in town. They're going to vote again on the continuing resolution today. It's going to fail. Then what do they just all go back to their apartments and wait till tomorrow to do it again?
Tomorrow we do it again.
This is a weird cycle.
Press conferences in the morning, votes in the afternoon, and no give from either side right now.
That's right. So if you're following along here on day 15, we do 2:15 expect another round of votes. To Mario's point, leadership already did news conferences earlier, and then they'll probably come back tomorrow and do it again when it comes to the Republican CR. Democrats haven't been blinking. Republicans aren't blinking. We got into it last evening on the late edition of Balance of Power with Senator Elizabeth Warren, the Democrat from Massachusetts. Here's what she said.
Democrats are really clear about what we're asking for. We want the Republicans just to roll back those cuts that are going to knock 15 million Americans off their health care coverage and drive up insurance costs for tens of millions more Americans. That's all we're asking for here. And the Republicans right now literally will not even sit down and negotiate. The House is out for its 4th week of vacation, so they can't even be here to vote. And the Senate just says, no talking. You know, that's not how it works in a democracy. We're fighting to try to help Americans be able to afford their health care. And I want to be clear, I'm not defending the American health care system. I think it's badly broken. But what Trump is doing to that system, along with the Republicans, is they're going to take a creaky, barely functioning system and just smash it apart. And that ultimately is going to hurt everybody in this country. And we're just trying to push back. Say, just give people back the coverage they had back in June. We're not trying to rewrite the whole system. We're not spending any additional money. Just give people what they had a few months ago before Donald Trump and the Republicans passed that one big, beautiful bill.
The BBB is talking about this with Elizabeth Warren on Bloomberg TV and radio last evening, and we fast forward to the latest research from Ipsos on the shutdown. Of course, Cliff Young is always running numbers on any number of issues, but Mario, storm clouds on the horizon. The headline here, a pox on all your houses. when it comes to blame for the government shutdown. Cliff Young is with us right now, of course, from Ipsos here in Washington, U.S. Public Affairs Chair, Professor, Texas A&M University's Bush School of Government and Public Service. Cliff, it's great to see you. Are these bigger storm clouds for D's or R's?
Well, I think it's storm clouds for all of them, really. When you look at the polling and you peel away the onion, Americans are just saying are criticizing everyone, Republicans, Democrats, and Trump and the Trump administration. Now, when you look a little bit deeper into the data and you force people to choose, they slightly blame the Republicans more than the Democrats. But overall, the takeaway is it's a dysfunctional system, a pox in all your houses.
And Cliff, just the fear about the tariffs, I think, was another one of your sub-headlines as well. And I'm old enough to remember when Donald Trump cast economic confidence in his policies, at least, as one of the reasons that he won the election. But we're seeing some different things play out in the numbers that you've run.
Yeah, well, the issue set is changing, right? He won on cost of living. It still is an important issue, but other issues like political extremism are more important. I would say that Trump overall, in terms of his approval numbers, he's in a relatively good position, if not great position. He's in the mid to low 40s, whether it be by Ipsos polling or polling from all other firms. That's a good place to be. It's better than 2017. But that all said, there's still a high degree of trepidation and unease among Americans about the tariffs. They see the tariffs as inflationary in nature. We've already picked up in our polling, in the surveying of American households, changing or adjustment of behavior on the margins. Maybe I buy a little bit cheaper. Maybe I stockpile a little bit. Obviously, this hasn't fully hit. When you look at sort of the projections from economists, it looks like the tariffs will have their full impact in Q4 and in Q1 of next year. So those, in my mind, are the real storm clouds. That is the impact or potential negative impact of inflation on Americans' opinions of the administration and Trump.
Well, based on the conversation we're having today about China, this couldn't be more important for the markets, for our audience, for consumers, Cliff. And boy, we've been given the administration a good deal of space on Wall Street when it comes to this. We're bumping up against all-time highs unless investors seem to think that this is falling apart. Scott Besson got the gains back on track today, suggesting we may have an extension in the trade truce, but fear that tariffs will lead to inflation. You say low levels of optimism in these policies, with the percentage that say Trump's tariffs on imported goods are making prices for things they buy go up is 70%. And that's consumers of both parties, right?
Yes, and it's a big number, and some of that is real, and some of that is anticipatory. You also have especially Republicans understanding that the short term might be bad, but the long term benefits of bringing back manufacturing and jobs is more important. So it's a more complex issue than just a fear of inflation or inflation specifically. Yeah. But once again, it's something that needs to be looked at and followed over time, because a vast majority of Americans are worried about the future and its inflationary aspects.
And Cliff, when we look at some of these numbers, I mean, the economic, as we mentioned, indicators show that President Trump has lost some support or lost some steam since last November. Immigration, relatively, seems to be a stronger issue for him. But when you look beneath those numbers, they look a little bit mixed in terms of National Guard, in terms of just deportations, et cetera.
Yeah, it's very interesting. That's a very important point, Mario. When you look at Trump, generally speaking, and his approval ratings in general, he's in a relatively good place. I already say it's like around 43 or 44. That's better than 2017. All things considered, it's a good place to be in a highly polarized America. But when you look at specifically the issues or the policies, that support falls off considerably. When you look across the signature initiatives by the administration, he doesn't garner a majority of support in any of them. Not even immigration. When you go specifically at immigration, you talk about deportation, it falls to around 40%. Obviously, still garners the support of Republicans, supermajority percent of Republicans, but across the board, these signature policies do not find majority support.
Fascinating numbers on crime here, Cliff, and it reminds me of polls that find, congressional approval ratings are off a cliff. They're in the single digits, unless you're talking about someone's own member of Congress, and they love that guy. Just you fire everyone but my guy or my gal, and that's apparently the case for crime in your city. Your city is safe, just not the other ones. And when you take a look at this, you asked questions about this compared to this time last year. Is crime in the following area higher, lower, or the same? When you look at the country, through the roof, it's higher. Major cities, a little bit lower. Your state as a whole, we're down in the 30s here. Your city or community, nobody thinks that crime is a major problem. It's in the 20s. So the president has seized on a national perception here that people may not rationalize with their own town.
Yeah, man, I love my town. I love my guy. I don't like your town. I don't like your guy. That's something we see perennially in polling since even the 1930s. And indeed, the administration has leveraged that, right? It's all about proximity. The closer I am to the issue of crime, the less I think it's a problem. And he has, pushed that agenda. Now, the Republicans have historically pushed that agenda with their base being in the suburbia and rural areas, not in those sort of blue urban areas. But ultimately, that's the explanation of the difference in perceptions. Now, that said, there is very little support for the deployment of National Guard troops in the urban areas. It doesn't matter how you ask it. You only get somewhere between 20 and 30% of Americans agreeing with it. But still, you get a strong majority of Republicans. But as a general, not base issue, it doesn't fly.
And Cliff, I do want to go back to one point that you made at the top, just about political extremism. We saw the White House present Charlie Kirk with a posthumous Medal of Honor yesterday. Some of your research shows that this had been front and center for Americans even before Kirk's murder about 5 weeks ago. What are you seeing there in the numbers?
Yeah, so as you said, Mario, that's a great point. It actually, worry about political extremism predates the Charlie Kirk assassination. It already was the #1 issue. What's happened since then, it's become a more national issue, not a Democratic issue, because historically it had been very much a Democratic issue, worries about threats to democracy, worries that Trump was authoritarian. Now we have Republicans saying the same, that they are worried with political violence, and it's directly a function of the Kirk issue.
It's great to have you back, Cliff, and thanks for sharing this research from Ipsos. As always, Cliff Young with us live on Bloomberg. It's Balance of Power. I'm Joe Matthew alongside Mario Parker in Washington. We've got a lot more ahead as we assemble our political panel, zeroing in on 3 Senate primaries that are going to capture your attention in the midterms. It's next on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are getting a lift from trade hopes, also from better-than-expected bank earnings. The Dow, the S&P, NASDAQ, they're all very much in the green right now. S&P up 31 points, trading at 66.74. That is a gain of about 0.5%. We've got the Dow up 87 right now. Dow Industrials up by about 0.2%, while NASDAQ, the composite index, up 161 for NASDAQ, an advance now of 0.7%. Our Mag 7 index also higher by 0.7%, with the 10-year 4.03%, the 2-year 3.50%. Spot gold at $41.92 the ounce, up 1.2%, and silver up 1.9%, $52.40 for an ounce of silver. A retreat for crude. West Texas Intermediate down 0.8%, $58.25 a barrel on WTI, and Bitcoin right now down 1.9% at 110,900 on Bitcoin. Bank earnings. Bank of America up 4%. Morgan Stanley after earnings up by 5.8%. As for the broader bank earnings picture, Stephen Auth is Chief Investment Officer at Federated Hermes.
You've got like a perfect world here. You know, the yield curve is steepening. That's always good, particularly for the regional banks. The economy's re-accelerating. You got Scott Bessent and company focused like laser beams on lowering the mortgage rate, which is artificially high relative to the 10-year. They're going to do that.
Federated Stephen Auth, and by the way, he's got a 2-year target on the S&P 500 index of 8,600. Keeping that call in context, right now the S&P is at 66.71. Abbott Labs has cut the top end of its 2025 earnings guidance by 2 cents a share. Political news, we have got New York City Mayor Eric Adams sharing with leaders in his administration that he has received, quote, an amazing job offer for when he leaves City Hall this year. This, according to a person with knowledge of the situation. And hedge fund billionaire Bill Ackman has given $1 million to a super PAC opposing Zohran Mamdani's New York City mayoral campaign. That, according to state campaign finance records. Again, recapping, stocks higher, S&P up by 0.4%. Balance of Power continues right now, and back we go to Washington. Once again, your hosts, Mario Parker and Joe Matthew.
Charlie, many thanks. We'll have more on the markets when we check in with Charlie Pellet coming up at the top of the hour. And if you are with us in hour 2, we're going to be joined by Congressman Sam Liccardo, Democrat from California, on what is now day 15 of the government shutdown. We do not expect this shutdown to end anytime soon. In fact, you've got leaders on both ends of Pennsylvania Avenue now bracing for what could be not only protracted, but a record-length shutdown. And we're going to have more on that as well with Mike Dorning when we get to the top of the hour. I'll tell you what, Mario, the fact that the government is shut down is not keeping politicians from turning to the campaign trail. And in the case of Seth Moulton today, this is fascinating. Democrat from Massachusetts, member of Congress. You've heard him many times, seen him many times on this program, right? An Iraq War veteran, Marine Corps combat veteran with an incredible story to tell, who has reached for leadership positions in the past. He, in fact, challenged Nancy Pelosi at one point for Speaker and did launch an ill-fated run for president. Now it's on to the Senate. Yes, Seth Moulton making the announcement in video form today. Watch and listen.
We're in a crisis, and with everything we learned last election, I just don't believe Senator Markey should be running for another 6-year term at 80 years old. Even more, I don't think someone who's been in Congress for half a century is the right person to meet this moment and win the future. Senator Markey's a good man, but it's time for a new generation of leadership, and that's why I'm running for U.S. Senate.
Wow. You know, Joe Kennedy tried this as well, and it was the end, at least for now, of his political career. It was the end of his congressional career. Ed Markey's like part of the woodwork up there, but Seth Moulton's right. He's turning 80.
And that's part of the risk, right? When you challenge these members in Congress who have been there for a long time. I'm from Chicago. I remember an upstart named Barack Obama who challenged Bobby Rush years ago and lost the only election that he had run in, right? So we see how tough this can be when younger upstarts and ambition go this route. But what's striking to me is that even as the Democratic Party is seeing some signs of lifting itself from the mat, right, from last November with the shutdown shutdown argument coalescing around healthcare, et cetera, that you're still seeing some of the demons that bedeviled them last November taking hold right now with the generational problems.
It's a generational issue. So enter Janet Mills. This is where it gets interesting, and we're going to bring our panel in here on this. Janet Mills, the Republican governor of Maine, has decided to run for Senate. It's going to primary Susan Collins. Janet Mills, this is the opposite effect here, would be the oldest, from what I understand, based on my research, the oldest freshman senator ever elected if she were to win at 78 years old. So this is an interesting push or pull. We've also got a fascinating one that we're waiting for in New Hampshire that could well be the knockdown, drag-out primary between Scott Brown, the former senator, and John Sununu. So let's bring the panel in here because we like talking campaigns. I miss this stuff, to be honest with you. I mean, we have to cover the governing of this country, but campaign season is what gets the political junkies moving. And just ask Rick Davis and Jeannie Shanzano. Bloomberg Politics contributors, they're both with us. Jeannie is democracy visiting fellow at Harvard Kennedy School's Ash Center, and Rick is partner at Stone Court Capital, our Republican strategist. So Rick, I'll start with you on this campaign by way of Maine. What do you make of this with Janet Mills running to the Senate at 78, while Seth Moulton says Ed Markey should run away at 80?
Yeah, there's no question that part of the debate that's going on inside the Democratic Party is a generational one. You know, when you've got Chuck Schumer, the majority leader, you know, as a geriatric in the Senate, and so, you know, the symbolism should not be lost, and it's not lost on voters. Voters have been pretty grumpy about older candidates in the past, and wouldn't surprise me that age is one of the dominant issues in this year's election cycle, not just here, but also in places like Texas. And as you pointed out, you know, you've got other barn burner races, but I think age is a constant in politics, and it's going to be a hot one in this election cycle.
And Jeannie, just from the Democratic side, I mean, does this hurt or help the party having these type of arguments in public view right now, these challenges that Moulton is making along these lines of generations and age?
Yeah, I first want to thank you guys because to Joe's point, I am so thrilled to be talking elections. It means we are in midterm season almost. And of course, as a New England person, I love 3 good New England stories. You know, we are seeing these generational fights, but there's a big difference on the Democratic side between what we're seeing in Maine and what we're seeing in Massachusetts. You know, the difference is we can't conflate age and ideology. It's so fascinating because in the Massachusetts case, Moulton is the younger and more moderate of the candidates. Markey is much more, or at least somewhat more, progressive. And I should also add, I believe I have these numbers right, that that Markey was elected to office 2 years before Moulton was born. So that'll tell you something. But Markey is the more progressive of the candidates. It's flipped around when you get to the Democratic side in Maine and you see somebody like the governor, Janet Mills, and you see somebody like Plattner, who is the younger and more progressive. So it's running along 2 tracks, the debates in the Democratic Party, generational and age. But one thing, generational, and ideological, but the one thing that joins them all together is they are all talking about issues of cost of living. Same thing we're seeing with Mamdani, same thing we're seeing with Moulton. Can you afford to live in this Trump 2.0 world? So that is what joins them all together, regardless of age and ideology.
To be clear, by the way, I should have said Janet Mills is a Democrat. She's got to get through a primary, as Jeannie is describing, to face off with Susan Collins. Jeannie, we remember the race that former Congressman Joe Kennedy ran against Ed Markey, and anyone listening to us right now on 92.9 in Boston remembers that was a tough one. That was a tough slog, and there were a lot of young progressives who had backed Bernie Sanders who said, no, we're sticking with Ed Markey. He also had a campaign manager in John Walsh who followed him to Washington and has since passed, who will not be with him this time. I just wonder how different the dynamic will be in this race with Seth Moulton.
Yeah, I was just thinking about that. I mean, that gives you a sense as to how strong Markey has been for years as part of the fabric of the Massachusetts political scene, that he could defeat a Kennedy. And he did so with a lot of support. This race will be different in part because of our experience in 2024 and the issue of age and questions about both Markey and Mills does it make sense for Democrats to be running people in their late 70s for office after what happened in 2024? That's a big question. But, another part of this is that Moulton not only is more moderate, but he has been challenging Democrats and doesn't have quite as many, I don't know if you want to say friends, a lovely guy, but doesn't have as many allies in the Congress. He's been there a while, doesn't have as many allies as Markey. So very different styles as well. But I think this is going to be a much tougher race for Markey because of the environment after 24.
And Rick, and just looking at Maine, I mean, whether it's Janet Mills, whether it's Plattner as well, I mean, for a long time, Democrats have tried to take that seat that Collins has held. From your perspective, I mean, is she finally vulnerable, or is this a mirage that Democrats risk just throwing a lot of money at?
Yeah, that's a good point. It was a mirage last time she ran, $50 million spent on both sides to unseat her, the number one target, and she survived quite well. And you're right. I mean, she is the number one target again this time. And so I do think the Democrats have found a much more competitive opponent this time. Janet Mills, very popular governor, 2 terms, survived quite well in a state that Donald Trump has a lot of supporters in. In fact, has actually done pretty well in hand-to-hand combat with Donald Trump in the Oval Office. So she's not somebody that Republicans are taking lightly. It's highly anticipated she'll cruise through a primary and will have plenty of money. And this will be, again, one of the most expensive Senate races of the cycle. That being said, Susan Collins, chairman of the Appropriations Committee, incredibly powerful in her own right and a terrific campaigner, and someone who's been taking this race very seriously since day one, has stockpiled a lot of cash, both in her campaign account and in her super PAC. So it could be a knockdown drag out. I would say that it will be the number one race Republicans focus on, and yet there are other growing more competitive races, especially depending upon how some of these primaries turn out.
What do you think about next door in New Hampshire, Rick? I consider you a bit of an expert on New Hampshire politics, having spent so much time there on the presidential campaign level. But you've got Scott Brown now, who's no stranger to New Hampshire. And, of course, he tried to beat Jeanne Shaheen once already, up against, apparently, and it's not official yet, but expected to be up against John Sununu. What does New Hampshire want in its next senator?
Well, as you say, Scott Brown's not a stranger, but he's also not been a resident of New Hampshire for a long time.
That's true.
So, it is a bit of a twist. Very hard to beat a Sununu in New Hampshire, especially considering how popular John's brother Chris was when he left the governorship just recently. I don't anticipate this being that tough of a primary for John Sununu, but I would say the general election there could be really material to Republican chances of holding the Senate, because Chris Pappas, who I've gotten to know over the years of hanging out in bars in New Hampshire, not that he's a heavy drinker or anything, but he's a formidable Democratic opponent, and in a state where even the current governor has, Republican governor has all kinds of efforts to try and distance herself from Trump. This will be an interesting one when it gets to the general too. So. Good primary to watch, knockdown, drag out, but even an equally more interesting general election, I think.
And Jeannie, to Rick's point about Pappas just being a formidable candidate, should it shake out that way? I mean, Democrats have. Otherwise, we're talking about some of these existential and philosophical differences, generational differences within the party. But Democrats are doing a pretty good job of putting forth some solid recruits, right?
Absolutely. And Mario, I don't know if you know, but I always like to challenge Rick Davis. So when he says that the governor of Maine is going to sweep into the primary on the Democratic side, I wouldn't count Plattner out. He is a very, very attractive, to your point, Mario, young and progressive up there. So sure, she has an incumbency. Sure, she's friends with Susan Collins. Sure, Collins would much rather like to run against her. But Plattner is a force to be reckoned with as well. So I'm just putting that out there, taking it to Rick Davis. And yeah, I think the Democrats are absolutely trying to recruit candidates. and that they believe can win. And that's why we are seeing, Chris Pappas, he is a formidable candidate. So that is certainly a race to watch.
You'd never say anything bad about Rick Davis. I know how this
Never.
works. Jeannie Shanzano, Rick Davis, our Bloomberg Politics contributors. They'll be back in hour 2 as the Pentagon press corps packs up and moves out of the building. We'll tell you why. Mario, thank you. We'll meet you back here tomorrow. Mario Parker in Washington. I'm Joe Matthews. Stay with us right here on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
The shutdown hits day 15. Welcome to the Wednesday edition as the Senate winds up for another vote that is expected to fail today. It'll take place in the next couple of hours as leaders brace for a lot more of this on both ends of Pennsylvania Avenue. Coming up, we'll get the very latest from Mike Dorning and our Capitol Influence team, and we'll spend some time in discussion with Democratic Congressman Sam Liccardo of California, with the House at the moment still out of session. The Pentagon press corps is packing up and moving out today after refusing to accept coverage limits We'll talk about the issue at hand with our political panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us. And we start all this after a look at Wall Street. Charlie Pellet has the latest on the markets from world headquarters in New York. Charlie, where do we start?
Right now we are higher across the board. Lows of the day on the S&P 500 index, but as is often the case, a lot of moving parts to this market. Stocks today getting a lift from bank earnings and trade hopes. Right now we have got the S&P up 13, 66.57 where we stand. That is a gain of just about 0.2%. The Dow giving up earlier gains, just about unchanged on the day, higher by 7 right now at 46,275. NASDAQ, meanwhile, up 85. It is up by about 0.3%. The 10-year yield, 4.03%. The 2-year, 3.50%. The Dow just turning negative, down now by 7. We've got spot gold up $54 the ounce, 41.97, up by 1.3%. Silver is at 52.44 the ounce, up 2%. And West Texas Intermediate crude down 0.2%. 58.56 a barrel on WTI. I mentioned those bank earnings. Morgan Stanley up 5.3%. Morgan Stanley's stock traders soared past expectations in the third quarter. Bank of America, after earnings, up 4%. Its third quarter results beat estimates as investment banking activity increased amid a long-awaited comeback in M&A. So again, the Dow, the S&P, NASDAQ trading mixed now, with the Dow Jones Industrial Average lower by 22 points. Argentine bonds are jumping on news that the U.S. is lining up $40 billion in aid, and David Ellison said to be preparing to submit an official merger bid for Warner Brothers Discovery. That's according to the New York Post, citing sources. Warner Brothers Discovery up now by 2.5%. Paramount Skydance unchanged on the day. Again, recapping here, S&P 500 index up 0.1%. Little change. The Dow just turning negative, down 0.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back we go to Washington. Balance of Power continues. Once again, your host, here is Joe Matthew.
All right, Charlie, many thanks. We'll have more on the markets from Charlie Pellet about 20 minutes' time as we connect the dots every day here between Washington and Wall Street. Thank you for being with us on the Wednesday edition. You remember the old saying, the beatings will continue until morale improves. And that seems to be the message from the White House when it comes to the government shutdown, now entering day 15. Well, we're halfway through it. There's going to be a vote in a little while. It'll be the Republican passed in the House CR that continues to fail in the Senate. And unless there's some sort of Christmas miracle here ahead of Halloween, it will fail again. And that will likely be the case for the days ahead. As we told you yesterday, leaders on both ends of Pennsylvania Avenue, whether it's President Trump, his budget director Russ Vought, or Speaker Mike Johnson, suggesting that they are bracing for a protracted shutdown, one that could set records. Maybe we're talking about this in November, maybe over our turkey roll at Thanksgiving. We'll find out. And we're going to talk in a moment with Congressman Sam Liccardo, the Democrat from California, with his thoughts on this. Because as I mentioned, the president is promising more pain the longer this goes on, and he's looking at Democrats. Here's what he said yesterday from the White House. We'll see if we can get that shot for you in just a moment here, because I want you to hear what the president said about canceling, as he referred to, Democrat programs and Democrat agencies. Mike Dorning is with us from our Capital Influence team here in Washington. And you know what I'm talking about, Mike. First, it was the layoffs, and I guess we got about 4,000 last week, but the administration is promising much more.
Yeah, no, they say that they're going to use this as an opportunity to go after what they call Democrat programs the president doesn't like, and to lay off a lot more federal workers. And they feel like that way they're punishing Democrats for this and Democratic constituencies.
So, with that said, it's not helping to dislodge any Democratic votes, right? When this comes to a vote today, we expect the same result.
We do expect the same result. The Democrats are dug in on the Affordable Care Act. They want the subsidies to continue. They feel like they have an important issue to stand on. That 20 million people will see, their insurance premiums double, that they can message this, that it's something the party cares about and something that's an effective campaign message. So they feel like this is an important thing to take a stand on. And right now, both sides feel like this is a political opportunity for them, or presented as such.
That's That's the toughest scenario you can be in when both sides think they have the moral high ground here. But an interesting turn in the rhetoric yesterday, as Speaker Mike Johnson suggested to the Associated Press that this could be the longest ever shutdown. And the White House very carefully picked off some important pain points from the calendar. This was supposed to be the day military troops went without pay.
Yeah.
They found a way around that. Federal law enforcement found a way around that. Funding the WIC program, managed to find some money for that. So these potential deadlines, for lack of a better term, have been removed. Could this, in fact, go on right into next month?
It certainly could, and the longest ever shutdown was under Trump. And the first administration went 5 weeks. And part of, Trump sort of views himself as someone who often tries to get the best of the other side in a deal, and part of that is through projecting strength, projecting that they're not going to give in, and showing that they're not going to give in. And the way you show you're not going to give in is to remove these pain points, because in the polling at the moment, the Democrats are doing slightly better than the Republicans on this shutdown. So you can't use the polls to force the Democrats to fold, at least not right now. And so the president is kind of fortifying himself and his party to at least show the Democrats that they can continue with this a long time. So he's trying to pressure them to cave or give in some way, rather than himself giving ground.
A lot of the conversation until now has been about how did Democrats in the Senate resist the jailbreak? Can Republicans pick off 4 or 5 and get this done, and then a deal is not needed? But I feel like at some point we need to start asking the questions about how long Republicans are willing to wait to address the issue of Obamacare subsidies, knowing that this is going to be a massive issue in many red districts. Just ask Marjorie Taylor Greene.
Yeah, no, and in fact, Texas, Florida, and Georgia, including where Marjorie Taylor Greene is from, are probably the 3 states that are going to get hit the hardest by these premium increases that start coming out November 1st. And it does disproportionately affect Republican areas, particularly Republican House districts.
Yep.
So they could start feeling pain. They're more likely to start feeling the pain when that open enrollment begins November 1st.
That's right.
I think the Republicans were hoping the Democrats would feel pain from the government being shut down, and the Republicans saying, hey, this is a Democratic-caused government shutdown. But that hasn't been the case. And in a weird way, Trump's steps to kind of fortify himself have also reduced the pain for the Democrats, because, hey, the military are paid.
Yeah, right.
The WIC benefits are going to go out. All these things that would be pain points have been ameliorated to some extent by President Trump's actions, and President Trump's efforts to punish Democrats by canceling these programs and laying people off have made it look more like a Trump shutdown, even if it otherwise might look more like a Democratic shutdown.
Mike Dorning on our Capital Influence team. He's the deputy team leader with us here in Washington. Mike, we appreciate the setup, as always, with someone who has spent some time covering Capitol Hill. And we want to talk to a Democrat now for his sense of things. Sam Liccardo is a Democrat representing 16th District of California, the former mayor of San Jose, back with us on Bloomberg TV and radio. And Congressman, it's good to see you. Welcome back. I wonder your thoughts on what we're discussing here, because if the Democratic calculation is correct, you wait long enough, Republicans will eventually have to address the Obamacare subsidy issue with this year-end deadline approaching. How long do you think that is?
Well, we shouldn't need to wait that long. Speaker Mike Johnson said yesterday that there is no strategy moving forward. Well, there is a strategy. It's actually the oldest strategy on Capitol Hill. It's called negotiation. And I've been on the phone with a half dozen Republicans over the last day, and I can tell you that we can extend Affordable Care Act tax credits for those 22 million Americans and many more. We can do so at a lower cost with income caps. But what we can't do is force the burden of higher costs on tens of millions of American families, including those 22 million Americans who are going to see their premiums double. We can't do that. And so I think many Republicans understand that. The question is whether they're going to have the courage to step up. We can do this through negotiation, but we need a speaker willing to negotiate. And we are here, more than 200 Democrats waiting for a speaker to show up to negotiate with. He's not here yet. And, you know, I was mayor of a city of 1 million people. We passed 8 balanced budgets, and every single one of them, I negotiated with people who disagree with me. That's leadership. That's what we all have to do.
What do you think about the moves, Congressman, that the administration has made that we were discussing, finding a workaround for military pay, federal law enforcement, helping to fund the WIC program? Did the administration effectively extend this shutdown by doing this, or take the glare off Democrats in the meantime? I'm trying to figure out the political strategy.
Yeah, it's a good question, and I don't think I'm paid well enough to be a very good political consultant to give you a good answer to that. But what I do know is that the focus now in the national debate is where it should be, which is health care. Because we know it's not just these 22 million Americans that are going to pay twice as much on their premiums, but all of us are going to pay much more for our premiums because another 4 million Americans will be pushed out of the insurance world into getting their care in emergency rooms and from ambulances, which is more expensive because we know that passes on the cost to all of us. So we're going to see all of our premiums rise if we don't get this solved. And we're out of time because we know November 1st is when all of us receive that information about what plans we can choose and at what price. So we've got to get it done quickly.
What is it that has you in Washington? I understand that your leader, Hakeem Jeffries, has called the Democratic Conference back into town just to be present. Are you having conversations with anyone? Are you doing interviews, trying to spread the message? What's the purpose of being here when the House is not actually in session?
Well, yes, we have had caucus meetings, and certainly we're talking to media as I am now. But frankly, my conversations with Republicans have been over the phone because they're not here, they're at home. Look, we're on duty, they're on vacation. We need everybody to be on duty because we need to do much more for the American people. They deserve better than this. And since the big ugly bill passed, 104 days ago, Speaker Johnson has called us into session exactly 19 days. So that is not a record of hard work that's going to be required to get us to negotiate to move forward. He's got to call the House back into session, and he needs to get his team here so we can negotiate.
Well, I know you have a unique view as a former mayor, and as we say frequently on this program, mayors don't always have the luxury of lawmakers in Washington when it comes to playing partisan politics. What is going to happen when these notices start going out? Many of them, to your point, are out already. Open enrollment set to begin on the 1st of November. Does your phone start ringing off the hook? Are you able to provide constituent services in the middle of a shutdown? And what would it mean? How many people would see their premiums rise in your district?
Well, we'll see 24,000 families see their premiums nearly double as a result. And in my district, that means about $3,200 a year more that they'll be paying for their health insurance. But really, this is going to be a burden on the entire health system. We know it's going to force the closures of some clinics and hospitals, and it's going to increase the cost for all of us, even if we're on private plans that we don't purchase on the exchange. And so everyone's going to feel the pain here. Yes, we're going to get the calls, and yes, we will be there manning the phones and receiving the emails because our offices have been open. In fact, I even opened an additional office back at home in the last couple of weeks to ensure that we can handle what we know is a lot of pain for folks. We've been meeting with federal employees and their unions and so forth to try to figure out how we can reduce the burden that so many Americans are feeling.
I understand the Capitol Police have missed their first full paycheck now for the first time. They're not included in the military or the federal law enforcement coverage, unless you can tell me otherwise, Congressman. We've had a big conversation about security in the Capitol recently with the uptick in political violence. How concerned are you about the Capitol Police not being compensated? What does that mean for your security?
Well, forget my security. I think it's a shame, and we should all feel shame because these are women and men who struggle to pay their rent, to live in a very expensive Washington metro. They deserve to get paid just like everyone else does who's working hard. By the way, members of my team, I'm also not taking a paycheck during this time. We all need to get the government open, and we need to be we need to be able to treat all of our employees and the American people more fairly.
I want to ask you about the rhetoric that we've been hearing from the White House, and I'm not sure what the president will say. He's going to have a news conference later on today, and I suspect will add to this conversation. But in promising mass layoffs, as Russ Vought has at least begun to announce the rifts with this shutdown, the president has also suggested that on Friday he will have a list, 2 days from now, a list of what he refers to as Democrat programs that will be cut. Let's play for our audience what he said yesterday, Congressman. We'll have you respond. Here's the president.
The Democrats are getting killed. And we're going to have a list of them on Friday, closing up some of the most egregious, socialist, semi-communist, probably not full communist, we're saving that for New York, but semi-communist programs, and we're closing them up. We're not closing up Republican programs because we think they work.
Congressman, I remain confused on this one because obviously citizens who are members of both parties and independents all tend to make use of these federal programs. Which programs are you aware that he's talking about?
I'm not sure I really know. Is he saying Social Security is semi-communist? I don't know, but nonetheless, I'm confident, as you are, that many Republican and Democratic Americans depend on all these programs, and we need to keep them up, open and running for America. But let's keep in mind, this threat is no different than the threat that we have heard since January 20th, right? We have seen 55,000 federal employees fired, 150,000 more pushed out the door. The most recent announcement was for another 4,000. We know it's all illegal. Obviously, that's in litigation. We've had many federal judges weigh in on this, and we've seen Republican-appointed judges telling this administration it's a violation of the APA and other laws. This continues to be illegal. We'll continue to fight it, but this is just more of the same.
Well, really interesting wrinkle here. Do you take him at his word? Will there be more firings? Will programs be closed down?
Oh, sure, he'll close them and then he'll reopen them when he realizes he made a mistake, just like he did a few days ago. Look, these folks are shooting from the hip and, more importantly, shooting before they aim. And we've seen that constantly, from the times of Doge through the rescissions and now these decisions. We know what the framers of the Constitution decided, which was the power of the purse lies with Congress. Obviously, everything that they're doing is illegal, and they're going to find that some of these things they're doing illegally are probably not very well considered even for them, as we have seen them routinely back up. So yes, we're going to see more of this, then they'll back off, then we'll have judges shut it down. We're going to continue to fight.
Well, we'll find out if you're right on that, Congressman, because it all does seem to be headed to the courts here. Sam Liccardo, many thanks. California's 16th District, the Democrat in Washington, with us live on Bloomberg TV and radio. We'll have more voices from both sides of the aisle as we make our way through this shutdown. And we'll assemble our panel next. It's move-out day at the Pentagon. For the press, this is Bloomberg.
7:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at a massive change in sentiment since our last update. Last time up, I told you just about everything was higher. Right now, just about everything lower. The Dow, the S&P, NASDAQ, all in the red, right to the numbers here, with the S&P down 10 right now. 66.34 where we stand. That is a drop of 0.1%. The Dow down 106, a decline of 0.2%. NASDAQ lower by 5, down under 0.1%. The NASDAQ 100 index just about flat on the day. The Russell 2000 index up now by 0.1%. A rally in stocks fading as a solid start of the earnings season, offset by speculation that a pause is warranted after that $28 trillion bull market run. The 10-year 4.03%, the 2-year 3.50%. Gold is up 1.2%, 41.92 the ounce. West Texas Intermediate crude down 0.7%, and Bitcoin's tumbling now by 2.1%, 110,635 on Bitcoin. NVIDIA has added another bull today as HSBC upgrades the chipmaker to buy from hold, citing the ongoing growth of artificial intelligence. HSBC also raised the price target on the stock to a street high of $320, up from $200. To put that call in perspective, NVIDIA now at 178, down by 1%. And investors led by BlackRock's Global Infrastructure Partners has agreed to buy Aligned Data Centers in a $40 billion deal, one of the asset manager's largest infrastructure investments ever. Again, recapping, stocks lower, S&P down 14, drop there of 0.2%. Back we go to Washington. Balance of Power continues. And once again, your host, here he is, Joe Matthew.
All right, many thanks, Charlie Pell. I think we need Scott Besson to start talking again. Interesting how stories evolve through the day, because the headline in the first half of the session was Besson's soothing words on China lift stocks, and I guess that only lasts so long with the S&P 500 turning negative before our eyes. Thanks for being with us here on the Wednesday edition of Balance of Power on Bloomberg TV and Radio. I'm Joe Matthew in Washington. Interesting conversation with Congressman Liccardo as we make our way through day 15 of the government shutdown. Roughly 1 hour from now, senators will vote again on the continuing resolution that continues to fail. We'll let you know what happens, or maybe we should just make a promise to let you know if anything changes, because this has become quite the spin cycle most recently here. The cycle at the Pentagon today is out the door. This is a fascinating story, and if you listen to this program, you heard this one coming after the Secretary of War, as President Trump likes to call him, Pete Hegseth, laid down a marker for the Pentagon press corps right up to and until signing off on a piece of paper mandating new regulations in the way the press cover the Pentagon here. It's not going over well with anyone, well, maybe except OAN. But let me speak about our own shop here. Bloomberg News, along with most every other national news shop, including Fox News, Newsmax, the Washington Times, some of the conservative outlets, along with all the others, the three-letter networks, the Washington Post, New York Times, and so on, the 5 major TV networks say they will refuse to sign the new reporting limits set out by the Defense Secretary, and they've been given a couple of weeks to do so. We saw this coming in slow motion. A Bloomberg News statement reads, the Pentagon's new policy on press access restricts the sort of standard news gathering essential in any democracy. We will continue to uphold the values of an independent free press and rigorously report on the U.S. government, military, and matters of public interest. Following the Hegseth criteria endorsed by President Trump. So what's going on right now at the Pentagon is a bunch of journalists and their support crew dismantling computer systems, breaking down furniture, and getting out of the building. At some point, they'll have to turn in their credentials as well. Yeah. The process of covering the Pentagon is about to change dramatically, and I'll be very curious to see what happens to the leaks coming out of the Pentagon. With one news organization, this OAN, they're going to be the only ones in there, acting almost like a state TV network. And this is where we start our conversation with our political panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us. Rick is our Republican strategist, partner at Stone Court Capital, and Jeannie is our Democratic analyst, democracy visiting fellow at Harvard Kennedy School's Ash Center. What do you think about this, Jeannie? Not so much the protocol, but the response to see Fox News, the Washington Times, and other conservative outlets, with the exception of ON, getting on the same page as CNN, MSNBC, and the others, yes, including Bloomberg, to push back on this Pentagon policy. Does that give you hope for the state of the national news media?
Yeah, I think it's very heartening that they have joined together to say that this is absolutely unacceptable. Let's not forget the Pentagon gets about $1 trillion of U.S. taxpayer money. It sends our young men and women into war. It's happening at a time we're shooting boats in Venezuela, killing people. The president, just hours after he says there's a chance we could have to go in and disarm Hamas. And Pete Hegseth flies off to Europe and says, oh, by the way, you can't enter the building until you agree to abide by these absolutely, insane, really is the way to put it, restrictions on press freedom. So I do think it is very, very heartening. I also think that Pete Hegseth doesn't understand a lot about reporting. Does anybody think reporters are just going to say, oh, okay, no more coverage of the Pentagon? I think we're going to see, Joe, and this is my guess, even better reporting. They're going to talk to their sources and they're going to be harder on the Pentagon from the outside. So I think he's doing himself a disservice if he's trying to control the narrative.
I do tend to agree with you on what could be enhanced reporting. We're going to end up seeing stories now we would not have seen otherwise because of this challenge by the Pentagon, and we should be more specific. This was a 21-page document that journalists were asked to sign last month. As we report, one of the most concerning elements is a line barring journalists. This is the heart of the policy. Barring journalists from reporting classified and even some unclassified information without the permission of the Pentagon. That's what would change here. You would have to get essentially the secretary to sign off on your story before it goes out, and the secretary doesn't work for any newsroom. He did used to work, of course, for Fox News, which is, by the way, packing up its bags right now and getting out of the correspondence corridor, as it's called. This goes back to the years just after World War II. The then Defense Secretary in 1972, Secretary Melvin Laird renamed the Pentagon hallway Correspondence Corridor and dedicated a memorial to reporters killed while covering U.S. foreign wars. If you walk down the corridor, in fact, they have a memorial set up there invoking the likes of Walter Cronkite, Edward R. Murrow, Andy Rooney, and others. What do you think about this, Rick? You've spent more time in the Pentagon than most civilians due to your career here in Washington, and I know you're very familiar with some of the top brass, or you have been. You've prepared them for confirmation hearings. The press corps is a pretty important element of what happens in that building. What happens now?
Well, as you pointed out, it's going to be a new question on all the confirmation hearings that are coming up. So they better be prepared to defend the policy being made by the Secretary of War in front of Congress, because this is gonna be an issue. And look, there's always been tension, in reporting at the Pentagon. There are a lot of reasons to keep certain plans and activities confidential. It's not an intelligence agency, so it doesn't have the protections that a lot of intelligence agencies have with the use of the press. And Jeannie's right. I mean, it's the largest single use of taxpayer dollars that the government has. And so how do you manage the push and the pull of the public disclosure of what goes on there with the need for some level of confidentiality on war plans, irrespective of who's tweeting them out on their Signal accounts? And so, long story short, it's an unenforceable policy. The reporters I've talked to, point out not only the point that you made, Joe, but also that there's a bar from even soliciting sensitive information and could get you thrown out of the Pentagon press corps. So, one, you don't know what's sensitive, and two, if you don't solicit, you don't get. You got to ask the questions, and so it's obviously an extreme situation, and I am not surprised that there's been a walkout, because the Pentagon press corps has been heralded as one of the greatest institutions inside and outside of government. And as you point out, people have given their lives for this coverage. So if Pete Hegseth thinks he's going to make some progress here, he better look at revising this policy, because these journalists know what they have, and they're not going to lose it.
Yeah, well, that was very well put. We remember what Pete Hegseth had to say to the media briefing following our strikes against Iran, Jeannie. That was a massive, here's what you should be talking about kind of speech, as some reporters were questioning whether Iranian nuclear sites were totally obliterated, as the secretary and as the president had said. But, like, what's going to happen in the Pentagon briefings now? I was talking to producer James about this earlier. Are you going to have one chair with OAN sitting in it? What's the point of even disseminating information?
That's absolutely right. I really hope that we are able to see the pictures of this and get the feed, because it will be very, very good to watch. The reality is Pete Hegseth has missed the mark that Donald Trump understands, and I'm surprised Donald Trump isn't pulling him in. You know the old adage, keep your friends close and your enemies closer? If he really thinks the press corps are his enemies, keep them close like Donald Trump does. He has no trouble answering questions all day long and directing what is happening in terms of the narrative coming out. That is the way Pete Hegseth needs to do it. Apparently, he is feeling like he doesn't have that skill, and so he's going to try to slam the door. And this is going to not work to his advantage. So strategically, politically, and of course, legally and constitutionally, this makes no sense. And the irony is he keeps saying this is because of national security. And yet the only leak, to Rick's point, we've seen this year, or the biggest leak, was from his own Signal chat, where he put a reporter on that Signal chat. So, you know, all of this is befuddling. And I really wish Congress was working and the Senate could call him up soon to answer some questions about this nonsense.
Well, we should note as well, The Atlantic was part of this group here of news agencies packing up bags, refusing to sign this. Boy, maybe they regret saying anything about being added to the Signal chat. That would be like a real-time news feed coming out of the Pentagon at this point. Rick, does this actually have to be altered, or would the next secretary be the one to do this? If Pete Hegseth finds himself surrounded by leakers, and we've got stories on the front page every day and on the terminal about something that he doesn't want us to be talking about, does he let them move back in?
Yeah, they're going to have to arrange something to accommodate everybody. You know, he's made his mark. He's like, I've told the press that they can't wander around the halls asking people questions, which is what they've been doing since there was a Pentagon. And so now he's got to sit down with a group and say, okay, what is it that I can do to meet my needs, for confidentiality, which is an issue inside the Pentagon, and make it, accessible to you and your First Amendment protections. And there's a deal there to be done. It is the deal administration. Go cut a deal.
That's right.
And
well, here we go.
I think Donald Trump would appreciate that.
And just yesterday he talked about moving the press corps out of the White House. Just behold that for a minute, because we've heard that story before too. Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors. Great insights. Thank you for the panel. Maybe this will change. Christopher Smart is on the way in next as we turn to the economy.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. All of a sudden, a lot of volatility in the stock market. Last update told you almost everything was down. Right now, we do have the S&P and NASDAQ back in the green. The S&P barely. It is up by 1.5 points now, up under 0.1%. 66.45 where we stand on the S&P. The Dow lower by 60, drop there of 0.1%. Keep in mind the S&P, by the way, was up as much as 1.2% before declining in the past 40 minutes or so. NASDAQ up 45, up now by 0.2%. The 10-year 4.03%, with the 2-year 3.50%. Gold surging another 1.2%, 41.92 where the precious metal stands right now. It is higher by $49 the ounce. Silver $52.58 now, up by 2.2%. West Texas Intermediate crude $58.47 a barrel, down now by 0.4%. And Bitcoin 110,680 on Bitcoin, down 2.1%. David Ellison said to be preparing to submit an official merger bid for Warner Brothers Discovery. That according to the New York Post, citing reports. Right now we got Warner Brothers up by 2.6%. David Ellison's Paramount Skydance down 0.3%. And just getting word that Comcast's NBC News division letting go 150 people. Fallout from the company's plans to spin off some of its struggling cable channels. Recapping, S&P up by 5 right now, up by about 0.1%. Balance of power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, many thanks, Charlie Pellet. Somebody let the air out of the balloon here, as Charlie just made clear. The headline this morning was stocks rise as Bessent fuels U.S.-China trade hopes. Now we're hearing about trade uncertainty, all in the same trading session. I don't know what investors were listening to here, but it reminds us of how much has yet to be accomplished on the trade front, specifically when it comes to China. We're going to be digging into that with Christopher Smart in a moment. He's with us here in Washington from our Broth Group. First, Christine Aquino joins us, managing editor for Bloomberg Markets Live blog, who has a little case of whiplash today, watching things bounce around. Christine, we just wanted to get under the hood with you for a moment here to kind of extend what we just heard from Charlie Pellet. It's great to see you, by the way. This market is one that's been described as frothy, as toppy, and so anytime somebody says the wrong thing in Washington, all of a sudden we see red arrows. But it has not been the beginning of a trend. Is this still a market that is owned by retail bros who can't help but buy the dip?
Good question, Joe. And my neck hurts watching these markets because that's exactly it. As you described, it does seem like it is a market caught between still wanting to buy that dip and still believing that this rally can keep going, but also very afraid of when the music will stop playing. And this is why we keep getting this back and forth between a rally and then suddenly a bit of a sell-off back to a rally again. And also the catalysts keep shifting, right? When it comes to how it all relates to trade, I mean, it is very much the fuel for a very volatile trading period because the situation in trade itself is very volatile. We don't really have a lot of clarity. All we've gotten this week is kind of headline trading between China and the U.S. in terms of what they're hoping to get out of this relationship, what are kind of their red lines and all of that. And it does feel like that's something that could continue until we get that sort of more clarity in terms of the relationship, how that's going to shake out, which probably we're not going to get until November, right?
How many times have you heard the word bubble today? Because part of your job is reading through analyst notes, and this is the question, right? This is the one politics show on Bloomberg. Every other show is asking whether we have an AI bubble. You saw Jared Bernstein, one of the former president's chief economic advisors, this is the Biden campaign, calling the bubble in AI in an op-ed earlier this week. But every time we hear from an executive, whether it's Jensen Huang, Lisa Su, they tell us we're in the early stages of what could be a 10-year spending cycle. How should the market be looking at this?
Yeah, I mean, very interesting. The word bubble has really permeated the sentiment in markets and also here in the Bloomberg newsroom for the past week, I want to say, at the very least. And, you know, what we're hearing from executives is, of course, very expected because they want to be talking their book. They want investors to be buying into this AI theme and convincing them that this is going on for much longer than anyone expects. And that may be true. true, but it's also true that in a longer term cycle, there will be pullbacks. And it's possible that, when we get instances like this where valuations are near the top and there's a lot of kind of hope already priced into markets, that we do get pullbacks when the news is not always as positive as markets expect. And increasingly, markets expect news to be more positive than their already very positive expectations. So it's a very high bar in terms of companies kind of getting over those expectations.
Yeah. Well put, as always. Christina Kino with us live from New York. Christine, thank you so much for your insights. Yeah, when it comes to the AI trade today, AMD is still cranking after that massive rally the other day, up $16, 8%. Micron still pushing higher. It's up 2%. Up about $4, though NVIDIA is sagging today, down just about $1, about 0.5%, and we'll have more on the markets coming up at the top of the hour. So yeah, uncertainty, maybe bubble is our first word of the day, uncertainty is the other, at least in the second half of the session. Despite what Scott Bessent said earlier today, we might even extend our trade truce with China. Here's a bit of his news conference from this morning.
Not only is China fueling Russia's war, but China's actions have once again demonstrated the risk of being dependent on them on rare earths, and for that matter, anything. If China wants to be an unreliable partner to the world, then the world will have to decouple.
Decouple? That was the word of the year in the last administration. But along with that tough talk, as I mentioned, the Treasury Secretary proposing a longer pause on higher tariffs on Chinese goods in return for Beijing putting off its plan to tighten limits on rare earths. We're only a couple of weeks away from the big meeting between Trump and Xi, and so the drumbeat's getting louder on both sides here, which is why it's great to be joined by Christopher Smart, and he's with us in person today as well. The toast of Boston with us here in the nation's capital, founder and managing partner, our Growth Group, former special assistant to the President, National Economic Council during the Obama administration. It's great to see you, Christopher.
Great to be with you. Great to be with you.
So this conversation's apparently never going to end, because I think we may have been talking about this last time you were on. What do you make of the bluster? And I'm assuming that's all it is on both sides here, whether it's an additional 100% tariff or cracking down on rare earth magnets if you're President Xi. Is this all posturing for a meeting, or are we in bigger trouble than we think?
I think it's a little bit of both. I think just to take a step back, you've got the two largest economies in the world, deeply integrated with one another, deeply uncomfortable with the fact that they are so integrated with one another. And whether you call it decoupling or de-risking or slowly trying to pull that apart is very hard to do without creating a lot of waves and a lot of blowback elsewhere. I think what's really interesting right now is for all of the issues we have on the table with China, whether they're military, diplomatic, human rights, the president is focused very narrowly on an economic deal, and then within the economic space, very narrowly on a tariff export control kind of deal.
Yes.
So it's almost going to be a tariff for rare earths or our technology exports for their rare earth exports. And all of the rest of it is going to be left unanswered for now.
Which has been the case with a lot of these framework deals, that they are quite narrow and might need further negotiating. Is the market kidding itself, though, to think that this meeting is going to change something? I mean, we're right near all-time highs, as we've just established, Christopher, and I don't want to turn you into an investment strategist here, but sometimes it's hard to justify what we're seeing when we know how scared Wall Street is of this not working out.
Well, I think they are scared. It's very hard, I think, for investors to price in tail risks.
Yes,
right?
sure.
So they're focused more on the good earnings that the banks delivered yesterday, the GDP numbers that we may or may not get anytime soon, the AI story, the deregulation story, the big beautiful bill, and the impetus that's going to give a lot of CapEx next year. So that is what I think is driving markets right now, and that's sort of the base case that everybody has, but everybody's looking over their shoulder. On the one side, there's the China risk. On the other side, there is the tariff blowback risk. And then there's just a whole lot of supply chains that have yet to work through all of these tariffs. And that's, I think, high on everybody's mind as well.
Stephen Myron, speaking earlier today, self-labeled as out of consensus, says the very uncertainty that the president is creating here with regard to tariffs is the reason why the Fed should cut interest rates. And that's been, well, that's going against the grain of what Jay Powell's been saying this whole time. He's been holding off on cuts because of the uncertainty, not knowing what the impact would be. Does Stephen Myron end up being right here?
Well, it's not anything I learned in my economics classes or in my investment career. I think
out of consensus.
It's out of consensus, and I think Stephen Myron is staking the ground on the out of consensus trade in his earlier speeches about what R-star should be, what's a natural interest rate for the economy, and I think he's got a view. We'll see how he's able to convince any of his Fed colleagues whether that view makes sense or not, but I'm not sure the market is buying it.
Well, no, I think that's clear, and I wonder as well about what comes next with regard to the government shutdown. We're talking about mass layoffs. I just saw a headline roll that it wasn't just 4,000, that Russ Vought saying just now on the radio that will probably be higher than 10,000. You add that to all of the early retirements and some of the buyouts, if I can even call them that amounted to about 250,000 federal workers. Add another layer with mass deportations. And we've got a job market that looks a lot different than it did even a couple of months ago, Christopher.
Yeah.
That would prompt interest rate cuts, presumably. How are you looking at the market?
I think that's right. I think, everybody who is so excited about AI and the CapEx story is also looking very closely at the weakness in the labor market.
Yes.
And that continues to unfold right now. And these moves with the government shutdown, what is remarkable is that it's the largest government and the largest economy in the world, and it's not really a top news story anymore, which I think means that neither side is interested in getting this settled anytime soon. Mm-hmm. And I think if you're an investor, you have to not just sort of assume at one point or another Chuck Schumer will call President Trump or the other way around and we'll get a handshake and a deal.
Yes, right.
This could go on through the end of the year, and I'm not sure markets are thinking about that at all.
And I'm hearing that a lot more often now. Even the Speaker of the House said this could be a record setter, and clearly President Trump is not looking to budge anytime soon, which is all the more reason why there's confusion about Argentina. I want to ask you about this while you're here, and we'll start with what the president had to say in terms of America first and his agenda economically. Let's listen to President Trump.
We're going to work very much with the president. We think he's going to win. He should win. And if he does win, we're going to be very helpful. And if he doesn't win, we're not going to waste our time, because you have somebody whose philosophy has no chance of making Argentina great again.
Okay, and he's sitting across from Javier Milei when he's saying this. I'm a little confused, because apparently this money does not arrive if Milei doesn't win the election, for starters. But $20 billion was the number yesterday. This is now, I think, up to 40. What was it, James? 40 or $60 billion, the headline?
I think 40.
That we just ran. $40 billion. So twice what the president said, saying openly that this really does not help America, that we're investing in good politics and a good friend in Argentina. What are you calling this?
I don't know what the word for it is, frankly, but it's sort of interesting to see the president say, we're going to bet on this guy if he wins, but if he doesn't, we're going to pull our money out. Right. Which may be too late.
So a conditional bailout is what.
There are lots of questions about Argentina and this particular set of bailouts because, first of all, Argentina is not a military ally. Argentina is certainly not systemic to the global financial system. We seem to be backing a horse in an ideological race for economic policy within Latin America. And it is, frankly, the first time that U.S. taxpayer dollars have been exposed to the Argentine peso directly.
Wow. Yeah.
The $20 billion seems to be a currency swap with the Argentine Central Bank. Mm-hmm. And then what was announced today, apparently from Secretary Bessent, was another $20 billion of private banks and other investors willing to put money to work. I'd love to see what that list is.
Indeed.
And who is ready to sort of take that leap of faith about Argentine midterm election outcomes.
Yeah.
So this is a head scratcher.
Well, okay. This administration has been, in many ways, original. Is this a first?
Well, it is. I mean, the last time we did anything close to this was with Mexico in the bailout with President Clinton, and those were actually backed. Our loans to Mexico were backed by Mexican oil reserves. Yeah. So there was a lot more going on there. Wow. Already, as you may know, as you do know, Argentina is $40 billion in the hole to the IMF. Uh-huh. So, it's got a big hole to fill if it's able to turn things right.
Some of the backroom conversations at the IMF this week in Washington are focused on this quite deeply. There are a lot of head scratching, to your point.
And as you pointed out earlier, it's very off-brand for a president who's putting America first.
Yes, right.
It's something that we've always thought that IMF involvement to help emerging markets with good policies, grow better is always in the United States interest. This sort of backdoor approach, end run around the IMF, is new and different, and as I say, off-brand.
Truly interesting times that we're living in here, and we'll let you know what happens to this and what the final number is, who might be behind that second tranche of $20 billion. You think FIFA's going to stay in Foxborough? That was the big story yesterday.
That is, we've got our fingers crossed in Boston.
Yeah, the president should know that Boston Stadium is not in Boston. FIFA calls it that, but Foxborough's like an hour away. Christopher Smart, Art Broth, great to see you.
Great to be with you.
Welcome back as always.
Thank
This
you.
is Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. I'm Carol Masser. Tim, as you know, is off this week. In the house is David Gore, who's like constantly working.
I'm here.
Very glad to be here. Well, no rest for the weary, but I'm very glad to be here. And glad Tim's having some time off as well.
Me too. He needed a break because there's so much coming at us,
Yes.
you know? Like the market's just kind of bouncing around, continuing to, I feel like, take cues from what's going on with U.S., China. I mean, two biggest economies, whatever they do with the trade deal, that's got to matter.
Yeah, we've been like paying attention to the, of course, end of the cessation of fighting and that shooting war in the Middle East, but this trade war deepening, and as you say, day after day, the undulations of the market really being driven by what's going on between the U.S. and China.
Well, you talk about everything that's going on and things we haven't talked about on our planning call. We talked about, remember the government shutdown now, like
We're in the third week. Yeah, 15th day of that government shutdown. And I don't want to say nobody cares. Of course, a lot of people being affected by it, but the market certainly doesn't seem to care that much about it.
Anyway, we're going to get updates on all of that. We're also going to talk about Apple's latest pivot away from China. And then we've got a great read, David, on the industrial space. This is Prologis. They are big time when it comes to logistical warehouses, but they're also getting into, surprise, data centers.
There you go. I was going to guess. You did it for me. But yeah, CEO of that company joining us in a few minutes here
All
on
right.
Business Week.
Lots going on, guys. Let's get to a check on the trading session, as we said, bouncing around here on this. It's a Fed Wednesday, and we've got the beige book crossing, so we're going to get to those headlines in just a moment. In fact, the Fed, well, we just got an initial one. U.S. economic activity, little change from the previous report. Charlie Pellet, take it away.
All right. Indeed, our Molly Smith's going to have a whole lot more on the beige book for you coming up in just a moment. Right to the equity markets here. Back in the green. It has been a choppy past hour. Last report told you the markets were lower. Right now, markets higher across the board. We have got the Dow, the S&P, NASDAQ all in the green. S&P up 20 right now at 66.64. That is a gain there of 0.3%. The Dow up 0.1%, and NASDAQ up by 0.5%. Indeed, seeing a renewed wave of dip buying. Also, stocks advancing on the strength of those bank earnings this morning. The 10-year 4.03%, the 2-year 3.50%. Spot gold up 1.4%. Silver up 2.5%. West Texas Intermediate crude down 0.6%. We are seeing a sell-off in Bitcoin down 1.7%, 111,108 on Bitcoin. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie, thank you very much. David Gura here in for Tim Stenevec with Carol Masser on Bloomberg Business Week Daily. And as Carol mentioned just a moment ago, the beige book, the latest beige book coming out, I guess if we use the formal term, that's the summary of commentary on current economic conditions by Federal Reserve District. We're talking about each Federal Reserve Bank gathering anecdotal information on current economic conditions in each of those districts, reporting it up to the Fed and giving us some flavor for how folks in those districts, we're talking about business owners, business leaders are feeling about the economy at this moment and what they're seeing. This, of course, coming in advance of the next FOMC meeting at the end of this month. That
I'm
on
kind of
October
excited.
the 28th, 29th. You're getting excited?
I always do.
Well, and there's, a lot
Whatever
of
that
strange
means about
factors
me.
to this one. We will get that CPI data. We can talk a little bit about that maybe as well with Michael McKee, Bloomberg TV and Radio's international economics and policy correspondent. He is in our Bloomberg News DC bureau, and here with us in New York, Bloomberg News economics editor Molly Smith. Mike, let me start with you. This is an impossible task to synthesize these many pages just a few minutes after it crossed the Bloomberg. But what are your takeaways? I think back on the last beige book that we got, and I think that the broad indication I remember is how there's flat to declining consumer spending because for many households they were worried about the path of the economy, worried about these tariffs and the effects they were going to have going forward. Picking up on the headline Carol just read a moment ago, sounds like we're seeing more of the same here with this iteration.
Yeah, pretty much. You asked how consumers and companies are feeling. I think the word would be meh. Economic activity slowed, and we saw hiring basically flat, according to the beige book. Nobody's really going out and adding employees. There is some sign, according to the beige book, that companies are increasing the pace of layoffs, and some are adopting more technology, they say. I guess a word for AI. Prices rising a little bit because of tariffs, and there are concerns about spending, which is slowing. Consumers starting to pull back, with the exception of autos, which the beige book says was driven by people trying to buy electric vehicles before the end of the tax credit at the end of September. So right now, it looks like the economy is still moving ahead. But there's you get kind of a different picture, and I'll be interested in Molly's view on this, from this beige book and what it's saying, and the Atlanta Fed's GDP Now number for the third quarter, which is about 3.8%.
Molly, come on in.
I think what stood out to me here is just this continued observation of this bifurcated economy between high and low income consumers. And that's what the Beige Book noted here, is that higher income spenders were still going out buying luxury travel and accommodation, that those kinds of categories were still strong, but that lower and middle income households still seeking discounts and promotions in the face of rising costs. So this is like just a very much like something that we've been seeing for, it feels like, I mean, this is pretty much, to me, what has defied every recession call that we've had for like the last 2 years. It's that high-income households are increasingly making up the share of overall consumer spending. Right now, it's, I think, just right about 50%.
Yeah, it's a big deal. You know, it's funny because I was thinking about LVMH came out, I think, with their results, and their shares surged, suggesting that maybe that slump in luxury demand is easing, because we have seen it in the space. Having said that, Molly, we're in this kind of void a little bit when it comes to government data, right? We are expecting, though, the CPI print, I think, later this month.
Supposed to be today, right?
Today. It was
supposed to be.
But in the absence of that, I compiled for you all of the other private sector
Which we say
inflation
thank
pages
you.
out there. You're so welcome. There aren't that many, though, honestly, which is something that Powell had observed yesterday when he was speaking at the NABE conference, that unlike the job market, we have so many private sector alternatives there to go to see what's going on with labor demand, with hiring, with wage growth. Inflation, not so much. So there are a couple of companies that compile price growth throughout the U.S., but it really is biased toward the goods space. They don't do as good of a job looking at services inflation. There are a couple of companies that specialize in housing inflation in particular, but they don't really get the overall view. So if we're really looking at just what goods inflation seemed to do in September, you definitely did see some signs of tariff pass through in certain categories. But in general, a lot of these economists are saying that the expectation is still that inflation will eventually level off.
Mike, I'm going to guess that these policymakers are going to take Molly's data and couple it with what we get from the Labor Department, the CPI data that's been delayed. Just help us understand the mechanics of that and how the Fed is kind of finding its way through this very strange moment with the shutdown extending into 3 weeks now. And I'm curious how much of a hindrance that is for them as they plot a path forward here, if any of that kind of resonated in what you heard from Chair Powell yesterday.
Well, I think there are 19 members of the Open Market Committee, and I think we had 19 downloads of Molly's story today about alternative data.
At least, I should say.
More than that.
Ouch.
That's what they're using.
Julie all of a sudden.
They're looking at alternative data to the extent that they can. And remember, they are also in constant contact with companies and with small businesses and consumers to an extent in their districts, the 12 regional bank presidents. So they're getting a picture of what people are saying is happening immediately rather than looking at the past data. And they're going to be making their decision based on what their estimate of what is, what is going to happen going forward, rather than what has already happened. They will have a pretty complete CPI report because the data was all gathered before the government went out. But the concern is whether they will have any October data, because we're getting deep into the month and they'll be able to collect less and less of it as the month goes on. So they really have to start relying on forecasts for what they think is going to happen. And in that case, what you get is different districts see different developments in markets, and this has just been a story throughout the Federal Reserve's time in being, because the country is one big country, but there are a lot of different changes. We were talking about prices from tariffs coming through, but we're also seeing reports in the Beige Book here about how in the agriculture industry and low-skill manufacturing, they're having trouble finding workers. And that was a big theme at the NABE conference yesterday, is that there's going to be a big worker shortage next year in these lower-paid manual labor industries, and that could drive up prices as well. So a lot of cross-currents out there for which there isn't great data right now.
And Molly, kind of complementing that as I look at the summary in the Beige Book that was just released, labor supply in the hospitality, agriculture, construction, and manufacturing sectors is reportedly strained in several districts due to recent changes to immigration policies. This is the other kind of big story looming here, the effect that this administration's crackdown on immigration is going to have on the economy. So there you have the anecdotal evidence borne out. What are we seeing in the data when it comes to the effects that policy is having on the labor market in the U.S.?
I think this is such a big debate right now as to what kind of shape the labor market is in, because in the one hand, you're looking at weaker hiring numbers, that you're thinking that the job market has significantly slowed, and it's true, the pace of hiring has come down substantially, but labor supply has come down substantially as well. So do you need as strong of job growth if the working population is that much smaller? I think that's really the key debate right now. And there was a blog post from a Dallas Fed economist recently that argued, no, you don't need that strong job growth because the labor force is that much smaller. So it's really still key to make that distinction of, is the labor market really weakening or is it rebalancing?
It's just a reminder of like kind of all of the tensions that are coming out at us that maybe are changing the read on statistics. Mike, I want to bring you in because on that note, still coming at investors, still coming at economists, still coming at business leaders, the trade tensions between U.S. and China. So we've got kind of that going on and trying to figure out the impact on that still yet to be determined. At the same time, we got a read on the big banks this week, which is another read on the U.S. economy and how things are going. How do you fold all of that in?
Well, if you're at the Fed, you hive off what's happening with the banks and earnings and Wall Street because it's a kind of a different world. To a certain extent, it can represent what's going on in the economy if you're talking about things like mortgages and car loans, of which they are not making a whole lot. The merger and acquisition business is doing very well, and the stock trading and bond trading and currency trading businesses are doing very well, we learned this week. But that's not the real economy, and that's not what's happening to the people on the ground across America. And so they're not really looking at those things. They are looking at whether or not people's wages are going up and whether they're keeping pace with inflation and what we think the inflation rate is, and also what consumer sentiment is, whether people think they want to buy something now or whether they're pulling back because they're concerned about the overall economy. One point I want to make about what Molly was just talking about in terms of do you need workers, the conference I was just at, the Business Economist Conference, they were making the point that even though we automate more stuff, or we may not need as many workers. Certain industries, particularly agriculture and construction, need a lot of trained workers, or less trained for agriculture than for construction. And many of those were filled by immigrants. And the euphemistically worded change in immigration policies, as the Beige Book put it, is causing a real problem. There was one survey one company put out at this meeting that said there's going to be 500,000 short construction workers next year.
Yeah.
And that's going to really slow down the housing industry, which, of course, is a big contributor to the economy.
As long as there's demand to build.
Well, I would say, I mean, look,
Let's just do the whiteboard here, kids.
Of all times to pull back on construction workers, this would be, I would say, a pretty good time to do it because builders are slowing the pace of construction anyway. There's so many new homes available on the market that have been sitting unsold because they had been ramped up when mortgage rates were a lot lower. And now mortgage rates are where they are. People are not buying these homes, so builders accordingly are pulling back on construction. So, of course, this is, you know, a real strain for these companies, but in the grand scheme of where they're sitting right now, not so bad in terms of a time where you're kind of slowing the pace anyway.
All right, good stuff, guys. A lot going on when it comes to the U.S. economy and trying to really figure out what is the way forward. Bloomberg TV and Radio international economics and policy correspondent Michael McKee, along with Bloomberg News economics editor Molly Smith. Hey, just a programming note. Fed Governor Chris Waller speaking with Bloomberg's Tom Keene. That's tomorrow, October 16th, at the Council on Foreign Relations. Bloomberg Radio and TV will be airing that conversation as well. So looking forward. Well, anything Tom does is
I'm going to be there in person.
You are?
I am, yes. I couldn't resist that.
You're going to be like heckling Tom from the...
Well, with moderation. I'll get the free breakfast at least.
Sounds good. Sounds good. And it should be a good conversation. So be sure to check that out. Hey, we're going to continue on kind of this macro environment and the issues that are impacting certainly the U.S. economy, the global economy, and also U.S. trading. U.S. Treasury Secretary Scott Bessent addressing one really important issue. We just brought it up with Mike and Molly, and that is U.S.-China trade negotiations. He addressed it earlier. He proposed a longer pause on high U.S. tariffs on Chinese goods in return for Beijing putting off its plan to tighten limits on critical rare earths. Secretary Bessent spoke alongside U.S. Trade Rep Jamison Greer.
This is China versus the world. They have put these unacceptable export controls on the entire world. China is a command and control economy, and we and our allies will neither be commanded nor controlled. They are a state economy, and we are not going to let a group of bureaucrats in Beijing try to manage the global supply chains. We do not want to decouple. We should work together to de-risk and diversify our supply chains away from China as quickly as possible.
That was Treasury Secretary Scott Bessent at a joint news conference earlier today at the Treasury Department in Washington, D.C. And Carol, I think what's so fascinating about this is the time and place at which this is taking place. We've talked a bit about the government shutdown, but right now in Washington, you've got these major meetings of the IMF and the World Bank and the IIF, so a lot of prominent financial ministers and bankers are in town. And it sounded to me, Carol, as the Treasury Secretary spoke, there's going to be an effort on his part and the trade representative's part to kind of bring over some of those officials from other countries to kind of convince them that they should be taking a stronger tack against China in light of what the Secretary was saying.
Yeah, I mean, we hear so much about the relationships that China has with Russia and elsewhere in this world, and the importance of making sure that kind of China is kept in check to some extent. But I mean, listen, we are in races here, whether it's technology, whether it's AI, and China is certainly thinking about its domestic economy. It's been trying to build it out, right, David, for so long, but still is so reliant on what it sells to other countries and what it sells in terms of exports. So interesting. I would say two biggest economies still need each other, still got to work together. And so I feel like, you know, what is this, third, fourth round of negotiations in terms of major teams from both countries? And you got to assume that something's going to be worked out that both sides benefit to some extent.
As we see the markets vacillating up today, we have the S&P up about 1/3%. We've noticed how much has kind of tracked the movement on this particular issue, on this trade war. And I just, you know, it's funny, we've become so inured to kind of the back and forth between the U.S. and China, the U.S. and other countries as well. But there was something inherently spooky, I think, about what happened on Friday when you had China announcing those export controls and Jameson Greer, the trade representative, coming out saying the scope and the scale of what was proposed by China, just unimaginable. That was his word, and it cannot be implemented. So I think that while it scared markets clearly and it's kind of highlighted such a big issue for them, clearly something that's a driving issue here for policymakers in the Trump administration as well. It's a non-starter for them to have to live with this.
It was interesting listening to Bessent too, and just talking about kind of the negotiations back and forth, and talked about that all of the meetings that they had up to this point largely have been friendly, cooperative, and then they talked about one specific official from China.
Kind of a mid-level, not the top official, a mid-level official on the Chinese side.
Who did not seem to play nicely and very critical in terms of methods. And I just thought that was kind of interesting. I'm not sure I've ever heard that.
Yeah.
Someone singled out.
Called out in that way.
Right, and whether or not really speaking for China more broadly and for the Chinese president. Hey, let's see what Dan Flatley has to say. He was listening to everything that Secretary Bessent had to say. He is a U.S. Treasury reporter for us here at Bloomberg News. He's there in our D.C. bureau. Dan, always a lot. I feel like I should take a breath, do a moment. Secretary Bessent, though, talked a lot about the U.S.-China relationship. What's the reality of where we are here? Is this just kind of show and the back and forth we should expect it? Are we making progress? Get us up to speed here.
Yeah, you know, it's a great question, Carol, and I just heard you mention this very provocative, I think, move by Secretary Bessent to mention one of the Chinese trade negotiators, Li Chenggang, who was at the London talks, was at the Madrid talks, has been at the other talks. And Bessent and Greer typically make a big show of, how well they're getting along with their Chinese counterparts. And for Bessent to single out Li in that way was very interesting. And I think, one of the theories behind that some folks have talked about is that they want to basically give the leaders, Donald Trump and Xi Jinping, some space to maneuver here. So, I was talking to somebody last night who kind of used this metaphor of the bureaucracies kind of running into each other. So the Chinese bureaucracy, the U.S. bureaucracy, all of these sort of this inertia around a lot of these measures that have been taken up to this point in time, sort of continuing even as the leaders try to come to some sort of an agreement. And so what we have here is a very odd situation where both sides are trying to gain leverage, and neither one is quite sure whether the other side is serious or whether this is just a play for more leverage heading into these these talks in South Korea, or what's going on here? So it's a very odd situation. But the latest that we know, of course, is that Besson came out this morning with some pretty strong remarks.
And you mentioned kind of the bureaucracies butting into one another, and then there's the prospect of the two leaders meeting in South Korea at this APEC summit in a few weeks' time. And it seemed as the weekend got underway, that wasn't going to happen. The President of the United States saying he saw no clear reason why they should get together, given that announcement about those export restrictions. What I'm curious about is how inchoate this policy is. So what's at stake now are these new tariffs on wood and furniture. Of course, there are these new levies that are going to be put in place on Chinese ships in U.S. ports. We saw retaliation for that as well. Carol starting off noting the exhaustion we all have. I mean, I think I was listening to the secretary. I thought like a good question for Scott Besson would be, could you list all of the stacked tariffs that are in place on China right now, because there seem to be so many of them. What's your sense of sort of what's in place, what additionally could be put in place, sort of where we are in this process? Yes, it's kind of teasing out the restrictions they want to put in place to see what moves could be made in response, but where are we in that process of just what the U.S. can bring to bear on China?
Yeah, it's a great question. And I think that, one of the things that was really sort of revealing is something that Besson said at the end of his remarks, almost as an afterthought, just as he was about to head off stage. He said, could we have a longer extension, meaning longer than 90 days, which has been sort of the rolling extension that we've seen since the original detente in May. Could we have a longer extension in exchange for a delay in these rare earth restrictions? Perhaps, he said, perhaps. And so there's a lot hanging on that word, perhaps. But I do think that was a little bit of an olive branch that he is offering to the Chinese to say, look, we can deal with some of these issues that you mentioned, David. The lumber tariffs, the tariffs on furniture, all of these sort of measures that both sides have taken in differing degrees. We can push that off. We can have continue the truce. We can get the leaders to meet. And we can continue working on these issues, but we need to sort of take down the temperature a bit. Now, he's saying that, he's putting that out there, and it's sort of now in the Chinese camp to respond to that. And we don't know necessarily how they're going to respond, because they may view some of the moves, as you said, David, that the U.S. has taken as a provocation, not as a peace offering. So there's a lot going on there for sure.
Talk about a bargaining chip, the rare earth materials, Dan. And I'm just curious if that wasn't part of the discussion, because I'm trying to remember, U.S.-China trade, it's a lot of stuff, right? And even though we have kind of a goods deficit with the world, we often talk about all the services that the U.S. exports to the world. And I'm not quite sure exactly where we are with China on that. But I mean, if we weren't talking about rare materials or rare earth materials, would we be closer to an agreement? Would it be easier? Would it be easier for the U.S. to slap higher tariffs? Just trying to figure out how important that is in the context of everything. We know how important it is in terms of chips in the auto sector. We know right now that the U.S. has really no position in it. It's China in terms of all the processing. But I'm just wondering, is it all largely about that and how vulnerable the U.S. is right now?
Yeah, no, I mean, it's a great question, Carol, and I think you're right. I mean, the rare earths element is key here. That is really the whole ballgame at the moment, because those are elements and those are components and they are products that are used in everything from iPhones to MRI machines to all sorts of consumer electronics. And without those elements, and let's remember that China still controls the production of many of those products and has much of the world's deposits of rare earths. So China, that's a real leverage point for them. But let's not forget soybeans. Let's not forget agricultural products. Let's not forget some of the other points of leverage that are out there. So if it weren't this thing, it could be other things as well. And one last thought that I had was that I remember looking back at some earlier stories from earlier this year where China was sort of saying, we want to talk to the U.S. We want to have somebody that we can deal with, a point person, somebody that we can respect. And Scott Bessent emerged as that person. So it really is kind of incumbent upon him to keep this relationship going because he is the point person at this point. And so we'll see, you know, how things shake out over the next few days and the coming weeks.
Dan
he feels
Flatley,
like the point person on a lot of stuff
yes,
right now. Right?
Yes, no, I think you're right. I think you're right. Yeah. And still, is he still overseeing the IRS? I'm not sure if that's like still.
Yeah.
Yes.
Yeah.
Sorry.
He's still the commissioner, although there is now a CEO of the IRS, which is a sort of another thing that we can get into another time. But yeah, he's definitely got his fingers in a lot of the stuff going on in DC now.
We will return to that at another time. Dan Flatley, thank you very much. Dan Flatley covers the Treasury Department, really spelling out for us kind of the moment that we're in right now, the calendar that we're on, looking ahead to that November 1st deadline, which, as Dan said, Carol, could be extended, and then that meeting in South Korea, which Secretary Bessent did say in those remarks today, as far as he knows, is still on the agenda. President Trump's still slated to meet with President Xi, so that will be sure to be a pivotal moment if and when that does take place.
Listen, we've always talked about getting any kind of deal done between the U.S. and China. It's going to be a long process, right? It's a big trade agreement, and so this isn't something easy. I'm waiting for President Trump to come out and say, got a deal done.
Right.
You know, because it tends to be his way to say, we got there. And then
different animal.
And then go back. Yeah, exactly. Hey, listen, we're going to talk a little bit about earnings right now. I am also curious to see what our next guest has to say about some of these big macro issues that are coming at us. Dan Leder is president and incoming CEO of Prologis. He takes over as CEO in January. He joins us from our San Francisco studio. And we should point out that the company shares are rallying. They're up after they reported better than expected quarterly earnings. They boosted their forecast. They talked about data center opportunities, which is always something that catches investors' attention. Stock, by the way, is up 15% year to date. Dan, great to have you here with David and myself. I do want to talk earnings, but we got to ask about the macro backdrop, whether it's trade talks between U.S. and China, government shutdown, rare earth materials, minerals. What do you really watch when it comes to some of these big macro issues?
Well, thanks for having me. It's great to be here. Coming off this earnings call, this was certainly a topic for us. We had a tremendous quarter. As a matter of fact, we broke a record this quarter for leasing. We leased 62 million square feet of space throughout our 1.3 billion square foot portfolio. And you think about that in context, 62 million square feet is the equivalent of leasing Central Park in Manhattan twice over again in one quarter. So our team, working tirelessly around the world, leased 1 million square feet a business day during the third quarter. And certainly these macro business trends are telling by our customers who are the front line of the economy.
You look at the softer data, and there is still some anxiety among a lot of business leaders about where things are headed. Maybe that's restricting them from making some of the CapEx expenditures that they would have otherwise. You're detailing for us very strong numbers, and I wonder what that says to you just about the capacity of these business leaders to look through or past the uncertainty surrounding policy, including trade policy. Just give us a sense of the moment that we're in right now as you understand it from talking to your customers about how they're feeling about the business climate going forward.
Sure, it's a great question. One of the things we're most proud of at Prologis is our customer franchise. We have unique proprietary data and we have unique relationships, just given the size and scale of these relationships. And after what has really been 2 to 3 years of uncertainty, going back to rate hikes 2.5 years ago, we see our customers actually getting off their back foot. What we've seen over this last quarter is actually customers moving from caution to optimism.
Huh. Wow. Why? Because things are getting settled in terms of trade, tariff? Like, what is it that has calmed some of your customers?
I think our customers realized after a couple sluggish years of not making many decisions that they have to make long-term decisions. And that's what they do when they do business with Prologis. And they have to look through the short-term noise in order to ensure that they're positioned for growth going forward.
So you're talking about Amazon, Home Depot, FedEx, UPS, GigaCloud Technology. I mean, these are some of your big customers. So you're talking about these guys are feeling more sure about the outlook than maybe they did over the last couple of years.
Yeah, precisely. As a matter of fact, coming out of a cycle, we're really in just a classic real estate cycle right now. And what you're seeing typically at this point in the cycle is it's the big, well-capitalized customers that lead the way out of this part of the cycle.
This is a basic question, you'll forgive me for, but when we talk about warehouses, what are we talking about? Are these just simply places to store stuff, or are they places where there's a lot of movement, a lot of products coming in and out? When we talk about sort of the bread and butter of your business, what are you building, what are you leasing out?
Yeah, thanks for that question. We own nearly 6,000 buildings. These buildings are located in 20 countries in markets that represent about 78% of the world GDP. As a matter of fact, in 2024, we had the equivalent of nearly 3% of the world GDP go through these buildings. Our focus in building this portfolio, curating this portfolio over the last 42 years, is having the highest quality, best located logistics real estate close to consumers.
So where are you geographically building out the most? And, where are you looking to kind of increase your square footage or buy properties or buy land?
Well, the way we've set this organization up is our teams are calibrated to look for good deals around the world. And we're heavily focused, certainly this year, on build-to-suits with our customers. We're on track for maybe our highest build-to-suit volume ever. And what does that mean? That means we have a contract in place with these customers before we start building for them. And we're seeing that broad-based across most of the sectors, as well as geographies spread throughout the world.
I bet you can't do an interview without being asked about AI, so forgive me. We're going to do it. And I want to ask about it in two ways. The first is sort of how it's changing the way that you conduct your business. And then the second question is picking up on what Carol said, you looking at the demand for data centers, maybe changing your business tack as well. Where do you see opportunity as this revolution, as it's called, continues and there's the need for more space for processing all of this data?
Yeah, AI is here, and it's big, and it's big at Prologis. Certainly, we have all sorts of different operational and tools that we're building to make our teams more efficient and to be able to help them move faster. But when you think of AI and Prologis, we announced today we now have 5.2 gigawatts of power, either secured or in the advanced stages of being secured in sites, mostly tier 1, tier 2 sites in the United States, and then the tier 1 markets called FLAP-D or the double M in Europe. So Prologis is now, we've long been in the higher and better use business, but again, given that footprint we have close to these consumers, well, the next wave in the modern economy is the digital economy, and AI and data centers are the logistics of that digital economy.
We're talking about Dan Leder. He's president of Prologis. He is incoming CEO, excuse me, takes over that spot come January. Wait, Dan, so give me an idea, just to explain your business. How much is logistical warehousing right now? How much is data center? And where do you see the most growth going forward, especially on a day where Meta, Microsoft, BlackRock, there's more, all doing data center, deals, and it feels like a lot's happening in Texas, to point that out as well. So give us an idea of your mix today and where the growth is happening.
Well, I look at our growth in our base portfolio. We own or control 14,000 acres of land close to these consumption centers that I mentioned. We can build out another 240 million square feet out of that land bank. That's a tremendous amount of space. And when it comes to data centers, this power that we've secured, we've long been in the higher and better use business. Think about the fact that logistics and warehouses is typically the cheapest house on the block. We've always been in the business of optimizing that real estate value for our investors, and data centers are certainly a trend right now that we're able to capitalize on, given the footprint and the raw material that we own and control.
Just want to note a headline here crossing the Bloomberg terminal that a judge has blocked federal firings during the government shutdown for now. We were talking about that a few moments ago as we were talking about the Beige Book from the Federal Reserve, Dan, and what that was telling us about the state of this economy. And one thing therein is how difficult it is to find workers, particularly workers to do construction. And I think a theme to the AI story is, amid all of this demand, it's hard to get folks to build the data centers that we need to buffet all of it. And I wonder if your company is dealing with that as well, just the difficulty of kind of keeping pace with how fast all this is moving.
Yeah, thanks for that question. I think about that as we look at what is the replacement cost rent to build the next marginal building, whether it's logistics or data centers. And we look at that right now, and the cost, the rent to build that next building is actually 25% higher than market rents today. And then I look at that relative to our in-place rents today, it's actually nearly 45%. And one of the key issues is the cost to build are getting that much more expensive, and labor is certainly a factor there.
Interesting. Hey, one thing just to follow on, going back to data center and your build out, you talked about also the acquisition of 5.2 gigawatts of power. It's a lot. How much, though, is in terms of the build out for data centers? You've got to track it with having access to power, and does that slow some of the build out? Just got about 30 seconds.
You know, this 5.2 gigawatts that we're quoting is just a portion of the universe of opportunities we actually have given our size and scale. With our 6,000 buildings, there's 14,000 acres of land. We already own this land and these buildings at logistics bases. And so we brought in-house expertise. We have a very large energy business. We've got 1 gigawatt of power that we'll be generating off our rooftops by the end of 2025. So we've been building that energy capability that gives us just a better relationship with the power companies.
Yeah.
And so we're in great shape there.
Listen, a great interview, and I want to keep going. I wish we could. Dan, come back soon. Dan Leder, incoming president of Prologis, joining us here on Bloomberg.
And again, that headline, judge blocking federal firings during the government shutdown. For now, we are on the 15th day of that shutdown. We'll have more coverage of that ruling coming up here on Bloomberg Business Week Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They're all higher. Stocks are getting a lift from bank earnings amid trade worries. S&P up 27 now at 66.71. That is a gain of 0.4%. The Dow up 21, up by about 0.1%. NASDAQ up 145, showing a gain there of 0.6%. We are experiencing a day in which stocks did move lower across the board, but right now gains for the Dow, the S&P, and NASDAQ. 10-year 4.04% with a 2-year 3.50%. Gold is up $56 the ounce, up 1.4%. West Texas Intermediate crude oil down 0.5%, $58.39 a barrel, and Bitcoin down 1.5%, $111,320 on Bitcoin. Papa John's International shares surging on a Reuters report that Apollo Global Management has submitted a bid within the last week to take the pizza chain operator private at $64 a share. PZZA on the ticker, and right now the stock is up by 8.3%. And TrueCar has agreed to be taken private in an all-cash deal valued at about $227 million. TrueCar is surging 61%. Meta Platforms has removed a Facebook group that's used to share information about immigration and customs enforcement agents in Chicago after a request from the Justice Department. Meta Platforms up 1.3%. And a judge, as we told you moments ago, a judge has blocked federal firings during the government shutdown for now. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Carol Master along with David Gore. We are live here at Bloomberg headquarters. David, of course, in for Tim on this Wednesday. Hey, in another Bloomberg exclusive, because it feels like it's one after another from our own Mark Gurman.
It's superfluous to say, maybe.
Exactly. Reporting out that Apple is preparing to expand its manufacturing operations in Vietnam as part of a push into the smart home market and an ongoing effort to really lessen its dependence on China. So let's get to it. Mark is managing editor for Global Consumer Tech. He's out there on the West Coast. Well done, well done. What's going on here?
Yeah, thank you so much for having me. So to your point, Apple is preparing to expand manufacturing operations in Vietnam. They are developing a series of new smart home devices for next year and for 2027. One is a smart home hub. We've talked about it a million times, I think, to compete with the Amazon Echo. The other is a tabletop robot, which would compete with some devices that are now becoming quite popular in China. And they're also working on a smart home privacy-centric security camera that would compete with Ring and Nest and all those other companies that make security equipment. These are going to be built, first and foremost, in Vietnam. They're working with a company called BYD. They're otherwise known as a China electric vehicle manufacturer. They're actually quite popular in Asia. They also do some mass manufacturing for Apple, though, out of Vietnam, and they'll be handling these devices. They already make some iPads for Apple, but this is going to be a significant expansion of the BYD business for Apple, but more importantly for Apple, an expansion in Vietnam. As you know, whenever they come out in major new product categories, they usually kick things off in China. So this is a bit of a shift.
Mark, I'm curious sort of what the Apple supply chain looks like geographically. So you've mentioned the importance of China. Obviously, Vietnam, incredibly important now in light of what you've been reporting. But I know that they make things in India. They make stuff in Malaysia, Thailand as well. So how do they think through the way that their supply chain looks now and how it should look in light of the kind of trade uncertainty that we've seen them having to grapple with, like so many companies?
Here are the broad strokes. China production is for China and everywhere but the United States. The United States production is elsewhere. Obviously, this is because of the tariff situation and the global politics and what have you. So India has become the iPhone base for the U.S. Vietnam, it's the Apple Watch, it's the home devices, it is the AirPods. And then for Macs, you're seeing a lot of production happening in Thailand. You're seeing some production happening in Malaysia and some in Vietnam as well. It's expected to occur there. And then Indonesia, very small player. They're making some mesh fabric for Apple products, including the AirPods Max headphones. So the supply chain has gone under a rapid expansion across Southeast Asia over the past couple of years.
Hey, one thing I want to ask you, Mark, is it sometimes feels like some mixed signals. Like we've got BYD, it's a Chinese company, so Apple is working with them. on these products, and yet at the same time moving manufacturing to Vietnam. So is that Apple kind of giving China something yet doing something else? Like, I always think they manage that relationship very carefully.
I mean, to be fair, Foxconn is a Taiwanese company, and they're based in China, and all of their manufacturing is primarily done in China. They've expanded to India and Vietnam and what have you. So, in terms of where the company, originated and where it's based versus where they do manufacturing, that's not as relevant. What's more relevant is that Apple has to sell the idea to the Chinese government that they're not backing down from China, even if they're diversifying outside of China. And the way they do it is continue to build for China and everywhere outside of the U.S. in China. And that's not to say they're not doing anything for the U.S. in China. My new iPhone 17 Pro Max, obviously I live in the United States, it was built in China. So they're still doing some, but that's really for the first wave of the new devices. Over the next few months or so, you'll see a lot of that 17 production for the U.S. shift back to India.
As you said, though, the onus on Tim Cook and Apple to say to Beijing, listen, China, we're not backing down. But are they backing down? Mark, as you look at it, it kind of feels like they're backing down a little bit.
I think there's a bit of a yo-yo effect here. I don't think anything is set in stone. Apple is moving as the wind blows. And right now the wind is blowing in the sense that they need to get manufacturing for the U.S. because of tariffs outside of China. There will be another administration at some point. There will be tariff changes during this administration. And so they're going to shift as necessary. They've built the supply chain to be fairly agile, where they can move layers of production in between countries. They have all the facilities there, and they can crank up that percentage of what needs to be done in Vietnam, crank down the percentage of what needs to be done in China, and just go as the wind blows. As you know, really 2026 is going to be the year of the tariff impact, because so far it's been negligible for Apple. The hit has been just like a few $1 billion, which is essentially nothing compared to the amount of revenue they bring in. They are getting some reprieves from Trump. Obviously, they did the dog and pony show around the glass shift from China to the U.S., but certainly there's going to be more movement to come as well. And so they'll shift as necessary. And I think the word of the day should be agile, because they're moving as they need to.
Mark, let me ask you lastly here, 2026, the year of the tariffs, the year of all of these devices as well, underpinned by this new Siri, and we've seen some delays on that and some difficulty getting that ready for prime time. In your piece, you kind of lay out what the ideal timeline is for Apple going forward here. I wonder, as you think about this and as you talk to your sources, is there a sense that they're going to be able to stick to it, or are those delays going to be kind of prologue for what's to come here in 2026?
No, I think this is it. I mean, these new home devices, particularly the first one, the Home Hub that I mentioned, that was supposed to come out last March or March earlier this year. Now it's going to come out in March, April of 2026. I would say it's going to be disastrous if they miss that March target. I don't anticipate them missing it. I think they're getting it out the door one way or another.
All right, we got to run. Hey, Mark, thank you so much. Mark Gurman, of course, managing editor for Global Consumer Technology out there on the West Coast. All right, you are listening and watching Bloomberg Business Week Daily. Carol Master, David Gore. Just want to rehash a headline that crossed just moments ago. A U.S. judge has ordered the Trump administration to pause plans to fire thousands of federal workers during the government shutdown while labor unions challenge the move. And this is a big part, David.
A huge part. And as we've said, this is the third week of this government shutdown. There's no clear off-ramp to it. A lot of folks are speculating this could last until November. So this is something of immediate importance, of course, to a lot of those workers who've been furloughed and laid off. And I should note, the President of the United States is signing some directives right now. He's signed a federal hiring freeze, which isn't to be unexpected, I think, during a government shutdown. And we're waiting for him to hold a press conference in the Oval Office with Kash Patel, the director of the Federal Bureau of Investigation. And we'll see, of course, monitor what both of them have to say. But certainly that would be a moment during which he could expound a little bit more, both on sort of his sense of how this shutdown is going, if he thinks that it's something that's advantageous to him and his Republican Party, if there's been any progress between the Republicans and Democrats. So far, all the reporting that we've seen indicates that both sides here, Carol, not talking to one another, again, 15 days in.
Yeah, no communication, it feels like, at this point. We should point out layoff notices did go out to more than 4,100 federal employees, but the order isn't a final decision on the merits of the case. So to be continued, as many things are. Hey, folks, you are listening and watching Bloomberg Business Week Daily. Carol Master, David Gore, and when we come back, we're going to take a look at some stocks on the move. This is Bloomberg.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
Good afternoon, everybody. David Gura here in for Tim Stenovec with Carol Masters. We got a lot of news, a lot of headlines out of Washington on this Wednesday afternoon. A federal judge just ordering the Trump administration to pause plans to fire thousands of federal workers during the government shutdown, a shutdown that is now in its 15th day, Carol, really stretching on here. And a lot of folks there in Washington, in the federal government more broadly, I should say, outside of Washington too, really dealing with a lot of uncertainty, who are furloughed, who have been laid off. This now going before the courts, this pause in place. And we're going to talk about it more with Laura Davison, who's our Washington Deputy Bureau Chief. She joins us now. Laura, I mentioned that uncertainty. I can't put too fine a point on that. Where do things stand now that we have this judge's ruling, not a final decision on the merits of the case? What does it mean for those workers who are very worried about their position here in the government going forward?
So it means that federal agencies right now have to stop and halt all the plans for the firings that that took place last week. So that means that those people will be able to keep their jobs for now, and that any future rounds of firings, as the White House suggested yesterday, is coming, will also be halted. This is just a temporary block, as you mentioned. They are just paused, and there will be a decision to come later on the merits of the case about whether these can proceed. It was quite a dramatic moment this afternoon because just before this ruling came out, Russell Vought, speaking on the Charlie Kirk podcast, said that he expects that layoffs would exceed 10,000 people. Right now, we've seen about 4,000 or so that have received layoff notices. So this is very much a clash of where the White House sees things going as where the judge came in and said, hey, look, you got to hold your horses here.
Laura, what's the status of conversations among lawmakers on Capitol Hill, among lawmakers and the White House, the Trump administration, just about sort of where we are in this shutdown and where it's going from here? I know there's a lot of concern